Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Okay, here we go. Thursday session almost upon us. Let's talk about where we were yesterday. European equities faded a little bit into the close. We actually broadly rallied into the close at the end of the session. What I think is interesting here is the US session. Tech was down, except for Tesla, which had a pretty good day yesterday. Tech was generally down. Names like Nvidia were soft yesterday. The big hyperscalers were all in the mix yesterday. So a little bit of a pause maybe on that breathless rally we've seen in tech stocks. Over the last couple of days, we're down on the S&P circa 0.8%. So a little bit of a pause yesterday. What does that tell us in terms of the pickup this morning? Lizzie, what are we seeing?
Yeah, the first back-to-back losses of more than 1% in 5 months for the S&P yesterday. So that negativity looks like it's going to continue in today's European session. We're read across the screen here. Particular underperformance expected for the FTSE 100. We had
Nephew, those kind of businesses. UBS also in focus. They have a policy, just like lots of banks, for how they would be resolved in an emergency. And must try harder seems to be the verdict so far from FINMA, but both sides seem to still be talking to each other. And H&M storming past estimates when it comes to third quarter margins and profits, Guy.
Absolutely. What is interesting is the top line was actually fairly static. They're doing well on the margin front over at H&M. Okay, here we go. Let's talk about this market Thursday morning. How are we opening? We're expecting a slightly softer open this morning, feeding off maybe what we saw stateside yesterday. So the FTSE 100 is a little softer, but as Anna's already indicated, keep an eye on what is happening with the mining stocks in that market this morning. So that's going to be something you want to roll in to that broader narrative. The IBEX is a little softer this morning. The stock 600, we don't yet have a fully sort of formed picture there. CAC 40, it's going to be interesting to see what some of the car stocks do this morning. I think that's going to be a feature of the German landscape as well. We've seen the data coming out of that. We'll keep an eye on the SMI. What does UBS do on the back of what we've heard from FINMA this morning? There's some interesting kind of idiosyncratic stock stories over sort of in this market, but the overall picture is one of what is being driven by this kind of tech narrative, this big story that is emanating out of the United States. Is Europe kind of missing out on that? Sort of feels like it at the margin. Does it persist into the rest of the year? That could be the defining factor. Lizzie, the stock sector story looks like what?
Well, we've got 3/4 of sectors in negative territory this morning. At the top of the basket, though, is basic resources. So we had the copper gains to about a year high, and this off the back of Freeport, as we say, having this mining incident in Indonesia. And you had the likes of Anto and Glencore moving off this yesterday. Today, Anto down 2.2%, Glencore up 1.3%, interestingly. Now, we're waiting for H&M to open, but we have got already moves for HSBC, down 1.1%. Anna, you would flag the medical device makers. This, as you say, off the news that the US is looking to maybe put tariffs on robotics and medical devices. We've got Smith & Nephew down 0.8%, but look at Philips here. They're down more than 3%. Convatec Group down 2.8%. Not a huge move for Oxford Nanopore, just down 0.3%, but definitely negative across the sector off the back of that tariff news.
Yeah, which strikes me as interesting. Philips maker of more of the machinery end of medical devices, and our story talks about syringes and sutures and things like that. But anyway, we watch with interest as these individual names respond to this Section 232 investigation now launched over in the US. I'll keep an eye on some of the automation, robotics businesses, machinery businesses on the MDAX, and they don't seem to be responding all that much to the downside. So we'll keep an eye on some of the nuance behind this story, perhaps.
Car stocks are coming back a little bit. Porsche's up, Stellantis is up. In terms of where the percentage change is coming through, it's not necessarily being reflected when it comes to the weight. Rio is the biggest weight sort of points gainer in the SOX 600 this morning, followed by SAP, followed by Anheuser-Busch, which is interestingly trading very strongly. Names like Anheuser and British American Tobacco are both trading quite strongly today, which would imply some sort of a defensive kind of theme. But cars and resources stocks. So Rio, Shell, Glencore, all trading higher. Then you've got the kind of the big car names are all bouncing back. Is it on the back of the data? You've also got H&M just coming through. We're seeing a big move there. H&M is up very strongly. Yeah, look at that. So a very strong, margin number, really delivering a bottom line performance for H&M, because the revenue line is actually reasonably static.
And the very in the moment guidance looking at least not terrible. So saying that this September, this month that we're in right now, looks very much like last year. Yeah,
and of course we already had a positive signal from Inditex, the Zara owner, which typically outperforms H&M, but it looks more positive for retail from these results. And
it's interesting because that's it. So it's interesting that's not the message you hear in the UK right now.
No.
Which is quite dismal when it comes to the data coming off the high street. But clearly there's quite a sort of big global picture that is different. I wonder whether Europe is as strong as the United States, whether the United States continues to be strong. What is happening? Because the consumer in the States is kind of what everybody's watching right now. Is there a signal in H&M as to what that consumer is doing at the moment?
I think we're going to dive into those results from H&M a bit later in the programme. But as we say, currently up more than 11%. Just finally, we've had a load of banking news this morning. And if you check in on HSBC, despite all this development when it comes to quantum computing, the stock down in London 1.3%. We had FINMA saying that this emergency plan of UBS's can't be executed. As you would expect, UBS shares down 1.2%. Let's get some analysis now, shall we? We have AJ Rajadakshi. Excuse me.
Not bad.
Yeah. We'll ask him
how would you rate that?
That was very good.
Oh, you're kind, AJ.
No, it really was.
Thank you so much. I'm so sorry for that. But we have AJ around the table with us, Global Chairman of Research at Barclays, and it's always a pleasure to have you on the opening trade, so thank you for making the time.
Sure thing.
Your investment outlook came out this morning, and I had a flick through it. You're positive going into Q4. We've been discussing whether this is a new normal, whether it's a bubble. Why are you convinced that this stock rally isn't a bubble?
Right. So in maybe 2 or 3 sentences, not to belabor the point, there's 3 big differences between 2000 and now. The first is that the tech sector now makes an enormous amount of money. Remember, the telecom sector in 2000, right, the sector that took on the debt that ultimately ended up going badly, operated in a low margin, low utility environment. I'm sorry, but 73% margins on NVIDIA are not low margin. That's one of the single biggest differences. The other is, we keep talking about valuations. The big 6, 3 years ago, traded at a 39 to 40 multiple. Since then, Microsoft is up about $2 trillion in market cap. NVIDIA has almost doubled in market cap, but they now trade at a 28, 29 valuation. And what has changed is earnings have overpowered everything else. These companies make an enormous amount of money. And even though we classify them all as tech, they don't actually all do the same thing. NVIDIA sells to the others, but the others are in retail, they are in e-commerce, they are in cloud computing. It's a little unfair to almost lump them all as one. They don't rise and fall as one.
Okay, so for you it's AI the driver, but then for many others it's also the Fed cutting rates. So keeping all of that in mind, if the Fed doesn't cut rates as much as promised, can AI and earnings keep the rally going?
Absolutely. I mean, the Fed didn't cut rates for a year, and the rally kept going. Not only did the rally keep going, it kept going despite the single biggest global reordering of trade that we've seen in 70 years. Remember all the doom and gloom in April? We are up 35% since then. And most of that rally didn't happen with the expectation, oh, look, the Fed is coming to our rescue.
Okay, so it wasn't all about the Fed expectation then, yes. So it was about AI can do magical things, it would seem. Now you're not as worried about the fiscal space that the US finds itself in as some others. AJ, tell us why that is, because this is going to get a lot of focus, shutdowns in focus.
Because believe it or not, the United States did enact a tax hike. The United Kingdom has struggled to do it or to cut spending. The France has struggled. The Japanese have struggled. These are all economies with poor fiscal profiles, including the US, I'll grant you that. They are all economies, with the exception of France, where inflation is not yet at target, and they are all economies, with the exception of the United States, where there doesn't seem to be enough political will to do fiscal consolidation. Tariff revenues matter.
And I mean, Trump talks about tax cuts. So which tax hike are you talking about? The ones on international businesses selling into the US?
Just to break down the numbers, right? The United States imports $3.1 trillion in goods, okay? Assume tariffs went up on that by 15 points. That means someone somewhere is paying $500 billion. Most of that $500 billion eventually will end up getting passed on to the end user, regardless of what the president says. But that is a tax hike, and the US consumer has taken it on the chin and just not blinked. Our fiscal profile, coming into the year, if you had told me just the Trump tax cuts would have been extended, I would have told you we were looking at a 7 to 7.5% deficit for the foreseeable future.
But lots of people tell us that these tariffs are not being passed on to the US consumer, either at all or yet.
So we do have customs data, right? It shows that tariff revenues right now are running at $300 billion, and the effective tariff rate is 11%. The US government, regardless of who's paying it, is getting in $300 billion a year. And as those tariffs rise to 15, 16, that will go to 400, 450. That's $4 trillion over a decade. Even for a $30 trillion economy, that's real money.
So everything just carries on. We're good.
This is going to come back to blow up spectacularly in my face, but yes, I think so. Yeah.
For how long?
If I worry about something, it is that fiscal profiles outside the United States cause a global bond unraveling. It's not my base case, don't get me wrong.
Yeah.
But I do worry about the
You're talking about the UK here, aren't you?
I'm talking about France as much as the United Kingdom. So, and this is perhaps not the most politically correct thing to say, but 8 weeks ago, there was a lot of headlines in the UK about the Chancellor having an emotional moment. For me, the more significant thing was that the Labour government could not pass through the cuts to the welfare bill. And now she presumably has to find more fiscal, tailwind somewhere because the numbers have weakened. But France is similar. They are on their 5th prime minister in 2 years. They cannot pass a budget.
Why does this, do you think this has a meaningful effect into the States? As you say, that the US in some ways is raising taxes. In theory, you'd think that would slow the economy down a little bit, but to your point, doesn't seem to be at this point in time. Why do I need, if I'm a US investor, why do I care about what these crazy Europeans are doing?
Because at the margin, global bond markets are correlated, and eventually if you get an unraveling in the 30 and 40-year points in the United States, in the United Kingdom and France, it's not clear that the Japanese are isolated, and Japan matters because the Japanese...
Where does this affect the US? Because the Fed's going to cut rates aggressively, right? Front end's going to come down. There's this whole talk of kind of doing QE, and that's going to keep the back end under control as well. Where does this... what is the vector?
If the Fed does QE, I will come back to this studio and eat this table.
Okay.
There is not a chance that is going to happen.
You realise this is on tape, AJ?
Yes.
Right. Bruce Richards was here from Marathon going, they're going to do it. It's going to happen.
I mean, between the two of them, between the two of us, he has by far the better track record. I get that. But that doesn't translate into every single call. The Fed is not doing QE for the foreseeable future. It would be insanity. I mean, we are talking about an equity market that is already at an all-time high. The unemployment rate is at 4.3%. Inflation is not at 2%. What are you doing? I mean,
for the first time in this conversation, I think you're lost for words.
I completely am. The Fed is not doing QE, just to connect it back to the U.S., the Japanese own $1.25 trillion of U.S. treasuries. and they don't have US liabilities. If they start to sell US treasuries because they want to support their bond market, that is the way that it passes on. I don't think it happens, but if there's something I worry, that's what I worry about.
Can I ask you how worried you are about central bank independence, not in the US, but here in Europe? We've got a meeting coming up between Nigel Farage, the Reform UK leader, and the Bank of England Governor Andrew Bailey. And the Times of London is reporting that actually he's going to urge him to cut rates. Surprise, surprise, it's the Trump playbook. When you've got the rise of right-wing politics here in Europe as well, do you think it's going to be imported, the risk to independence of central banks?
So I'll say two things. One is that US bond markets, believe it or not, are not worried about central bank independence in the United States. The day that Governor Cook was let go, right,
she's fighting to stay.
She's fighting.
Yep.
She's won 2 rounds of cases so far.
Yep.
But that day, you would have expected inflation break-evens to widen. They did not. They actually came down. Okay, it seems the bond market in the United States seems very confident that the institutions will hold. The United Kingdom, the central bank has always been a little more beholden to Treasury than in the US, the way things are set up. But yes, if you go down this path, I would worry a little bit, because inflation in the UK is not at target. It is an island. It imports a bunch of things. Currency weakness passes through to inflation very quickly. So if you go too far down this path, it starts to become a problem.
But is the reason that break-evens are steady because they think that the next Fed chair is going to be orthodox, or is it just that the market doesn't have any idea how to price all of this?
I think it's because the market believes that the institutions in the United States will hold, that the bond market is the final arbiter. And 3 times in 2025, the president has threatened to get rid of the Fed chair. And each time when the bond market, started to get upset about it, he backed off. So I think that is what markets are banking on.
You've woken everybody up with the finger snap. I love it. We love to have you. Hopefully you'll never have to eat a table on this show, but we will hold you to it. AJ Rajadiaksha. On the show for us, Global Chairman of Research at Barclays. Thank you so much for joining us. Let's go to the Core 6 guy.
Let's talk about what's happening in the markets this morning, get a quick snapshot of what is going on. Let's talk a little bit about the main movers. As you can see, there's an awful lot of red out there this morning. Defence stocks are definitely giving back some ground. The AI trade is giving back a little bit of ground. ASML, Schneider are both soft this morning. You've also got weakness in the pharmaceuticals sector. There is strength out there. It's just not on this board. It is in the auto sector, surprisingly. It's in the mining sector, rather surprisingly. Let's get some details on what is happening therefore there. Chloe Melly's got all of that.
Good morning, guys. Let's start with some mining movements this morning. Rio Tinto and Glencore are both up this morning. The U.S. company Freeport announced that it was suspending a mine in Indonesia following an accident, and that will therefore reduce near-term copper output and therefore push up those copper prices, and that is benefiting those 2 names this morning. We've got Rio Tinto up almost 2%, a little bit more of a modest move in Glencore, but a little bit of a movement there this morning. Moving on to car makers, and the car making sector is doing quite well. It's quite rare to see such positive movements in that industry in Europe. But there's 2 things. So there's the European car sales that have risen for the 2nd month in a row in August. And then there's also the fact that the lower US tariffs on auto imports of 15% are now in place. They have now taken effect. And that is really moving the shares higher for those companies this morning. We've got Volkswagen, Stellantis, Renault and BMW. We've got green across the screen there. Moving on to another sector, but that is not so lucky with tariffs. We've got some downward movements across this robotics, medical devices and industrial machinery sector, because Trump is setting the stage for potential tariffs on those sectors. So we can see Philips, for example, their medical device maker, down almost 4%, and also down movements in Siemens Healthineers and Convatec, as well as Smith & Nephew. So a little bit of a red there. And finally, let's end on H&M. H&M is up 8.3% this morning. Its quarterly margins and profit were way ahead of expectations, and that is thanks to really good cost control and also a refocus on its core H&M brand. And it's being rewarded by the market quite a lot this morning.
It is. Chloe, thank you very much. Chloe Melly from our equities team. With that look at plenty of stocks on the move, in fact. And Chloe ended there with H&M. We'll pick up that theme shortly. We'll take a closer look at those H&M numbers, the outlook for the business, the 3rd quarter profit beat, what it's doing on cost control seems to be important. News from Milan Fashion Week also may get a mention. We'll be back with more on that. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities. It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Welcome back. This is the opening trade. We are 19 minutes into a session that looks pretty negative, actually, for European stocks, down around 0.5% on the Stoxx 600. And most sectors in negative territory, including construction and materials. That's the worst performing sector this morning. So we'll continue to watch that as basic resources and autos have a day in the green. Now, Bloomberg understands that Intel has approached Apple about securing an investment and discussed how to work more closely together. For more on this, let's bring in Bloomberg tech anchor Tom McKenzie, who's with us. So why is Intel approaching Apple then, Tom? Because they used to have a very close relationship. Intel made their chips.
Yep.
That's not the case anymore. And Intel's just making friends with everybody right now.
I mean, what a turnaround in the last few months for Lip-Bu Tan, the still relatively new CEO of Intel. Given that investment, about a 10% stake from the federal government, about $5 billion from NVIDIA, about $2 billion from SoftBank, and now looking to court Apple, who, as you said, used to, of course, use Intel chips. No longer. They're now produced by TSMC for Apple. They have their own in-house designs. So they're looking potentially, we know that they are reporting, has suggested, told us that they are in conversation. Whether that leads to an investment by Apple, clearly to follow on the lines of NVIDIA, is something that we're looking at. Liquidity is less of a challenge now for Intel. The bigger challenge is actually securing significant customers for its foundry business that Lip-Bu Tan is still committed to, but is much more cautious on. That would really be catalytic if Apple turned around and said, you know what, we might consider you as a producer.
You do wonder how these dinners go. You're at the White House, you're sitting there, you've got all of these guys around a table. Trump's just made a big investment in Intel. NVIDIA's just made a big... who's next? Like, somebody put up their hands? Is it kind of just go around the table? Who's going? I'm joking, of course, but there's a certain sort of feeling about that.
It's hard to see how politics is not part of the calculation. SoftBank, $2 billion, NVIDIA, $5 billion. Apple have committed $600 billion domestically in the US. This could be part of that $600 billion they've committed.
We should probably have talked about Oracle. That went well, yeah?
Oracle went very well. So they raised a little over $18 billion. Demand at one point peaked at $88 billion in terms of this debt sale. Across 5 times. Yields, of course, given that demand, yields were lower, about 1.37% above the equivalent. That's on the 40-year, because they went all the way up to 40-year. It's worth noting that Oracle went cash flow negative this year for the first time since 1992. Analysts don't see them going cash flow positive until 2027. as they spend on these data centers to fulfill those commitments to the likes of OpenAI and Meta.
And then we've got to talk about HSBC, because they've had a Sputnik moment when it comes to quantum, they say.
Yes.
And yet the stock was down when I last looked, 1.5% down this morning.
Yes, so this is using quantum computers, which are large and expensive and quite volatile and have been in this research phase. But it's the first time they say that they've been able to use real data, not live data, but real trading data at scale with a quantum computer, and specifically in this case, to calculate how a bond will trade at a particular price. And the quantum computer was able to do that at 34% better than their legacy computers and their algo teams. Now, 34%, of course, in the world of investment banking, when you're looking for every margin, is significant, and that's why they've said this could be a potential Sputnik moment. We know JP Morgan, Citi, and others are investing in quantum computing, and I think it raises a question as to when quantum computing becomes a real competitor for the cash flows that are currently flowing into AI, if this progresses.
You think all the models that have changed the world, kind of Black Scholes, and how it's all changed the sort of pricing of options, and this could be amazing in terms of the arbitrage factor within markets. Tom, great stuff. Thank you very much indeed. So it falls to me to talk about fashion, which is a surprising thing, but I'm going to do it anyway. H&M shares are having a pretty good day this morning. The top line's actually reasonably static. This is H&M executing really strongly. So let's bring in Andrea Felster to talk about all of this. That's what it looks like, because the top line actually looks kind of okay and pretty comparable, but it's the margin number that seems to have really ticked higher here.
That's right, although I wouldn't be surprised if they've got some help from the external environment, because we had very good... We had very good weather over the summer. You know, the sun shone at all the right moments for buying fashion.
Yeah.
So they probably won't have had to discount as much because you've sold things at the right time.
Yep.
I think the competitive environment could also be going in their favour. You've got Inditex Zara, which is really stretching upwards. You know, it's really trying to take the white space that's been left by the luxury brands.
Oh, yeah, I've seen jackets for like 300, 400.
Exactly.
Exactly.
Lizzie's pulling her face.
Exactly.
Yes.
Exactly.
That's unprecedented.
Yeah, so that leaves a lot of white space for someone like H&M. You've also got Primark. Primark don't have a permanent CEO. They lost their CEO, who was very good on product.
Yep.
And then in the US, you've got the crackdown on the de minimis rule, which is going to hurt Shein. And Temu. So you've got all these things, and you've got COS, which is having a bit of a fashion moment. It was in the list.
A good one or a bad one?
A good one.
Right, okay.
It was in the list index of the most, in-demand brands. It was the only kind of high street brand that was there. You've also got this fashion change that I wrote about the other day, from sort of leggings, skinny silhouettes, to an oversized silhouette, which COS is very...
Have an oversized silhouette?
See, when I think of the cheaper end of the fashion market, I do sometimes think of leggings, but you say they're entirely out, and
they're
I
not
need to
entirely
catch
out.
up.
No, the death has been exaggerated, but they are definitely on the way out, and that's I think that's particularly helpful for COS. But so I think all these factors, H&M, as you say, has been executing well, but I think they have been getting help. Yeah.
Can we just leave fast fashion to the side for one moment and talk about the fact that it's Fashion Month, Andrea? We've got you on the show. How's it going?
Well, it's been very interesting so far. We had Burberry on Monday, which
the Fab Ladies were there in force.
Ladies. I was very surprised at what they sent down the catwalk. I know the catwalk is very divorced from what you find in stores, but they've been really majoring on outerwear on the check. There wasn't much of it in evidence. The big one has been Gucci. Gucci is under a new creative director with Demna Gvasalia, who I have to say I'm very sceptical about at Gucci, but he delivered. He did this bonkers film, which carried like a viewer discretion urge warning on it. It was crazy. But it's created a lot of buzz. It's very different. We've got some big catwalk debuts coming this week. We've got Dior, we've got Chanel. So it got in there first with something that was very different, something that was very shareable online. And we got a few hints of where he might go. He went back to the Tom Ford era. He went back to the Alessandro Michele, very successful era.
Guys lost. All you need to know, watch out for Jonathan Anderson at Dior. I cannot wait. Andrea Felstead, I'm so glad we got to talk about this. Andrea Felstead from Bloomberg Opinion coming up on the programme. We're going to head back to EPEM in Paris and look at the role of private markets in Europe's AI infrastructure. That's next. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
This is the opening trade. We're 30 minutes into today's session, and it's red across the screen for European equities at the moment. We'll bring you the SMB decision in just a couple of seconds, but look at all of this. We've got retail, autos outperforming in the sectoral basket, but you wouldn't really know it looking at the DAX this morning or the CAC. Everything down by about 0.3%. Guy, what's under the hood?
So we are up on volume on a down day, which is significant. Pay attention to that, because earlier this week you saw an update in the States on low volume, which again is an indicator, but that's not what we're seeing here in Europe today. 175 up, 407 down. The balance is definitely to the downside today, and there's some heavyweights on the downside as well. In terms of that Swiss story that Lizzie just referenced, let me give you another angle on what we're seeing here, and that is some of the 52-week lows. Alcon, Sika, Kuehne+Nagel. I just had to do a quick translation there. We should probably fix that. Down by 1.22%. But Sika is in the chemical space. It's down by 1.1%. Alcon in the eyewear space down by 1.2%. Alcon keeps falling. It's on that list quite often. But it's interesting you've got 3 Swiss stocks that are under pressure. Anna, what are we watching?
Yeah, let's get an update on some of the other stories we're following this morning. European car sales rose in August, with new car registrations rising by 4.7%. That's as consumer appetite for electric and hybrid models drives up demand. But sales in the UK and Italy dwindled, and it's not good news for Tesla, seeing sales drop by 22%. Meanwhile, BYD continues to outshine, more than tripling its deliveries. HSBC says it's achieved a world-first breakthrough in deploying quantum computing in financial markets. The London-based bank used IBM's quantum processor to attain a 34% improvement in predicting bond trade prices. The lender has described this as a, quote, Sputnik moment, with banking rivals expected to follow suit. And Oracle sold $18 billion of U.S. investment-grade bonds on Wednesday, the market's second-largest deal this year. Bloomberg has learned that demand for the bond sale peaked at nearly $88 billion. The borrowing frenzy brings to light the current funding gap of AI investment pledges, a question we ask often on this program, Guy. But right now, we're asking what the SNB is up to.
Nothing. Absolutely nothing. Nothing to see here. Let's move on. I joke. Let's just delve into the details of what we're learning here. The SNB has left rates unchanged at 0. The estimate was for 0. This is exciting stuff so far, I appreciate. But when you dig into the details, actually, they see inflation ticking slightly higher. They see the inflation forecast, though, within the range of price stability. Inflation is likely to be, quote, slightly higher in the short term. Inflationary pressure, basically, though, unchanged versus the prior quarter. 26 GDP growth, likely around 1%, 25, 1 to 1.5. So maybe actually, in some ways, a slight slowing predicted there. But inflation looks like it is going to remain within the range that the SNB is broadly comfortable with. I define that quite loosely. It looks like, and this is actually the most exciting line I can see out of all of this, the Swiss economic outlook has deteriorated due to US tariffs. So those high tariffs that we talked about a few weeks ago are starting to have an effect. Unemployment, therefore, is likely to continue rising. We heard that a little bit earlier on from Jay Safra-Saracen, the view coming from there. There is going to be an effect, but the S&B, no effect.
Yeah, 39% the tariffs on Swiss product in many areas going to the United States. Now, let's get back to the EPAM conference, which is underway in Paris. Kriti Gupta is there for us. A lot of focus on funding, private markets funding infrastructure, private markets funding AI. Where does the conversation go next, Kriti?
Well, Anna, you used all the magic words there because those are the buzzwords at this conference, specifically AI. And this is a conversation that we have in the public markets all the time. The private markets still catching up on how you really use and look at those valuations, and especially how you apply what you're seeing in the States right here in Europe. We've got the perfect guest for that. I'm pleased to say I'm joined by Brookfield's head of Europe, Sikander Rashid, joining us, overseeing about $210 billion for this region. He's here with me in Paris. Lovely to have you. Thank you for joining us here in Paris. I feel like you are the AI guy, and so we're going to get to that in a moment, but you're also wear the hat of head of Europe. So let's start there. We're sitting here in Paris. We're talking about Europe having this moment of attracting capital from around the world. Why, and does it stay?
Yeah, look, Kriti, I would say the U.S. market is very robust at the moment, and the European market is constructive. And the reason I say that is the U.S. consumer is strong. The U.S. GDP is 2 times higher than that of Europe. U.S. has got a business-friendly administration, and all of that bodes really well for M&A activity. And we've seen $1 trillion of M&A deals get done in the U.S. in this year alone. Europe, on the other hand, the story is slightly different. One, the consumer is relatively weak. GDP growth is hovering around 1%. Despite that, we're seeing deal activity. So we've sold our port assets in the UK in a $2 billion transaction. Brookfield also sold right here in Paris $4 billion of stabilized data center assets. And looking ahead, we remain bullish on Europe because interest rates are lower. GDP is now heading finally in the right direction. And Europe as a continent still needs trillions of dollars of capital to upgrade the existing infrastructure and to build new infrastructure for AI, and that is very exciting.
Viewers of our program, The Opening Trade, will know that I often cite the valuations in the public markets, my 2 favorite companies, NVIDIA and Rheinmetall, as they get kind of this AI hype. And it was shocking to me when I used our handy-dandy Bloomberg terminal. I saw that the Rheinmetall valuation is juicier than that of NVIDIA, and NVIDIA is already trading at such multiples. It begs this question of valuations in the public markets. In the private markets, are valuations frothy? Are they juicy? How are you thinking about it?
Yeah, look, I would say at Brookfield, we are, whilst technology firms are building the brain, we are building the body for AI. And what that means is we are building the power plants, we're building the transmission lines, the distribution lines, and the data center assets, or the kit that goes inside of that data center. And I would say the valuations on that front, so long as we are investing in the right locations, we are investing with the right counterparties and signing long-term contracts, I think we're still earning very strong risk-adjusted returns.
All right, let's go into your specialty here. You mentioned AI there. The AI build-out in Europe feels to be that it centers around the energy security question specifically. How true is that? Are we still at the infrastructure build-out stage, or are we at the adoption stage when it comes to AI?
Yeah, look, I would say it's a bit of both. And energy, in fact, is the bottleneck. So people always talk about, is energy the bottleneck? Is capital the bottleneck? Is adoption the bottleneck? I would say today it is energy, and it's not generation. Generation will never be the bottleneck. It's the transmission and the distribution, or the energy grid. But there's 2 solutions to that. Previously, electricity was brought to the computing centers. Now, the computing centers, because of this grid problem, are being taken to the electricity generation sites. So that's the first solution. We'll see more build out here in France because there's enormous amounts of nuclear power here. We'll see higher levels of build out in the Nordics where we have lots of clean power. That's the first solution. The second solution is on-site generation through fuel cells or small modular reactors within the next few years.
So you're talking, and you've said this in previous iterations as well, that France, because of that energy source, is really the leader when it comes to that AI build-out. But what about the other parts of Europe? When we talk about the UK, when we talk about Germany and their fiscal spend promises, how does the AI playbook apply in the rest of Europe?
Yeah, look, I would say, Kriti, Europe for AI is a very exciting place. And the reason for that is Europe is probably 4 to 5 years behind the US. So as a continent for infrastructure build-out, it is an ideal location. Now, having said that, your question is, what is the right market in Europe to invest in AI? I would say it's either markets that have a big infrastructure gap, and I would say those are the UK, Germany, as you mentioned, and France. These are big economies that will require large-scale build-out in the next few years, or it's markets where there's abundant clean power, and I would say that's Nordics today.
All right, I'm going to ask you a left field question. You oversee a lot in Europe and a lot in AI. What keeps you up at night? What are you worried about?
Look, what I'm worried about is we have a big business. We have $210 billion in assets in Europe. On the AI side, we have $155 billion in total assets around the world, and we have an amazing platform today. We've been investing across the entire AI value chain for the last several years, if not decades, particularly on the power side. What keeps me up at night is we have a great business. The future is bright. We're excited about it. We need to continue to work with the best customers and continue to build in the best markets. And as long as we do that, I think it'll be a really good outcome for us.
Well, I'm glad you brought that up because there is a fear, and we see this in the public markets, we see it in the private markets as well, that so much of the momentum that is fueling the interest in Europe right now is driven and incentivized by public spend and fiscal spend getting pumped into the economy. Have you, when the clients you're speaking to and the partnerships that you're making, especially with some of the AI players out of the States like Microsoft, among others, for example, is there a fear, are you hearing in the ether, any concern around the fact that the full fiscal promise won't actually come to fruition?
Yeah, look, we haven't heard that, particularly from our clients. But what I would say, Kriti, is we are in a moment where it's a great opportunity for private investors. And the reason I say that is, I'll go back to my earlier comments. First, Europe needs a lot of capital in the next few years, trillions of dollars of capital to upgrade infrastructure and build new infrastructure at a time when debt to GDP ratios in Europe are at all-time highs. So in France, 2 weeks ago, we hit 114%. In the UK, I believe we're just over 100%. And that backdrop bodes really well for private investors. And what the governments, I believe, will have to continue to focus on is the right frameworks for public-private partnerships where governments and private capital together solve that fiscal issue for the government whilst facilitating funding for the build-out of large-scale infrastructure. And I would also say that our announcement here in France from a few months ago with President Macron to build out $20 billion of AI infrastructure in France is a perfect example. Sovereign governments have realized data security and data sovereignty is critical in the short term. It's a great way, construction projects are a great way to stimulate the local economy. Medium term, AI can solve the productivity issue for Europe. And the governments want it to happen, but their balance sheets are stretched and they want to work with operators like us who can build and fund. And that's a perfect example of what a future triple P arrangement between governments and private investors can look like.
You led me right to my final question. We're sitting here in Paris. You talk about this very bullish investment landscape for AI, but specifically for France as well in the partnership you laid out. There is a concern, though, as the French government deals with some of these fiscal concerns. Does that mean doing some disincentivizing some business-friendly policies, things like a wealth tax, things like fundraising measures that could weigh on international money entering the system, but also domestic money looking to make those big investments? Are you seeing that dampen some of the optimism around France?
not at the moment. Look, we have over $30 billion of assets right here in France. Our businesses continue to perform extremely well. And what you just outlined, this has been the story on and off for the last 10 to 15 years in some of the European economies, but we remain bullish on Europe because, as I said, the economies are heading in the right direction. There is a little bit of a geopolitical tariff overhang, but rates are lower. There's pent-up demand for infrastructure, and I think that bodes really, really well for investment in the next 2 to 5 years.
Lovely to see you. Thank you for
Thanks
your
for
time.
having me.
Of course, always. Sikandar Rashid there, the head of Europe over at Brookfield. Like I said, overseeing about $210 billion in AUM for this region alone. Guy, I might have found one of the few lone bulls on France in the backdrop of some of this geopolitical volatility. But of course, Brookfield, a major large-scale player, and that seems to be the roadmap here at EPAM, the fact that the large-scale players are the ones driving the investments when it comes to Europe.
And you've got some great conversations coming up throughout the rest of the day, focusing on that very subject. Bloomberg's Kriti Gupta joining us from EPAM in Paris. What are we going to focus on next? We'll take you from private equity and AI to the car sales story. Car sales in Europe actually continue to pick up. Electrics, hybrids are selling. We're going to figure out what it tells us about A, the consumer picture, and B, the global story on cars is a fascinating one and worth paying attention to. We'll do all of that next with Ollie Crook. This is Bloomberg.
Estava sitiada.
Nisso eu começo, eu não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being a billion-dollar business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade, 47 minutes into Thursday's session. And European equity markets in the red, off earlier lows. Some of these markets now just down a couple of tenths of a percent. The AEX actually in the green. US futures are flat. To the upside, we've got retail and autos and basic resources. We've talked about all of those sectors a lot this morning, all of those going higher. And in fact, we're kind of 50-50, sectors going up and sectors going down right now. Now, financial services and banks, certainly an area of focus with some news out of Switzerland. The Swiss financial regulator says that UBS has made progress in its plans for crisis situations, including any potential wind down of the bank, but more work is still needed. Bloomberg Intelligence senior European banks analyst Philip Richards joins us now with more. Help us understand more about this FINMA UBS story then, Philip. So which are the areas that the regulator says UBS needs to try harder on? This is around how you'd wind down the business in an emergency.
Yeah, good morning, Anna. Yeah, as you say, it's not anything to do with be concerned on UBS. It's very much the case, if they did get to this point of non-viability, as it's called, then could they be resolved in a manner which makes it very safe for the country overall? They don't need to have taxpayers' money, etc. And the areas they're looking at is what they call legislative or legal changes which are needed. So not in a way directly under UBS's control. This is, it might be how AT1 bonds or anything else are resolved in that situation.
And Philip, just talk us through the significance of all this. Why is it taking UBS so long to please FINMA here? Is it all on UBS to sort it out? Because I know that FINMA talks about legislative changes that might be needed as well.
Yeah, well, it's very interesting. The reason it's so important is because the size of UBS, a very large bank in Switzerland, a very small country. So in the event of something did happen to UBS, the impact on the country would be massive. And that's why this is such a key topic for them. So the whole issue is if they did default, what would happen and could they wind it down in a very calm way? We all know what happened in 2007, 2008 when huge taxpayer support was needed. So that's what's going on. And yes, UBS are going through. They talk about progress since next year, but clearly they're not at that final hurdle yet. And this all comes on the sideline, as we know. The Swiss regulators are asking UBS to have up to 26 billion of extra new capital. So if they went and said everything was fine today, you would say, well, wait a sec, do they really need that extra capital?
It's really interesting and kind of impacting so many other aspects of Swiss life as well. Philip, thank you very much indeed. Philip Richards, Bloomberg Intelligence, senior European banks analyst, on what we've heard from FINMA, the regulator in Switzerland, about what would happen in the case of a crisis at UBS. Let's turn our attention to another sector of the European equity story that we're watching carefully this morning, the car sector. European car sales edged up again in August. New cars registrations rose in the region 4.7% last month from a year earlier. Let's talk more about this and what we're seeing within the data, because this is where it gets really interesting. Our Europe correspondent, Ollie Crook, joins us now. There's a few winners here and there's a few losers. Why are they significant, Ollie?
Yeah, that's right, Guy. I mean, you look under the hood here and you look at the actual brands. I mean, there's so much interesting data to go through here. I'll limit myself to a few things. But if you look at the actual car companies themselves and what they did in the month of August, BYD has got to be, the standout here, up 216% in their August sales from a year ago. SAIC, the other Chinese automaker that is the owner of MG, up 45%. Looking for BMW, who's also one of the big winners here in Europe, up 11%. And Stellantis, we know the troubles that they've been having, really coming in below the trend, up only 2%. And Tesla, you just got to see that number there on the screen. August from a year ago, down 23%, continuing to get hammered here in Europe. When you look at the market share of each of these things, trying to put them into context in terms of actually how much market share each of these brands is holding, Stellantis is there at about 15%. That is a reduction in about 1.3% from a year ago. SAIC, you look at that, the other EV maker out of China, now has overtaken Tesla, which is now at only 1.5% market share within Europe, and BYD, gaining about 80 basis points, so we say, to 1.1%. So again, for a lot of these car makers, we look at the Chinese automakers, they're coming from a fairly low base, but they are gaining market share, and they are gaining it very rapidly.
Yeah, that movement of the Chinese makers, really interesting, isn't it, Ollie? Especially at a time when Chinese authorities are calling on their manufacturers not to take their price war to the United States, not to take over production to the United States as well. So we watch what that means for Europe. So geographically, what are we seeing then? What kinds of cars are selling?
Yeah, so listen, we'll do the geography, but we'll also do the kinds of cars that are selling, because this is where things get very interesting in terms of the engine types, right? When you look at the month of August, petrol sales, or I should say gas sales of cars, was actually down 16%, despite the fact that the headline was up 15%. Diesel down almost 20%. But again, look at the hybrids, look at the battery electric vehicles. Hybrids up 14%, battery electric vehicles up 30%. We should say that last year in August, there was a massive drop in EV sales because a lot of these sort of incentives expired. So there's a bit of a base effect there. But for me, the number that really stood out is the number of hybrids sold year to date in the European Union was almost 2.5 million cars. Compare that to the number of ICE petrol vehicles, that was only 2 million. So this year, more hybrids sold in the EU than petrol cars did, and that is not the case from last year. That is a real reversal that we've seen in 2025. And again, just going to sort of the national level, you know, looking at the EU number overall, sales up about 5%. Germany still pretty strong, the strongest market within Europe, up about 5%. A couple of ones that really stood out was Poland, up 15%, Spain, up 17%, and we've included the UK, despite the fact that they're not in the EU, down 2% in the month of August.
Very generous of you, Ollie. Ollie Verkrook walking us through that European car sales data that we've already had out this morning. We've got lots of other data coming out today as well, particularly from the US. At 1:30 p.m. London time, we've got the second quarter US GDP third print. We've also got at the same time US durable goods orders, and we also have at the same time US initial jobless claims numbers. But what I'm really looking forward to is hearing from the Fed's Stephen Myron speaking to Bloomberg TV. And I know someone else who's excited about that. That's Valerie Teitel. She's with us around the desk. Val, I wonder what you'd be asking Myron. We know his views on the neutral rate. We've also been talking a lot about AI. I wonder how that could come into the macro conversation.
Look, I think the key question to Myron is what he makes of this AI boom, and does that pose an issue for his call to lower interest rates. You know, we heard from Scott Bessent yesterday. He was talking to CNBC. He was asked about this, and he essentially said that, look, maybe AI warrants a different interest rate, but the Fed sets the interest rate for the real people, for the main street, and that warrants cutting interest rates. But there is a real risk that kind of narrative really gets disrupted by what we're seeing in AI, this investment boom, and the fact that we could have AI raise the neutral rate without a boom of job creation. Yeah. And that would be a massive pickle for the Fed to disentangle.
So what do you do with it? Because you're being told by the president that you need to cut rates. Like, apparently you're independent. So how do you battle these forces at the moment? And is Myron the kind of... What do we listen to Myron for? Like, what is the message that we need to take away from him? Is it kind of what is happening in the economy, or is it what is the White House take on this narrative?
Well, look, he has spoken to the media before this week and has mentioned things like immigration being a deflationary force. Yeah. I really want to hear his thoughts on that because he's thinking immigration is going to be a deflationary force because of its effect on housing. Yeah. Now, housing is a massive part of core inflation, so I really want to pick apart his brains on why he sees that's the case, because you talk to other Fed members, you talk to other economists who see perhaps immigration that's drawing down the labor force, that's reducing the population growth in the U.S., maybe causing wage inflation, because if you can't hire a migrant because they've left the U.S., you have to hire someone else, maybe at an expense of doing a different higher paid job. But that is currently something that's being very debated right now, and it means so much for the trajectory of core inflation.
And we watch we listen to what he thinks because he's a member of the FOMC, but does he also have that larger stature? So to Guy's point, does he tell us something about the future thinking at the FOMC and some of the other voices that might be coming? And so I wonder, we still get voices around the desk, some saying it's still a conventional Fed, and others saying, no, this is going to be a really creative quote-unquote Fed doing all kinds of things that we don't expect.
Look, I think that does come down to what happens with Lisa Cook's seat. It's all whether Trump has the majority of the federal governor board in order to somehow mess with the reappointment of the regional Fed members, and that's something we still have yet to have an update on. The Supreme Court is currently
But is he the precursor to the next Fed chair, I guess is the question that everybody's asking.
He could possibly be, right? We know that Bessent is interviewing more candidates this this week. He said 11 to CNBC yesterday. So this is very much where the administration wants to go.
Okay, Valerie, thank you very much. Bloomberg's Valerie Seidel. Well, we know what we're watching for the rest of the day. Certainly that interview, some GDP data out of the United States as well. That is it for the opening trade. European equity markets just on the back foot a little. US futures entirely flat. Lots more ahead. The Pulse is next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
European stocks slip as Wall Street takes a breather from the AI-driven rally. Investors weigh the possibility of a bubble in the sector. Bloomberg learns Intel has approached Apple about an investment in the struggling chip maker after securing funding from NVIDIA and the US government. Plus, the US sets the stage for tariffs on robotics and medical devices while lowering tariffs on EU auto imports to 15%. Let's get to the markets then. A second straight day of losses so far for European stocks. Autos in focus on the changes around the tariff regime from the Trump administration to 15%. That's now locked in. That is providing some relief for the auto sector. In terms of the futures picture stateside, you're looking at very modest gains as the index sold off around 0.3% by the end of the close yesterday. Part of that was down to questioning the next steps for the Fed. Mixed messages from FOMC officials. We'll hear from Stephen Myron later today on Bloomberg TV. The benchmark 10 years currently yielding 4.13 after a bit of selling across treasuries yesterday. There is stability across the treasury market so far today. Euro dollar at 1.17 on the single currency, just marginally weaker. Copper in focus, and that is leading to an uplift for the miners at around the highest price in about a year on supply disruptions out of Indonesia, up 0.6% so far for Dr. Copper. Let's check in on the map and see how things are breaking down, reaching then across Europe. Here in the UK, On the sovereign debt side, some concerns about soft demand for gilt sales so far this week. We have another sale later today, so watch that as well as we lead up, of course, to that deeply consequential budget for Chancellor Rachel Reeves and the Prime Minister. The FTSE 100 here in the UK down 0.1%. The CAC count over in France off by 0.3, and the DAX in Germany also softer by 0.3%. Retail is doing well, and that is thanks to H&M coming through with earnings that beat expectations. Also, autos and basic resources amongst the sectors that are higher today. But on the downside, you do have the likes of medical device makers as well as construction. So the Pulse starts with the analysis, with the interviews right now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. The AI boom has made its way to the credit market after Oracle's jumbo bond sale. That's as the software maker ramps up its spending on the technology. Let's bring in Bloomberg's Valerie Teitel. Val, how well received was this bond sale?
It was pretty decently well received. They issued a total of $18 billion. They had started with a target of 15, so it was upsized over the course of the day yesterday, and it attracted a total of 88 billion in orders, so well oversubscribed. But Tom, it marks the second largest bond issuance for the investment grade credit market in the U.S. this year, second only to Mars's $26 billion deal to finance an acquisition. It was a large issuance for Oracle as they look at their funding gap and how they're going to finance generating the power and the data and the infrastructure needed for these cloud contracts. But it does start to begin questions of if now, where is all this financing going to end up? Flip the board. I want to talk about this recent study from Morgan Stanley talking about where the financing is going to be. They see the funding gap at around $1.5 trillion from now until 2008, and they see a lot of it going into the private credit market, Tom. $800 billion flowing into private credit to finance the AI boom. Another big segment is $300 billion into other private markets such as venture capital and private equity. But this just really underscores that we're now dealing with the reality of how these AI companies are going to be funding themselves on their endeavors. And it's really shaken the equity market this week. S&P 500 futures on the week are softer, but it's looking to be the worst week now in 2 months.
Okay, $800 billion potentially flowing into the credit markets on this AI spend story. Valerie Teitel, thank you very much indeed with the size and scope on that piece that we should be thinking about and how it ties into the equity market moves as well. Now, investment giants KKR and Blackstone are leading a combined $17 billion investment in the natural gas industry. It's part of a major push by private funds into a sector that is helping to quench AI firms' relentless thirst for energy. So from financing to the energy piece on AI, let's bring in opening trade anchor Kriti Gupta, who is on the ground for us in Paris at the EPIM conference with another great guest. Kriti.
Tom, thank you so much. As you said, we are live in Paris at the EPIM conference. I've got the perfect guest for you. We were just talking about KKR's monster deals. They've been very active in Europe in the last couple of years, building on top of an incredible profile. We've got the head of Europe, Philip Freisha, joining me right here in Paris. Pleasure to have you. Thank you so much for your time.
Good morning,
this morning. Good morning. Lots of energy from Philip this morning. Europe is having a moment. Everyone is saying that. You see it in the public markets, primarily, especially from the start of the year, funds coming from around the world, arguably limiting their exposure to the States, Europe being the next big thing. Is that visible in the private markets?
Kriti, it's a great question, and it's so nice to be on. We at KKR have invested more than $20 billion across all of our businesses and $10 billion in private equity this year. That's a record year. We have never invested more. So the facts actually support what you're saying. Europe definitely is having its moment. And the reason Europe is having this moment, despite all the challenging aging society, a pension system that needs reform, low productivity growth, fragmentation, things are happening, things are changing. There's a real resolve forward to make reforms and to bring it to the future.
Some would argue that this is temporary, that this is a blip in the system, a blip in allocation, because ultimately when you look at some of the macro conditions in Europe, you named a couple of the challenges, but also the idea of the regulatory environment being not as friendly as other parts of the world, and namely here in France. We're sitting here in Paris, there's a question of that geopolitical concern, the domestic political concern, and even the concern of a potential wealth tax. Does that chill some of the optimism around Europe and France specifically?
So we at KKR have celebrated our 20th anniversary last week, actually, in Paris. We've been around the block a few times, in Europe 30 years. Political cycles come and go. What matters is really the direction of travel. It's always the direction of travel that matters, not the absolute. And Mario Draghi said it very well in his report. We do need to invest 800 billion euros a year or so. We do need to reform our capital market union, pension reforms, etc. But things are moving there. And what I'm very encouraged by, I've studied in France, I'm German, as you figured out by my accent by now, is that the France and German resolve together to bring it to the EU level and move things forward. That whenever that happens, things are moving forward in the right direction.
How much of that 800 billion euros is coming from the private markets?
Draghi pointed very much out that it cannot be done by the public sector alone. 80% or so, we would argue, of the 750, 800 billion a year will need to come from private capital. Now, we have been already a trusted partner of the industry, of companies, of families, of governments in Europe for a very long time. So the moment to bring this to bear is now, and the muscle has already been well trained. But yes, it's a lot of capital, and reforms need to happen for this to really show its results.
So our Bloomberg colleagues had reported a while back that KKR has been very active in the deal space for obviously 30 years, but more recently picked up quite a few deals in the UK, in France, in Germany as well, which is something you did during the COVID era as well, when valuations had really come down. There's an argument here that valuations aren't actually cheap right now. They're actually quite lofty. Does that chill deal making, or would you still buy in that environment and look to invest in that environment?
So at KKR, we very much believe in linear deployment. Times look frothy. We still deploy, but in limited amounts. Time look very crisis prone and nobody invests. We still deploy, and we try to deploy at the same level. So that is the point here. We just don't know what the macro will bring us. We know what we can control, and that's the micro. The companies that we invest in, how can we make them better? How can we bring them across borders? How can we put new technology in, etc.? And that is absolutely the moment to invest now in Europe, because Europe is so behind. So valuations come and go. We just deploy linearly.
Where on that spectrum are we right now? The deploy a little or deploy a lot?
Well, again, it's linear. We deploy the same amount. We are certainly not in a COVID period where it was clear that in 2020, it was time to deploy. Valuations globally, especially in the US, are high. I would argue in Germany and UK as two examples that you put your finger on, they are relatively low still, given the potential the companies have. But again, valuation is one thing. What's more important is what we actually can do with the companies that we invest in through all the toolkit we have.
There's a big conversation in the United States right now about democratizing private equity, and they're looking to do that through 401ks, through retail investing. Now, those are parts of the financial investor base that are not as developed as Europe. Do you see that kind of seeping through the thinking here?
Well, Kriti, you're putting your finger on one of the most important topics of our time, which is that in an aging society, people need to be having comfort and trust and confidence in their retirement, in their retirement savings. And our pension system needs to wholly reform itself in terms of giving access to investments that actually produce the returns that can allow you to retire with that kind of saving pot. And therefore, our industry opening for that is extremely important. So you're right, democratizing the industry is a meta trend right now. We're at the early innings of it, but it will be a mega trend for the next 10 years for sure.
Well, it's fascinating as well, because part of the conversation around democratizing it, whether it's through pension reform in Europe or whether it's through the retail base in the United States, there is an argument out there that democratizing some of this alleviates the pressure that GPs are facing when it comes to exits. Would you agree?
Not at all. So at KKR, what we do when we offer our investments to the retail vehicles, it is just at the same level. They do exactly what the institutional vehicles do. And therefore, the cycle of investing and divesting, creating liquidity and returns is the same for the retail vehicles as it is for the institutionals. Our job is to find great company, make them better, and then ultimately sell them at great results for investors, regardless of whether that's institutional or retail investors.
Are you worried about exits as well? We've had about 3 years where people are kind of waiting for that moment for the capital markets to open up in full. Where are we on that?
So again, KKR has been around the block a few times. These cycles of, very rapid and dynamic IPO environments are often followed by times of drought. We reopened the IPO market in the UK with Trainline in 2019. We kind of reopened the IPO market at the NYSE with the IPO of Nielsen GfK recently. So IPOs are happening, and we are constructive in the next 18, 24 months that things will normalize back to where they were. Of course, 21 was an aberration, and we're never going to go to those levels.
So if not IPO, then what? This is a conversation around exits right now, that if you can't rely on an equity exit, a public equity exit, are there other ways that are becoming more popular?
Well, Kriti, we are also at a cyclical low of M&A as a percentage of GDP across the world, and that means corporates have also been quite careful. Therefore, assuming that that will normalize as well, we will have our fair share of those strategic exits. In fact, over 15 years or so, more than half of KKR's exits in Europe had always been to strategics. So I'm confident that given what we build, that will also be a very fruitful source for our exits.
All right. Thank you so much for your time. Lots to dig through there. Philipp Freische, the head of Europe over at KKR, walking us through the prospects in Europe, some of the concerns, how it differs from the playbook in the United States. With that, Tom, I'll hand it back to you.
Yes, some great lines from that interview. The retail piece, really fascinating. Opening trade anchor, Kriti Gupta, thank you very much indeed. More from Kriti, of course, in and throughout the show. Meanwhile, we're going to talk to Beata Javorcic, the chief economist at EBRD, about pressures on emerging European countries from the world's two biggest economies. That is next. This is Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Aqua in Sintra, Portugal, and this is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Bersecci. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back. The US has formally cut tariffs on EU cars to 15%, with the lower rate backdated to the 1st of August, when the agreement between Europe and the US was reached. Bloomberg's trade czar, Brendan Murray, is here with the details. So, Brendan, good news, it seems, for the auto industry. They've been screaming and crying out for this, for their certainty as part of this original deal between the EU and the US. Are there still hurdles ahead? How significant is this?
Yeah, exactly. The European automakers were facing something like a 27.5% tariff, so the 15% looks a lot better. So they're relieved. It took about 2 months to work this out from the original deal, but there are still some issues that the European Union needs to resolve. The main one is the 50% tariff on steel and aluminum. That still applies. The two sides are trying to get together at the ASEAN conference this week and to try to work that out. The Europeans want some sort of quota system where tariffs wouldn't be applied up to a certain quantity of steel and aluminum. So that is still a very sticky situation. The Trump administration is really going as far as it can go to protect the steel and aluminum industries. So it's going to be a tough battle for the Europeans to try to work out that part of the trade agreement.
Yeah, so to your point, as one piece of the puzzle is put in place, another piece is loose, and we need to get an idea as to when that's going to be fitted in. And the same now with an update from the Trump administration that they're looking potentially at tariffs on robotics and the makers of healthcare devices. We're seeing a bit of the market impact on that. What are the details around this? Do we know the timing? What's the rationale?
So these are 232 investigations. These are not the reciprocal tariffs authority that the president has used to put these blanket tariffs on most major economies, and they're more legally justifiable in the longer term. The IEEPA tariffs, the reciprocal tariffs, are under a Supreme Court challenge right now. They could be overruled, and so what the Trump administration is trying to do is to use these 232 investigations, as you mentioned, the latest ones on robotics, industrial machinery, medical gear, to try to, as a sort of belt and suspenders approach to their protectionist agenda. And so these reviews can take 270 days. This one started in early September, so we're looking at several months perhaps before the justification could come for those tariffs. But in the meantime, the American manufacturing industry is looking at this and saying, these are the tools that we use to make our goods in the U.S., robotics and the like. So it could cause extra pain for car manufacturers in particular that use a lot of robotic machinery and hospitals with the new tariffs potentially on medical equipment.
Okay, so we'll see if there's domestic pushback to these proposals as it works through, maybe 3 months until these are actually implemented. Brendan Murray, thank you very much indeed with the update on the trade front. 15% for European autos, that is now locked in, but uncertainty around the makers of healthcare equipment and robotics as well. Now, countries in emerging Europe, and this all ties in to the next conversation, and Turkey are facing intense competition from Chinese exports as a consequence of US tariffs, rerouting of those exports. A report from the European Bank for Reconstruction and Development finds that China is increasingly competing with countries like the Czech Republic, Hungary and Poland, all economies that rely heavily, of course, on exporting their manufactured goods. Very pleased to say EBRD Chief Economist Beata Javorczyk joins me now in the studio. Beata, thank you for your time, and we'll get into the diversions of Chinese manufactured goods into the European market and the impacts that's having. But I want to start with the news of the day and your view and your take on the significance of the settlement around 15% for the automakers of Europe when they're shipping into the US. We now have that certainty. How significant is it from your perspective?
Well, the certainty about car tariffs is a big deal. It's excellent news for Slovakia and Hungary, the two countries which in emerging Europe have been the most exposed directly to the US tariffs. This is a big industry in Slovakia, accounting for about 5% of total employment.
Okay, so it's significant for those economies and those industries. And when we think about the competition that's now emerging with China, the competition has always been there, of course, but now it's stepped up a gear as some of these exports are diverted from the US market to European markets, and particularly the emerging European space that you look at. Talk us through what is happening. To what extent? What are the numbers that we're talking about? How have things changed and shifted and adjusted?
So what we draw attention to in our recent report is the growing similarity between export structure of emerging Europe, as well as Germany and France, and that of China. So China produces goods that are more sophisticated than what you would expect given its income per capita. And these goods are very similar to what emerging Europe is exporting. So in the medium term, we are going to feel more and more pressure on these countries. And this is going to be compounded by what you mentioned exactly, this redirecting of Chinese exports from the US market to other markets in the world.
Okay, so it's the fact that the products being produced are quite similar in terms of innovation and nature and pricing, but also the fact that there's going to be a diversionary impact as well. So it's those coupled together is significant. Exactly. How does that change your outlook for the broader economic picture for these nations particularly affected?
Well, this is something that is going to play out in the medium term because emerging Europe is much more exposed to this type of competition than other emerging markets. So in a sense, if you think about emerging Europe, it's squeezed by the US tariffs and by growing competition from China. And of course, the primary force is the slowdown in Germany, which is spilling over to the European periphery.
Specifically, which sectors are most vulnerable right now?
Well, you know, slowdown in Germany means that not only sectors that are part of the global value chain, so the automotive chain, are affected, but also consumer goods, so anything from food to furniture.
What would you offer a policy prescription to governments in those nations when they're thinking, I mean, is tariffs a response to the diverted flow of Chinese goods? Is that something that you would recommend? What is the potential policy prescription for adjusting and mitigating some of these impacts?
You know, we have instruments that allow us to deal with dumping and unfair competitions. But of course, that's only a short-term solution. What you would want to see is more innovation, more diversification, and moving up the value ladder. And that, in a sense, brings us to the Draghi report, which was published a year ago, and signaled the fact that Europe has been left behind the US in terms of competition, but China is catching up strongly.
Where are you seeing evidence that policymakers are taking that seriously and implementing the necessary reforms? Are you seeing any nations and any examples where that is starting to take place?
So we've heard a lot of talk about it for the past year, but now the attention seems to have shifted to defense industry, and a lot of money is being spent on defense, and that's putting pressure on government budgets. So my hope is that a big chunk of defense spending is going to be devoted to R&D. So in other words, rather than purchasing the best defense systems of today, we are going to focus on developing the best defense systems of tomorrow, and that's going to also spill over through innovation to other parts of the economy.
Okay, and when you speak about the spend on defense, we have to think about the fiscal space or lack of fiscal space that some of these governments have. Where is that vulnerability most acute? Which nations have more wriggle room versus others? We know that Germany has the space and they're going to be spending, but in your particular world of emerging European nations, what is the fiscal situation?
Well, the levels of debt in emerging Europe are not very high by international comparisons, but what matters is the trajectory. And we see these countries planning to increase their deficits for the years to come. And one of the effects of that is that cost of debt servicing has become a very significant item in their budget. It's 4% of GDP in Hungary, it's 2% in Poland and Romania. And at the moment, these countries are borrowing at a very good rates, compared to the rates charged by the markets in France. Of French borrowing, but of course, should there be some turbulence in the markets, the cost of debt servicing will go up.
What is your expectation about defence spend beyond Germany in light of what we've seen and a ramp-up of tensions just in the last few weeks with Russian jets, for example, intervening in NATO territory? It is going to put the fire under the feet of policymakers to really act on the defence piece. What is your expectation in terms of how much spend is coming down the pike beyond Germany?
Well, you see a lot of spending that has been discussed prior to the most recent events in Central Europe. So from Poland to Baltic states, countries are increasing spending even beyond their NATO commitments. What's positive is that larger share of that spending is being devoted to investment. So not just the upkeep at the army, but rather building new structures, investing in fixed assets. And that's a good thing because these countries have seen a big drop in their investment rates in general since the time of the global financial crisis.
Okay, we'll see if that investment impulse has a broader impact on the economy, R&D, and the innovation that you are pushing for as well, in light of some of those challenges. Beata Javorczyk, Chief Economist at the EBRD, the European Bank of Reconstruction and Development. Thank you very much indeed. Staying on defence, air traffic in Denmark is resuming again after large professional drones were spotted at 5 regional airports, disrupting flights and sparking a major police operation. It's the second drone attack this week. Copenhagen Airport was shut for 4 hours on Monday night in what the Prime Minister described as a serious attack on critical infrastructure. Mette Frederiksen indicating that Russia may have been behind that incident. Plenty more coming up with a focus on private equity. This is Bloomberg.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum or we will never create the solutions that we need.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Good morning. Welcome to the Pulse. I'm Tom McKenzie in London. These are your top stories. European stocks slip as Wall Street takes a breather from the AI-driven rally. Investors weigh the possibility of a bubble in the sector. Bloomberg learns Intel has approached Apple about an investment in the struggling chip maker after securing funding from NVIDIA and the US government. Plus, The US sets the stage for tariffs on robotics and medical devices, while lowering tariffs on EU auto imports to 15%. Now, let's get back to the world of private equity and private credit. Earlier this month, Bloomberg learned that Carlyle was working on a new fund worth more than $4 billion to help investors unlock money from their private equity investments. It's the latest expansion into the secondary PE market as traditional buyouts face slower growth. Let's get more and return to opening trade anchor Kriti Gupta at the EPEM conference in Paris. Kriti.
Tom, thank you so much. You were there just talking about Carlyle. We've got the perfect guest, hot-footing it over from the States, and joining me here in Paris is Brian Bernasek. He's the co-head of corporate private equity over at Carlyle, live with me right here in Paris. Thank you so much for your time.
Hi, thanks for having me. It's great to see you.
We're thrilled. We are absolutely thrilled. Let's talk about these capital markets here. There seems to be quite a bit of contention. Two key cohorts of people who are saying a recession's right around the corner, these capital markets aren't where they need to be, and then a cohort of people saying, well, actually, IPOs are kind of coming back. We're seeing a little bit more movement than we have in a few years. Where on that spectrum do you lie?
You know, it's a great question. And look, this is a spot where there is volatility. There is definitely complexity in this environment, in this market. But underlying the noise, what we see in our businesses is really good performance on revenue and EBITDA. We see that in the S&P 500 in the earnings numbers. And that's fundamentally very important for any economic structure and for the capital markets, clearly. And the markets are good. You know, the equity markets are up 12 or 13% this year. The debt markets are very strong. We're seeing private credit and the bank syndication lines quite strong. We're seeing spreads at really decade lows and the ability to reprice a lot of our debt for sure across the portfolio. And, you know, the IPO market has awakened and opened a bit across a number of sectors and industries. You know, it's up 15% year over year. You know, the M&A market has slowly and steadily improved as well. It's up 20% year on year. So I'd say it's a bit of a healing in the market and the fundamentals in businesses and in the capital markets.
So what I'm hearing is that some of the geopolitical volatility perhaps isn't weighing on the capital markets that maybe a lot of folks 6 months ago would have said it was. Walk us through kind of the connective tissue there. Is it the fact that perhaps governments on both sides of the Atlantic are becoming a little bit more business friendly? How do you think about that?
Yeah, I think, well, there's definitely, that's been a piece of the volatility and the complexity, clearly. And you think back to the tariffs and Liberation Day, I mentioned the market being up 12 or 13%. It was down 12 or 13, 15% around Liberation Day. So there has been volatility in this, and there's certainly complexity with what's happening geopolitically in Ukraine and Israel, and that does weigh on sentiment and weigh on opportunities to some extent. But you know, the key always as an investor, I believe, and we certainly believe, and I think those who perform well in whatever the asset class, they're always focused on being prepared for whatever complexity may come, having plenty of liquidity in their businesses, having a plan to drive value and change in companies regardless of the economic cycle or what may be happening around them, and having real knowledge and edges and angles in the businesses that they own. And that's certainly been our strategy. I think that's what winners can do in any environment.
Well, so one of the bull cases for both the public and the private markets has been massive fiscal spend. And you've seen that conversation in Europe. You're certainly seeing it in the United States, first under the Biden administration, now under the Trump administration as well. Carlyle is a DC-based firm. Just walk us through kind of your exposure to that world, your exposure to that fiscal spend story.
Sure. So we are headquartered in Washington. I've been with the firm for 25 years, based in Washington, and I'm not alone. A number of my partners and colleagues have similar backgrounds in Washington. We've been really of the town and have lots of networks and connectivity, which is very helpful for assessing what's really happening on the ground and, you know, what the likelihood would be of the tax bill that did get passed, of the DOGE impacts, how far along are we in those paths forward, what will happen with tariffs and will there be in a zone. And it does feel as though a lot of that is behind us from a government perspective, which also gives more optimism to us on the general overall markets. You know, one thing that is interesting with that, though, is you're seeing significant spending on defense in the U.S., highest ever budget levels around $1 trillion. And you're seeing it in Europe, clearly, with the challenge with Ukraine and the dollars to be spent, being spent by all the NATO countries. And that's an investable trend as well, and one we expect that we'll participate in.
Walk us through the valuations on that front. If you look at the public markets, again, my favorite fun fact of the European markets is that Rheinmetall, the German defense giant, is trading at a higher public valuation. We're just looking at pure PE relative to NVIDIA. That says a lot in the public markets about where we are. When you're talking about defense valuations, where are we on that? Do they look frothy to you?
Well, they look heavy in certain areas, but there is a lot of macro trend and support on long-term growth, decades-long growth in that sector for sure. And interestingly, we sold one of our assets to Rheinmetall, so that is an avenue of asset sales for us. We've actually been very active on the DPI front, returning $11 billion in the last 18 months in all angles, in strategics, in the case of Locke, but also in the public market, and also the financial sponsors, sort of a third across all those angles. So we've been able to tap that. I think to your question on where valuation is going to be, there's such a range of opportunities. Small businesses that are founder-owned, that are family-owned and developed and managed over time, that they are looking for partners to help them to grow. And that valuation could be much more attractive on an entry level than it might be to play in the Rheinmetall avenue. So there will be lots of opportunities, both in the U.S. and Europe, and having the connections, the resources, the capabilities, and the track record in the sector, which for us it's been 20 to 25% of where we've invested our funds, I think is a real edge and differentiator.
Well, it's interesting when you're talking about these kind of valuations and where you see it. It kind of, what I'm hearing, correct me if I'm wrong, is that it's almost too good not to invest in. And that is something we've heard in the tech space previously as well. Is that right?
Well, I believe and we believe fundamentally there are going to be great companies that have really good long-term tailwinds, that there are also ones where you can drive with great management teams improvements on revenue, on efficiencies within the business, and that's where we're focused. So they can be long-term macro trends for sure that we want to invest behind, but independently in the business, there really needs to be value drivers and value enhancements as well.
I want to ask you a final question when it comes to exits. We started this conversation talking about the capital markets and how they are starting to warm up. In the absence of capital markets warming up, or in the absence of maybe an IPO, whether there's geopolitical volatility that kind of freezes that environment, what are the exits that are on the table here if you were to face LP pressure?
Sure. Look, every deal that we do, every new investment, we're thinking about what are the multiple exit opportunities we could have in this company downrange. Certainly the public markets is one, but it's an option. Strategics have been really viable for us for many, many years, as has selling to other financial buyers. There's the entree of continuation vehicles that can be a potential small opportunity as well. There are a number of areas to tap, and as I mentioned, we've hit a lot of those in the $11 billion that we've distributed in the last 18 months, really tapping all avenues in really kind of equal measure.
Are you sensing any sort of nervousness from your LPs?
I'm seeing, well, in the market, it's clear that DPI is the factor. DPI is the IR, multiple money, everything rolled into one. DPI is the focus. We're hearing good things from our investors because we've been delivering. We're delivering around 20% of NAV back to our investors, which is industry leading, and we're really proud of that. A lot more to do, but we're really proud of that.
All right. Thank you so much for your time. Always lovely to have you live here in Paris. Tom, I'm going to hand it back to you. That was, of course, Brian Bernasek over at Carlyle, the co-head of corporate private equity, walking us through some of the dynamics in the U.S. that are actually, as we were listening, very similar to what we're hearing in Europe. Some warming up around IPO, some diversification, and certainly that defense theme hitting strong for Carlyle.
Another great conversation. Kriti Gupta on the ground for us, opening trade anchor, of course, in Paris at EPEM. And a little later, Kriti will be speaking exclusively to Anthony Tutrone, Global Head of Alternatives at Neuberger Berman. That's just after 10 a.m. London time. Now, European new car registrations rose in August as consumers continue to warm to electric and hybrid models. The appetite for more affordable EVs has led to a 22% drop in Tesla sales on the continent, while BYD tripled its deliveries. For more, let's talk to our Europe correspondent, Oliver Crook. Ollie, break down the numbers for us. That's quite the divergence, BYD versus Tesla, but there's a lot going on here, and there seems to be, again, a bit more momentum when it comes to European car buyers and their views on hybrids and EVs.
Absolutely. There's a lot going on under the hood, and we should really break it down because there's some really fascinating numbers within this report. And I'll go just kind of the good, the bad, and the ugly within the sector in terms of the brands themselves. And you highlighted it there in the introduction. In terms of EU car sales, BYD in the month of August up 216%. SAIC, the other Chinese automaker owner of MG, up 45%. BMW, another winner, this is one of the winners within Europe, up 11%. Stellantis, below the trend, you know, it was about 5% up overall, but Stellantis up only 2%, and Tesla down 23% in the month of August. We should say there are some interesting things within these numbers because of the base effect of last August when a lot of EV sort of subsidies expired. So last August was really a terrible number. When you look at like for like across these makers, it's very clear, BYD versus Tesla. BYD obviously is coming from a much lower base, but again, I'm not sure that it's just that the Teslas are too expensive. There was another slight political story that you may also have caught that was going on with Tesla. When we look at the types of cars that were also being sold, we look at these sort of engine types, petrol versus diesel versus hybrids. Petrol was down actually in the month of August, 16%. Diesel down 18%. You look at the hybrids, up 14% in the month of August. And again, battery electric vehicles, and again, this is a little bit of the base effect, up 30% in the EU in the month of August. And I'll leave you just with one final figure here. This I found really, really interesting. Year to date, in terms of the kinds of cars that were sold into the European Union, 2.485 million were hybrids. That beats actually the number of gas cars, petrol cars that were sold into the European Union, which is only about 2 million. That was a trend that we did not see last year. That is a new sort of phenomenon within 2025. So some real motion within the automotive space that we're learning from this car sales report this month.
Yeah, and it kind of clashes, doesn't it, with all the reporting and all the announcements around the European car makers kind of walking back some of their more aggressive EV plans.
Absolutely.
So it's intriguing on that front, isn't it? And I love, Ollie, the fact that you nod to the politics. Yeah, Elon Musk, look, he's intervened in politics in Germany and France. Yeah. He's tried to do it here in the UK as well. And he's paid something of a price, and he continues to do that for that. Oliver Crook, thank you very much indeed. Important numbers and a really great breakdown in terms of what we're seeing in auto sales across Europe and particularly when it comes to hybrids and EVs, BYD versus Tesla. Meanwhile, shares in H&M are soaring after the fashion retailer's profit topped expectations. It suggests a focus on its core brand and tight cost controls are helping its turnaround take hold. The ramp-up in advertising over the past year also helped draw shoppers back into stores and online. The stock, as you can see, up 9.5%. Meanwhile, in the banking space, the Swiss financial regulator says UBS needs to do more work on its crisis plans, including in the event of a wind-down. Switzerland's biggest bank was asked by FINMA to revise its emergency planning to take account of its takeover of Credit Suisse in 2023. In a report on bank resolution, FINMA said UBS had workable plans for restructuring and resolution, but needs more room for manoeuvre if there is an acute emergency. UBS says it has an emergency plan that would be available in, quote, an extreme crisis scenario. And to technology, Bloomberg's learned that Intel has approached Apple has approached Apple about a potential investment in the struggling chip maker. They're all kind of talking to each other at the moment. As part of its comeback push after the US government took a stake, sources say the companies have also discussed closer cooperation. For more, let's bring in Matt Block, some tech analyst at Bloomberg Intelligence. Talk us through the rationale for this conversation. It's at early stages, we understand that, but the two parties are talking, Intel and Apple, what it could lead to, and what they're hoping to get out of this, potentially.
Yeah, so obviously these two companies have history. Apple used to source its PC processors from Intel up until about the 2020s and then went in-house. I think it's very unlikely that Apple's looking to start buying chips again from Intel, but they will probably be interested in their foundry business, and this kind of comes with this broader make things in America again push by Donald Trump. And I wouldn't be surprised in the background there's some encouragement coming from the US administration for these talks to happen. So I think there could be interest there from Apple in having essentially a competitor to TSMC, which is their main provider of chips right now. Obviously, TSMC is also investing in US-based manufacturing, but I think some resilience and rivalry would be good for Apple in terms of securing supply and maybe kind of pushing to get better deals on that production. Obviously, Intel's been pushing to create a foundry business for quite some time. It's been stumbling because they haven't really had buyers come to the table to justify the investments they need to make in the production facilities. And so I think lining up people like Apple with skin in the game from an investment perspective may give them that confidence that there is going to be demand to make those investments.
And as you say, it does align, it seems, with Trump administration policy at this point. From what's happening then in terms of the chip space to what's happening in a future technology that's showing some proof points right now, and that's quantum computing. And this is HSBC telling the team here at Bloomberg we've done the reporting on this, that they've been actually using it with real trade data at scale, and have come out with some pretty significant results that they say, and one of the executives described as almost as a Sputnik moment. What have HSBC and quantum computing done that could move things forward?
Yes, I should say that they used real-life trade data about bonds to see if they could get better predictive power around pricing of those bonds. And obviously, in financial markets, it's the margins that really matter, and the financial markets are no stranger to using technology to try and gain some kind of edge. So that they said that they'd gained a 34% improvement in that kind of pricing versus current technology using IBM's most advanced quantum chip. Now, my initial thought would be, is a 34% improvement enough to justify the cost of this computing power? Now, quantum's still at a very early stage. I think there's a lot of questions there about whether the economics are going to ever work out, certainly not in the near term. But I think definitely there's a lot of banks looking at quantum technology. JP Morgan, for example, recently announced something around creating truly random numbers, which could help with encryption. So I think you're going to see a lot more interest and investment into this market. And perhaps one of the interesting things is when quantum and AI collide, because quantum could really unlock unimaginable almost kind of capabilities and performance of what we're seeing in AI today. And so that brings longer term questions for like NVIDIA. Well, is our GPUs going to be the future of this, or at some point is quantum going to become the next kind of rival, if you like, to GPUs? I think we're 5+ years away from that at the very least, but it is an interesting kind of mid to long term kind of conundrum about where the technology is going to move next.
Yeah, and what that does to investment flows into both of those areas. Matt Bloxham, thank you very much indeed. Analyst at Bloomberg Intelligence with the context around that story. Coming up, why bonds backed by private credit loans are now among the hottest financial products on Wall Street. That is next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Welcome back. Bonds backed by private credit loans, known as collateralized loan obligations, CLOs, are now taking up a larger part of the $1.7 trillion private credit market. So far, about $30 billion of private credit CLOs have been sold this year, and issuance is expected to hit an all-time high of $50 billion by the year end. Joining us now is Angie Long, CIO at Palmer Square Capital Management, one of the largest global CLO issuers with $36 billion in AUM. Angie, let's start with the broader picture then in terms of the demand and the issuance, and then we'll get to what you're doing in Europe, because that's really fascinating as well. Good morning. Thank you for joining us around the set.
Thank you for having me.
So we're expecting to get to kind of record levels. What is driving this at this point?
I think there's tremendous demand from investors for products with yield. And it's been a very strong year for issuance, both in the U.S. and in Europe.
What is the global rate environment doing to that? And globally, I mean, we'll look at the Fed, rates coming down. We're not sure exactly where the neutral rate will land. The ECB's at 2%. Here, the BOE's at 4%. But rates are gradually, in most of those jurisdictions, if you strip out Japan, moving lower. What is that doing to the broader demand picture in that search for yield?
I think it means you need to go to alternative places to look for yield. And what's interesting about the CLO market is it's a tremendous pickup also from corporates and other areas of more traditional credit. So you're getting a pickup from the rates environment, but also from other areas of credit.
What are the benefits for issuers?
Well, I mean, for issuers, it's it is a tremendous way to finance new business growth and acquisitions. And I mean, it is. The leveraged loan market is the largest credit market in the world. And you're launching, or you have launched, a CLO ETF in Europe now, collateralized loan obligation ETF. We have the first passive CLO. The first passive CLO in Europe. That's right. Why now, and what is the demand looking like for that product? The demand has been incredibly strong. What's interesting is that of the CLOs that are in existence, only 0.25% are in the ETF market. So we still see huge room for growth, but there's been several issuance this year. I think there's 16 CLOs that exist 16 CLO ETFs that exist right now. And this is the first passive CLO ETF? This is the first passive one. Do you have more in the pipeline then? We do. In what kind of time frame? What do they look like? How they differ? I mean, a lot of our income products are tremendously strong, so this will be more, we can do more of an actively managed one. We can do ETFs that are not just for the senior part of the capital structure, but more the mezzanine part. Why start with passive versus active? We have an index that has been in existence for almost 8 years with tremendous performance, so it's tracking an index that's done really well. Okay. In terms of, regulatory structure means that these are institutional investors that get exposure to this passive CLO ETF for now. What are you hearing in terms of whether or not regulators start to think about changing the goalposts so that retail investors can get exposure? The CLO market has been one that has generated steady, strong income for a long time, and it seems to me that that's a product that a lot of retail investors would and should be able to access. And are you hearing? Do you have conversations with regulators in Europe? Are you hearing anything with your? Yes, but I'm not sure that I'm on the most inside track of anyone for sure. Okay, but you think it may be heading in that direction? I think it makes sense too. Okay, so retail investors can watch this space as well. Look, you also have a broader feel in terms of the credit markets right now, and you look at the spreads. I mean, when you look at U.S. corporate credit, spreads are very, very tight. They are. You can put it into historical context for me, but it's looking tight. Is it looking? Evaluations looking a little too rich for you? I think it means you've got to pick your spots. For us, we tend to be up in quality, and the good news is, especially in the CLO market, even a really defensive posturing can give you a tremendous pickup in yield, vis-a-vis corporate credit, more traditional bonds. And so I think you've got to be careful in the companies that you are picking. Spreads are tight, but CLOs offer a space for yield pickup. Okay. Do you have a particular region? I mean, in Europe, is there anything that's kind of screaming by at this point? Anything you're avoiding? Anything you're looking at? Where are the opportunities in credit in Europe? In general, up in quality. Up in quality. Steady companies that can be resistant to any sort of economic pullback, resistant to inflationary trends. We've seen, going back to the ETF piece of this as well, so we've gone a little macro, now we're going back to the product itself. We've seen some examples, an increasing number of examples of mutual funds being converted into ETFs. Yep. Does that continue? What is behind that trend? I do think that continues. It's a global trend that we're seeing. I mean, it is, from a fee perspective, it's a friendly move for investors, and I think there's a lot of investors that appreciate the liquidity, intraday liquidity that can happen, and transparency in the ETF market. And do you see that as a driver for CLO ETFs? For sure. I think across the spectrum of ETFs, credit is a space where people really want to be right now. And again, CLOs offer the most compelling yield
that you can get within the credit market.
Okay, Angie Long, thank you very much indeed. Really interesting in terms of developments when it comes to collateralized loan obligation ETFs, their prospects here. Institutional investors, maybe things change for retail investors in the future. Angie Long, CIO at Palmer Square Capital Management. Thank you. Now, we're going to be speaking to the SNB, the Swiss National Bank President, of course, Martin Schlegel, a little later. They kept rates on hold at 0%. There was some excitement, trepidation that maybe they would move into negative territory. They did set the bar very high in terms of wanting to do that. They're pretty reluctant to do that, and they didn't. They held rates, but we're going to be speaking to the head of the SNB. Views, of course, on the tariff impact, 39% still on Swiss exports to the US market. The currency, of course, and strength that we've seen there. All those questions will be put to the head of the Swiss National Bank, having kept interest rates on hold after 6 consecutive cuts. And the new Fed Governor, Stephen Miron, will be on Bloomberg Surveillance at 1 p.m. London time. He's called for multiple 50 basis point cuts from the Federal Reserve. That will be a fascinating conversation, so certainly stay tuned for that interview. Stephen Miron, of course, with our US colleagues. Let's check in briefly on the markets in Europe. A little bit of a soft picture right now across the benchmark, down 0.4%. You do have concern about some of the makers of healthcare equipment, given the Trump administration threats to additional tariffs there. Here in the UK, the FTSE 100 is down 0.2%. The DAX is off 0.5%. US futures right now, range bound. We've got more data, jobless claims, and then PCE, the inflation gauge, which we know is spotlighted by the Fed. That comes up tomorrow. That is a picture right now. US markets, it seems, looking for direction. Stay with us. The brief is next. This is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's 5 a.m. in New York City. Good morning, I'm Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. A potential mass layoff. The White House Budget Office tells federal agencies to plan for job cuts during a possible government shutdown. A bid for a comeback. Intel extends gains as it's said to have approached Apple to secure investment. And stock futures fairly steady after 2 days of losses for the major indices. Jobless claims among the data on deck as Daly and Goolsby diverge publicly now on rate cut views. So let's take a look at those futures because we are very fractionally lower. Now, we have had 2 days of declines. But for the S&P 500, those 2 days don't even add up to 1% of a decline. And September hasn't really turned out to be the gloomy month that it tends to be in a typical year. We're still up 2.75% month to date, even with those 2 days of declines, which, as I say, for the S&P don't even add up to 1%. So we'll see how we fare today. Let's take a look at yields because we have backed up from the lowest levels, but we are sticking around these levels now. The 2-year, sure, it's up a few basis points. The 10-year yield, actually, too. We're at 4.14 now, but that 30-year yield is still sticking to under the 4.75 mark. We're going to be speaking to Apollo's Torsten Slok in just a little bit. We'll ask him all about the yield curve and what it is signaling. I do want to point out, too, that the VIX is above 16, not exactly elevated, but in terms of volatility indexes, they're all really, really low right now. So is there complacency out there? Not too sure. We'll have to find out. Let's get to some individual stock movers now. Over to London and Valerie Teitel. Valerie.
Good morning, Ivani. Let's start with a check on Intel after it was reported by Bloomberg that they have approached Apple in seeking an investment. The shares are reacting positively to this report, up to shy of 4%. Now, sources have told Bloomberg that these two companies have discussed working more closely together, and this comes in the context of the fact that Apple used to use Intel chips in its devices, but that was a phase-out that began in 2020 and completed in 2023. Now, while investors in the market seem unlikely that Apple would use Intel chips again, it still is reacting positively to this news of a potential investment. Next, let's move over to the car rental industry. Hertz shares jumping this morning, up 8.3% after they announced a $250 million senior note offering in a private placement that would help it pay down its near-term debt. It is suffering from some sort of a debt crunch with notes due in 2025 and 2026. So Hertz reacting positively to that private placement. Lastly, let's head over to Sweden. H&M, the retailer, they're jumping after earnings, up over 9%, a massive beat on profit and margin as they struggle with their turnaround, but it's looking good. This is now their second beat in a row, quarter on quarter. They are now focusing more back on their H&M brand, and also cost cutting help them with their margins. Bonnie?
Valerie, that's amazing. Thank you so much. Valerie Teitel there in London. And our lineup for you this morning will be live from the EPAM Private Equity Conference in Paris with Tony Tutrone of Neuberger Berman. And later this hour, a deep dive into the labour market and inflation dynamics with Apollo's Torsten Slok. So back to our top story. Federal agencies are being told by the White House Budget Office to prepare for mass firings during a possible government shutdown. For more detail, let's bring in Bloomberg's White House correspondent, Tyler Kendall. Tyler, what is the normal government protocol during government shutdowns? Remind us, because it hasn't been that long since the last one, but still it's hard to remember.
Right, exactly. It feels like we are consistently at the brink of seeing the U.S. federal government shut down. And normally, these workers that are deemed non-essential are furloughed, and then they're brought back to keep working. Often they're given back pay in some sort of form. Instead, this really does mark a significant escalation beyond the normal shutdown protocol. This memo from the OMB Director Russ Vought directs agencies to identify programs and other spending items where discretionary funding is set to lapse October 1st, and there's no alternative for other funding. So in this memo, it then goes on to say, quote, such programs are no longer required to be carried out, essentially looking here to be a bidding by the administration to try to cut back on those programs that they deem might not be aligned with the broader policies. For example, the memo goes on to say that those priorities, those areas where the administration has really focused in on, such as immigration and border control, it looks like those funding areas would be kept safe.
And then, Tyler, we got word that the Department of Commerce has now started investigations into the imports of robotics, industrial machinery, and medical devices. I say tariffs because I'm curious, how does it play into the Trump tariff playbook?
Right, well, you're exactly right. This is considered to be the basis for future tariffs down the road. This is a Section 232 investigation initiated on the grounds of national security concerns. And it's interesting here because this is going to expand the scope of potential tariffs that we see. And it really does hit the broader-based industries that impact domestic manufacturing more broadly. This idea of these tools, these robotics, industrial machinery that go into a broad range of sectors. Now, these investigations, they typically last 9 months, though this administration is known, of course, to be working on a little bit more of an expedited timeline. But what's really important here, Vonnie, is that 232 investigations, tariffs that are enacted through them, are considered to be more durable. These are the ones that have perhaps a stronger legal basis, as we've seen President Trump's more broad-based tariffs, those tariffs enacted under IEEPA, the International Emergency Economic Powers Act. Those are the ones that are really going through the court system and seeing those legal challenges. So this signals to us that the administration is taking perhaps a broader view when it comes to tariffs, and to make sure that they are more long-lasting to accomplish those goals of reshoring.
And of course, there are already 232 investigations outstanding into other industries and other parts of tech industries, for example. Are we awaiting any results anytime soon on any of them?
Right, there's a few, actually. This is, of course, not just limited to this. We know that investigations have already been started into pharmaceuticals, for example. That is one that we have been long awaiting. We have gotten some information from the White House on how that's going to be structured, likely a tariff that gets higher over time. You mentioned chips, critical minerals. We are still waiting for that right now. Of course, there's this exemption that impacts the entire supply chain. Comes as a reprieve to those critical industries, but we're still going to have to wait and see. And then the last one I'll put on your radar, aircraft are currently going under a Section 232 investigation. And we've seen in recent weeks leading up to the United Nations General Assembly, President Trump making these deals around Boeing. We know that aircraft is something that this administration in particular, when it comes to addressing persistent trade imbalances, has really been focused on. So I would expect those coming down the line.
All right, Tyler, we'll chat to you again. Thank you so much. That is Bloomberg Washington correspondent Tyler Kendall. Well, turning to tech, shares of Intel extending gains following a Bloomberg scoop that Intel has approached Apple about securing an investment. For more, joining us now is Bloomberg Tech Europe anchor Tom McKenzie. Tom, give us the details. What do we know about this approach?
Yeah, I mean, what a turnaround for Intel and its prospects, particularly when it comes to the question of liquidity. That seems to be less of a challenge for Intel right now. They've had that investment, of course, from the US government, about that 10%, approximate 10% stake. They've had that investment from NVIDIA, around $5 billion. They've had an investment from SoftBank, $2 billion. And now, again, according to Bloomberg reporting, they are courting Apple for potential investment. Really intriguing given the history of these two companies, because of course Apple used to rely on Intel chips but have started to phase them out in the last 5 years. Now they have their own in-house designs, and those chips are produced and manufactured by the foundry TSMC in Taiwan. So we'll see how far this progresses, and it does again remind us that Intel has made significant progress in addressing its liquidity challenges. Now, what it has to do is see if it can actually get some significant customers for that foundry part of the business. Lip-Bu Tan, the new CEO, says he's still committed to foundries, but he's going to be more cautious, and he wants to see some of those big customer commitments before he pushes out on the build on that. It seems unlikely that Apple is going to start producing and buying Intel chips again, but it may be beneficial for Apple, number one, politically, to be seen to investing in Intel, given the US government stake, and number two, to maybe have a bit of competition in the foundry space between TSMC and Intel.
Yeah, it'll be fascinating to see what Apple's response will be. Now, elsewhere, HSBC talking about quantum computing, saying its trial is actually beating out its Wall Street rivals when it comes to bonds and bond trading. How competitive is this space? I didn't realize we were at this point yet where it could actually be used.
Yeah, it's gone. Quantum computing has gone from the theoretical to the research stage to implementing in small levels and small cases. But HSBC's findings seem to be pretty significant. In fact, one of the executives told our team that he sees this potentially as a Sputnik moment for quantum computing. They were able to use a quantum computing processor to radically improve the calculations around how a particular bond would trade at a particular price, a 34% improvement. And if you think, of course, when you're looking at margins and percentage changes, minimal, that can be hugely beneficial on the balance sheet of some of these investment banks, 34% is clearly going to be significant. Quantum computers, they're very expensive, they're very hard to scale. We're still at the very early stages of this. There's all sorts of factors that go on with quantum processors that include things called qubits that are very volatile around temperature changes and other effects in the environment. So there's all sorts of questions in terms of how you scale this technology, but it seems like HSBC have made a pretty significant breakthrough with this. All sorts of implications for trading, for fraud, for encryption, should this innovation technology continue to
go at pace, which it seems to be doing. The timeframes are very difficult to pin down, not clear in terms of when this becomes really, truly scalable at cost, but we know JP Morgan, Citi and others are investing along these lines as well.
Certainly a hot area. Some quantum stocks have been on an absolute tear in recent weeks. Tom, thank you so much. That is Bloomberg Tech Europe anchor Tom McKenzie. Now to other top stories trending on the terminal this morning. Disney is preparing for President Trump to retaliate against the company for putting late-night host Jimmy Kimmel back on the air. Sources say Disney leadership has consulted legal experts and is confident it will win any case over broadcast licenses. Kimmel's return drew 6.26 million viewers, the most ever in the show's regular time slot. South Korea's investment projects in the US will remain in limbo until visa issues are resolved. The South Korean Prime Minister spoke to Bloomberg in an exclusive interview.
Realistically, without a solution, it's difficult to invest in the United States and carry out the various joint projects currently planned between South Korea and the US. We absolutely must find a solution. Several projects are underway between South Korea and the US. Without resolving the visa issue, meaningful progress remains virtually impossible.
And Denmark is investigating potential Russian involvement after a second drone attack this week. Large professional drones were spotted at 5 regional airports in Denmark, disrupting flights. The country's defense minister said the incidents did not look like a coincidence. They looked systematic. Coming up, private credit seeing a pullback in fundraising. Our next guest, though, remains optimistic. Anthony Tutrone, Neuberger Berman Global Head of Alternatives, joins us live from the EPEM conference in Paris. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bloomberg Brief, I'm Bonnie Quinn in New York. The $1.7 trillion private credit market has seen fundraising slow in recent months. Defaults also beginning to creep up, prompting concern about underappreciated risks. Despite that, Anthony Tutrone, Global Head of Alternatives at Neuberger Berman, is predicting growth in private markets over the next 5 years will dwarf what we've seen over the previous 10 years. I'm pleased to say Tony joins us now from the EPEM Private Equity Conference in Paris. Tony, a broad question first. The Fed has kicked off its rate-cutting cycle. What does that mean for the private credit universe, given that much of it is floating rate?
Yes. So on one hand, it makes absolute returns lower.
So you're going to be looking at slightly lower yields. But the best part of it is it's going to make it easier for companies to cover their interest. So those low rates will make companies more creditworthy and hopefully also spur some growth in the economy, which would also be helpful.
What stresses are you seeing in the system? We are seeing defaults creep up. Now they're still low, but we're not used to seeing defaults in private credit. We're talking about 2 to 3% and creeping higher.
Yeah, so I think some of those are some very aggressive deals that were done kind of in the 2021, 2022 period, and it was mostly on the large end of the market. We're quite fortunate at Neuberger Berman. We really focus on the middle market. We have not seen that in our portfolios at all, and we also avoid some of the industries that are probably having more problems, facing tariffs than others. So I think the credit market on the private market side is going to be really about credit selection and about picking the right managers. But if you compare private credit to other areas of credit, I still think you're getting a premium return with similar or less risk. So compared to other areas, I do expect overall private credit will perform very well, even if we have a slowdown in the economy.
Tony, NB has been using some novel securitization structures in recent months, collateralized fund obligations, for example. What are the threats that come along with these?
So whenever you have new technologies that deploy leverage, there's always risk. So again, it really has to do with the underlying quality of the assets that are in these securitizations and making sure that your coverage is good, even in scenarios where you have distress, slow economic growth, or other factors. So I think the results are going to be mixed, depending on the underlying assets. So investors in these types of transactions, I think, are really going to have to be careful about their selection of where they play. On the other hand, these are innovative structures that allow insurance companies and others to buy the types of securities that help them meet their portfolio goals. So overall, these innovations are good, but whenever you have new innovations, you will see winners and you will see losers.
Sure, and Isabel Samama of AXA just told our Kriti Gupta earlier that, you know, it could be the case that the fact that private markets and insurance companies are very closely linked now, that there might be systemic risk, maybe less so in Europe, but she pointed to the US as a place where there could be systemic risk. What are your thoughts on that?
Yeah, so whenever you have joint ventures, mergers, partnerships, some are going to be highly successful and some are not going to be successful. And it has to even do with things like culture, what are the goals and the parameters, and what are the risks that all the parties are taking. I don't see any huge systematic risk from my point of view, but I do see probably many of these partnerships may not achieve their goals, and I think there's already signs that some of them aren't. On the other hand, some of them will be highly successful because there is real synergies and real reasons why insurance makes a good partner with private markets and how they can help each other meet their goals.
Tony, what are your general partners telling you about valuations for the fourth quarter? Should we be looking at more markdowns?
Yeah, so I don't think so. I mean, right now, you know, private equity is always on a delayed. We have the second quarter numbers in. They're good. You know, not as good as they've been in some of the runs that we had in 21 or 22. But on average, portfolios were marked up. Less than 20% of buyouts were marked down. And I think right now, the economy is still pretty strong across the developed markets. Unemployment is low. Again, we don't see a lot of issues in the portfolios, although we are seeing slower growth. We're a very growth-oriented shop. And over the last 5 years, in the direct equity and credit investments we've made, which is 600-700 companies, they've been having double-digit top-line growth. The most recent couple quarters, we're seeing high single-digit in the companies that we're investing in. So I definitely think there's signs of some slowness in the economy, and I think that's something that we're going to have to watch very closely. But overall, I'm expecting valuations to continue to rise as these companies grow and the private equity firms implement their operating and strategic strategies to accelerate earnings growth.
Tony, I'm sure you're always extraordinarily discerning about, who you choose to finance and so on, but you did mention a few times now winners and losers and picking, very particular parts of the market. So where are you, all in, and where are you avoiding like the plague?
Yeah, so we think that the benign economic environment that private markets have had for many years, that gave them a bit of a free lunch, is over, and that the dispersion of returns among different firms is going to be much greater. And we've seen that in the last 5 quarters of data that we track. We track thousands of companies, hundreds of funds, and we're seeing that dispersion occur. And so within the buyout world, it really is about, we think, making money by making your companies better. And so the firms that have deep vertical expertise and lots of resources to go into those companies and provide them with coaching, with resources, with infrastructure to accelerate earnings growth, they're going to be successful. It's a way to make money away from the market. We also have a bias towards the middle market. I mean, you saw in 2024, 6 firms raised 60%
yes.
of the private market's capital. That was up from 20% 5 years earlier. So you got to follow the money flows in our business. I'm not saying that you can't get good risk-adjusted rate of return on the higher end. Those firms have lots of resources. They're investing in really great companies. But the middle market has a real opportunity because they're struggling to raise money. There's less money flowing there. It's going to be less competitive. And they are going to be able to build companies that I think the big guys are going to have to buy. Not only will want to buy them, they're going to have to buy them.
We'll get you back for an update on all of those companies very soon, Tony. Thank you. That's Tony Tutron there of Neuberger Berman in Paris. This is Bloomberg.
When we look at the businesses in the UK and the business in Switzerland, is our view that those businesses are subscale, and the amount of capital that it would have to go into those businesses to get it up to scale to meet our strategic ambitions would be misplaced. SPAR being where it is and how competitive the South African market is, we really just want to refocus on our home markets. Our liquor brand, Tops, has been around for also about 25 years. And through independent retailers, we've become the single biggest retail liquor brand in this country. Our business has the ability, and our independent retailers have the ability to compete directly with the chains. And we are now the second biggest supermarket brand in this country.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Time now for your front page news. First up on the New York Times, a gunman opened fire at a Dallas ICE office Wednesday, killing one detainee and injuring two others. The gunman died of a self-inflicted gunshot wound. The shooting was the second at a federal immigration facility in Texas in recent months. Next up, the Wall Street Journal reports that Delta Airlines is replacing power units on more than 300 Airbus jets to address cases of toxic fumes leaking into the air supply. A Delta spokesman said it's about 90% of its way through the process of upgrading the engines. And then the FT, stablecoin issuer Circle, looking at ways to make reversing transactions involving its tokens possible. Circle's president said a mechanism that allows money to be refunded would help the industry's mainstream push. Do stay tuned. This is Bloomberg.
So today, has value investing been a profitable thing to do over the last 10 years or so, or has it been hard to do?
The market structure has changed, and there has been what I consider it to be a broken market, or the value investing industry, I think, is defeated, so to speak. It used to be that most money was invested by these long-only investors, these big mutual funds and stuff like that. And they had money coming in every day, and they were getting nice fees on all of that money, and they had large research teams. And they would sit around following all of the companies with teams of analysts, and they would say, this company we think is undervalued by 30%. And it might be a growth stock or a value stock, a Magnificent Seven or otherwise, but they would say, I think this is undervalued by 30%, and if I buy it and I hold it, I'll make the S&P plus 30. Now, as we've moved to passive, they've lost their customers, and the remaining customers are paying them lower fees, and they have reduced their research staffs, and they don't have new money coming in to make new investments in any case. And so most of the investing these days is no longer done by people who are buying something because they think it's worth more. They have opinions about price. Like, what is the price going to be tomorrow? And so the result is most trading that is going on right now has nothing to do with value. So it leaves us sort of as a dinosaur.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. A potential mass layoff. The White House Budget Office tells federal agencies to plan for job cuts during a possible government shutdown. A bid for a comeback. Intel extends gains as it's said to have approached Apple to secure investment. And stock futures fairly steady after 2 days of losses. Jobless claims among data on deck as Daly and Goolsbee diverge on rate cut views. Let's take a look at those futures now, because we are lower for the most part, just very fractionally though for the S&P and the Nasdaq 100. 2 days of declines, but it doesn't even add up to 1 full percentage point. And I do want to point out that we're up 2 3/4% month to date so far for the S&P 500. So just a little pullback, maybe a little softer when it comes to risk sentiment. The VIX though is above 16, even if generally volatility indexes are trading near their lows across asset classes. Let's look at yields, because the 30-year is still below 475. In fact, down another basis point below 474 now. The 2-year and 10-year up very slightly, 360 and 413. We have the perfect guest to talk about all of this in just a moment. But before we get to Torsten Slok, let's get to some individual movers. Over to London and Valerie Teitel. Valerie.
Good morning. Let's start with a check on Intel. After Bloomberg reported they have approached Apple seeking an investment. Investors are reacting positively to this report. The share up 3.8%. Now, sources have told Bloomberg that these two companies have discussed working closer together in the future. And this comes under the context, Vani, that Intel's chips used to be used in Apple's products up until 2023. Now, while investors think a return to using Intel's chips is unlikely, we're still reacting positively to the possibility of a possible investment. Let's move over to the car rental space. Hertz shares doing very well so far in pre-market, up nearly 4%. This comes off the back of a $250 million senior note offering that they announced yesterday in a private placement that would help them with a near-term debt crunch. So those shares reacting positively to this news. Lastly, let's go over to Sweden. H&M out with results this morning, absolutely flying when it comes to their share price, up 8.5%. A large beat when it came to margins and its profit, really signaling that this rebound, a turnaround, is really looking good for the Swedish retailer. Bonnie?
Valerie, thank you so much. Valerie Teitel there. Torsten Slok of Apollo has been warning about the labor market for some time, and now is concerned the inflation trend is no longer in the Fed's favor. He writes, quote, "The more general story is clear that there is upside pressure on inflation from tariffs, immigration restrictions, and a lower dollar." Torsten joins us now. He's chief economist at Apollo. Torsten, Austin Goolsby writing in today's FT that he could be less willing to support further cuts at future meetings because inflation is now headed in the wrong direction again. And you pointed out this week that 72% of components in the CPI are growing faster than the Fed's 2% inflation target. Should the Fed be done for the moment?
Well, the challenge for them at the moment, Vanya, is that there are these impulses coming from tariffs is putting upward pressure on inflation. We also have upward pressure on inflation coming from the lower dollar. And we also have upward pressure on inflation coming from immigration restrictions and deportations, creating more wage inflation in the sectors where unauthorized immigrants are working. So these upside pressures are beginning to, unfortunately, become more sticky. And that's why the consensus expects inflation to be around 3% for the next 12 months. And that's significantly higher than the Fed's 2% target. So it makes sense that FOMC members such as Austin Goolsby today are worrying about that maybe we have a problem that inflation is unfortunately not quite trending down to 2% the way that we would all like.
So is it less likely we'll get 2 more cuts this year, do you think?
Well, I think the challenge for the Fed is that on the one hand, high inflation says that the Fed should actually be hiking. On the other hand, the labor market is weakening, as you also mentioned earlier, and the weaker labor market that we had, especially here in the last several months, is pointing in a direction that the Fed should be cutting. So which one is it? Where will the Fed put weight? Will they put weight on inflation being high, which argues for not doing much, meaning keeping rates at these more elevated levels? Or will they begin to cut rates further simply because they're so worried about the labor market and the softening we've seen? It's clear that Jay Powell, including in the speech here yesterday, has been saying, well, they are worried about the weakness in the labor market becoming more persistent, but it's all about how long is the shock coming after Liberation Day? Is the trade war something that just will take a few months and then we're off to the races again? Or is this something that has elevated uncertainty to a new level where companies are under more significant headwinds for a more extended period?
So if we're not sure which way the Fed is going to lean at the next meeting, what is 475 on the long end and what are we, 360 now for the 2-year yield telling you that the Fed will do this year?
Yeah, so that's one, exactly the yield curve shape here is very important because on the one hand, the dot plot is telling us that the answer to your question is that the Fed will be cutting more. That is their expectation. So we in the market should expecting front-end rates to come down. In the long end, in particular, if front-end rates come down very quickly, there is a risk that inflation could remain not only sticky at 3, but potentially go up even more, especially if the dollar would begin to go down more significantly. And at the same time, we still have fiscal pressures putting upward pressure on the long end of the yield curve. So it still is the case that we should expect the yield curve to steepen, mainly because the Fed will be cutting, but also because we have significant upside pressure on the long end, partly because of inflation being sticky, but also because of the fiscal challenges still exerting more upward pressure on the belly and in the long end, and yields therefore staying at high levels when it comes to 5- and 10-year rates.
And of course, all the other questions in the background too, like a potential shutdown, which looks more likely now, and of course, Fed independence. How far away are we from significant job market weakness, Torsten? I know you talked about wage pressures feeding into inflation. We also had the Fed chair talking about how AI might be playing a role in what we're seeing, and migration might be playing more of a role than we had thought.
That's exactly right. And the issue of migration is very important because it is the case, absolutely, that border encounters are essentially zero. So that means that we've had a fairly sharp drop in immigration this year relative to last year. That does mean that there are simply fewer new entrants into the labor market. So simply because of lower immigration, we should also expect to see lower job growth. But the question is, and this was very importantly pointed out by several FOMC members, including by Neil Kashkari from the Minneapolis Fed, it is the case that it's not only lower immigration that has lowered employment growth, it is also a decline in demand for labor. So the fear that you can have is that the headwinds coming from tariffs, the headwinds coming from also student loan payments restarting earlier this year are all at risk of putting further downward pressure on the labor market. So that's why the conversation around what should the Fed do, there are really a lot of question marks and uncertainties around the labor market trajectory and also the inflation trajectory. But they are telling us with the dot plot that we should continue to expect more cuts to come.
Governor Myron is coming up on Bloomberg TV in just a couple of hours. I want to ask you about his Economic Club of New York speech. What in there made sense to you, and what caused friction with your outlook?
Yeah, he has really put a very important foot down here in the discussion about what is the terminal rate. He did some work where he showed in a table in his speech and some calculations that he thought that the R-star and therefore where the Fed funds rate is going to end up during this cycle is dramatically lower than what basically everyone else on the committee has been saying. So that's why there's suddenly a whole new debate emerging around, well, maybe the current forward curves pricing that the Fed funds rate will end up at around 3, that maybe there are some arguments coming from him that maybe the Fed funds rate should be significantly lower. So that's why the direction of travel is that interest rates are going modestly lower here. But it all comes, as you also mentioned, at a tailwind. At the same time, in AI, we have a tailwind, of course, significant spending on energy transition, on climate, on infrastructure. All those things have to be weighed against each other and still argue here for slightly lower rates. But in my view, still rates that are significantly higher than where we were for the long period from 2010 to 2022.
Torsten, is it possible that this slowdown could be temporary, that things improve next year once particularly trade war dynamics at least settle?
That's exactly right, Vonnie. So this becomes hugely a function of how do we think about what role does the trade war have on the economy? Is it the case that after Liberation Day, yes, it was a bit of turbulence for the economy, and therefore we have seen consumer spending slow down. We've seen business spending outside of AI has also been slowing down, and now we've also seen job growth slow down. Is this just a temporary shock to the economy because of what happened in April, or is this something that is a more permanent state of uncertainty for companies, where companies are now more permanently stepping on the brakes with hiring, and consumers are permanently more stepping on the brakes with consumption? And you can begin to fear that some of the indicators, especially again on the labor market, they do become very important, and they are suggesting that maybe this is going to take a while longer. So yes, therefore, Vonnie, the core question in markets at the moment is the trade war just a temporary shock, or is it something that is going to have a longer lasting effect well into 2026?
Torsten, always wonderful to have you. Thank you so much. And do read Torsten's Daily Spark. That is Torsten Slok, Chief Economist at Apollo. Coming up, mass layoffs in the event of a shutdown. The White House Budget Office is preparing agencies for job cuts. That's next. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now, the White House Budget Office is priming federal agencies for mass firings in the event of a government shutdown as that deadline looms. For more, let's bring in Bloomberg's White House correspondent Tyler Kendall joining us in studio in New York. Tyler, remind us of the process. What exactly happens? I can't seem to remember the last time, even though it wasn't that long ago.
Right, exactly. It feels like we go through this process every few months or so, as this Congress has really preferred to do continuing resolutions, kicking the can down the road. Now, this marks a significant escalation in rhetoric and threat from the Trump administration, because normally we see those non-essential government workers furloughed but then brought back with back pay. Instead, we're seeing this memo from the OMB, which is directing agencies to come up with a list of workers whose activities are not paid for via mandatory funds or any new funding from the One Big Beautiful Bill, as well as to make a list of programs deemed inconsistent with the president's priorities. And these are the areas that could be on the chopping block. Now, OMB did not provide additional details. We don't know how big these layoffs could be, but it's important context to keep in mind that 6 out of 10 federal workers are typically deemed essential during shutdowns, which means that they keep working, while 4 out of 10 are told to basically stand by until Congress reopens the government. So, of course, this could have some very big economic implications here, Bonnie. But just for an update on how these negotiations are going, they're not going too well. We had been reporting that there was going to be this high-level meeting at the White House, actually today, between President Trump and Democratic leaders, including Hakeem Jeffries and Chuck Schumer. But then President Trump posted on Truth Social earlier this week saying that it's not worth his time to meet with them, and that has sort of derailed this process. I can say at the heart of this, the potential agreement could revolve around some changes when it comes to health care provisions. We know that Democrats want to see an extension or made permanent Obamacare tax subsidies that are set to expire. They also want to see some changes from the One Big Beautiful Bill, but it's really hard at this point to see that Republicans would make any changes to the president's signature legislation.
Amazing. So many people in Washington, D.C. wondering if they're going to be furloughed literally next week. Now, the other thing I wanted to ask you about is new Department of Commerce investigation. So this time it's the imports of robotics, industrial machinery, and medical devices. When can we expect some kind of an answer?
Right, so this is a Section 232 investigation. It is enacted over national security concerns. Typically, Section 232 investigations take about 9 months to complete, though this administration has been known to work a little little bit faster here, but essentially this could be setting the stage for some more broad-based tariffs. It's interesting to see which industries are going to be impacted. These are the machineries, the robotics that go into the broader-based domestic manufacturing base, so it really does play into President Trump's efforts here to reshore. I'll quickly add that Section 232 investigations really are known to be the ones that have that more durable legal basis, as we've seen now repeatedly. Some of the Trump administration's other tariffs, those enacted under IEEPA, for one instance, face those legal challenges in court.
Tyler, thank you so much. That is Washington correspondent Tyler Kendall. And let's get more details on this now with Brendan Murray, our trade czar. Brendan, what more can you tell us about these new Section 232 investigations and, of course, the ones that are ongoing?
Yeah, exactly. So these tariffs, these sectoral tariffs, and there are now 12 ongoing investigations of a similar sort, would be stacked on top of the reciprocal tariffs that President Trump rolled out in August, country by country. So I think what you're going to see over this period of the investigation is a lot of pushback from manufacturers who use robotics, particularly automakers. I believe that they are the #1 user of foreign imports of robotic machinery, and hospitals and medical equipment purchasers are going to be hit by this. So, you know, the president likes to talk about lowering healthcare costs, but the hospital industry would say if you start putting tariffs on syringes and gauze and, you know, sort of medical supplies, you're only going to raise the cost for domestic use. So you're going to see a lot of pushback from these industries for robotics. Some of the biggest suppliers overseas are Japan, Germany, Korea, Denmark, and Canada. So those countries are all, you know, in various ways in talks with the administration to try to reduce their tariff burden.
Yeah, it's amazing. Usually when some of these are announced, we can sort of see the reasoning behind it, you know, but this one's a little bit more opaque. Now, we have formally now set tariffs on EU autos at 15%. Is that a relief in some senses to European car makers?
Yeah, this was expected, but it took almost 2 months from the time that the European Union and the U.S. signed this deal at President Trump's golf club in Scotland back in late July. So it was a bit of relief. European automakers are looking at these 15% tariffs now compared to the 27.5% tariffs that they were looking at before. But of course, steel and aluminum, those tariffs still are stuck at 50%, a very high rate. The European Union is the largest exporter of steel and aluminum to the U.S. So Brussels is really trying to get some sort of clarity on what's going to happen with those sectoral tariffs that are already in effect and are hurting European producers. They're hoping to get some sort of quota system where those tariffs would be 0 up to a certain quantity of exports to the U.S. But that still has to be worked out, and those are industries that President Trump has made very clear that he's going to protect as best he can with that high tariff wall of 50%.
Brendan, thank you so much for all the context. That is trade czar there, Brendan Murray. Turning to tech now, shares of Intel rising in the pre-market. That's after a Bloomberg scoop that the firm is seeking investment from Apple. For more, joining us is Bloomberg Intelligence tech analyst Matt Bloxham. Matt, how unusual is it that Intel has approached Apple, and what could an investment bring to Intel?
I don't think it's that unusual, you know, given the context that Intel's going through a massive kind of overhaul and transformation under new leadership. Obviously struggling a lot, losing momentum to NVIDIA in the chips, and have really struggled to kind of make this new business, the foundry business, essentially producing chips for other companies, really kind of take off. So I think this search for investment is really about that foundry business, and Apple could potentially be a big customer of that business, and Intel's been reluctant to invest in the facilities it needs to expand this foundry idea without clear customer commitments, and those customer commitments have been slow to emerge, mainly because most people use TSMC, certainly for the kind of really leading edge chips, and Apple has a very close relationship with TSMC. Now, TSMC is building its own infrastructure in the US, under pressure from the US administration. Clearly, Apple feels that pressure too. So I think having a duality of supplier would also make sense for Apple. So we'll have to see where this goes. But I think that the talks do make sense in the context of what the US administration is trying to do in terms of bringing high-tech manufacturing back to the US.
Yeah, it's going to be fascinating to see Apple's response and what it comes up with for its part. Now, elsewhere, quantum computing. So HSBC is saying that its quantum computing trial is actually beating out its Wall Street rivals. How significant could this be for the lender, and how long will it take others to catch up?
Yeah, so I think for context, what HSBC did is they've used a whole bunch of real data about bonds and used quant computing technology to see if they could better predict where bond pricing would sit, so they can essentially make a better margin and outcompete their rivals. And they found that something like a 34% improvement using quant computing versus current technology. So it's got potential. I guess my question right now would be whether 34% improvement is enough to make the commercial economics of quant computing work, because quant computing is still at an incredibly early stage development and incredibly expensive. But it is an interesting and exciting development. I think with everything that's going on with AI too, it's another example of how the financial industry is really at the leading edge of deploying technology to gain advantage. Obviously, historically, the hedge funds have been really involved in this, using their own fiber technology capabilities, developing their own data centers to get a kind of timing edge in the markets. And it'll be interesting to see whether the hedge funds are looking closely at quant computing too. I think the reality is we're probably 5 to 10 years away from quant really becoming kind of widely available at kind of sensible price points, but clearly the investment's going there. And then when you combine the computing power of quant with AI, you really potentially into a kind of a whole, almost unimaginable kind of world of technology developments, maybe in the next decade.
Yeah, the mind boggles. Can't wait to see it. Hope I'm around. Bloomberg Intelligence tech analyst Matt Bloxham, thank you. Coming up, a slew of Fed speak in your day ahead. That's next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. First up, earnings before the bell from BlackBerry and CarMax. Then another round of jobless claims and GDP data at 8:30 Eastern. And a raft of Fed speak from Goolsbee, Williams, Schmidt, Bowman, Barr, and more all throughout the day. Let's take a look at some individual movers pre-market now. Intel extending those gains on reports that the firm is seeking investment and closer working ties with Apple, up 3.5% plus. Opendoor up another 7.5% pre-market. We had a 13G filing from Jane Street, which shows a 5.9% passive stake, and that's just one of the catalysts that are moving this stock higher. Let's just put it that way. Oracle down 2%, falling as Redburn initiates coverage of the firm with a sell rating, citing that the market is materially overestimating the value of Oracle's cloud revenues. So as we get you set up now for this Thursday of trading, let's take a look at where futures are pointing us. Well, they're pointing us lower after 2 days of declines. We knew there was a breather underway. Whether this will stick throughout the day, we'll have to see. What the next catalyst will be, perhaps after the data, we'll know a little bit more. Let's flip it to the bond side of things, because the yield curve just flattening ever so slightly. The 30-year staying at 4.74. We have the 2-year yield at 3.60. Not much movement in this early going. That does it for Bloomberg Brief. Surveillance continues the conversation. This is Bloomberg.
Estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
clients are in the market, they're invested, they're happy because markets are at all-time high.
The key driver of this bull market has been AI and tech.
Everyone who announces plans to spend is rewarded.
The AI investment, I think, is just starting to scratch the surface.
It's when founders and disruptors show up at the same time and they collide and they change the landscape, right? And I think that's a moment that we're in.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday on a two-day losing streak, equity futures finding some stability after pulling back from record highs as Intel stock jumps after approaching Apple about securing investment, and Oracle raises $18 billion in the second biggest bond sale this year. Signs of fatigue. What fatigue?
Well, I have fatigue. Evidently, the market feels a lot less than I do right now because it seems like capital markets wide open. We're talking about bond sales at the fastest pace going back several years. If you look at just, for example, high-yield bond sales, Oracle coming out with this massive bond issuance, leverage starting to creep into some of the build-out of some of the tech equipment. The larger point here is, sure, we may see a pullback in stocks. We're still near record highs. The pullback is unusual, and capital markets very much wide open.
And not exactly testing the limits of investor tolerance right now. Just think about what's happened in the last 24 hours. Alibaba comes out and says we're going to spend more. Stock rallies. Intel, based on our reporting, just having a conversation with Apple, and that's enough to send the stock soaring.
You know, I'm confused by that because Apple didn't confirm its investment. The fact that Intel is approaching the likes of Apple raises a question about just how much or how little investment commitment they've already gotten. But the idea that investors welcome anything having to do with artificial intelligence feels frothy, maybe, but at the same time, if people are buying, others will certainly get on board.
Bernstein had a note out this morning about this potential talks, and maybe this leads to a deal, saying, why are companies so eager to throw money at Intel's way, given their track record? Oh, I'll tell you why. Intel is going around basically saying we are backed by President Trump, and if you want to maybe, you know, have some warmer relationships with this Oval Office, it would be a good idea to look at Intel's way. What is in it for Apple besides some patriotic credibility the next time Tim Cook sees Donald Trump?
Intel up in a pre-market by another 3.6%. Let's talk about the Federal Reserve. Here's a take for you from Mike Dada of Roth, who says the Fed appears to be placing an undue amount of weight on highly volatile payrolls figures while downplaying forward-looking credit market and financial market indicators. This market is telling a different story.
Yeah, especially when you pair it with what he pointed out was 53 consecutive months of inflation above that 2% target. The market has moved on. Is the market reflecting a reality that hasn't yet shown up? Or are we already seeing that positive reality get baked into some of the numbers? Look, a lot of questions right now. Fed officials seem to be parsing through this with a varying degree of stress and difficulty. The issue for me is, are we baking into your question that you've asked many times, an acceleration that already is underway, or one that the Fed is only going to fuel early next year?
Over at the Federal Reserve, we'll be speaking to the man of the moment, Stephen Myron. Governor Myron joining us at 8:15 Eastern Time. Do not miss this conversation. He is pushing for some aggressive moves from this institution. He joins us a little bit later this morning. If you are just joining us, welcome to the program. Equity futures slightly softer on the S&P 500. Coming up over the next hour, we'll catch up with Matt Miskin of John Hancock as stocks look to snap a two-day slide. Dan Ives of Wedbush joins us as Intel turns to Apple to boost its comeback bid, and Joseph Spack of UBS on the street-high upgrade to GM. We begin this hour with stocks holding steady ahead of the latest read on the U.S. labor market. Matt Miskin of John Hancock writing the following: this year has been a short-term investor's dream market. We still like the U.S. the best and are still calling for an overweight to technology. Matt joins us now for more. Matt, welcome to the program. Lots to talk about. Let's start with that overweight to technology. Are we reaching the limits of investor tolerance, or can this one keep on going?
Yeah, John, it is getting more challenging as the valuations are getting tapped out. It is going to be hard for valuations to help the technology sector for a long-term investor. Short-term investors are really benefiting from the increase in day trading and more investors coming in trying to get as much as they can out of this market. In our view, multiples are tapped out across basically all global equities. So you're not going to see that as a return driver. But earnings growth is the last equity return driver left, and technology companies are growing earnings. Now, what we're hearing and what we're seeing is it's almost like a circular feedback loop. There's so much cash on these balance sheets, and they're basically paying each other for services within the technology sector. It's almost keeping the money right there. But we're following the earnings growth. We're following better balance sheets, higher ROE companies. We're trying to minimize low quality stocks within portfolios, and we still have that technology weight there because they are still the highest quality companies in the world.
Matt, let's follow that earnings growth. This came from Scott Croner of Citi. He's going to join us later. The S&P 500 is pricing in a forward growth expectation in a manner that has only existed 2 other times in the past 30 years. Matt, just how high is the bar into next year?
14% earnings growth is the consensus. On 22, we're almost at 23 times forward PE. So we're basically on the highest multiple. And then this is a little bit of math. I know it's early, John, but the PE ratio, the denominator, the E, already embeds 13% earnings growth. So for you to get more out of this, you've got to get you can't get much more multiple expansion. You got to get earnings to beat that 13% rate. Now, here's why. Overall, for equities, we've been modestly underweight. It has been a brutal year to be modestly underweight equities. But this is the deal. This is the issue we're dealing with, is that this market is priced for perfection in a far from perfect world. There are going to be risks into next year. Next year, 2026, growth estimates on the earnings side and the economic side, frankly, are booming. And we think that next year is going to be a tougher year than the markets are pricing in. We're a little bit underweight risk. We're a bit more overweight bonds, a bit more overweight income as a return driver. It has been a tough year. I know Lisa's probably going to be coming up next, but we think that that's a more comfortable position to be, and we think that's riding out the volatility in a better way.
I'm not going to hold you accountable, Matt, for maybe not seeing the rally for the beginning part of this year, but I am wondering if someone were a bull and they were sitting here listening to everything you would say, they'd say, actually, for big tech, it is almost perfection in terms of the environment. And then if you add on top of it rate cuts heading into next year, that actually helps some of the multiples, even at these elevated valuations, which is the reason why everyone's getting increasingly exuberant. Why do you reject that?
Yeah, I mean, Lisa, you did tweet this morning about how AI is basically keeping this economy alive. If you took out AI, we may be in a recession right now. You look at all the charts, all the economic charts, and basically we are near recession levels as it relates to jobs data, as it relates to leading indicators, so on and so forth. The AI side, the spending has been so powerful, but what's the next? All right, so the companies are buying all this AI stuff, the infrastructure, everything behind it. Now they got to use it, and they got to make money off of it. That has yet to be seen. So as we go into next year, all right, it's great that we can now do things a little bit quicker than before. Is that profitable? Is there a way to generate cash flow off that? And as you see this circular feedback loop as of late, where, as you commented before I jumped on, where it was, hey, you could just say you're spending on AI and the market already rewards you. Great. That's CapEx, though, that you need a return on investment. So I think that is where it gets a little frothy. I think the bull side, rate cuts, yes, but it's not as much rate cuts as you know, looking into next year. The Fed's only saying 1 more. We're getting 3 this year. We think that's fair. The tax cuts aren't as big as you might think. We're looking at basically just a continuation of the tax cuts. So we think the sentiment has gone beyond the positive fundamentals. We're just going a bit underweight beta, like a 0.9 beta, as the froth has gotten more ingrained into this market.
You said something, Matt, that I thought was really interesting, that maybe this market is overpricing how many rate cuts is priced into the market, or is going to be, how many are going to be effectuated next year, and yet you see opportunity in long duration bonds. Can you kind of square that circle?
Yeah, so we're more on the intermediate part of the curve. We're income investors, so we're not playing a ton of duration as a return. We think we can get 4 to 5% in return just from an income side. In terms of the outlook, the Fed is saying 1 next year. To us, that's too little. We actually think there's going to be more like 3 to 4 next year. The bond market is pricing in 2, but just going into why the market is so positive, to your point, it's basically saying, hey, there's tax cuts and rate cuts. My point is actually that the tax cuts aren't as big as you think. The rate cuts being priced in aren't as much as you think. And we actually think that the bond market's going to have to adjust more. The bond market's not as expensive as everything else. It's still coming out of the biggest bear market basically in history from 2022. Everything else is at all-time highs, super high valuation. Bonds are still licking the wounds of 2022, and we think they have got more upside potential in the next year. That's why we're sitting here collecting nice income while we wait.
When you say 3 or 4 times next year for the Fed, Matt, is that because of economic conditions or because a new regime politically pushed potentially next year at the Federal Reserve?
Yeah, and Marie, this is the debate that is going on across, I think, all firms that are looking at Fed policy in the next year. And you're really trying to say, is there a Powell rate policy and then a post-Powell rate policy? And I can't wait to dial into your interview at 8:15 to hear kind of more perspective. But at the end of the day, we think actually you're going to be more able to see where the economy stands in 6 months or so. So let's go into May and next year. If the employment rate and basically the jobs market is still doing what it's doing right now and the trend is negative, you're going to know that we should be cutting. If the jobs market reaccelerates by the end of the year, then you're also going to know, all right, we probably don't need to cut as much. And also with inflation, you're going to get more answers on tariffs. We think actually the Fed is very divided right now. They may actually come together into next year because the policy is going to give you, or the economic data is going to give you more answers. In our view, the jobs data, it's very unlikely that it reaccelerates. And we actually think that it's going to be weaker than you think into next year. And as a result, the Fed's probably going to be cutting more than the markets think into 2026.
Yeah, Matt, just quickly then, with that in mind, Governor Myron coming up a little bit later, what do you want to know? He's made some massive calls in the past week. What's the question you want the answer to?
Yeah, it's just going back to the labor data and just saying, hey, what's the unemployment rate that would be the trigger to kind of cut more aggressively, maybe 50 basis point cuts or, maybe 4 to 5 cuts next year. And, just looking at also the housing data, I still struggle with the Federal Reserve not focusing on housing. It's such a big part of inflation. It's 35% of CPI, and it is decelerating. Some of the housing data this week's been all over the place, but generally speaking, we're seeing housing prices moderate to nearly negative on a year-over-year basis. And if that gets caught up into the CPI, the inflation data into next year, they're going to be behind the curve. So I'd love to hear about employment data. What are they watching exactly? And then can you talk about housing and how that's going to feed into CPI into 2026? That might actually be a pretty compelling thesis for more cuts into next year.
Interesting. We'll find some space for that, Matt. Always good to catch up, sir. Thank you. Matt Miskin there of John Hancock. Governor Stephen Myron coming up later on this morning, 8:15 Eastern Time. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara Arnott. Hey, Yahara.
Good morning, John. U.S. Envoy Steve Witkoff is predicting a breakthrough in the Israel-Hamas conflict in the coming days. The comments follow President Trump's meetings this week at the UN with officials from nations including Egypt, Qatar, Turkey, and Saudi Arabia. Witkoff didn't offer details, but said the plan addresses Israeli concerns as well as those of its neighbors. Meanwhile, HSBC says it has made a breakthrough in deploying quantum computing in financial markets. The bank says it is the first time real trades have been used at scale to show the potential benefits of the emerging technology. One senior executive even describing it as a Sputnik moment for the industry. And a check on Intel shares, they are rising 3.6% in the pre-market. Sources telling us here at Bloomberg that the chip maker approached Apple about securing an investment. Apple was a longtime Intel customer that switched to in-house processors in the past 5 years. The deal would follow a $5 billion investment last week by NVIDIA. That's your Bloomberg Brief. John?
Follows a 6% move just yesterday off the back of this news. Yahara, thank you. Up again this morning. Up next on the program, a looming government shutdown.
We hope there's a path forward to avoid this Trump shutdown.
The Democrats are trying to hijack it to get $1 trillion in new spending, and I don't think that's a very good deal for the American taxpayer.
Here we go again. John Lieber of Eurasia Group up next. Live from New York City this morning. Good morning. at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
People really do prep for this program, watching old interviews, combing through Bramo's social media accounts. Matt Miskin wasn't bad, eh?
He did a great job. Matt, thank you for reading. One viewer, one watcher. We appreciate it.
He knew exactly what was coming. Equity futures on the S&P 500, almost totally unchanged. Two-day slide. Easy to sit here and say the anxiety's building, fatigue and all of that kind of stuff. We're still within 1% of all-time highs. Alibaba's just had a big rally off the back of just announcing more spending. And Intel, just off the back of our story, we're having a conversation with Apple. Stocks up yesterday, big, up 6%, up again this morning.
You know, it feels new. What's remarkable is that Apple actually moved away from Intel as one of their chip providers not so long ago during 2020 to bring it in-house. And now is this potentially a reversal? We have no idea. This is just the idea of talks, but it shows how high speculation is that Intel can get some sort of foothold in the American economy as a result of some of the backing from the White House.
Intel up 4% in the pre-market. Dan out of Wedbush joining us in about 15 minutes' time. Under surveillance this morning, a looming government shutdown.
We hope there's a path forward to avoid this Trump shutdown.
The Democrats' requests are completely unhinged and unreasonable and unserious.
We want to sit down. We want to negotiate. We're not going to get everything we want. They're not going to get everything they want.
The Democrats are trying to hijack it to get $1 trillion in new spending, and I don't think that's a very good deal for the American taxpayer.
So here's the latest this morning. The White House telling federal agencies to prepare plans for mass firings in the event of a government shutdown, with funding set to lapse on October 1st. Bloomberg's Tyler Kendall has the latest here in New York. Good morning, Tyler.
Hey, John. Good morning. The White House is essentially using the threat of permanent layoffs as leverage in these negotiations to keep the government open. And this does mark a significant escalation to what's considered to be normal protocol during a shutdown. Typically, non-essential workers are furloughed and then they're brought back with back pay once the government reopens. But now we have this new memo released by the OMB, which is directing agencies to essentially identify a list of workers that are funded through non-mandatory funds and then new funding from the One Big Beautiful Bill, as well as to identify those workers that are part of programs that might not fit with the president's broader priorities. And the OMB says that these could be the workers that are on the chopping block. We've never seen an escalation like this before. And while the OMB did decline to comment on the scope of what these layoffs could look like, we know that 6 out of 10 federal workers are typically deemed essential during shutdowns, which means that they can keep working. But we should also keep in mind here that the bulk of federal workers actually aren't in Washington. Less than 20% work in the nation's capital. So this could have some pretty broad-ranging impacts. John, we really saw the negotiations for keeping the government open derailed earlier this week. President Trump was actually supposed to meet today with Democratic leaders at the White House, but then he ultimately posted on Truth Social and said that it wouldn't be worth his time. Republicans are looking for Democrats to get on board with a short-term stopgap measure that would fund the government until November 21st. But Democrats say they want to see some key concessions, including when it comes to health care. They want to roll back some of those changes that we saw to Medicaid under the One Big Beautiful Bill. But at this point, John, it doesn't seem like Republicans would make any changes to the president's signature legislation.
Tyler Kendall with the latest. Thank you. Let's get to those requests. Joining us now is John Lieber of Eurasia Group. Just to build on what Tyler was talking about there, John, the Democrats' requests are completely unhinged, unreasonable, unserious. You heard the quote. John, what are they asking for?
Yeah, I mean, you heard Tyler break down a lot of that. They're asking for changes to the Big Beautiful Bill. They want to restore some of the funding that the Trump administration cut unilaterally from agency funding earlier this year. And there's one nugget, which actually is somewhat, both of those are non-starters, and there's a few other things like that, but there's one nugget that is a little bit more bipartisan, and that's these Obamacare subsidies, which expire at the end of the fiscal year. The Democrats want to make them permanent. The Republicans are actually open to extending those, but not for permanently. So there's several tens of billions of dollars in healthcare subsidies that could go along here that the two sides could agree to, which the Republicans are saying, give us a few more weeks and we'll work out a deal. And the Democrats are saying, no, let's do this right now, which is why I think the government's on a verge of a shutdown.
Well, aren't they on the verge of a shutdown also by the fact that the speaker is telling lawmakers not to show up till October 1st, when the government would already be in shutdown? They're not even trying to take a vote?
Right, yeah, they're not going to try to do this because the Republicans think they have the upper hand here. And I think that's why the Democrats are kind of desperate to look like this is the Republicans' fault. In the past, the blame game of these shutdowns is a big part of this thing. I think in this case, the blame game doesn't matter at all. I mean, President Trump shut down the government personally for about a month in his first term and paid no political price for it. So I don't think I don't think when this is all said and done, anyone's going to emerge from this shutdown as a winner or a loser. And I would be looking at the policy, and what the Republicans are saying is that we don't really care about the policy. And now you've got the Office of Management and Budget saying we're going to shut down agencies permanently if you allow us to shut them down temporarily. And that seems like a big policy loss to me. So if I were the Democrats, I'd be extraordinarily worried about this shutdown coming, but it looks like they're headed there anyway.
Is that memo from the White House just more of a threat and pressure they're trying to exert on Democrats, or are they serious, not letting a good crisis go to waste and actually want to eliminate government jobs?
Yeah, I mean, it could be a threat. We don't know, but you got to take it seriously because this administration has done quite a few unprecedented things. We know that they want to eliminate agencies. We know they want to reduce headcount in the federal government, and we know they're looking for opportunities to do so legally. And this could provide an opportunity to do so. They're kind of saying, go ahead, Democrats, make my day. Let's shut down the government and we'll see what happens. And, I think that this is a bluff that I would personally be scared to call if I were the Democrats because of all the other, insanely unprecedented things in different ways this administration's been pushing the federal bureaucracy. And I think it's a real concern.
John, if the government were to shut down and they do make good on this threat, which departments do you think would get eliminated?
Oh, I mean, they've already eliminated the Department of Education. So, I mean, I think that's the low-hanging fruit. I think there's probably going to be workers at the Department of Labor that are affected by this. That's one of the areas the Republicans are typically more hostile. I think it's possible you get the Environmental Protection Agency. There's a whole host of ones where I think that there's, HHS, I assume there's some bloat they want to get rid of. There's a whole host of ones that are not core to what Republicans care about. And I think it's important to note they have discretion to put the money where they do care about it, because either some of these funds have been declared mandatory, so not subject to appropriation, or because the administration can deem workers essential. So one place they're not going to be cutting is Immigration and Customs Enforcement. They're not going to be cutting the Department of Defense. They're not going to be cutting, Social Security or Medicare, because those are mandatory programs. These are, they're basically just they'll be able to take control of the government and put the money into the law enforcement agencies that they like, and ignore the ones the Democrats don't. And this could go on for a prolonged period of time.
John, you said earlier that there are no political winners or losers from this, but can you give us a sense of, from a polling perspective, how much the average American voter really cares about this? I know the market isn't paying any attention whatsoever until it goes on for more than a month. But how about the average rank and file member of the United States?
Yeah, I mean, there's just not great. I mean, I think that there's polling data from previous episodes where you can say who's to blame for the shutdown, ask whose fault this is. But if you look out over a period of 6 or 12 months, the shutdown fades into the background. So what really matters here is how does this affect the midterm elections? We are more than 12 months out from the midterm elections. This is not going to affect the midterm elections at all. So I think that either side, the political consequences of this are going to be extremely muted. And we've seen this time and time again. You get a big shutdown in 2014, a big shutdown in 2019. It's just not what voters care about 6 and 12 months down the road, which is why I think ultimately the politics of this are completely irrelevant. And it's just an inside baseball, inside beltway game to argue about it. But the policy impact is the thing that politicians should be looking at.
Well, Hakeem Jeffries sat down with our colleagues at Bloomberg Government yesterday for exclusive roundtable, and he said Democrats are really going to be focusing on health care. Is that some place that Democrats could potentially make inroads ahead of the midterm election and when it comes to this government shutdown?
it's typically been the area where Democrats poll better than Republicans. So I think this is them trying to get the upper hand coming into the midterm elections. Totally plausible to me, I guess, that could be something. But, I think a lot of this stuff is just fades into background noise, right? And how many of these shutdown battles have we had over the last decade, and how many actual shutdowns have we had? And there's so much else going on in the news cycle that I think this just ends up fading away. Yeah, people's vacations will be disrupted, and there will be real problems that start to bite in the real world, particularly if the shutdown goes on a long time. But I just don't think this is a great way to position yourself.
Hey, John, thank you, sir. As always, John Lieber there of Eurasia Group talked a lot about fatigue in the market. Fatigue with this story. People in this market just do not care about this story at all.
I think it doesn't even rise to the fatigue level because there are other things to get fatigued about, so people just sort of ignore.
We're going to ignore until I guess we can't no more. Coming up on the program, Dan Ives of Wedbush as Intel turns to Apple to boost this turnaround.
Said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive. Getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Two-day losing streak on the S&P 500 this morning, down by just 0.1%, still within 1% of all-time highs. Decent rally yesterday for Intel. It continues this morning. We'll catch up and get you up to speed on what's happening with that name in just a moment. Let's turn to the bond market. Yields higher for a fifth day in 6 yesterday. We're down this morning by not even a basis point across the curve. 2's back to 360. 10's back to 414. Going to keep promoting this one, but later on this morning, 8:15 Eastern Time, Governor Myron's going to join us. You know what my first question's going to be?
What is it?
I just want to know how well received he was on the committee, walking in, how different the experience was to what he expected going into it.
Yeah, and what he felt about the other members and some of their arguments, and which he found most credible. My main question for him is, what is his response function if inflation starts to tick back up? What is that type of policy? Is it to stop cutting rates, or is it to keep going and use other levers to potentially suppress long-term rates?
These are conversations we've got to have a little bit later this morning. Look out for that. That's the setup. Let's get you some single names, some morning movers. Here's Danny Berger with more. Hey, Danny.
Hey, John, let's get with that top story that you flagged. It is Intel. Shares are soaring just under 4% this morning, approaching Apple about an investment, according to our reporting. Early stages, but the two companies are apparently also looking at how to work together. Already some bearishness on that. Bernstein's analyst Stacey Rascone writing that they have a capability issue. Money doesn't solve that problem, and they continue to question why people want to, in his words, throw money at Intel, given their track record. Elsewhere, Hertz, those shares also moving much higher in the pre-market this morning, up just about 4.5%. They are offering $250 million worth of senior exchangeable notes due in 2030. They say they will use that to help pay down their debt. As part of this announcement, they also mentioned that they're doing a transaction with Bill Ackman's Pershing Square that will allow them to get more long Hertz shares. So again, those moving higher. To the downside this morning, though, is Oracle, but this thing has had a massive run higher. Shares are down 2%. Redburn analysts saying that currently, what traders are pricing in is a blue sky scenario that looks unlikely to materialize. So they initiate coverage of Oracle with the sell, saying at some point this market is going to stop focusing on the headlines and start focusing on the fundamentals. John?
Danny, we'll get to that in just a moment. Danny, thank you so much. On a radar this morning, White House officials directing federal agencies to plan for mass firings during a potential shutdown. Agencies must prepare to suspend non-essential jobs if Congress misses the October 1st funding deadline. Elsewhere, new tariffs are on the table for robotics, machinery, and medical device imports after the Trump administration opened formal trade investigations. The Commerce Department has 270 days to make its policy recommendations. And finally, as Danny indicated, Oracle launching an $18 billion U.S. investment-grade bond sale as the software maker ramps up its spending to meet the needs of the artificial intelligence boom. The move marks the second largest bond sale this year, and the order book was huge.
It was massive at a time when everyone is looking to get a hold of something that is high quality. Just to give you a sense, we were talking yesterday with Vishy Tirupattur about how we aren't seeing as much issuance as the market even wants. And yesterday, we saw something like $88 billion worth of orders for this $18 billion bond sale. It was upgraded. The prices went down. The prices went up. Yields went down on some of this paper. And this goes to $180 billion of debt sales just in September so far alone, which would be the greatest monthly tally going back for investment-grade bond sales in the U.S. since February. Question is it the beginning of an issuance boom? Does this highlight how open capital markets are? And are we starting to see the tech world use leverage, not just free cash flow, to pay for some of these investments?
It's not just IG, it's junk too. You talked about it. Junk bond sales, according to the data here at Bloomberg, the team's put it together, set to reach their highest monthly total since September 2021. The market's wide open. It's taken down the supply quite nicely.
It raises this question, and I think it's a really important one. If the Fed is cutting rates, what are they looking to stimulate? Doesn't this indicate that the market's already wide open? And is the market wide open because of the promise of Fed rate cuts to come? Or is this independent of it because there is so much demand and all that cash on the sidelines that people talk about? All of those bond investments are throwing off cash as well that need to get reinvested. So you have this dynamic where if you build it, they will come. This market wants to buy, and so there will be manufactured by Wall Street.
Oracle this morning down about 2%, but that's nothing compared to the rally we've seen more recently. Let's stick with tech. Sources telling us here at Bloomberg that Intel is eyeing investment from Apple to bolster its comeback bid. The company's discussing how to work together more closely. Joining us now is Dan Ives of Wedbush. Dan, welcome to the program. Let's just start with Intel. What problems does Intel have that money solves?
Well, look, I mean, when you think about, first of all, innovation, I mean, now with NVIDIA being a backer, I mean, that's something that's important because, look, I mean, you talked about some of the issues that Intel has had. You now have the government backing. You have NVIDIA bringing them into the AI game. Look, they are the comeback kid. Intel. So look, could Apple do a deal with them? I think anything's on the table right now, because also this just also gets you in a better spot in the 202 area code relative to, I think, the view right now. You want to be in the Intel game rather than outside if you're in big tech.
Well, Dan, let's talk about why, and let's talk about the government stake in Intel. Anne-Marie talked about it. Do you see that? Do these companies see that as an incentive to partner with the company, knowing that it gets them in the good favor of the White House?
Oh, yeah. I mean, my name's Dan. I mean, the point is like that 100% is at play here, because it gets you, I think, in good grace in terms of the 202 area code. You were clearly seeing that this is an arms race between the U.S. and China. Intel has clearly been the laggard, and obviously it's been a nightmare. But now with this backing, you get NVIDIA, you potentially get Apple, you potentially get others. I mean, it changes the story. Now, look, they have to execute, but I mean, this is almost historical. What's happening for Intel? The stage is set. Now they have to execute.
Dan, isn't it uncomfortable for you that the U.S. government is just picking the winners and the losers?
Look, I mean, it's the new rules of the road, right? And I think it's one where, when you look at Intel, if they didn't have Trump administration backing, you don't get NVIDIA back. You don't ultimately get Apple, right? So it's one where this was the laggard. You could argue, especially what's happening in China, they needed to essentially, put fuel behind this in terms of when it comes to Intel. But look, I think the reality is big tech CEOs are adjusting to new rules of the game. Intel's on the positive side of that. Others will be on the negative. And I think in this fourth industrial revolution, that's how this is going to continue to play out.
Well, do you think Tim Cook is going to do it just to get a better welcome treatment in the 202 area code, as you put it?
Yeah, look, I don't think Cook's doing it solely to, for that reason. But I mean, strategically, obviously, there could be good reasons why they do it. And look, Apple right now, I mean, they went from back against the wall, as we've talked a lot in the program, to now they're on offensive mode. I think, that Google Gemini deal on the AI front is probably next. They could do an Intel deal. They could do others because, since that DOJ win for Google, that gives Apple, I think, a lot more flexibility. But if that phone rings from the 202 area code, I think Cook picks it up.
We were talking earlier, and John brought up how it was notable that Intel shares rallied just on the idea that they approached Apple to have discussions, even without any result. We saw a similar kind of response when it came to Oracle shares, not today, but yesterday and the day before, when there was a discussion around potentially investing more in OpenAI. And then there was this question of NVIDIA and how much money they've been investing in OpenAI, and that this caused both shares, or the value of OpenAI and the shares of NVIDIA, to pop. Doesn't the market reaction make you a bit queasy when we're just buying first, asking questions later?
Yeah, Lisa, I thought you nailed it what you said before in terms of just the green light essentially right now, in terms of not just in terms of Fed, but everything that's happening in big tech, right? I mean, this is now the next stage of growth. And I think for investors, they're going to bet as it plays on. They're not going to bet against it because, it's our view, tech stocks rally hard into year end because now you're actually seeing this next stage of investment in AI. Government's backing it as well. And I think it just comes back to investors that have bet against this and been weary, they're right now in hibernation mode, underperforming, and they can't find AI in the spreadsheets.
It's important not to talk too much in generalities, because you're right that this is a sea change, and I think a lot of people do agree with you. There is a technological revolution underway. There are going to be some very big winners. It will lay the groundwork for whatever is the next phase of business and work. Oracle shares, I want to talk about those, given the fact that we were speaking with Gil Luria yesterday, who said this is one company that isn't showing it, where we're not seeing that positive operating revenue that they can put into some of these investments. It's betting on things like OpenAI and putting more money into it that it could possibly see profitability in the near term. Do you see pockets of excess, even if you are a big believer in this story?
That's like saying Scottie Scheffler is not a good golfer and he's not going to crush at Bethpage, right? I mean, to me, it's, when you look at what Oracle's done, I mean, they're the case study. I mean, Benioff, Adobe, I mean, they look at Oracle, that's the playbook. because they've bet on AI. That's what investors are focused on. In terms of profitability, some of those other metrics, that's right now, I think, in the background. You're focused on what the growth looks like when it comes to AI. And Oracle, I could argue, is still being underestimated relative to where I see it over the next 1-2 years as they play, just like Microsoft, just like Google, just like Amazon, in terms of big tech. The strong will get stronger. That's what Oracle is.
So, Dan, not a perfect example, but work with me here. I think it was back in 2018. Do you remember Long Island iced tea? And they became something like Long Blockchain. I remember having conversations about that at the time. And there were people who quite rightly had a very, very real interest in what was happening with crypto and Bitcoin that made the case that you shouldn't allow that to distract you from the real things that are happening. At the same time, you shouldn't allow the real things to distract you from the crazy things that are happening elsewhere. So, Dan, do you know any signs of bubble-type behavior happening beyond the stories that you have conviction in that you are cautious about?
Oh, of course. Well, there's fraud. I mean, there's companies I talk to. They say AI 50 times, and it feels like basically that there's really no technology there, right? So that's why we spend all of our time figuring out who are the winners, who are the imposters. There will be froth, like there always is, but it's my view, like this is the real spend because of the use cases exploding, and my view of where autonomous and ultimately robotics is going. But look, that's why you have to be weird. You have to figure out who are the winners, who are the imposters. And that's why we spend all of our time doing it.
But Dan, as you know, in experience, you also have to be prepared for a washout of everything at some point. And the same thing happened with crypto. And I wonder, and again, I know it's not the perfect example or parallel, but I wonder if that's a phase we have to go through too, and whether that phase isn't too far away.
Yeah, I continue to view it. It was 1995. This is much more of a 1996 moment rather than 1999 moment. And we've said, I think it's still a few years as this all plays out, these trillions being spent. And it's our view, like in that AI party, it's still about 10:15, 10:30 p.m. Party goes to 4 a.m.
Dan, I wonder what you think if you do start seeing more deals in the bond market to finance some of the build-out of the infrastructure required for tech, similar to what we see from Oracle, but from others as well. If you start to see that tech issuance really skyrocket, does that make you more concerned if this is being used, if this is being done on leverage rather than free operating cash?
Look, I think it's a balance, as you hit before. But look, I think it's important because right now it's like it's only the called the tech stalwarts that are really the ones that are funded $350 billion in capex. What you're now going to see is you're going to see a lot of other tech players. They'll finance this, whether it's debt, whether it's their own cash, because they cannot be left behind. So I think there's something from a bond market perspective. It's a green light. You're going to see, I think, significant issuance out there. But you want to see these companies, they'll be supported by investors to bet on the AI revolution. You don't want to see them in that right lane going 45 miles an hour.
Dan, if I could just ask you one final question on the geopolitics of this all. We had that Alibaba announcement this week about more AI spending, but also the fact that they are using NVIDIA chips. Do you continuously see China relying at this moment on NVIDIA, or do you see China really moving into their homegrown heroes?
Look, I mean, they could obviously Huawei, and they'll have all the focus on domestic, and they're doing some great things. There's one chip in the world fueling the AI revolution. It's led by Godfather of AI, Jensen, NVIDIA, and that's why, you know, Baba and others, despite what you hear from Beijing, they'll continue. Even if it's the number 3 chip that NVIDIA comes out with, it's still years ahead of what they have domestically, and that continues to be the biggest chip on the poker table for Trump. And he knows that, and that's why wherever he goes, who's to the right of him? Wearing black leather jacket, Jensen.
Dan Ives, appreciate it, sir. As always, good to touch base. Dan Ives of Wedbush there on the latest on big tech and the AI trade. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Denmark is launching a probe over potential Russian involvement in 2 drone attacks against the country this week. The Danish defense minister described the strikes as looking systematic. Authorities are set to change legislation to restrict the use of drones in Danish airspace and discuss how to involve NATO allies. Meanwhile, we are seeing shares of H&M surging more than 8% in Sweden after it reported better than expected earnings in the third quarter as its turnaround efforts take hold. The Swedish retailer ramped up advertising to help draw shoppers back, offsetting the consumer uncertainty and rising trade barriers. This is the second consecutive quarter where earnings beat expectations. And Delta Airlines is addressing reports of toxic fumes leaking into cabin air supply. According to the Wall Street Journal, Delta is replacing power units on more than 300 of its Airbus jets. The carrier is already about 90% through the process. The issue stems from earlier reports of toxic fume events leading to brain injuries and illnesses. That's your Bloomberg Brief. John?
Yahara, thank you. Never good news coming from the airline business, is it?
Toxic fume events.
Brutal.
That sounds like quite the happening.
I guess the good news is they're figuring that out. Up next on the programme, relief for European autos.
The market's become very, very narrow. And unfortunately, companies like autos and a lot of the older industries are not getting the capital that they need. Europe is muddling through with, frankly, very difficult regulations. The US, as ever, going completely the other way.
A conversation up next with Joseph Speck of UBS from New York City this morning. Good morning. You're watching Bloomberg TV.
Bloomberg Screen Time is back this fall for year 3. We're bringing together the biggest names in business and pop culture, like Netflix co-CEO Greg Peters, Instagram boss Adam Mosseri, and Los Angeles royalty Will Obey. We're going to talk about sports and eating entertainment, check in on the state of the movie business, and get an update on LA after the fires from Rick Caruso and Irving Azoff. You should expect newsy interviews from industry leaders, meaningful business networking, and of course, great food. We'll feature some of the best chefs and food trucks from my hometown of Los Angeles. Tickets are available now, and you should head to bloomberglive.com/screentime for details. I'll see you in Los Angeles, October 8th and 9th.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Equity softer this morning. We're down by close to 0.2% on the S&P. Similar move on the Nasdaq 100, just a little bit lower following 2 days of losses on the S&P. Under surveillance this morning, relief for European autos.
The market's become very, very narrow. And unfortunately, companies like autos and a lot of the older industries are not getting the capital that they need. Europe is muddling through with, frankly, very difficult regulations. The US, as ever, going completely the other way. Growth is becoming harder and harder and harder, and investors are looking for growth wherever they can find it.
So here's the latest this morning. The United States cutting tariffs on EU autos to 15% from 25%, despite some of the headwinds facing the whole of the sector. Joseph Spack of UBS is upgrading his call on GM to a street-high price target of 81. We trade this morning at 59.91, and Joseph joins us now this morning. Joseph, welcome to the program. Still getting an idea of where the policy is and where it will be over the next few years. Just walk us through this upgrade, this bigger call on GM and this new price target. What's behind it, Joseph?
Sure. Thank you very much for having me this morning. Essentially, when we look at where estimates and expectations for GM have gone post the initial round of tariffs, there was a big hit to earnings expectations. So, for instance, GM has always had this GM&A target of 8 to 10% margins, again, for their North American business. When we look at how those tariffs have impacted them, we would say it's about a 300 basis point hit. And in fact, if you look at the second quarter, margins in that segment were about 6%. What's interesting to us is that as we look towards 2026 and 2027 estimates for GM, expectations are still in that 6 to 6.5% range. And we see a path back to 8 to 10%, driven by a number of levers that GM has at its disposal. And one of them is actually a little bit of tariff relief. So, for instance, even though it's not officially finalized yet, there is sort of an agreement in place with South Korea to move that tariff rate from 25 to 15%. GM does actually import a number of vehicles from South Korea. We estimate that's about $1 billion annualized. While we're not counting it and it's not in our model, we believe the odds are more likely than not that there could be potential relief on Mexico, which obviously a lot of vehicles are imported from Mexico for GM and U.S. autos broadly. And, you know, that rate is still at 25%, where you've seen the EU, as you mentioned earlier, go to 15%, Japan, Korea, also 15%. If that were to occur, that would be about another $1 billion or so. Now, the other main factor I want to sort of call out this morning is that there are the regulatory environment in the U.S. has meaningfully changed. So that has a couple of functional applications or for GM and U.S. autos at large. The first is they don't need to buy credits from Tesla or other EV makers to be compliant for GHG, carbon, or even fuel economy in some cases. In 2024, GM expensed about $1 billion of those credits. Now, in 25, we think that's a smaller amount, but that still is, I think, a tailwind headed into 2026 and beyond. And the final thing I'd say, again, is that because of the regulatory environment in the U.S., the automakers, including GM, really had to sort of move their mix towards a certain level of vehicles, including smaller cars, including some of the loss-making EVs, and away from the large and profitable full-size pickup trucks and full-size SUVs that these companies make. So we estimate, on average, for instance, those higher profit vehicles, you know, might have a variable profit of about $17,500. If we take everything else GM makes, and a variable profit of about $6,000 per vehicle, and we just assume a 1% shift from low margin to high margin, which is only a little bit over 30,000 units. It's not even that much. That is worth $400 million. So in 1 year, maybe 1% is reasonable. Over a number of years, we think that can continue to move higher. And we see evidence of this because GM has announced a $4 billion investment in the U.S. Some of that is reallocating capacity from Mexico to the U.S. because of trade policy, but a portion of that is for their full-size SUV. And what's interesting to us about that is all the full-size SUVs are already made in the U.S. So this is clear incremental capacity. To us, that's a signal that they think there's more demand for the product. It's demand that was probably artificially capped because of regulatory policy. And those are very profitable vehicles. So at full ramp, that could easily be, over a number of years, another $1.5 billion to $2 billion for GM.
We just have about a minute left. I'm just wondering how much your upgrade really includes moving production back to the United States, even at potentially a higher cost.
Yeah, it really doesn't contemplate a lot of that, especially for 2026. In 2027, we do anticipate that there are more vehicles built in the U.S. because of policy. And clearly, there is a wage rate differential between the U.S. and Mexico. But also, we think with new manufacturing techniques, some new automation, for instance, there's ways to sort of help offset that differential.
Joseph, thanks for making time for us. Appreciate it. Joseph Smack there of UBS, an interesting call following his call just yesterday to upgrade that price target to a street high on General Motors. USMCA is going to be the big focus for these names into next year.
Absolutely, especially since we already see Mexico coming on board with the United States is doing. For these automakers, they actually are at the moment, a lot of these parts are tariff exempt because they are in the condition right now as being USMCA compliant. The problem is, for these automakers, is they need to see where the Trump administration wants to move on the margins, this trade deal, and it's going to mean a lot for them in terms of their supply chains.
Got some news from CarMax just moments ago. Not good numbers.
No, they missed their estimates by a significant amount. The idea that it was 64 cents earnings per share results versus the estimate of $1.03. What I find notable, and I'd love to dig more into this, is that used car prices were actually lower and used car volumes, resale volumes, were substantially lower. I'm curious as to why. Is this because of an increase in the incoming new vehicles, or is this the lack of consumer demand?
Stock is down by almost 6% so far this morning. Up next on the program, we'll catch up with Scott Cronin of Citi, Heidi Kriber-Rediker of the Council on Foreign Relations, Ozan Tarman of Deutsche Bank, Matt Hornbeck of Morgan Stanley. The second hour of Bloomberg Surveillance up next.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that three-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
The economy is absorbing a stagflationary shock.
A lot of the strength in the economy is being driven by things like consumer spending.
There's still a lot of uncertainty about which way the economy breaks.
We think that the yield curve is kind of in equilibrium here.
The spreads are tight, but yields are right.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. 2-day slide on the S&P 500 could become day 3. We're down 0.1% on the S&P, down by 0.2 on the Nasdaq 100. In the bond market, price and yield shaping up as follows. Yields higher by not even a basis point. The 2-year at 361. Going into this data point at 8:30 Eastern Time. Another read on the jobs market. Jobless claims just around the corner.
Yeah, is there a sense of a reality check, a gut check, if some of the economic data starts coming in significantly softer than people previously expected? I keep wondering, what's the bigger risk right now? A reacceleration that actually does fuel some form of inflation, or a melt up that defies even some of the more optimistic outlooks? Or is it a downturn in the economic outlook? It could break either way, as we were talking about, but this is really the key question, and which data point is going to really be the kicker to make that deciding factor.
Seemingly stocks are priced for one and not the other. Stocks are priced for a pickup and a reacceleration. Based on that, you'd have to imagine the risk is that we don't see it going into 26. Are we seeing any validation of that whatsoever? Working our way into Q4, closing out Q3.
Yeah, we are. I mean, that's the bottom line, but not everywhere, right? I mean, we just saw CarMax underperform. Big question as to why and what this means about consumer demand, particularly at the lower end of the income sphere. On the other hand, some of the big tech giants that were worried about getting into bubbles, et cetera, have delivered. Their earnings have been incredible. And even as they make these big investments, they've been largely doing it with cash, and they've been delivering the earnings to show for it. If that continues, well, maybe this is something different.
Jobless claims, 830. We're looking for 233. Previous week, 231. Those are decent numbers. Based on that, that's a strong labor market. But there are people on this Federal Reserve right now very concerned. Governor Bowman, Governor Myron, who thinks that we should be moving a lot more quickly, much more aggressively.
And Governor Myron's going to make his case right here on this program. And he really thinks that, and he says his opinion's not going to change until the data changes. And right now, he thinks that we are just way too restrictive in this economy, and he's going to continue calling for this 50 basis points of cuts. This is going to be challenging, though, for Fed Chair Jay Powell in his final months of running the Federal Reserve. How does he coalesce the different thinking when you have other members of the Fed coming out still saying they are concerned about the other risk, which is inflation, and the fact that the economy is still working through the one price adjustment when it comes to tariffs?
That conversation with Governor Myron about an hour away, 8:15 Eastern Time. Look out for that. Coming up this hour, we'll catch up with Scott Cronin of Citi as investors question the AI-fueled rally. Heido Kruber-Rediker of the Council on Foreign Relations joins us as the U.S. offers Argentina an economic lifeline, and Matt Hornback of Morgan Stanley on a divided Federal Reserve as they watch for fresh labor data. We begin this hour with stocks finding some stability following 2 days of losses. Scott Cronin of Citi assessing the present value of future growth, writing the biggest question facing U.S. equity investors is whether the growth expectations embedded in markets can be met, if not exceeded. Scott joins us now for more. Scott, good morning.
Great being here, Jonathan.
Hey, it's good to see you in person here in New York. Thank you, sir. I wanted to share another quote of yours with our audience. Enjoyed this note. The S&P 500 pricing in a forward growth expectation in a manner that has only existed 2 other times in the past 30 years. Just how aggressive is this pricing?
Well, I think we know for some time we've been pricing in soft landing, if not Goldilocks, right? But that's where you begin to layer in the influence of tech and the AI spending, you know, the paradigm that's underway here. And what happens is that the market is pricing in our view, an extended period of acceleration and fundamentals related to this, okay? So what does that map to historically? And we pulled out this tool we use, present value of future growth, We last used it back in 22, in the spring of 22, when we were navigating recession risk and we were trying to determine how deep the sell-off might be. And at that point in time, we say, well, look at on this measure, right? The S&P 500 is paying almost nothing for future growth. All the value in the index was predicated on the present value of flat earnings, okay? So you hold that concept for a while. When you're at that point, say, wow, it's pretty good optionality to say that over time earnings are going to grow, I'm going to be bullish, right? In which we did back at that point in time. The risk reward skewed positive. Now we're flip side, right? Now we've come kind of full circle to where we're looking at how much of the market's value is, it can be justifiable according to where future growth is right now, and right now it's approaching 50% of the value. We've seen this in two periods previously. One was 99, going into the 2000 bubble burst, if you will, and then the other was in 21, when we're coming out of the COVID risk-on rally, right? Which, remember, a lot of companies got caught up in, hey, this growth dynamic is going to perpetuate. It didn't, right? So the bottom line here in all of this is that this is an issue. The market clearly is pricing in a decent amount of expectation for forward growth. We get it. The AI, the storyline fits that perfectly. What's so interesting about this, though, is that this doesn't mean you have to run to the sidelines. Back in previous periods, when you've had this much of the market pricing in that future growth, the median returns for 12 months is 7%. The point being here is that as long as the fundamentals continue to come through, you don't have to wig out on the valuation. And that's where we kind of go back and forth with, gosh, is the market rich? The market's rich if you don't think the earnings are going to grow. The market's fine if you think you're going to continue to see this earnings tailwind, which I think, increasingly we're very comfortable predicating a view on.
Well, let's talk about the market and what the market is. So this is index level analysis. Can you break it down, tech, ex-tech, whether it's the same story or whether it's different?
Yeah, so that's even, so in our view, okay, in the work we've done previously, is that we're suggesting that roughly half of the S&P 500 is affected by AI. So let's call it AI affected. That leaves the other half. That's going to be much more traditional, okay? So we know that we're essentially trying to navigate dual markets here. One is this AI thing that we're talking about persistently right now. The other is everything else that probably ties back more to what the Fed's doing, what the economy is doing, so on and so forth, the traditional macro condition. Interestingly, both parts of the market are equally priced versus their history on things like PEG ratios and future growth and future valuations. So nothing is being given away here, right? No matter where you look in this market, you're predicating a view on something improving, either that AI influence on fundamentals for the tech and related part of the market, or on the gradual benefit we're going to get from lower rates supporting a pickup in economic activity going into 2026. So we're out there and extended. And again, it's not shaking us. It's just saying, when looking at the risk reward here, the importance of companies continuing to support all this with fundamental improvement is the big storyline for us.
This bifurcation, these different markets, how much has that been the reason why this is a market that's less sensitive to economic data? It's a market that's less sensitive, longer term, to even some of the Fed policies, like raising rates to where they had been.
You're spot on. I'm going to get myself in trouble here a little bit, because I'm going to say the Fed hasn't really mattered for the past 2 years. We had a different sheriff in town. That's really been the issue here, and that's been, we're at least 2 years into this AI spending infrastructure development tailwind, right? And it's negated a lot of the historic views on how you think about the Fed condition. I mean, a year ago, we were writing a note on cycle limbo. Basically, we didn't think there was any economic cycle in a historic perspective, because the business cycle itself had been influenced, to a certain degree by what you're beginning to see in terms of the CapEx that's been unfolding related to AI. So the game has changed, and so the historical, perspectives here are certainly important, but we got to be a little bit careful in terms of how closely we expect them to give us a roadmap from this point going forward.
There is a question, though, with what Fed policy, what trajectory it does take when it comes to the other 50% of the market. Right. And Deutsche Bank put out this chart that I thought was fascinating, showing that without the overlay of tech spending, the U.S. would have been in a recession earlier this year. And this coheres with what we've heard from the CEOs of United and others in terms of consumer demand. If the Fed cuts rates, and based on what you're seeing right now, do you see a reacceleration in that other 50% that could lead to some sort of leadership differential in the market?
Yeah, so we're talking about this broadening thesis, and I think it's really important here. And the way I think about it is, again, I'm not the House Fed watcher, but what I will say is that from my perspective, the Fed should not be in restrictive policy right now. You look at 2 years of sort of a non-existent industrial production growth. You look at some of the signs of stress you're seeing coming on the consumer side, and everything tells me that the Fed should be at least towards neutral, if not potentially stimulative. Now, when you look at within the market, though, how does that play out? Well, you go down the small mid-cap space. Much less of this tech influence, much more traditional economic sensitivity. Small mid-cap's been in an earnings recession for 2 years. You've had negative earnings for 23 and 24, and you're just now starting to show signs of an inflection.
Well, but doesn't that create a bubble? I mean, honestly, don't you get more leveraged, fueled build-out of AI that ends up creating the bubble that you're worried about?
Well, okay, this is where I'm going to take it down a little bit different path. So, yeah, so what I'm suggesting here is the broadening narrative is important, but in terms of how the index continues to march to new highs, well, I'm going to argue that I need this AI-influenced tech component participating, right? But the path to a higher index level is now I get other sectors that begin to contribute positively to the price action. And you look at the bifurcation of sector performance this year, it's pretty stark. You know, we've had this mega cap growth tech leadership, got it, very clear on what's driving all of that, yet other parts of the market that are still trying to find footing here.
The Fed chair said this week that stocks are fairly highly valued. When Alan Greenspan talked about exuberance in the market, then the market went on a 4-year bull run. Is that where you think we are? 4 more years of this?
You know, we talk about, you know, there's as much melt-up risk as there is meltdown risk, right? And so we have to go down that path. Exuberance is a tough word. It's a tough word. What I would just say is that the expectations for performance fundamentally to follow through here are big and growing. Now, you know, there's other elements of this. You know, we talk about the productivity enhancement that potentially comes from AI, and this is a big story. As it turns out, you know, at an index level, your sort of EBITDA margins have been improving pretty persistently over the past decade. You already have sort of an improving quality dynamic that's at work as a function of the read-through of the increased capitalization of these mega cap growers, okay? But, you know, I can also look at the S&P 500. I like to show a chart that looks at the employment for the S&P 500 over the past year. It's flat. So Q2 25 over Q2 24, no net gain in jobs within the S&P 500. Sales per employee, though, looks like this. It's up and to the right. So as you talk about the market's expensive, it's euphoric. At the same time, there's something happening here where you're getting more productivity out of your workforce, and this is where you come back to the AI opportunity for my perch. If it puts us in a position where corporate America, I'm thinking mainly large cap equities at this point, are more persistently profitable, then you know what I do? I assign a higher terminal value to that company. I'm able to justify a higher through-cycle valuation for the companies in the index.
Scott, this was super smart. I just wanted to finish on one thing. You lived 99 and the late 90s, and I get that every bubble is different, but are there things that you experienced then that you're seeing now? Is there a lesson then that you would apply to this period?
Yeah, I mean, there's a couple of lessons, right? And I think we have to expect that as you go down this path, there's going to be a lot of tag-on companies that do find the way to markets with the next novel element of this. A number of things were going on back in the tech bubble. I think in general, you know, we overcapitalized the internet infrastructure build-out, but at the time, what you were doing, a lot of the times, you know, these companies weren't projected to have positive cash flow for several years. And so your price targets were, again, a function of where you thought terminal value 10 years down the road was going to be. Not a really good place for if things begin to unwind fundamentally, right? I do think that the nature of the companies involved in the spending right now, where it is coming out of free cash generation, is incredible, right? And it's very powerful. And these companies are able to do this without compromising other balance sheet machinations. For example, last I checked, 5 of the 7 Mag 7 are still net reducing fully diluted share count, right? Which is a pretty impressive place to be. So I think we're in pretty good shape in terms of the foundation of the companies making the investments. Now we have to allow the big potentially get bigger here. As a function of that free cash generation, what are you able to do? Moat build. Right? So it should not be surprising to see a lot of the acquisitions, the partnerships, all the things that happen. Well, you can do that when you have a lot of financial flexibility. Tech bubble, a little bit less. You did have the companies doing business with each other. Source of the revenues, though, was more IPO and fundraising than it was traditional free cash, a different setup.
This was a super sophisticated conversation, so forgive me for asking the following question. Can we put a price target on this? What's the price target for next year?
Well, we're base case 6,900 for mid 26, right? We haven't done our full year 26 numbers. We'll do that a little bit later. Like to get the 3Q earnings behind. But, you know, that's why we've been going down this base bull and bear case. And it's I don't want to say it's a cop-out. It's just it's recognizing that there is this different driver in place right now. And you know, we all kind of get caught up on being wary of not wanting to build too aggressive of a valuation into our expectations.
Scott, right? Super smart. It's good to see you in person too. Thanks for dropping by. Thank you, sir. Scott Cronin there of Citi. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahara Arnad. Hey, Yahara.
Hi, John. Turkish President Recep Tayyip Erdogan will make his first visit in 6 years to the White House today. Sources telling us here at Bloomberg the meeting is expected to clear the path for Turkey to buy U.S.-made products like Lockheed Martin fighter jets, Boeing planes, and liquefied natural gas worth more than $50 billion. Meanwhile, copper is extending gains after an accident in the world's second biggest mine. Freeport-McMoRan saying it might not be able to meet its supply contracts at its Grasberg mine in Indonesia after a mud rush incident. This as the global copper market already faces supply disruptions and soaring demand due to AI. And we are seeing shares of CarMax fall 8.4% in the pre-market after reporting second quarter earnings that came in well below analyst estimates. The used car retailer reported earnings per share of 64 cents, well below the Bloomberg consensus estimate of $1.03. Net sales and revenue also coming in light, falling 6% year over year, primarily driven by a 7.2% drop in used car sales. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes' time. Up next on the program, supporting Milei's Argentina.
It's very hard to believe that it is different this time, but I believe with President Milei, it is. We are not going to let a disequilibrium in the market cause his backup in his substantial economic reform.
That conversation up next with Heidi Fribo-Rediker of the Council on Foreign Relations. Live from New York City this morning. Good morning.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back to the program. Equity futures on the S&P 500, negative here by 0.3. We're down about 0.4 on the Nasdaq. Near session lows now across the board. On the Russell, small caps down by 0.39. Under surveillance this morning, looking elsewhere, supporting Milei's Argentina.
People are concerned. People are skittish. It's very hard to believe that it is different this time, but I believe with President Milei, it is. We are not going to let a disequilibrium in the market cause his backup in his substantial economic reforms. I don't think the market has lost confidence in him.
So here's the latest this morning. The Treasury Secretary Scott Bessent reaffirming America's commitment to supporting Argentine President Javier Milei, praising his tireless efforts to make Argentina great again at a gala in New York. Bloomberg's Tyler Kendall joins us now for the latest. Hey, Tyler.
Hey, John, good morning. Well, this potential $20 billion lifeline is seen as much-needed financial support for Milei as he seeks to regain investor confidence and stem a run on his nation's currency amid concerns with his own economic agenda ahead of some key midterm elections there next month. Now, the Treasury Secretary, Scott Bessent, does say that the terms of this deal are still being negotiated, but the fact that this deal is being made at all is effectively seen as the U.S. propping up a key ally of President Trump on the world stage in a region where China has made significant inroads, including in neighboring Brazil, which we know isn't on the best terms with this administration as it faces that 50% tariff, though President Trump does say that he has plans to meet with the Brazilian President Lula next week. I'll also quickly point out that this really does mark a shift for the administration, considering that President Trump campaigned pretty heavily against financial interventions abroad, but Argentina does appear to be that one rare case. John, you mentioned it at the top there, but the Treasury Secretary Scott Bessent did tout Milei yesterday during this gala here in New York City, saying that he is laying the groundwork for a golden age in Argentina. That, of course, echoes what President Trump told the United Nations General Assembly earlier this week, but in terms of the U.S. being in a golden age.
Tyler, thank you. Tyler Kendall with the latest. Joining us now to extend the conversation, Heidi Kribo-Rediker of the Council on Foreign Relations. Heidi, welcome back to the program. Just want to build on some of the thoughts of Scott Bessent, the Treasury Secretary, who talked about supporting the economic reforms of Argentina. Can we talk about the regional politics? Why are the reforms of Argentina so important to this White House?
So I think that Milei has really made some tremendous progress with an economy that has been a chronic defaulter and had suffered with huge problems over many decades. So he's brought inflation down beyond where anybody really could have expected and stabilized the currency. So I think everybody was really hoping that the reforms would actually take. But Milei lost support in a regional election recently, and there's an upcoming election on the 26th of October, where if Milei loses support in this nationwide midterm, then he'll have a very difficult time pushing his reforms forward, and the markets know that. And so he's faced a lot of instability in the past several days. Last week, they ran through about $1 billion plus of their reserves just defending the currency. And so I think really the ambition is for this White House to step in between now and October 26th, give the markets short-term stability in a whatever it takes moment, and put, I think the devil is really in the details with the use of the Exchange Stabilization Fund, because that's actually tricky. It's tricky in any circumstance, but Argentina is a very unique circumstance.
Well, also, I sat down with the Treasury Secretary in Argentina in April when he was there to meet Milei, and this wasn't on the table then. And when the Treasury Secretary talks about it being negotiated, the Treasury can't give a swap line. Only the Federal Reserve could. And if it is going to be a loan, then Argentina's Congress needs to vote on it. So what exactly is the U.S. willing to do?
So, I mean, that's the big question. And as you rightly point out, the Fed gives swap lines. The Treasury does not, and it does not use the Exchange Stabilization Fund for that purpose. There are conversations, if you do use that $20 billion-ish of liquid assets that are within the ESF, then, you know, the U.S. government has a process to basically price the risk of the use of those funds. And that's a conversation, this is a little in the weeds, but that's a conversation with OMB. How do you price this risk? And are we going to put this on the table for Argentina? And how are we actually going to do that? Are we going to make the same bet? I mean, this echoes, you know, what Trump 1 did in supporting a massive IMF program for Argentina back in 2018. And the IMF lent $50 billion to Argentina and took a big political risk and sort of lost that risk. And so the question is, if we do this, how do we structure it to protect taxpayers? How do we do it in a way that is useful for Argentina without putting taxpayer funds on the line that it might lose? And and really at the end of the day, how can we do this? The swap line, I think, is just terminology to make it simple for the headline. But this is actually a very complicated financial engineering exercise that's going on.
Well, China has a swap line with Argentina. Is this also the U.S. maybe countering China in South America?
Absolutely. I mean, that's part of it. Not only is this a relationship that I think is real and substantial between the Trump administration and Milei, but China has an 18 billion RMB swap line, and it could be this could be wound down. I don't think that China. I think that the U.S. would really like to see itself be the dominant player in providing any kind of support that Argentina needs. Argentina also is very resource rich. And I think this would be a strategic play as well for the U.S. in a very strategic part of the world, Latin America, where it was pointed out we don't have a lot of great relationships.
It's true. It's a good point. Heidi, thank you. Appreciate it, as always. Bramo, you know that region well, and you've seen that influence of China down in South America.
It was shocking to see how much they have really made inroads in places like Peru, in places like Chile, in Brazil for sure, as they try to lock down some of those key minerals. And the question is, what is the U.S. going to do to compete?
Coming up on the program, we'll catch up with Ozan Tarmat of Deutsche Bank, shrugging off concerns of an AI bubble. Plus, Danny has your morning movers. CarMax falling short of street expectations. That stock is down by almost 11%.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Two-day losing streak on the S&P 500, about to become day 3 if we don't do something about this. We're down by about 0.3 on the S&P 500, negative by 0.4 on the NASDAQ. If you switch up the board and get to the bond market, 2-year, 10-year and 30-year bond yields. 2-year yields this morning higher by a single basis point, 361.44, up a single basis point on 10s to 416.20. In about an hour from now, another read on the labour market. Jobless claims at 8:30 Eastern Time. That is just after an important conversation we're having with a key member of the FOMC, Governor Myron, joining this programme in about 45 minutes' time. Look out for that in the next hour. With 2 hours to go until the opening bell, let's get you some morning movers, some single names. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. It continues to be the top mover this morning, and it is Intel getting all the attention, up 1.8%. Not as big of a boost as it was just an hour ago, but even so, trading this higher on a report from us that they are in talks with Apple about getting some funding from them. They're also, this is early stages, I should say, still trading off of it nonetheless. The two are also talking together and how they can work more closely together. So Intel shares rising off the back of that. Also in the last hour, we got earnings from CarMax, and they were tough. Both prices and sales of used vehicles fell and missed estimates. In fact, used car sales fell by about 7%. The CEO called it a challenging quarter, but it's been a challenging year for CarMax. Shares are down 30% year to date. You add some weight to that, down nearly 12% in the pre-market. Finally, this is a story that's been getting a lot of attention, and that is HSBC saying that they have achieved a breakthrough in using quantum computing in financial markets. They did it with an IBM processor, so it looks like IBM rising off the back of that, up 3.2%, but it allowed them to better predict the price of bonds by more than 30%. It's a key technology for the likes of IBM, and this is a very clear and real world use case for it. John?
Very cool. I imagine we'll see much more of that still to come. Danny, thanks for that. On our radar this morning, one of our top stories, the White House telling federal agencies to prepare for mass firings as the threat of a government shutdown looms. President Trump cancelling a meeting with Democrats, calling their demands unrealistic. Elsewhere, U.S. Treasury Secretary Scott Bessent praising Argentina President Javier Milei for his tireless efforts to make his country great again. The comments coming as the U.S. moves to save the nation from financial crisis. And finally, the San Francisco Fed President Mary Daly suggesting further rate cuts are likely needed to support the labor market. But the Chicago Fed President Austin Goolsbee warning against a series of cuts, seeing the jobs market as, quote, mostly steady and solid. Some division between those two.
Yeah, although finding the division is like combing through sand to try to find hairs, because Mayor Daley also said that she doesn't see a weak labor market. She just doesn't want to see it weaken further. The reason why people are so confused is because you have the likes of the big tech companies coming out reporting high earnings. You have the likes of airlines coming out, executives saying that there's a reacceleration in purchases. And then you have CarMax, used car prices going down, people buying fewer cars. You have the likes of Starbucks coming out this morning, having a restructuring plan as a result of sluggish labor growth and this lack of consumer demand. There are confusing stories, and Fed officials are struggling with them.
Which is why they're so divided. They are divided over just where neutral is, how restrictive we actually are, how restrictive we should be, and to have that conversation openly, you need to agree on an end point, a start point. None of them agree on where neutral is, and I understand that, but ultimately that's the source of a lot of the debate, a lot of the division on the FOMC and the dot plot.
Yeah, and I don't have a lot of confidence in what exactly the reaction function is to either a weaker jobs print or potentially even a reacceleration in inflation. One thing that Mary Daly said is that recession risk is very low, talked about how she doesn't want to see a worsening in the labor market, but then Austin Goolsbee talking about inflation still remaining above target for so many years. At what what point does that become a preeminent concern?
That Fed conversation continues in about 40 minutes' time. Look out for that conversation once again with Governor Myron. Let's turn to tech. Following weeks of massive investment announcements, there are growing rumblings of an AI bubble. Ozan Tarman of Deutsche Bank shrugging off concerns, saying those crying the loudest are the ones who missed the trade. Ozan joins us now for more. Ozan, good morning and welcome to New York.
Wonderful to be here.
It's always a bubble when you're not in it. Is that the takeaway on this one?
Definitely. There is a little bit of bitterness, defensiveness. But that being said, maybe for this show, right the night before, I held this big macro dinner, almost 30 clients, friends, sovereign wealth funds, hedge funds, real money. At the question round session, questioning the bubble, questioning that closed circle, AI to NVIDIA, to Oracle, questioning where we are in the labor cycle. But then trade idea session, gold S&P, long EM. So even for me, as somebody, we exchange messages. You guys know it's like being in the family. I do believe in the risk parity. It's been a great call since the April 9 fear. But to music to Lisa's ears a bit, this is a bit too much. I sense a bit of a fly in the soup. Even today, like they talked up. How do we start? Again, red. Nothing major, but red. These memes flying around on gold, on AI. Don't get me wrong. I think when I come back, either from London or here in December, I think we'll still be talking positively about gold, about AI, about NASDAQ. But fear of missing out is turning into a bit of orange sign.
Can we just build on this a little bit, the relationship between risk and gold? What the traditional relationship typically is, and why it's developed into something else. Why is this the long call on both gold and the NASDAQ? What's the relationship between the two now?
Very good question. It's working on risk on and risk off, John. So obviously, orthodoxy at this moment, it should work because finally, they're not exactly going Stephen Myron's way, but they are cutting. So that's going to help gold. But before that, because of everything going on in geopolitics, Russia, Ukraine, central banks feeling much better when they hold their reserves in gold, it got a big trigger. Besides that, as you know, FX at the end of the day is storytelling. You need a dollar, but you need the other side of the story as well. Even though I'm Deutsche Bank, I share some of your anxiety on what's going on in Europe, on engine of Germany. We can go into our dear island UK, Japan, China laggards. So where do you go? You don't like the dollar for very understandable reasons. Soft dollar is working, but you need somebody, some horse that keeps running, and that's gold.
Well, this sort of goes to the question of what could possibly disrupt these trades. And right now, the feeling is that the only thing that could really disrupt some of the long tech trade would be earnings that didn't come in more positively. Do you see it the other way, that you think that actually more negativity in the economic growth picture has the bigger potential to be that disruptive factor to cause the 3% decline?
I do actually, because November 19, even if NVIDIA's so-called misses, we can find another good story in another earnings. But all of us, you know how these markets are narrative, markets are storytelling. 3 more days like this, Jonathan will open the show a little bit differently. So
please tell us how he's going to open the show.
No, he's going to talk about these orange signs more and more. Also, one thing that I want to keep in the radar, because macro, we need to talk about rates as well. Supreme Court. These tariffs, talking about narratives, all the way from January to April, Tariffs was the bad guy. Oh, he's going to do this, that, lightizer, 1930s, and because of that, TY was going to go to 5%, Euro was going to 0.95. All of a sudden now, tariffs are the good guys. Maybe he was right on certain things. Revenue, big revenue generation. On Twitter, my dear friend Torsten's talking about it. My research is talking about it. So if Supreme Court blocks this, that's off the left field. I know Anne-Marie will say maybe 301, they have their plan Bs, etc. But that's going to take 4 to 5 months, and that can finally move the long end.
I love how we don't even have to ask the question, so Zod already knows what we're going to say.
Interested.
Exactly, which I love. It's fantastic.
I listen to you guys. This is Champions League.
Okay, fantastic. I will just say, though, that this is one reason why people keep buying big tech. And even though they're worried about valuations, that's the one area of growth that's kind of powered, really, the U.S. economy out of potentially what could have been a recession otherwise. Isn't that the only clean trade right now, given all the hair on the narratives that you're talking about?
Agreed. With gold aside, gold as well, works on risk off. That's why even, look, I'm a macro guy. Even if we have when I poll people and they all go for higher, the lower end of that was 3%. If we get for this or that reason 3% correction on S&P, my binky will probably come out on this show and say, buy the dip. As important as Binky, retail, who want this way or another beat the professionals since April 9, that big panic day, on buying those dips, will continue to believe. So that, even my scenario of Supreme Court stopping the tariffs, etc., we need something else. We need more DeepSeek moments. We need to question all this close circle between OpenAIs and Oracles and NVIDIA. I'm not sure we're there. Maybe 2-3% correction, but doomsday, I don't see.
But the Supreme Court stopping the tariffs, won't that be bullish for equities?
I hear you. At the end of the day, they will say, look, then they'll have to do more fiscal, even more fiscal loosening. Equities may find a way to see that as glass half full as well. That risk would be the bigger trigger for the long end. We came into summer, end of summer, waiting for these famous trust moments everywhere. UK, France, Japan, of course, US, big beautiful bill. It happened for 4 hours on September 2, led by my island. And then look what the long ends are doing now. So steepener crowd, do you hear them now? Much more quiet on these studios, on the on the macro dinner roundtables. Maybe they're waiting for something new, and that can be their catalyst, at least in US.
When you have these dinners and you're talking to investors, as you say, real money, are they concerned about what we're seeing out of the US government and taking stakes, and then basically companies maybe wanting to have a better reputation with this administration, considering even investing in those companies the US government cares about?
Very good question. I completely hear you. Intel, Apple, right? They do. So because of that, maybe we have a world in which NVIDIAs keep rising, but dollar also keeps eroding a little bit. So in that sense, it's not exactly a Thatcher-Reagan world, is it? So for many different reasons, this institutional decay, different approach to US, seeing more, how do I put it, Hungary, Turkey, Argentina-like developments in Treasury, Central Bank working together in our USA as well, that makes people hedge more. The important hedge ratios. My partner in success, George Seravalos, I think a very important piece. Everybody was questioning, okay, Ozan, you guys are saying sell the dollar, but if NVIDIA, Microsoft, Meta keeps going higher, that has to help the King Kong dollar. Well, no. If they are hedging, hedging when they buy their NVIDIA, maybe we can have this equilibrium in which dollar remains soft and NVIDIA continues to go higher.
Ozan, just a final question. What's the difference between appetite to take risks right now, comparing the investors you've dined with this week in New York to what you experienced on a weekly basis in London?
Beautiful question. Much more US-centered. Doesn't care that much about France worries, Germany, when that stimulus coming, etc. I would say still almost sucked into the equity and credit trade. Look at Oracle yesterday, 3 basis points, 3 basis point concession, that's it. So whether they like it or not, they almost get sucked into whether I give the orange signs or no, into equity and credit. Much more quiet money on the rates and FX. Unfortunately, I'm a macro guy, I need to talk up volatility, but the trade at the moment is volatility is on its knees, and we need some surprise. Otherwise, FX and rates traders continue to sell those straddles.
Dare I say things are quiet compared to the rest of this year so far, at least. Ozan, it's good to see you.
I love being here.
We'll catch up again soon, no doubt. Ozan Tarman there of Deutsche Bank. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. The FBI says the deadly shooting at a Dallas ICE facility was targeted. 1 detainee was killed and 2 others were critically injured. The shooter died of a self-inflicted gun wound and no law enforcement officers were hurt. It's the second attack at a Dallas area facility of ICE in recent months as the Trump administration ramps up mass deportations. Meanwhile, Starbucks announcing that it plans to close a number of stores and eliminate 900 jobs. Starbucks announced that the closures will focus on stores that have underperformed, with the company poised to focus on making its open locations more inviting to visit. The move comes amid a $1 billion restructuring effort undertaken by CEO Brian Niccol. Shares are slightly in the red. And in sports, New York Yankees superstar Aaron Judge made history by becoming just the 4th player in history to reach the 50 home run mark in 4 separate seasons. Judge hit both his 50th and 51st of the season against the White Sox. Judge is second in the American League this season behind Mariners catcher Cal Raleigh, who became the first ever catcher to hit 60 in a season. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. You just have to look to the one side.
I'm so excited for him.
With the merch and
Mark
everything.
McGuire, Babe Ruth, Sammy Sosa. It's an incredible list.
Okay, good stuff. All right.
Cheers.
To you. Yeah. Up next on the program, a divided Federal Reserve.
Now, my own view is that further policy adjustments are likely. Will they come right now, this year, or going forward? It's hard to say.
Matt Hornback of Morgan Stanley joins us in just a moment, live from New York City. You're watching Bloomberg TV.
When we look at the businesses in the UK and the business in Switzerland, is our view that those businesses are subscale, and the amount of capital that it would have to go into those businesses to get it up to scale to meet our strategic ambitions would be misplaced. SPAR being where it is and how competitive the South African market is, we really just want to refocus on our home markets. Our liquor brand, Tops, has been around for also about 25 years. And through independent retailers, we've become the single biggest retail liquor brand in this country. Our business has the ability, and our independent retailers have the ability to compete directly with the chains. And we are now the second biggest supermarket brand in this country.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Live from New York, welcome to the program. Under surveillance this morning, a divided Federal Reserve.
Now, my own view is that further policy adjustments are likely. Will they come right now, this year, or going forward? It's hard to say. But what's really important is that making those policy adjustments will likely be required to balance both of our goals. Keep pressure on inflation to bring it to price stability and offer support to the labor market to ensure that it stays near full employment.
So here's the latest this morning. Fed officials offering more insight into the division of the FOMC. San Francisco Fed President Mary Daly saying additional rate cuts are likely needed. The Chicago Fed President Austin Goolsbee telling the Financial Times he's not comfortable front-loading cuts on transitory inflation arguments. Matt Hornback of Morgan Stanley joins us now for more. Matt, good morning, sir.
Good morning. It's great to be here.
It's good to see you. You put in your note, and I think this is important, within the dot plot, embedded in that, is an important debate about where neutral is. Can you build on some of that?
Absolutely. I mean, when you look at the dot plot, it's very clear that in 2025, there are two camps. And this division has been pretty clear in all of the dot plots so far this year. What becomes a little bit more murky is when you go beyond the 2025 dots, what happens to these camps? And I think you can divide these two camps into a camp that believes that neutral rates are higher and a camp that believes that neutral rates are lower. And it's interesting, they both agree that policy should be moving back towards neutral, and they almost agree on the time frame over which policy should move back to neutral. They just seem to disagree on where neutral is. So I think what's interesting is the speech by Governor Myron this week was talking about this concept of R-star being lower. I wrote about this last Friday. I did not know that Governor Myron was going to give a speech on R-star, but I wrote about this last Friday, which is maybe why I'm on the show today. But what I was talking about is a concept that was actually offered up by our chief U.S. economist, Michael Gapin, who is talking about the changes in labor force growth and how those changes in labor force growth over the past couple of years have probably been a very important driver of potential growth. And then there's this natural link between potential growth of the economy and equilibrium interest rates. So one of the more interesting things that has come out of John Williams and his group previously at the San Francisco Fed and now at the New York Fed is a model that tries to estimate where these things are. Where is potential growth for the economy and where is the equilibrium interest rate? Prior to the great financial crisis, both of these model estimates were the same thing. They moved in the same direction at the same time. And so if you believe, as many people do today, that we are beyond the secular stagnation period for the U.S. economy, then you must believe that as potential growth slows, R-star, or equilibrium interest rates, also go down. And that's kind of the point that I was making in my note.
So Governor Myron is in the mid-twos. Where are you in the team?
So Michael Gapin and team believe that R-star is likely falling. They're not at the 3% that the median FOMC participant currently finds themselves. Not speaking for Mike, but I would guess that he's going to be somewhere in the mid-twos on R-star. So not dramatically lower, probably not as low as Governor Myron is, but you know, that's where I think he's probably going to be.
If that's true, why haven't rates where they are torpedoed the economy?
Why haven't rates torpedoed the economy? Well, okay, let's talk about how we measure change in the economy. Typically, people look at this in year-over-year terms. So let's talk about inflation. Inflation at 2.8, 2.9, 3% core PCE on a year-over-year basis. That's where inflation has been over the past year. But what about the next year? Right, we think inflation is going to continue to move lower. Once we get past this little bump related to tariffs, same thing for growth, Letha. I mean, we have real growth in the economy in the mid-twos, but next year we think it will be in the mid-ones. So policy is restrictive on our estimation, and as the Fed gradually lowers interest rates on our forecast, they're really just going to be keeping up with the decline in R-star. We don't see them taking policy into accommodative territory.
So if that's the case, you potentially think that there is a greater risk of recession or economic downturn than the market is accounting for based on where rates have been, given how long they would have been quite restrictive. Is that correct?
Absolutely. I mean, the recessions in the U.S. don't occur that often, clearly. And we haven't had a normal recession since before the great financial crisis. I mean, you could even argue that in 2001, that wasn't really a normal recession. But the risks are rising because the labor market and potential growth have slowed so dramatically over the past 6 months.
If this is true, then wouldn't it be not a once in a lifetime, but a very good opportunity to buy the long end of the yield curve if you do believe that neutral is so substantially below where people currently believe?
Absolutely. At a 2.5% 30-year real yield, there's a tremendous amount of value And it's been there for some time. So it's not as if this is a new development. 30-year real yields have been in the mid-twos. Sometimes they're high twos, sometimes they're mid-twos. But they've been generally in that zone for quite some time. That's fantastic value. You know, investors, long-term investors who have been buying 30-year tips are probably sitting very, very well today.
When you look at what Governor Myron is saying about the policies that the Trump administration has, which basically means that there should be lower interest rates, are they also basically then acknowledging that those policies might mean slower growth?
Well, I think there's a difference between, you know, what's happening with the potential growth rate of the economy and then how the economy is actually growing from one year to the next. In some sense, that's how I would interpret it, that if potential growth is coming down, equilibrium interest rates should also come down. You know, so kind of how are you wanting to frame the argument? If the argument is, hey, we think that these policies are bad for growth and therefore the economy needs lower interest rates, that's one framing, clearly. Another framing is the potential of the economy is just slowing, and it's not recessionary potential, but if the potential growth rate of the economy is slowing, then the economy simply requires lower interest rates. It's not a let's sound the emergency alarm, let's just adjust interest rate policy to accommodate an economy that is growing a little bit slower on a potential basis.
Got about 45 seconds left. Just wanted to squeeze in the FX call. What does this all mean for the US dollar?
Absolutely. We think the dollar is going lower, John. We've thought the dollar was going lower earlier this year. We continue to believe the dollar is going lower. In general, we see it as a broader trade than just euro-dollar. We think the dollar is going down against the euro, against the yen, against the Australian dollar. We see it as more of a broad-based move, and it's ultimately because we think that real yields in the U.S. are going to continue to decline.
And against gold as well, based on a conversation we had a little bit earlier.
Yeah, I just keep thinking about what this means for the two economies that we were talking about with Scott Kroner, the idea that the economy is not the tech bubble that could be still continuing to emerge and could get fueled. It's a fascinating moment right now.
Yeah, and for the market versus the economy too,
Exactly.
which seem to be on two different planets at the moment. Matt, it's good to see you. Thank you, sir. Matt Hornback there of Morgan Stanley. Coming up next, Brent Schutte of Northwestern Mutual Life Insurance, Fed Governor Stephen Myron, Neela Richardson of ADP, Chris Heisey of Bank of America. The third hour of Bloomberg Surveillance just around the corner.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We have 2
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Clients are in the market, they're invested, they're happy because markets are at all-time high.
The key driver of this bull market has been AI and tech.
Everyone who announces plans to spend is rewarded.
The AI investment, I think, is just starting to scratch the surface.
It's when founders and disruptors show up at the same time and they collide and they change the landscape, right? And I think that's a moment that we're in.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, 90 minutes away from the cash open. The opening bout just around the corner. The scores look like this. Equity futures on the S&P 500 lower by 0.4%. Session lows on the NASDAQ down by 0.6%. Likewise on the Russell, down by 0.75%. In the bond market, 2-year, 10-year, 30-year bond yields just a little bit higher by a single basis point, 29 minutes away from this data right here. Jobless claims up next.
Yeah, a question of just how powerful or not the engine of the U.S. labor market actually is. If we get a down week in terms of the S&P performance, that would be the first down week going back to August, even at a time when we're talking about some sort of deterioration in the labor market picture. Right now, the key question is, it keeps being, are people underweighting the risk of a downturn in growth, or are they underweighting the risk of potentially a reacceleration that could potentially fuel the rally even further?
We'll speak to the man of the hour a little bit later this hour. We'll catch up with Governor Myron of the FOMC, and he's got his own thoughts on the biggest risk going into 26. He believes that if you keep rates where they are right now, you're risking some real downside risk.
And he really wants the Fed to recalibrate where we are right now in economy, especially with the policies from the Trump administration. Lower immigration, less government, borrowing, lower regulation. He thinks it is way too restrictive right now. The issue is, can he bring the Fed officials along with him? Because right now there are a number, like Austin Goolsbee, who are still concerned about what tariffs may do to higher prices and inflation.
Yeah, there's two different questions, Anne-Marie. One is how persuasive that argument is on the committee right now. The other is how credible it is with the market participants, investors, and markets more broadly.
Right now, it has been fairly credible, the idea of rate cuts. It hasn't led to a complete unmooring of the long end of the yield curve. Has encouraged people to buy gold, but that's another story. But there is this feeling that this is a difficult economy to understand and get your arms around. On one hand, people are feeling not great. They are worried about getting jobs. They experience the inflation in real time. The dual mandate of the Fed very much in conflict, but people have talked about the idea that this economy would have been recession if it hadn't been for tech spending. And that overlay is confusing things, and that is the reason why people are saying the markets and the economy kind of are looking very, very different right now.
I'm so happy you keep bringing up this Deutsche Bank note, because today in the front page of the Financial Times, they're talking about the vacuum, the hole that's being filled with Elon Musk leaving the White House and the likes of Sam Altman and Mark Zuckerberg trying to fill that hole. And an insider said this to the FT, an insider for the Trump administration: if you took AI investment out of the economy, we'd probably be in really, really bad shape. That's what this is, a marriage of convenience.
Futures right now in the S&P, if you're just joining us, down by 0.4%. The open and bout just around the corner. The next hour shaping up as follows. Brent Schutte of Northwestern Mutual as the record run for stocks cools off. Federal Reserve Governor Stephen Myron as he makes his case for more aggressive rate cuts. And Neela Richardson of ADP as we break down the latest jobs data. We begin this hour with stocks stabilizing after pulling back from record highs. Brent Schutte of Northwestern Mutual Life Insurance writing Wall Street might not want to break out the champagne just yet. The labor market continues to do just the opposite. Brent joins us now for more. Brent, welcome to the program. In just a moment, we'll catch up with Governor Myron. He's very concerned about what's happening or could happen with the labor market. That conversation's happening at the same time. The credit spreads are super tight and the S&P 500 is within 1% of all-time highs. Is that a tension that needs to be reconciled?
Absolutely. So to me, you spent the entire morning talking about the tails. And so for one of the few times in my career you could convince me that a recession is on the way, something you've talked about. You've seen the labor market weaken. We're expecting 43,000 jobs next month, which is not enough to replace the current new people entering the labor market. At the same time, core inflation is going to run at 2.9%, which makes the reality that it's been between 2.6 and 3.1 for the past 21 months. And so this is where the oddity is. Those tails are larger, yet the market and credit spreads and everything else, the thing in the middle, kind of where everything turns out just right, are still tight. And that's why I think there's quite a bit of a debate about what happens next.
Brent, you've been worried about inflation taking off next, and perhaps that story is still to be wanted to be developed, and that maybe we're moving on a little bit too fast. Brent, do you think that inflation story could constrain the Fed's easing bias?
Absolutely. We've always said the last mile on inflation would be hard after we came down from the supply constraints of COVID. And that's where that 2.9% and not being at their target of 2% since 2021 is a reality. Where do we go from here? Do they cut now and risk that inflation side of the equation? Or do they cut because of the labor market? And that's where I think there's so much uncertainty that's out there. And maybe just to kind of pile on to the economy is not the markets. I think it is. You've had the AI story hold up the economy, and the AI story has held up a very, very narrow rally in the S&P 500 for the last couple of years. It's held up a very narrow rally in that S&P 500 against small caps and mid caps, and that's where I don't think we can continue like this. We need the market to broaden back out because we need the economy to broaden back out, because what happens if all that AI spending slows?
We are seeing it broaden out, though, Brent. When you look at, for example, the other 493 in the S&P 500 and their earning projections, the earning expectations for next year, at a certain point, if the Fed is going to let inflation run hot, isn't that beneficial for stocks on some level?
Yes. And so to me, this is where you have optionality. To me, if you do have a recession, I think rates are going lower. That will help those parts of the economy that have kind of been in a recession-like place for the last couple of years, and that'll help those parts in the market. At the same time, if we do have inflation that runs away because economic growth does revive, I think that helps those parts of the market also. And that's where you look at relative valuations right now in a very expensive market where you see small and mid-cap at relative valuations they haven't seen since 1999, which was an incredibly similar time period where you had the internet and Y2K spending holding up the U.S. economy and also being reflected in a very narrow market. And that's where I think if you look at the next few years, it did broaden back out. The equated S&P 500 did well. Mid-caps and small caps did well. And even if you look at the past 25 years, mid-caps and small caps have outperformed large caps, even with large caps doing well the past 5-6 years. And that's where I want investors to focus on, planting those seeds today that you can harvest later, because I do think valuation matters, especially in an S&P 500 that it's at the second highest CAPE ratio in the last 150, 160 years.
The one fear that a lot of people keep raising is that this is a different moment in terms of the technological sea change that's happening and how much this could actually drive a number of smaller and mid-sized companies into obsolescence, especially as large companies have the capital to invest, to create those moats around themselves and to adopt to some of the changes more quickly. At what point is there a different paradigm for smaller companies that don't have the same agility, that don't have the same balance sheets as larger ones, facing into what is a pretty transformative moment?
This, to me, reminds me of the narratives that Wall Street makes up at different points in my career. And so I heard a lot of the same things back in 1999, and I actually worked at a bank. And if you recall, there were going to be no bank branches any longer because the internet was going to make those obsolescent. And that's where I think if you look today, there are still bank branches. And so the answer is probably somewhere in between. And that's where I think AI becomes a benefit now, not just to the companies who are implementing it right now and laying the train tracks, but to those who actually use it to increase their margins at a time when margins are being squeezed, which I think it becomes more of a whole society thing pushing forward. And that's why I would encourage people to kind of take those narratives with a bit of a grain of salt, because I've heard all the different ones over the last 100-some years, not me 100 years, but you've had those. And that's where you mentioned the commentary this time is different, and that still makes me scared in just a bit of a way.
Brent, you certainly don't look that old. Don't worry about it. Brent, in about 7 minutes' time, we're going to catch up with Governor Myron of the Federal Reserve. He made a big splash in his first meeting at the Federal Reserve, pushing for a 50 basis point rate reduction. What do you make of his argument? How persuasive do you find it? And Brent, ultimately, what would you like to know in the next few minutes?
Yeah, I mean, to me, this is where I just think the current situation is so odd that you have all these different economists who haven't seen tariffs like this for 90 years, so they don't have much history to go upon, where there's such a broad variety of opinions. That's where I think it's so odd and so interesting of a time period. And that's where I'll bring it back to something from an investing standpoint. There are myriad outcomes that could occur. You could have higher inflation, certainly as something. You could also have a recession. I don't think there's much area in between, and that's where, to me, you come back to diversification and investing in that manner. I think it's interesting to hear his comments on where the neutral rate is, and maybe just to push a little bit harder on that, because he seems to be at quite a bit of a lower level than what most of the other Fed members are.
He certainly has a different view. Brent, thank you, sir. Appreciate it. Brent Schutte there of Northwestern Mutual Life Insurance. Looking forward to that conversation in about 5 minutes' time.
Yeah, how much does he really understand neutral as something closer to 2% and what that actually means for how quickly a raise can get cut? And frankly, I'm just fascinated, but Morgan Stanley is kind of on the same page as he is.
Yeah, not much daylight.
Yeah, it's not as though he's a complete outlier when it comes to rejiggering a concept around neutral.
What happens if he's right? We talked about that last week. What if he is right? What would that mean for this market? Already very close to all-time highs and credit spreads at multi-decade tights.
Yeah, it means basically to the moon, right? I mean, in terms of valuations, the real question that I have is, what does this do for inflation? And why has the market, why has the economy not completely fallen out of bed if we were this restrictive for this long?
I've got the very same question in front of me too. I think we all have the same one with regards to that. Equity futures right now in the S&P 500, negative by about 1/3%, with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. Former French President Nicolas Sarkozy has been convicted of criminal conspiracy. Paris judges made the ruling over allegations his 2007 winning campaign was covertly funded by the regime of late Libyan leader Muammar Gaddafi. Sarkozy is expected to serve a 5-year jail sentence, even if he appeals. Meanwhile, Disney is preparing for a legal battle with President Trump after it put Jimmy Kimmel back on the air. The Trump administration has threatened to revoke the broadcast licenses of Disney's local stations. Disney's leadership has consulted legal experts and says it is confident it will win any case. And Oracle launched an $18 billion U.S. investment-grade bond sale, the market's second largest deal this year. The debt raise comes as Oracle begins to fulfill massive cloud infrastructure deals with customers like OpenAI and Meta. Sources telling us here at Bloomberg, the tech giant issued the debt in 6 parts, including a rare 40-year bond. That's your Bloomberg brief. John?
Yahara, thank you. Some real demand at that offering yesterday afternoon. Up next on the program, Federal Reserve Governor Stephen Myron as he makes his case for more aggressive rate cuts. That conversation is just around the corner. Live from New York City this morning. Good morning. at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Overall, for equities, we've been modestly underweight. It has been a brutal year to be modestly underweight equities. But this is the deal. This is the issue we're dealing with, is that this market is priced for perfection in a far from perfect world. There are going to be risks into next year. Next year is going to be a tougher year than the markets are pricing in.
That was Matt Miskin of John Hancock on this market. Your market right now just a little bit softer going into the opening bout. Heading into the opening bout, let's turn to the Federal Reserve. The newest Federal Reserve Governor, Stephen Myron, making the case for aggressively lowering interest rates to avoid damaging the economy, diverging from some other FOMC members. I'm pleased to say that joining us this morning, live from the Federal Reserve, is Governor Myron himself. Governor, welcome to the program, sir. We've got tons of time to talk about what's going to happen next, your thoughts on the labour market, the balance of risk, the broader economy. I actually wanted to lead the conversation with this one. Governor, what was your experience like? I'm sure this was unexpected 12 months ago. What was it like walking into the room, and was it different to what you expected?
Good morning, and thanks for having me. It's great to see you again. Look, walking into the room, I had a good briefing ahead of time about what the meeting would be like, and so that was very helpful. But I will say that everyone was extremely friendly and welcoming and kind and collegial, and I really appreciated that. And it's important to understand that the FOMC is a body, the Federal Open Market Committee is a body that makes decisions by arguing on the merits of the economics and the merits of policy. And that's how it was, and everyone was very collegial in airing their views, and I the same, and that's how it'll continue to be. We make policy, as the chairman said last week, by persuasion, and so I will continue to try to lay out my views and make the case as best as I can.
Governor, I sense you got the opportunity to articulate your argument. Just how much daylight did you sense there was between you and everyone else on the committee?
Well, I mean, it's sort of funny. If you look at the dots in the summary of economic projections, obviously there's a divergence between my projection for appropriate policy for 2025 versus where the weight of everyone else's is. But if you look at next year and the year after, I'm sure I'm still on the low end, but there's not really that much daylight between all the rest of the dots and myself in following year. So it's really just about the speed with which we come down to what's closer to neutral.
Well, let's get into the neutral argument. I think that's what separates you from a lot of people. So you've got it in the mid-twos, Governor, and you think we should get there quickly. Can you just build out why you believe that's the case and why we should get there so fast?
Sure. So, look, I discussed a number of forces which have kicked in over the course of this year and which are, I think, in stark contrast to where they were last year. So I've argued that neutral was higher in the past than it is now, and that neutral was higher for a variety of reasons, but I've highlighted recently fiscal policy, sort of driving up net national borrowing, decreasing net national savings, as well as immigration policy, driving what was the biggest positive population growth shock in my lifetime and has now turned into the biggest negative population growth shock in my lifetime in very rapid succession relative to how changes in population growth normally occur in the data. And so, to me, when you have huge swings in net national savings driven by fiscal policy, and you have huge swings in population growth driven by changes to border policy, it would be bizarre for me to think that wouldn't have implications for the fundamental structure of the economy that gets reflected for monetary policy in the neutral rate. So my view is that neutral was higher last year because of these reasons. And so last year policy was not as tight as a lot of people believed. And now neutral has come down or is in the process of coming down. And now policy is more tight than people believe. And this has happened recently. You know, these policies didn't change, you know, sort of overnight. They've been kicking in over the course of the year. And that means that policy is becoming tighter every day as these policies continue to kick in. And my view is not one of enormous economic pessimism. You know, I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy. If policy stays excessively restrictive for too long, then you do get to in a situation in which you have a meaningful increase in the unemployment rate and a failure of the employment mandate.
So, Governor, that's the tension, I think, in your view, that's worth exploring just a little bit more. On the one hand, you don't think the economy's at risk of breaking down, but you also think we are excessively tight at the moment and getting tighter. There are some people who would say, and we've had this conversation around the table this morning, if we were as tight as you're suggesting, why is the market within 1% of record highs? Why are credit spreads super tight? And why is this economy still doing okay?
Yeah, so that's a perfectly natural thing to ask. And let me say two things. One, I don't think that all financial conditions are universally loose like that. In particular, if you look at the housing market, I think it's in quite a different state than sort of some financial markets and sort of security markets. So I don't think that that's necessarily a holistic look at the world of financial conditions in the economy. But even that aside, I think that people in financial markets tend to focus a lot on monetary policy because interest rates are sort of huge tradable instruments, right? But there's so much more that goes into determining economic growth and the state of the economy and inflation and employment than monetary policy. And I think that attributing all changes in financial assets to monetary policy can be a mistake. And in particular, that's what I tried to do in my speech. Was to draw out some of these effects from non-monetary policies that are affecting the economy, and of course, therefore, also financial markets. And so, if you have changes in tax policy, right, like significant incentives for investing that lower the effective tax rate on capital, of course, that's going to get reflected into capital assets. If you have significant changes to the regulatory environment, where you're removing barriers to operations that companies can make more cheaply, which, by the way, is disinflationary and pushes out the output gap, then, of course, that's also going to be reflected in asset markets. So I think it's a mistake to conflate the state of financial conditions with monetary policy. They're connected, they're related, they affect each other, but they're not exactly the same thing. And in the speech, I go line by line through these different items. And the reason why monetary policy doesn't have to react to the hawkish side in response to these policy changes is because they push out the supply side of the economy at the same time that they push out demand. And so if you're increasing supply and demand at the same time, there's no change to the output gap. And of course, it's monetary policy job at the end of the day to be balancing the output gap, to be balancing aggregate supply and aggregate demand in the economy so it doesn't overheat or underheat.
I think there are a lot of people, Governor Myron, who would agree with you that probably the neutral rate is quite a bit below where we are now. You said even the other Fed governors did seem to agree with that, but not necessarily the speed. And I'm still unclear, why do you think it is so important to get rates down by 125 or 150 basis points more this year if inflation is still running hot and you're not seeing anything alarming in the underlying economy?
Yeah, so this year is merely a function of where the calendar is. So my view is that policy is quite restrictive, and so I'd like to adjust quickly to get back to a more neutral area, right? That just means a series of 50s until you get much closer to zero. The fact that it's this year is just a function of the calendar. But again, it comes back to the longer that you stay restrictive, the greater the risks. And let me put it this way, like it was just a few years ago that we were having endless conversations about declining population growth rates and the whole world becoming Japan in terms of interest rate profiles, right? Those forces are still real. Those dynamics are still real. They didn't go away. Those channels, those channels by which population growth affects neutral rates didn't disappear. I would rather act proactively, right? And sort of, we know that we just had the biggest population growth shocks in many people's lifetimes, mine included, right? We know what the consequences of those are economically. I would rather act proactively and lower rates as a result ahead of time rather than wait for some, giant catastrophe to occur because you suddenly wake up and find out that you are sort of resuming those dynamics. In my mind, if you wait to to see the result of that, you'll have waited too long, and there will have been a potentially quite material downside miss to the employment mandate.
A lot of people on this show have been wondering what the reaction mechanism is going to be for a Federal Reserve that does start to see inflation as transitory once again. The idea that we have been above 2%, the 2% target for the Federal Reserve for 53 consecutive months for more than 4 years. If there is an upsurge in inflation, how long are you willing to look through that if you are cutting rates before you say, hold on a second, maybe we need to stop?
Yeah, so I would want to understand why there was an upsurge in inflation and what was driving it, and then sort of think about whether that shock is likely to be persistent or whether the shock is likely to be transitory. And it's the nature of the shock. It's not just is inflation higher for a certain number of months, it's why is it higher or why is it lower? And how long are those shocks likely to persist? And if you have a situation in which inflation is much higher because there's, let's say a very significant expansion in national borrowing that drives up demand, could be driven by fiscal, could be driven by something else, that might be the type of thing that you would expect to be more persistent in my mind. If you have the type of shock that's driven by a, basically one-off change to tax rates, right, whether that's a VAT tax or tariffs or anything else, that in my mind is not the type of shock that would lead you to think that inflation is going to be sticky for a long period of time. And in fact, there's, most central banks around the world, I think actually all of them would sort of, encounter this in a much more direct manner through changes in value-added taxes. And they always look through them. They always say, okay, look, the VAT went up or the VAT went down, and that's going to affect the inflation statistics for a period of time. But then we all know that this was basically a fiscally mandated price change, and monetary policy shouldn't respond necessarily to fiscally mandated price changes because that's not indicative of changes to the underlying supply-demand balance in the economy, which ultimately drives the type of persistent inflation that the central bank cares about.
Governor Martin, I'd love to get your thoughts a little bit more deeper on housing. This is something Matt Miskin, Neil Dutta have talked a lot on this program about. Going into next year, do you think the housing market will weigh on a deceleration of inflation? Is that part of your thesis on inflation coming down?
Yeah, I mean, it explicitly is. I mean, look, supply and demand dominates all things economically, right? And if you're increasing the demand for housing by dramatically increasing population growth without a material increase in the supply of housing at the same time, of course, you are going to get upward pressure on shelter inflation. And then vice versa, if you start decreasing population growth because of a change in border policies without destroying shelter supply, or if shelter supply keeps on expanding at a rate that it has been in previous years, then you get a relative change in shelter inflation once again. So it's simple, it's simple supply and demand. If we have a material downward population shock because we have negative net migration, that's a net increase in the supply of shelter. And I think that the study that I cited in the speech on Monday, work by Albert Sayers, found that an elasticity of 1, basically that a 1% increase in the number of immigrant renters leads to a 1 percentage point change in the rents.
Right, but immigration is short-term,
yeah.
right? This is a short-term story. Would you be willing to revise up neutral if immigration is not much of a drag?
Well, I mean, I have good reason for expecting that the immigration story is going to persist at least for another 3.5 years. And I think quite likely potentially after that also. So I'm not convinced that immigration is really a short-term story.
Hey, Governor, just before you go, because I know you've got to run, have you got a taste for this? Is this a position you'd like to keep beyond the end of this year?
Look, I love this country, and I'm happy to serve this country in any way that I'm asked to do so, but personnel decisions are not decisions that I make.
Governor Myron, appreciate your time. Diplomatic end. Thank you, sir. Thank you very much. Governor Myron from the Federal Reserve on the next views from the Fed and his argument for a much lower neutral rate.
Yeah, and the key issue here in terms of how much daylight there is between him and the other Fed members is the speed. And he's saying that recently he saw a real turn, and you might as well get ahead of that, especially with a very different backdrop. Also, really interesting what he said about some of the other inputs to asset pricing and how that doesn't necessarily have to do with Fed rates, kind of agreeing with some of our previous guests talking about how it's been a Fed independent equity market in particular.
The question you ended on is the one I was thinking about the entire time. Is this going to be a Governor Myron just till January, or is he going to be someone that the Trump administration decides we are going to keep him in that spot? And I think this is becoming very political in Washington, obviously, because he's still keeping he has a leave of absence right now from CEA, so 1 foot kind of still in the White House. But if he continues going on this and trying to change the thinking of the Fed, this is really going to be the future. The Treasury Secretary said he wants more of a Greenspan-led Fed, forward-thinking, not data-dependent.
In just a moment, we're going to get jobless claims at about 8:30 Eastern Time. Mike McKee's been tracking the conversation we've been having around the Federal Reserve. Mike, the labour market, if you look at jobless claims, I don't know what the number's about to be in 2 minutes' time, but jobless claims so far look okay, don't they?
They do, and that's part of the story that Jay Powell and the rest of the Fed have been telling, that we're in this unusual situation where we're not hiring people, but we're not firing people either. And the question is, which direction do you go and how fast do you get there? The whole question with Stephen Myron versus the rest of the Open Market Committee is where is neutral? And he makes a big case for negative population growth because of the negative labor force growth because of immigration. And that should start to show up in the jobs numbers, but not necessarily in terms of layoffs. So the jobless claims numbers may not settle that debate.
Mike, how persuasive is his argument at the moment, and how well received is it based on the communication we've had subsequently?
Well, it hasn't been extremely well received because there are some holes in his story, and some of the research he cited isn't necessarily considered the best research. But the real issue is he's talking about this negative net migration, but the labor force has not slowed, has not fallen. So the impact he's talking about hasn't happened yet, but the inflation impact is still happening. So that's what the rest of the Open Market Committee is looking at this point and saying we should be cautious here.
Mike, stand by. We'll get those results in just a moment. I just want to tee you up with the price action 60 minutes out from the opening bell. Equity futures are negative by about 1/3% on the S&P. On the Nasdaq, we're down by 0.5. In the bond market, bond yields shaping up as follows. Yields higher by about a basis point on a 2-year to 363. With that economic data, with jobless claims and a whole lot more, here's Mike McKee.
Well, John, we are certainly not seeing any problems in the labor force connected to jobless claims. 218,000, a big drop from a revised 232,000 last month. So it doesn't look at this point like we have a firing problem at all. Initial claims, continuing claims, 1,926,000. That's down a little bit from a revised 1,928,000. So all in all, jobless claims numbers still show companies sitting on the sidelines not making decisions. What else have we got today? We've got the advanced good trade balance. It is 85.5, a deficit of 85.5 billion. That's down from 102.8 billion last month. There was a lot of thought that what we were seeing in July was imports pulled forward because the tariffs were going to take effect in August. They did take effect, and it looks like we've had quite a change in import balances there. Durable goods orders up 2.9% after falling 2.7% the prior month in July. The core goods, capital goods orders, non-defense ex-air up 0.6. That was up 1.1%. So it's down a little bit, but not what you would consider any kind of bad news. And finally, we've got the GDP, annualized GDP numbers, their third revision, the second revision, the third issue, 3.8%, a significant revision up from 3.3%. Personal consumption is the reason Americans spent more money, 2.5% from 1.6%. No real change in the GDP quarterly price index is 2.1% for headline on the year over year, and 2.6% for core. Both of those a little bit higher, but that's not the number we're looking at. We'll look tomorrow for the latest monthly release.
And Mike McKee, thank you, sir. I just want to sit on one data point. There are many here, but let's pick out one. 218 on jobless claims. 218. We're freaking out about the labor market. Big downshift in payrolls. I understand the concerns. I'm not dismissing them. You see it. It's real. But the fact that claims have come in at 218, it doesn't speak to any kind of weakness whatsoever.
And even continuing claims actually came in slightly. They didn't expand, so people are coming off that. Look, no one is saying that this labor market is falling into a ditch. The point is, do you need to have a more robust, a robust labor market in order to get growth that can sustain a lot of the expectations currently in markets? Do we need things to be a little bit less frozen? And ultimately, that might be the argument, but no one is saying that this is a labor market that is falling off a cliff.
I wish Governor Myron was still with us. Pretty impressive data points there for jobless claims, at least. Yields are up at the front end by, let's call it 4 basis points on twos, 364. There's been a steady grind higher in bond yields ever since the Federal Reserve cut interest rates last Wednesday. The 10-year bond yield higher by about 3 basis points, so approaching again 420. We're at 417. And in the equity market, we were softer going into this print. We're softer still coming out of it. We're down 0.4% on the S&P, down by 0.8 on the small caps. Joining us around the table, Nita Richardson of ADP. Nita, good morning.
Good morning.
That claims number, pretty impressive, hey?
It is. In fact, if I would have just parachuted in from like some other place in time
5%
and
GDP
saw those
growth,
numbers that Mike McKee just read, I would be like, so what's the issue? What's the problem here? This is a perfect economy. But the thing is, I've actually not parachuted in. I've been here the whole time, and I've been looking at the data. And there are some cracks here that I want to uncover because, yes, it is a low hire, low fire. It's been well-established jobs market. It's a stasis that I've been talking about with you for the better part of the year. But if you look, that stasis is having an effect that is not uniform in the labor market when it comes to wages. And wages, as I've said before, are the bridge between the jobs market and inflation. Inflation, when I look at those Fed projections, we're 4 years above target and 2 years to get to target. So wages are going to play a big role. And what you're seeing is that for low wage earners, those are the ones who were keeping wages higher for longer, they are losing ground to high-income workers. So even though we have this low hire labor market, wages are suffering for those who are most affected by inflation, low-income earners.
So this raises a question about what that means on a bigger scale, whether this tends to be a leading indicator of lower income workers are not seeing the pay raises that can keep up with inflation, whether that kind of leads a broader downshift, or if this just continues to emphasize the K-shaped economy where you have the high income earners benefiting from their wages, benefiting from the market, and benefiting from a world that seems to be increasingly catering to them.
Exactly. So when you look at that GDP print, it was on the backs of a 2.5% consumer spending growth. And that growth we think of as being really top heavy. So when you look at the labor market, and I said this last week with you, that the labor market is supporting consumers, but it's not consumers supporting them uniformly. So for high-income workers, you're seeing that their wage growth is actually peaking up from a year ago, whereas for low-income workers, it's decelerating fast. And so the disparity is rising, and that's going to show up in consumer spending trends. You're going to see this disconnect between high-income people and low-income people. And who are those low-income workers? Well, the majority of them are women. 60% of workers at the bottom of the pay distribution are women compared to 30% at the top end of the distribution. And they are concentrated in certain industries. Those industries happen to be where all the gains have been: health and education, leisure and hospitality. So this disconnect in the labor market is going to show up in a disconnect in consumer spending.
If the Fed were to cut rates aggressively this year on the heels of our conversation with Governor Stephen Myron, do you think that would change the picture? Would you see a pickup in the wages and the employment at the sort of lower end of the income sphere?
It's hard to tell. You might see a pickup in hiring, which would generate some more momentum in wage growth at the bottom end. You may not see a tilt in the housing market because that is also an inventory affordability story, and most mortgages are priced off of the 10-year, not the short-term rates. So it's hard to tell exactly how Fed policy would move through to Main Street, but it wouldn't be instantaneous. Fed policy is still going to operate with a lag on Main Street, so you wouldn't see the gains. But with 3.8% GDP growth, you probably don't need to see those gains right now broadly. But to the people who it matters most for, maybe there would be an increase in hiring, which would spill over to wages.
Well, wouldn't have to be a wage increase if, like Governor Myron says, this pace of immigration policy we're seeing in the Trump administration is not short-term. He thinks this is going to continue for the remainder of 3.5 years?
Well, let's hold there. There's a lot going on with demographics in the labor market. It's not just immigration policy. It's the fact that 10,000 Americans every day are turning 65 and older and leaving as well. So those shifts are being seen in the labor force participation rate. It's edging down. You have the sandwich generation being impacted in terms of the number of hours they can contribute if they're taking care of their parents and their children. So there's a lot going on demographically. What it ends up being is labor shortages. Those shortages could tilt up wages in the sectors that are most needed to take care of an aging population. But what I read in that is inflation. And that's what you don't want to see. You don't want to see a wage cycle that leads to an inflation increase.
When it comes to the other part of the labor markets, of course, a lot of these grads coming out of school unable to find jobs. How much is AI part of that story, even though there should be enough supply given what's happening in immigration and given this aging workforce?
AI is having an effect on early career. We've partnered with Stanford on research showing just that using ADP data, that if you are in an AI-exposed field, a software developer, customer service
Isn't that
agent,
everything at this point? AI exposed almost?
No, there are some jobs, a plumber, HVAC. There's actually quite a few jobs that are not AI exposed, but those aren't the jobs that young people, or especially college graduates, sometimes are oriented towards. But if you're in the healthcare field, needed more than ever, and you can see the employment trends going up. So not in 2025. Maybe in 2035, every job will be an AI-exposed job, but not now.
Nita, it's good to see you. Always is. Thank you. Nita Richardson there of ADP following that better-than-expected jobless claims data, the right kind of downside surprise. Kevin Gordon at Charles Schwab writes in, the biggest two-week drop in claims since October 2021.
Yeah, if people were looking for some sort of confirmation of ongoing weakness, well, congratulations, you didn't get it. You actually got quite the opposite, the sense that things aren't falling out of bed. And it just goes to the ultimate question that we've been asking so much on this program, which is, are we heading into a reacceleration? Are we already seeing it, especially ahead of some of the infusion of cash from the One Big Beautiful Bill, and with the likes of the airlines saying that actually they're seeing bookings pick up? So, I mean, it might be on the heels of the upper quintile of earners, but nonetheless, that is the personal spending. That is some of what you're seeing maybe in this data.
If you're long equities, that's what you're priced for into next year. Let's see if we get it. Long equities with reacceleration plus the interest rate cuts. There will be questions about that if we continue getting data like this in the labour market. 218 for jobless claims. Big downside surprise. The estimate was 233 in our survey. Push that through the bond market and you were getting higher bond yields at the front end of the curve, up by 5. 2's up to 365. 10's up by 4 to about 418. Let's get you an update on news worldwide with your Bloomberg brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. Let's recap that latest economic data. We saw weekly jobless claims fall by 14,000 last week to 218,000. That's the lowest level since mid-July. Analysts surveyed by Bloomberg were looking for 225,000 to 242,000. And don't bet against the U.S. consumer. Personal spending for the second quarter was revised up to 2.5% from 1.6%. Meanwhile, Best Buy has been making job cuts, including reductions to its Geek Squad team. The changes come as the electronics retailer has been impacted by tariffs and struggled to reignite the level of growth it saw from pandemic-era buying of computers and other gear. Shares of the company are down nearly 14% so far this year as of yesterday's close. And Jimmy Kimmel's return to late-night TV drew 6.3 million viewers, the most ever in the show's regular time slot. The total is significantly higher than the 1.6 million viewers Kimmel has averaged this year. That's according to Nielsen data. The host's opening monologue was also viewed more than 26 million times on YouTube and social media services. That's your Bloomberg Brief. John?
Yohara, thank you. Thanks for this morning. Appreciate it. Up next, we'll catch up with Chris Heisey of Merrill and Bank of America Private Bank Plus. Danny has your morning movers. IBM climbing after HSBC says it found a way to use the company's quantum technology. That stock is up by 2.8%.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive. Getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks, but that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Policy is quite restrictive, and so I'd like to adjust quickly much closer to zero. Those channels by which population growth affects neutral rates didn't disappear. I would rather act proactive. If you wait to see the result of that, you have waited too long.
Governor Myron making the case for much lower interest rates and getting there quickly. We just had data moments ago. 16 minutes ago, jobless claims 218. Big downside surprise. No problem in this labour market based on that data point. The estimate was 233. The response to it, bond yields higher, equities softer. We're down by 0.5% on the S&P 500. On the NASDAQ, down by 0.7. With that move in the bond market, small caps down 1 full percentage point. Twos at 366. With about 44 minutes away to the opening bell. Let's get you some morning movers, some single names. Here's Danny Berger. Hey, Danny.
Hey, John. Intel continues to climb higher, but has lost some of its steam, was up more than 1%. Now just up 0.5% on this report that they approached Apple for an investment. That's maybe the key, that it was just an approach. It's in early stages that you are talking about how they can work together, but a lot of skepticism, including Bernstein analysts saying that IBM doesn't have a money problem necessarily. It has a capability problem, and money won't help with that. Elsewhere, CarMax shares plummeting this morning. It missed on a variety of metrics. Used car prices fell. Sales fell to about 7%. It is very clear that what CarMax saw in the first half of the year was that pull forward effect from tariffs, and that has started to ebb. So shares there down 14%. Finally, the buzzy story of the morning, and that is HSBC saying, hey, we figured out quantum computing. We are using IBM servers, and we've been able to more accurately predict the price of bonds by 34% in a trial. There's some questions as to how you extend that trial and if you can use it more widely. Even so, IBM shares up 2.5%, John.
What a crazy story. Danny, thank you. Thanks for the update. Big rally for that name this morning, and others too. Let's turn to the Federal Reserve. Chris Heisey of Merrill and Bank of America Private Bank writing loosening conditions, including further Fed rate cuts, support risk assets further. Chris joins us now for more. Chris, good morning.
Good morning. Thanks
They're
for
on
having
top,
me.
decent numbers like that. Labour market data. What do you make of that claims data?
I make of it what I always do, which is week to week is data points are pretty noisy. It doesn't necessarily mean it's a trend, but it is something that I think we'll likely see, which is right around those numbers for the foreseeable future. There's a little bit of a supply and demand balance in the job market overall. Many companies are still in the wait and see mode as it relates to how you democratize artificial intelligence. So claims numbers are pretty much in line with what our belief is, which is a reacceleration coming, not just in real growth, but nominal growth and ultimately profit growth.
Are you seeing any signs of that already? Beyond that jobless claims number, where are you seeing signs of a reacceleration? Where are things firming up?
You know, it comes down to the beginning of the year before the tariffs were put in place. There was this notion that you'd have double-digit profit growth for this year and then next year. Then it was ratcheted back by pretty much everybody across Wall Street. Now we're back to the numbers again where they were at the beginning of the year. So it's a reacceleration. We're seeing it already in profit revisions, not just for third and fourth quarter, but already for 26.
Do CEOs and CFOs believe it? Do they believe it enough to actually take big steps and engage in some of the M&A, engage in some of the hiring plans that they were talking about maybe late last year, early this?
Really depends on the actual sector, obviously, but in terms of the general broader community, you're starting to see sentiment, the soft data, start to change for the better. Remember when we were all talking about soft data being weak and then it was going to filter into the hard data? Never did. Now soft data is coming back. You're seeing in the small business segment a little bit because of rates coming down, but a little bit better economy, perhaps an adjustment to the neutral rate coming down a little bit, as Governor Myron just said. All of that coalesces around better optimism from the corporate side. I would say this, though. Margins have held in there, and that's the key. The bottom line is being used on an efficient basis. Some productivity is increasing, but when you get a little bit above average inflation, that feeds directly to the revenue line, and you don't have to produce as much to get that higher revenue number. So that's why margins have actually stayed in there, in some cases actually widened out.
This sounds like a perfect scenario. It sounds like just nirvana, investing nirvana. It's priced as though it's investing nirvana too, though. At what point have we priced all of that in and then some that leaves it kind of vulnerable to anything that doesn't look like what we just got from jobless claims?
Yeah, Lisa, that's a great point. And I think a lot of that is priced in the here to now, but much of it is still not priced in for next year. There's a little bit of discounting of what the story I just laid out already, given where the S&P is 22, 23 times forward. I would say that in this asset-light world that has driven the index higher, multiples are higher because they're still driving higher revenue growth. And if you look at the contribution of the tech sector, it's about 44% or so of the market cap of the S&P, but its earnings contribution is in the 30s. That's very different than 99 and 2000, when the earnings contribution was almost 1/2 of that peak.
The investors you speak with, are they more worried about some sort of downturn in the economy, or are they more worried about missing out in the next leg higher?
You know, they're still worried about the downside scenario. They still have that frame of mind of the credit crisis, little frame of mind of what happened in August through December of 2018 when the Federal Reserve was raising rates, when inflation was below their target at that point, and then fast forward into 22 with the inverted yield curve and then the tariff situation in April. So they still have all of this in their mind. and they're comfortable still getting a decent yield on their cash. On the flip side, there are some that are very worried about missing the next move, particularly as it relates to the infrastructure build out of artificial intelligence. We believe there's some room to go there. We would caution, though, the signs of artificial intelligence and infrastructure build out peaking are all about the margin, all about the price side of the equation. We're not seeing that yet, but we need to watch that closely to understand what the demand for that will be once all of this is built.
Clients that are concerned about the downside, is it because they think we're in a bubble?
They always talk about bubbles. Number one question I get right now is, are we in a bubble?
Are
I
we?
had 4 different meetings yesterday. Number one question. In some cases, in areas that are low quality, that don't have any revenues, that are built to sky-high valuations, you can argue yes. In other areas where they're still kicking off very good free cash flow, the answer is no.
So what's your advice?
The advice is diversified portfolio. I know that sounds like, okay, that's easy.
You're killing us, Chris.
Right?
Well,
I
okay,
know.
what's the
We
second
talked about
question
this
investors are asking?
But diversification works when you need it the most, and you can still participate. So for us, it's about having a little bit more non-U.S. than you would traditionally have. We heard before about potential weaker dollar. Weaker dollar is probably a fading dollar story, not necessarily a weaker dollar story, given the re-accelerating economy. Mid-caps, for whatever M&A cycle is around the corner. And then on the large cap side, I think it's 2 stories. It's the rest that we always talk about that are starting to rotate a little bit, a little bit on the value side. Those areas that were starved for capital, like materials and energy and others, we're still overweight financials. We're still overweight industrials, consumer discretionary, and utilities. We're trying to make sure that we stay balanced where we can, but participate in the AI growth story.
Does balance mean a little bit of gold as well?
Well, it's fortunate. We don't actually have it in our asset allocation schema overall, but yes, gold is showing some incredibly different signs than it normally would. It has a negative correlation with treasuries right now, which a lot of people aren't talking about.
And a positive correlation with risk assets for the year so far.
That's right. And also defensive assets. It's throwing off signs. Again, it's not perfect, but when you get one of the largest central banks in the world recycling their own foreign reserves and euro reserves are not going up, but gold is, that's an interesting story.
What do you think's behind all that? Is there a dominant driver or just multiple pillars?
I think it's this regional economic trade zone developments from this ultra-competitive global world we were in for so long. As the world looked to the U.S. to fund their growth, now with all of that switching, I think you're going to have to see some of these central banks diversify their reserve base.
Bramo, nodding along, agrees with you entirely.
Well, if you look back to when it really started, it was 2022 with the Ukraine and Russia conflict, when Russia invaded Ukraine. This question of repatriating some of the money, and that really kickstarted a central bank diversification away from the dollar. And that, I think, people have just seen accelerate from there.
Frozen Russian assets are a big piece of this conversation.
Absolutely. The Russians realized, their central bank realized they could just freeze our foreign holdings, so we need to diversify. And then other dictators around the world, like the Chinese, were also like, wow, we should probably actually up our gold as well.
Chris, it's good to see you. Thanks for dropping by. Thank you, sir. Chris Heisey of Maryland Bank of America Private Bank. Gold, what a year so far. Equities too, by the way, both equities and gold. Our guest from Deutsche Bank earlier on this morning saying a lot of people just liked what? It was the S&P, it was gold and EM. The S&P, gold and EM.
Yeah, I just am imagining someone walking through Midtown just totally draped in gold saying, I'm diversifying, I mean, at a certain point.
Security.
I just think it's really an interesting moment right now as people rejigger their ideas of the macro trade landscape and what it means to be diversified.
We've got to wrap up and rejigger our views on this labour market. That number, 25 minutes ago, what a jobless claims print. 218, that's a really strong figure.
I'm struggling to get my head around what these numbers mean. Exactly, because if we're looking at low hiring, then if you have that level of firing and you don't have that many new people brought in, what kind of stagnant market are we looking at? This is a very confusing economy. I don't know that it's going to get that much clearer.
218,000, the estimate was 233. The bond market doesn't like it. Yields are up at the front end by 6 basis points. Equities a bit softer on the S&P 500. Session lows, we're down by 0.5%. Coming up tomorrow, Cameron Dawson of New Edge, Mike Dada of Roth Capital, Victoria Fernandez of Crossmark, and the former Fed President, Jim Bullard from New York City. This was Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you
the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
So today, has value investing been a profitable thing to do over the last 10 years or so, or has it been hard to do?
The market structure has changed. And there has been what I consider it to be a broken market, or the value investing industry, I think, is defeated, so to speak. It used to be that most money was invested by these long-only investors, these big mutual funds and stuff like that. And they had money coming in every day, and they were getting nice fees on all of that money, and they had large research teams. And they would sit around following all of the companies with teams of analysts, and they would say, this company we think is undervalued by 30%. And it might be a growth stock or a value stock, a Magnificent Seven or otherwise, but they would say, I think this is undervalued by 30%, and if I buy it and I hold it, I'll make the S&P plus 30. Now, as we've moved to passive, they've lost their customers, and the remaining customers are paying them lower fees, and they have reduced their research staffs, and they don't have new money coming in to make new investments in any case. And so most of the investing these days is no longer done by people who are buying something because they think it's worth more. They have opinions about price. Like, what is the price going to be tomorrow? And so the result is most trading that is going on right now has nothing to do with value. So it leaves us sort of as a dinosaur.
Bloomberg Screen Time is back this fall for year 3. We're bringing together the biggest names in business and pop culture, like Netflix co-CEO Greg Peters, Instagram boss Adam Mosseri, and Los Angeles royalty Willow Bay. We're going to talk about how sports is eating entertainment, check in on the state of the movie business, and get an update on LA after the fires from Rick Caruso and Irving Azoff. You should expect newsy interviews from industry leaders, meaningful business networking, and of course, great food. We'll feature some of the best chefs and food trucks from my hometown of Los Angeles. Tickets are available now, and you should head to bloomberglive.com/screentime for details. I'll see you in Los Angeles, October 8th and 9th.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Futures down again today. Third day in a row of losses. Could be 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, Fed Governor Stephen Myron sounds the alarm on U.S. vulnerability, but fresh data points to resilient economic growth.
And a bid for a comeback. Intel seeks an investment from Apple as the two discuss how to work more closely together.
And Starbucks is closing stores and cutting jobs while the White House orders federal agencies to prepare for mass firings.
It's a weird thing because those headlines would imply that it is a weak jobs market, but we just had jobless data. And it was really good.
Yeah, there's so many up and down stories. Myron's worried about the economy.
Yeah.
It's growing at 3.8%.
Yeah.
Prepare for mass firings. Jobless claims drop.
This is a choose-your-own-adventure market, and Starbucks is part of that adventure. As we were talking about, it's one of the stocks we're watching, even though it's not moving that much. As a matter of fact, it's basically unchanged. Matt, it says that it's going to close several stores. It's going to be cutting 900 jobs. It's part of a $1 billion restructuring plan. Overall store count, they say, is going to drop by 1% during its 2025 fiscal year.
All right, only a drop of 1%, so maybe they could cut a little deeper. Intel was up as much as 3% this morning after Bloomberg reported it approached Apple about securing an investment that follows the $5 billion investment from NVIDIA and the 10% stake from the U.S. government. Maybe, just maybe, this is going to perk up Intel's foundry business a little bit.
Just maybe. That's certainly the hope, and let's broaden out and ask that question on the conversation on Intel. Joining us is Bloomberg Tech co-host Caroline Hyde. And Caroline, there's Been a lot of skepticism thrown out there, and maybe that's why you're starting to see the stock come in. Bernstein, for their part, said that they have a capability issue, not a money issue. So what would an investment from Apple help Intel do?
I think, once again, just a sign of support and maybe future end demand for the fabrication of chips. All along, we have worried about the ability for them to keep up with the innovations that are necessary to produce the most sophisticated chips out there. And that's why Lip Bhutan, the relatively new CEO in the previous earnings, had said, I'm putting this fabrication stuff on ice. Pat Gelsinger's idea that Ohio was going to become one of the biggest producers and manufacturing of chips in the world ever.
Great state of Ohio.
Great state of Ohio. Go Ohio. But, I mean, it was put on ice because they were like, this is too complex at the moment, and I can build it, but I don't know if they're going to come. Well, maybe this is a signal that they're going to come. Apple doesn't use Intel to make its chips. It designs its own in-house, then it leans on TSMC. NVIDIA does the same. NVIDIA designs chips, and most of them are made by TSMC. But NVIDIA put in money. Now, if you can persuade Apple that strategically they could work better together, this would really help Tim Cook, that $600 billion deployment that he's promised into US in terms of domestic manufacturing and AI focus on servers, training. But that's a lot of money to put to work. It would be nice if he could help back Intel. Intel added $8 billion in market cap yesterday on the back of it.
Yeah, I mean, it could really help Donald Trump, right? Because remember, he got this 10% stake, and then he somehow convinced NVIDIA to buy a $5 billion stake. Maybe Apple wants to take a stake. It could be good for their business, right? It could be good for them if they start doing more business with Intel, and I'm sure that's part of the calculus. I want to ask about, speaking of calculus, quantum computing, because it seemed like there was no real use case for it yet, but HSBC says it can help them price bonds 35% better than they could have previously, or predicts bond prices.
And real tangible data there. They're saying, look, this wasn't an out in the wild actually pricing in the real market, but running as if it would. And they got so much more efficient pricing. Everyone's going to run to catch up with this. It's interesting that, of course, IBM is rising pre-market on the back of this. This is the provider of quantum. It's Quantinuum who helped JP Morgan make a breakthrough previously when it came to quantum computing and the ability to find really certified, truly random numbers. That's helpful in cryptography. It's helpful in just understanding that transactions has actually helped and gone forward. But we're seeing basically a race going on. IBM has already put its stake in the ground. We will have a fit-for-purpose quantum computer in 2029. They're already in the wild with plenty of people experimenting, and HSBC is one of the key clients that have shown that this is really working in some way to make their business more efficient. But in the same way that AI has set off this firestorm in the financial services, everyone's racing to use it within their own quant strategies and be able to make more efficient in terms of pricing data, so too, quantum is the next iteration. It's using in parallel an ability to solve so many problems simultaneously. This is just going to make the world of AI supersonic.
By the way, we just showed a 5-year chart of IBM. That's just the price
record
change.
high, yeah.
If you adjust for dividends reinvested, so total return analysis, they have tripled, up 192%. They have far outperformed Amazon on a 5-year basis, and they have even outperformed Microsoft on a 5-year basis. So they're neck and neck right now with Meta. They're doing just as well as a lot of these hyperscalers, and that was pretty surprising to me. Carolyn Hyde co-anchors Bloomberg Tech with Ed Ludlow. You can catch her program starting at 11 a.m. They're going to talk, obviously, a lot about quantum computing, as well as Intel and Apple, I imagine. We mentioned Starbucks approving a restructuring plan that includes job cuts and store closures. Let's talk about that with Bloomberg's Shelley Banjo. She's our managing editor for Global Business. And Shelley, this is Brian Nichols' second round of job cuts since he took over a little over a year ago. Since then, Starbucks shares are down 6%. So, like, is he going to finally do something to make these moves in the right direction?
I think that's what investors are hoping. We saw the shares pretty much flat on this news, and you might be wondering why. I think it's about, could they have gone a little bit deeper? But in general, people, I think, want to see him right-size this store fleet. They want to see him get this stuff right, get rid of the stores that are not performing, that haven't performed in a very long time, and start reinvesting that money into refurbishing. They said they're going to refurbish about 1,000 other stores and then start building again come next year.
But he already made all these splashy announcements, things like, we can refill milk on our own, which I guess is super appealing, that they're going to cut the menu down and not have as many crazy orders for baristas to do. Is this a sign that that turnaround so far hasn't taken hold, that those measures haven't yet helped?
I think a lot of that is aesthetics at the front. You know, let me put some splashy announcements so that people start coming back into our stores. They start pouring their milk again. And that was actually a thing people really, really wanted, and it seems to have made a difference. Then it comes the hard part, right? We got to close actual stores. We got to fire actual people, pay those restructuring costs. This one in particular is $1 billion of restructuring costs. That takes time. That doesn't really tend to resonate with customers. In fact, it's bad press often when, you know, you shut a store down and people lose their jobs. And so a lot of this is the hard part, but is impeccable and important to get this company, you know, operating as it should be.
I want to finally ask you about CarMax. I know it's very different business than Starbucks, but you cover
We do it all. We do it all here at
global business,
Bloomberg.
and you sit next to Rick Clough, who's our transport, our autos
True.
team leader here in the Americas. I thought that people were going to be buying more used cars because, you know, new cars are so expensive and people are trying to save money, and yet they missed on the top and bottom line at CarMax.
You're not wrong. People are buying more used cars, but this is an instance where you saw a lot of pull forward because of the tariffs. You saw a big frenzy of buying back in April after the Liberation Day and the tariff announcements. And so we're lapping some of those things. And also, you know, as a lot of people, you know, went into new cars, some of the used car business fell down a little bit.
Yeah, shares getting smashed this morning, down 16%, adding to a 30% year-to-date decline. Shelley, thank you so much for joining. That is Bloomberg's Shelley Banjo. Now, all of those things would seem to suggest that this is an economy in trouble. Not so, according to the economic data released in the last hour. It showed the U.S. economy growing at the fastest pace in nearly 2 years, thanks to consumer spending, though apparently not on used cars. Fed Governor Stephen Miron spoke to Bloomberg ahead of that data on the next steps for the Fed.
My view is not one of enormous economic pessimism. You know, I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy.
I wonder if you would still call it as restrictive with this latest batch of data in hand. Joining us now is Michael McKee, Bloomberg International Economics and Policy Correspondent. Mike, can we talk about the data? Jobless claims, GDP, what did it show?
Basically, it shows it's a tough day for the Trump administration because on the one hand, they want you to believe that the interest rate should be cut significantly, but the data are telling a totally different story, one that the administration could embrace because, as you mentioned, we get strong GDP growth and we have this odd situation that the Fed's been talking about, low hiring but low firing, with jobless claims falling to 218,000. Durable goods orders were up 2.9%, and as part of GDP, the increase in GDP, we saw an increase in business spending overall. Now, durable goods is interesting. You're talking about Intel, but computers and computer chip orders were down during the month. Even though we saw a big increase in durables, it was mostly airplanes. The trade good balance shows the effect of tariffs, $85.5 billion, because imports fell by a huge amount, over 4% in July after rising significantly because basically we saw people pulling forward expenses. As you mentioned, GDP up 3.8%, revised up from 3.3%. Consumer spending pushing that higher, business spending pushing that higher. So where do we go from here? Well, we know where Governor Miron is, and now we're beginning to see where more members of the Fed are. We have a lot of Fed speak today, and the first three have been out. You heard from Miron, Austin Goolsbee a few minutes ago saying he's not sure they should front load rate cuts given where the economy is, and Jeff Schmidt, who is perhaps the most hawkish of all the Fed governors, just out with a speech this morning saying that inflation's too high. The labor market, though cooling, still remains largely in balance, and he views the current stance of policy as only slightly restrictive, which I think is the right place to be. So he's not calling for rate cuts either. Mr. Miron, I think, is on his own island at this point.
All right, Mike, thanks very much. Michael McKee there in Washington, D.C. Let's get a quick check on futures. Just about 20 minutes to go until the start of trading. Looking at red arrows across the board. S&P futures down about 0.5%. NASDAQ futures off even more, 0.75%. And Russell futures down by more than 1%. So we have some pretty significant declines in futures after what has already been a couple days in a row of losses.
Yeah, and that is also being fueled by what we're seeing in this bond market. Yields are higher across the board. The 2-year yield goes up by 3 basis points, 10-year also 3 basis points. We are trading at around the highest in about 3 weeks. So that causing the pain, especially in the small cap index that you pointed out.
Yeah, absolutely. They need those rate cuts that Myron is pushing for because a lot of the small caps
are unprofitable.
Don't make any money
Correct.
At all. Coming up, the U.S. lowers tariffs on auto imports from the EU, not to a level that you may not have expected, but to the level that they had already promised, and prepares for levies on medical devices. Your trade roundup next. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bloomberg Screen Time is back this fall for year 3. We're bringing together the biggest names in business and pop culture, like Netflix co-CEO Greg Peters, Instagram boss Adam Mosseri, and Los Angeles royalty Will Obey. We're going to talk about how sports is eating entertainment, check in on the state of the movie business, and get an update on LA after the fires from Rick Caruso and Irving Azoff. You should expect newsy interviews from industry leaders, meaningful business networking, and of course, great food. We'll feature some of the best chefs and food trucks from my hometown of Los Angeles. Tickets are available now, and you should head to bloomberglive.com/screentime for details. I'll see you in Los Angeles, October 8th and 9th.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. Former French President Nicolas Sarkozy has been sentenced to 5 years in jail for criminal conspiracy after judges found his 2007 campaign was secretly bankrolled by Gaddafi's regime. Sarkozy, who denies wrongdoing, was cleared of more serious corruption charges, but must begin serving his term within a month. The White House Budget Office is ordering federal agencies to draft plans for mass firings if Congress doesn't fund the government by October 1st. That's a sharp break from past shutdowns when most non-essential workers were only furloughed and later paid back. Democrats call it intimidation, and Senate Minority Leader Chuck Schumer is warning the move will end up reversed in court. And Jimmy Kimmel's late night return earlier this week pulled in 6.3 million viewers. That's the biggest audience ever in his regular slot, quadruple this year's average, despite the fact that Sinclair and Nexstar stations didn't air the show in major markets. The spike follows Kimmel's suspension over remarks about conservative activist Charlie Kirk. His opening monologue has racked up over 26 million views online. Joe Matthew yesterday was talking a lot on Balance of Power about the fact that they couldn't see it in Washington. And I wanted to call up Joe and tell him about this thing called streaming or YouTube. You don't have to have cable to watch it. You can just have Disney Plus.
Does Disney get the same amount of revenue, though, if you're just watching a video on YouTube? Probably not, right?
I don't think so. But the point is, you don't need the normal linear television setup. You don't need bunny ears to watch ABC, NBC, and CBS. They all have streaming content that you can watch anywhere, whether or not Sinclair decides to broadcast in your region.
Which is like kind of bad for Sinclair and Nexstar, for people to be like, we don't need you. We can just go look at this stuff online.
Apparently not everyone's figured it out yet, but a lot of people have figured it out.
That they have, and a lot of people clearly watched on cable too, of those that could. Elsewhere, Matt, there are a number of developments on the trade front. The U.S. has officially lowered tariffs on European Union auto imports to 15%, a win for the bloc. Meanwhile, the Trump administration launched investigations into imports of robotics, industrial machinery, and medical devices. Let's discuss with Bloomberg's global trade czar, Brendan Murray. Brendan, a reminder that none of this is settled. Let's start with the 15% tariff on autos from the EU. It's something that the bloc had wanted. They'd wanted relief. How big of a win is this for them?
Yeah, exactly. It's not exactly a win if you pay 15% more for your exports to go to another country, but it's a relief because the previous level was 27.5%. So this is something that European automakers have been waiting 2 months for. It's backdated to August 1st, so there's a sense that that they can deal with 15%. It's not exactly a best case scenario, but it's something they can absorb and we'll just have to deal with. The big question now between the U.S. and the EU is, can they address the 50% steel and aluminum tariffs? Those sky-high rates are hurting the exports of European steel and aluminum to the U.S. They're the largest suppliers to the U.S. market, so that's a big issue that still needs to be addressed. They're going to try to work out some sort of quota arrangement where some quantity could be imported into the U.S. At low or zero tariffs, but that's still an issue that needs to be worked out. It's going to be a thorny one because the Trump administration really wants to put a tariff wall around their steel and aluminum industries.
Well, and this is a benefit in a couple of ways for European, Japanese, and South Korean automakers, Brendan, in that they have certainty, first off, but also, that 15% tariff doesn't look so bad if you're looking at Ford, Tesla, and GM that are paying those 50% tariffs on steel, 50% on aluminum, 25% on components made overseas, like 80% on anything you get out of China, which is a lot of stuff. So, Ford says, for instance, the cars that they make, when they go head-to-head with cars out of Japan or South Korea, are still far more expensive, like $10,000 more compared to $5,000 for those that only have to pay a 15% flat tax.
Yeah, exactly. I mean, I think what you're describing there is just the complexity of this tariff policy that the Trump administration is rolling out. For every industry that you help, that you protect, you hit another one over the head. And this is just going to continue to happen. We now have 12 sectoral investigations ongoing, which could lead to tariffs, these so-called 232 cases. These are the ones that are coming on pharmaceuticals and chips and critical minerals. We just got word yesterday about the robotics and the medical equipment are subject to these investigations now. So this is Plan B if the administration loses the Supreme Court case on these broader country-by-country reciprocal tariffs, that they can hit these industries pretty hard and with a legally solid authority to use these tariffs. But when you start mixing them all together, it gets very complicated to pick winners and losers. Eventually, you just create this massive bureaucracy that hurts a lot of companies.
Yeah, it really has a feeling of one step forward, 2 steps back. Brendan, thank you so much for joining us on that. That is Bloomberg's Brendan Murray. And speaking of cars, We talk the ultimate car. It is McLaren Racing's team, which is now valued at over $4 billion in its latest stake sale. We're going to speak to the CEO, Zach Brown, a conversation that we are excited for. Will Piastri win the Drivers' Championship? Will they finally get the Constructors' win? That looks to be on the docket in their next race. All of that, stay with us. This is Bloomberg Open Interest.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Stocks may not be in bubble territory. That is according to strategists at Bank of America. The team led by Savita Subramanian told clients that, quote, the S&P 500 index has changed significantly from the 80s, 90s, and 2000s. Perhaps we should anchor to today's multiples as the new normal rather than expecting mean reversion to a bygone era. That is a stark difference from many on Wall Street who have compared AI stocks to the dot-com bubble. Joining us now around the desk is Alpine Saxon Woods Chief Market Strategist Sarah Hunt. Sarah, this time is different. We always say it every time we think times are different, and then it's not. But the thing is that if this is a bubble, it can run a whole lot longer before something bursts. Just how are you thinking about this environment and the huge run-up we've had specifically in AI-related stocks?
Well, not to date myself, but I was around for for some of the changes that happened in those marketplaces. And the parallel between now and the dot-com bubble, for me, is a little bit disingenuous, only because at that point in time, you were seeing a lot of customers being financed by their vendors. So a lot of the sales, now this is the argument.
You mean like NVIDIA?
I was going to say that.
And I was just about to say, and now we have a round robin of one, but it is one where the cash actually exists. This isn't something where people are giving you credit for buying something because you want the sale. There's actually a lot of cash being generated by these companies, so that the customers have the cash to do it. The question will be when that spending uptake starts to slow down, because even if you don't stop spending, any acceleration that decelerates, markets don't like that, investors don't like that, and that's where you start to see cracks in the margin, and that's where you keep seeing these little moments in the tech sector where
the stocks have a problem because people are starting to worry about that cadence of spending.
But are we really going to see a return on these investments? I mean, so far, I haven't seen many practical use cases. HSBC was pretty cool today with their bond pricing.
So that's the other.
That's not even AI. That's quantum.
That's
computing.
quantum computing, and that's the other issue. But if you think also about all that money that was spent on dark fiber, how long did it take to get absorbed? But then you started to have fiber shortages again. So I don't know what the answer is in the near term, but I think from right now, people are much more worried, as I think Facebook put it, than of underspending than overspending.
All right, we're going to keep you here with us because we have a lot more to talk about than just this, one question. Although I think it's pretty fair to say that's been a huge market driver. Sarah Hunt staying with us. Check on futures as we head to the opening bell. We're down for a third session in a row. If we open this way, and it looks like, of course, we will, because there are only 4 minutes to go. Down 0.5% on S&P futures, down 2/3% on NASDAQ futures, and the Russell down more than 1%. We'll be right back with your market open. This is Bloomberg.
For Trung Jobin, you're never too young to learn AI. That's why he's urging the government for school kids as young as 6 to be taught how to use it.
Within this system, from first grade, they all start with the AI education. They play 4 years, just playing. And then from 5th grade, they start to develop AI by themselves. And STEM and robotics, I see very clearly how Vietnam should be in future. Vietnam just about 100 million people, young people, good education, and latest technology. That's the only way to go. Education not contribute much profit for equity, but from the country point of view, that's most useful contribution, what equity should do. And today we're thinking about every kids, not in cities like Hanoi or Ho Chi Minh City, but kids in the countryside should got the good education. That's what we're going to do now.
So you're leapfrogging?
Yes, exactly.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question. I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
We are moments away from the start of trading. I'm Matt Miller. This is Bloomberg Open Interest, looking at a real drop in futures here, 0.5% on S&P futures. We're down 2/3 on NASDAQ futures, and Russell 2000 and small cap futures down more than 1% because, at least in part, we have really strong economic data out, and that doesn't bode well for the Stephen Myron camp. Why would we need, 100, 150 basis points of rate cuts by the end of the year if the economy is growing at 3.8% and jobless claims are coming in at a low? Ringing the bell, the New York Stock Exchange, you've got Lee Jae-myung, His Excellency Lee Jae-myung, the president of South Korea, to celebrate the 80th anniversary of the UN at the UN General Assembly. I'm sure he was just electrified by President Trump's speech the other day. Down at the NASDAQ, you've got Kodiak, which is, I'm going to say it's like some kind of AI autonomous vehicle SPAC. In any case, I'm sure we'll hear much more about that in the months and years to come. Danny, what stocks are you watching?
I am watching Starbucks this morning, Matt. Sure, it's not the biggest mover, but it is noteworthy what they're doing. They're down just about 0.3%, and they say that they're going to be closing several stores. They're also going to be cutting 900 jobs. All of this is part of a $1 billion restructuring plan. Overall store count for them, that drops by 1% during its 2025 fiscal year. And Matt, that also comes off the back of all the changes they've tried to make, like you can pour your own milk now. They tried to put things like boba in the stores and cut down on the complexity of drinks. But I guess those are all just cute things, and you actually need to start firing people and closing stores to make change.
I mean, they have over 18,000 stores, and the ones that I've been in aren't so impressive. So maybe,
you can't sit in them anymore. Have you noticed that they've like taken out seating in so many Starbucks? I'm trying to sit, drink a coffee, and relax.
It's just not chill. But maybe it will become chiller. Intel is set to extend Wednesday's rally after Bloomberg reported it approached Apple about securing an investment. You know, hey, Tim, you can do this the easy way or you can do this the hard way, you know? That follows a $5 billion partnership with NVIDIA and, of course, the 10% stake from the U.S. government. Right now, those shares are up 1%, but to me, this is something we can talk just briefly with Alpine Saxon Woods Chief Market Strategist Sarah Hunt about. I feel like if the government is buying these companies, right, and you want to get on the good side of the president in order so that your business goes more smoothly and you don't have regulatory problems down the line, maybe you chip in a little bit, right?
Well, it's an interesting confluence of events, because if the idea is we want strategic items made in the United States, then Intel makes sense in terms of you can actually produce chips here, because one of the biggest concerns about that post the pandemic was a shortage of things and then tensions between China and Taiwan. So
it's a good point, and that's not safe, right? I mean, we need to be able to make chips for national security.
We need that. If it was a different kind of investment, then I think the questions would also be different. So this is one of those things where it's an and, where the government is doing it and it makes sense strategically for companies that are here to be doing it as well. Is that the case in all industries? That's a different question, and I'm not sure I would answer it that way. But I would make the argument that similar to chips, pharma would make sense to have more stuff produced here, because you don't want to be dependent on other countries for ingredients. There are a lot of things that you could argue we gave away strategically that we want to now pull back. Is that going to work? I don't know. We're in the process of trying to find out.
So, Sarah, is it time to brush out the list of companies, look through each individual one, say maybe who's gotten a loan from the U.S. government, who looks to be crucial for security, and just start buying up those companies, assuming the government's going to buy a stake in them?
Well, interestingly, even the defense companies have rallied, but there was a period of time where the defense companies, where you would argue we're still going to need a lot of defense, were looked at as we don't really want to own these right now. So I think that there is a yes to that, but there is a fashion that goes through, a momentum and a fashion that goes through investing themes, and whether or not those themes can stay forever is really the question. And I think you're getting a look at that now, because some of the quantum computing, to your point earlier, is one of those areas where the valuations aren't really there, but the theme is driving them so strongly. So I think that there is a point to that, but it doesn't always guarantee the things.
What's your take on the Fed? It's such an interesting, we all love the kind of macro chat here, but it's such an interesting day to watch Stephen Myron do the rounds on cable news and say, like, the economy's in a difficult position. Everything's slowing down. Rates are excessively restrictive, right? And then you see GDP come out at 3.8%.
So I think that there are a couple of different factors going on there as well. The first one is we still don't really understand the pull through, how strong that's been, whether or not that's going to come to be a problem. I think
tariffs.
Right. So I think that the idea that we are going to need some stimulus may be coming from the idea that the tariffs are finally going to hit, things are going to slow down. I don't know the answer to that. The employment numbers, I mean, this is one of those instances where the future's changed very rapidly, because now good news is bad news, because it means the Fed doesn't necessarily have to cut, and bad news has been bad news, bad news has been good news. So we're back in that area where it's all about monetary policy. But the question really is, does monetary policy, can it fix the things that we think are going to be the problem? And I'm not sure the answer to that is yes, but that's the argument that you're going to have because that's the argument that you can have.
Right. By the way, Myron's argument isn't necessarily that the economy is really bad. It's just that it could get really bad because we're too restrictive. So maybe he would look at today's data and
because
say,
we're too restrictive and because we're putting massive tariffs on all of these companies, right?
Well, and because of immigration, he thinks so too. But Sarah, this underscores the point, is that there's a lot unknown.
Hang on, so Myron's saying the economy could get really bad because we're doing mass deportations and we're putting massive tariffs on our trading partners.
No,
so let's use the Fed as a tool to make this policy a little bit more
Not exactly.
digestible.
His argument is that less immigration and tariffs, all else equal, lowers the neutral rate. And the neutral rate is much lower than where the Fed is. Not that the economy is bad, but just that the neutral rate is lower. But Sarah, I mean, this is a concept that people really struggle to understand what the neutral rate actually is. Could we be in an environment where next year the Fed is making policy over something that's really squishy and difficult to understand, and maybe gets over their skis in rate cuts to get to this philosophical level that, again, we don't know what it is?
I think that the inflation data is going to be the guide on that, because I think that it is harder and harder to make that argument if you see inflation going in the wrong direction. If inflation is quiescent or stays less problematic, that's going to be the debate. If inflation picks its head up, that debate is going off the table, and the debate that you're going to have is, it doesn't matter right now what the neutral rate is. Inflation is so bad that we have to do something about it. And if the labor market is where it is right now, it's looking not nearly as scary as people keep thinking it was. And this is very similar to the scare that we had last year, where the numbers were really bad in August. September created a big 50 basis point change. And then this year it was sort of like, well, we don't know, but we should do something. And you could argue that the Fed rate, the Fed funds rate, was a little on the elevated side. Now it's it's going to be a different debate each time, depending on where the data shakes out.
By the way, to their credit, at least so far, tariffs don't seem to have destroyed the economy, and inflation hasn't really picked up. I mean, I know the Fed says 2%, but we all know they don't mean that, right? 3% is really where they feel comfortable. If we stay here, is it a surprise to you that we've done so well keeping inflation in check and, continuing to grow with these massive tariffs?
So this is the big question about what tariff rates are actually hitting whom at what time. How much pull forward is there? Is that one of the reasons that GDP is up so much, because people pulled forward? What was the import? What does it look like? It changed in July, but you had a massive move higher in June because people were bringing goods in. When does that run out? And I would argue that if you can keep moving the tariff rates around like we have been doing, you pull forward and it continues to look good, and then people say the economy is really great. Is there a point where it falls off a cliff? I don't know. Does it slow down a lot? Do people just go, here's to CarMax's point, right? I bought a new car because I was afraid it was going to cost too much, and now I didn't buy a used car, but now I have a car. So to what level are we front-running our own economic activity?
By the way, does the equity market keep trading higher if we keep getting good news, or do we get more days like today if that happens?
I think that if you keep getting good news on the hard data front, like GDP and sales, yes, because that's earnings, right? It's all about earnings, and it's all about that change in direction. If that direction looks higher, the market keeps going. If that direction starts to wobble, the market starts to wobble. And if people start baking in, third quarter numbers are going to be really important. The commentary is going to be important, because that's going to be where the rubber may be hitting the road on tariffs and or what's going to happen in the next couple of quarters. I don't think you're going to get a lot of forward guidance in the third quarter, but people are going to be parsing through what companies say, because it's all going to be about margins, because margins lead to earnings, and if earnings come down, we have a problem.
Sarah, this has been so excellent. A masterclass. Sarah Hunt, Alpine Saxon Woods Chief Market Strategist. Please come join us again soon. All right, let's get a check on your equity market this morning. About 10 minutes into your trade, we're lower by 0.7%. What is leading us there? Let's go straight to the decliner column. It is NVIDIA, Broadcom, Tesla, Oracle. It is all the very highly valued stocks. So there are a little bit of jitters in this market. Oracle down after a downgrade this morning. Actually, was Redburn initiating coverage saying that they are trading on headlines, not fundamentals. When it comes to the price action for the individual sectors, by the way, IBM, that one's gaining off that HSBC thing. Energy at the top, as oil has been continuing to gain at the bottom. Communications, infotech. So Matt, it seems to be a market where the most expensive things are the ones leading the declines this morning.
Yeah, very interesting stuff. I'm I'm a little bit distracted because I just keep thinking about Formula One, and I know we need to stay focused.
I'm excited about that too, Matt.
On markets, and you know, we just opened up, so we are continuing to watch these markets. The S&P 500 down 0.8%. Coming up, Oracle under pressure after it gets a rare sell rating on Wall Street, but they were successful in selling like $1 gazillion worth of bonds. So we'll talk about that, and Zach Brown is going to join us after Top Calls. This is Bloomberg Open Interest.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Let's get you some top calls. Some of the analyst action that we are watching this morning. First up, Oracle gets initiated with a rare sell rating. That's at Rothschild and Redburn. The firm is warning that the cloud boom, that is just overstated. Its price target is $175. That would imply a 43% decrease from the last close. Shares down nearly 6%. Next up, Lululemon. That gets downgraded at Needham because the competitive environment is too challenging. Needham recommends moving to the sidelines until Lululemon can, quote, right the ship. Those shares down almost 3%. Meanwhile, Wendy's, that gets downgraded at North Coast Research. The analysts say the fast food chain lacks leadership, market direction, and momentum, and warns that 100 stores could be at risk. Matt, those shares down 1.5%.
It's delicious. Delicious. My favorite store was closed on Broad Street in Columbus, Ohio.
I honestly can't remember the last time I've had Wendy's, so I can't participate in this.
Yeah, well, I grew up in Columbus, so it's an important restaurant there. Coming up, speaking of important, investors pile into F1 as the popularity of the sport continues to speed ahead. We'll talk with Zach Brown, McLaren Racing CEO, next. This is Bloomberg Open Interest.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The team currently at the top of the F1 championship standings is winning in more ways than one. McLaren Racing was valued this month at over $4.1 billion in a stake sale, the valuation underscoring the increased investor interest in a growing sport. Joining us now is Zach Brown, McLaren Racing CEO. He's also the author of the upcoming book, 7/10 of a Second, which will hit shelves later this year. Danny is very excited to read this book. I mean, I want to read it too, but she's the bigger F1 fan.
I will be the first buyer.
Well, I hope you enjoy it.
Thank you.
I hope you enjoy it.
Tell us first about the valuations. And I'm not, did that stake sale go through? Is that
we're all done? We're all done and dusted.
So, man, these valuations continue to just fly. I mean, that's double what it was last time I spoke with you.
The sport is on fire. Yeah. You know, every metric, demand for teams. You know, it wasn't long ago before Liberty acquired the sport and put a cost cap in place, which kind of ensured everyone's financial stability and on track stability and competitiveness. So it's been a wonderful thing. The fans are coming out in the tens and hundreds of millions. Sponsors, partners in the sport, unlike we've ever seen before. So the sport is on fire, and long may it continue.
There's always calls out there when sport valuations pick up that it's a bubble. Redburn's and the Milan owner, for example, has been calling out sports valuations are in a bubble. How do you think about it? Because you are at the top of your game right now. You are in serious race to have both the constructors and championship victory, but also you're going to get regulation changes coming in next year. So have we kind of hit a ceiling in how high valuations can go?
I don't think so. I think if you look at sports in general, and I wouldn't say I'm an expert in all sports by any means, but they've only been going north forever. And, you know, every time there's a kind of record deal in whatever sport it is, everyone goes, oh, that was crazy. And then you look back and in 5 years, they've still gone up. So I think our sport in particular has a lot of room for growth. We have 24 races. We have demand for probably 30 Grand Prix. So the demand is strong. Our car is, has the best brands in the world, the MasterCards, the Googles, et cetera. The competition is amazing. Last year, 4 teams won, 7 different drivers won multiple races. It's the first time I've seen that in my 30 years of following the sport. So the on-track competition is great. The off-track drama, as captured by Netflix, is fantastic. The demand for Grand Prix has never been stronger. So I think the sport, in many ways, is just getting going.
You have also, I think, 53, or last I checked earlier this year, 53 commercial partners, and you've generated the most revenue of any team in F1 history. How do you go about that? Since you're so focused on cars and racing, and you're dealing with Norris and Piastri, and you're focused on aero, like how do you take off the sports hat and put on the business hat?
Well, fortunately, we're a big organization, and Andrea Stella has done a wonderful job running our racing team. So he focuses on the on-track performance, and I focus on running the business. And of course, we're about 1,400 people inside McLaren, so it's definitely not the two of us. We just have our leadership roles, and we're very focused on our partners. We're very focused on our fans, because you need to have every part of your racing team, not just the technical side, operating as we call world championship materials. So whether it's your CFO around your cost cap, or your head of HR around culture, which is what's made our team so strong, our commercial team, everything has to be firing on all cylinders. Sorry to use the pun.
Yeah, I wish there were more cylinders.
Maybe the regulations in 2026 will get there. But Zach, I mean, this is kind of where like the drama bleeds into the sport and the business of the sport, right? Especially with a more diverse viewership coming in. I know you've been very open in saying Christian Horner leaving F1 is good for the sport, or at least it's in a healthier place. There have been rumors that he's going to be able to come back now and maybe will next year. What do you make of that for the sport if he does come back?
I mean, he's had a stellar career in Formula One. His results are lots of driver championships, world championships. So I think when you get into sport, not everyone's best friends. There's different characters. So while we may not have too many cups of tea in England, as we say, you know, you need also different types of characters in the sport. And I think that's what makes the sport very exciting. You know, that's that kind of Netflix effect is what happens off the track. And I think our sport's unique in that not only is the competition on the field of play extremely exciting, there's a lot of competition off the field of play, and it's a small group of, you know, team bosses and drivers, so I think the fans can kind of get to know us all. And yeah, so I've got my friends in pit lane and some that aren't, but I think that's what makes it exciting, and it's authentic and genuine.
It's very fun. I will say that we now have Gunther Steiner in MotoGP. So my family, we watch the motorcycles, and it's awesome to see Gunther come over from Haas.
He's a great personality.
He's
definitely a character.
He's so much fun, and that makes it all the more fun to follow. Like, we've been able to get into that because of the Netflix documentary. Do you think, on balance, that's, I mean, is that only good for F1?
It's only good. If we look at what Formula One, where we needed to continue to grow the sport, kind of pre-Netflix, pre-Liberty, it was North America, right? The sport's huge everywhere, but North America, we had one race, and it was kind of a second-tier sport. Now we have 3 races, and it is a major sport in North America. Tick. Youth, because that's all of our future, and we've brought in a lot of youth, and then women in diversity. So the sport over the last 5-6 years under Liberty's ownership has really modernized and become a very inclusive sport versus what was a very exclusive sport. And you saw it took a little bit of change when Netflix came out. 2 teams didn't participate because it wasn't kind of, we're not going to open our doors. And then when we did, and you saw the fandom that came and the exposure it brought for our sponsors, I think they went, uh-oh, I think we need to be in this next time. And so it's been wonderful. And I think the sport now recognizes that without taking care of our fans, we don't have a sport. And I very much believe sport is entertainment. Anytime you're buying a ticket, whether it's for a movie, a sporting event, a rock concert, that's entertainment. So we need to put on a good show for our fans.
But it's beyond athletics, right? I mean, because now Lando and Oscar and you, and you know, you've got to deal with this intrusion into almost into your personal life as well.
Yeah, but you know what? We're in the public spotlight, and that's how our sport works. So if you're not comfortable with that, maybe you should pick a different job. And so I remember my first ever Grand Prix, 1981 Long Beach Grand Prix. I met my first Formula One driver. I saw the cars and the impression it left on me. So at McLaren, you know, there's not a photo or an autograph that we don't stop for, whether it's a driver or myself or Andrea, because you want to leave that lasting impression that I have from 1981 of I remember it like it was yesterday. And we've all met athletes over the years that you were a bit disappointed once you met them. And so therefore,
Don't meet your heroes.
it was a St. Louis Cardinal. I'm a Cardinals guy. But, you know, being good 95% of the time isn't enough, because those 5%, it's kind of a heartbreaker. So, you know, you got to be on your A game all the time. And whether it's a restaurant, you can't control when people see you and they want to talk to you. They're excited. They want to learn about the sport. And so I enjoy it.
So you still like going out to restaurants?
100%, 100%.
Zach, we can't let you go with just asking about the rest of the season, because you've essentially got the Constructors' Championship essentially wrapped up. How much of your attention now is shifting to the drivers? And how much of a threat do you think someone like Verstappen could come up and really threaten, be it Lando or
a disruptor?
Oscars? A disruptor, yes.
I think you got to pay attention to Max. We got to keep doing what we're doing. The Constructors is looking very good. You know, we had a chance to wrap it up in Baku, but let's not talk about Baku. Hopefully we can get the job done in Singapore. And what we want to do is we want our two drivers and Max, but we'd like to kind of get them out of there, to fight for the championship and just give them equal opportunity, equal equipment, which is what we're doing, and kind of may the best man win. That's what we want to do. We'd like to not play a role if at all possible, but you get into, you know, Lando had a mechanical and things can happen and safety cars and things of that nature. But I think our goal is to just set Lando and Oscar up to be competing for the championship down to Abu Dhabi, and may the best driver win.
All right, well, that is an excellent way to put it, and great place to end it. Zach, thanks so much for joining us. Zach Brown, they're the CEO of McLaren Racing. Coming up in the next hour, Morgan Stanley's Caterina Simonetti joins us on the FOMO that's emboldened retail traders, and the CEO of Nutrabolt, the company behind C4, plus the Prime Minister of Holland. This is Bloomberg.
Do you know what to tell people about what the tariffs are going to do on the United States economy and the investment environment, or is it not clear yet?
If you look at the impact of the tariffs, they were much more significant and broad than I think the market expected. Looks closer to 19% on balance versus 2 and change last year. So effectively, it's a 20% increase on 10% of household goods that are imported into this country.
And do you think it's going to lead to a recession?
Well, we think that it's going to impact both inflation and the economic growth scenario. So we were coming into yesterday expecting the real economy to grow at 2%. And inflation to be closer to 2.8%. If you just go through the math, it would suggest there's probably 1 to 2 points upward increase on inflation and a similar amount on economic growth. So it could put us in a position where we're teetering.
So the tariffs will likely depress the GDP growth rate and increase inflation. So what's the advantage of tariffs?
From our standpoint, we have a hard time seeing the benefits of tariffs. They do tend to be inflationary in the short term. As you're pointing out, the longer term impact on economies is probably the greater downside.
Good morning.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. A dramatic upgrade on growth. The Commerce Department's revised reading shows the economy expanded at a surprising rate of 3.8% from April through June. Economist Gus Fauché.
So the economy looks even stronger in the spring, early summer of 2020-25 than we initially thought. There was an upward revision, particularly to consumer spending. So we continue to see consumers increase their spending, at least through the middle of this year.
Palestinian leader Mahmoud Abbas is addressing the UN General Assembly via video right now. He called on all countries to recognize a Palestinian state and assured through an interpreter,
we are ready to bear full responsibility for governance and security there. Hamas will not have a role to play in governance.
He condemned the October 7th attack against Israel. Sources tell CBS News federal prosecutors will make a decision on whether to comply with an order from President Trump to indict former FBI Director James Comey before the statute of limitations expires next week. Former Justice Department official Tom Dupree.
What is different about this case is that there clearly has been significant presidential pressure brought to bear, and you don't want a universe in which that pressure distorts the prosecutorial judgment.
Trump allies have accused Comey of lying to Congress 5 years ago when he testified about Russian interference in the 2016 election. 2 students at Syracuse University have been charged with a hate crime for disrupting a holiday observance at a Jewish frat.
Witnesses say one suspect entered the Jewish fraternity house and threw an open bag of pork inside during Rosh Hashanah observances for the Jewish New Year. A second suspect is accused of driving a getaway car. Brian Raphael is president of the group End Anti-Semitism Now.
It's really upsetting and very frightening for the whole community that this can happen.
The DA says the religious implications of pork being thrown into a Jewish fraternity house make this a hate crime, not a college prank. The 2 suspects are Syracuse University sophomores. Peter King, CBS News, Canastota, New York.
In Paris,
Je suis donc condamné.
70-year-old former French President Nicolas Sarkozy says he'll sleep in prison with his head held high after he was convicted of receiving millions of euros for an early 2000s political campaign from Muammar Gaddafi's Libyan regime. The BBC's Hugh Schofield was in the courtroom.
Not only was the former president sent to jail, but the particularly harsh terms of the sentence mean he should now be incarcerated even if he lodges an appeal.
And he says he will. Dow down 200. This is CBS News. The number of measles cases is still rising in the Southwest.
A month after health officials declared a major measles outbreak in West Texas over, infections continue to rise in parts of Arizona and Utah. As of this week, 52 cases have been reported in Arizona, mostly in the northern part of the state, and 42 have been confirmed in Utah, mostly in the southwestern portion near the Arizona line. The CDC says the number of known measles cases in the U.S. this year now tops 1,500, the most since 1992, with 3 deaths reported. Steve Kathan, CBS News.
Starbucks is set to make big cuts. CEO Brian Nichols says the coffee chain will lay off more than 900 corporate workers tomorrow and eliminate many open positions. It'll also close about 1% of its locations in North America. He says it's in order to trim costs and plow money into improving cafes. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Scarlett Fu, Paul Sweeney, live here in New York. We're streaming live on YouTube as well. This is the Bloomberg Intelligence program. Lots of economic data. We'll get to that later. But boy, the GDP numbers, Scarlett, were really good.
Which is a surprise. It was a third read of this data point.
And the personal consumption was up. So it looks like the economy's kind of hanging in there.
No need to cut rates, right?
No need to cut rates. That's what I would say, but who knows? All right, we're going to check in with Ed Ludlow. He's our B-Tech co-anchor. He does all the technology stuff. I want to ask him about this Intel talking to Apple. That would be something.
That's a Bloomberg scoop, by the way.
That is a Bloomberg scoop. That is a green B. That is right on the Bloomberg terminal. And Starbucks, yet again, another restructuring. Scarlett and I were just saying, don't they always kind of restructuring here? But Michael Halen, he's the restaurant analyst of Bloomberg Intelligence. He'll break it down for us. Dana Dioria, co-CIO and group president at InvestNet Solutions, give us her market outlook. It is Environment Week here in New York City. Jessica Roswell, European Commissioner for Environment, Water Resilience, and Competitive Circular Economy. She's going to talk to us in studio on the link between environmental protection and economic growth there. So we'll have an interesting conversation there. So a lot coming up in the next 2 hours. Let's kick it off with John Tucker and a Bloomberg Business Flash.
All right, guys, and this Bloomberg Business Flash being brought to you by IBKR. Will December 2025 CME E-mini S&P Index Futures settle above $6,200 on September 30th of 2025? At IBKR Forecast Trader, the yes was recently at 80%. You can start predicting today at ibkr.com/forecast, a last trading day for this contract, September 30th. All right, the major stock averages are lower as rates push higher, and a lot of economic data. One that was just out, it actually came out a little early. It was supposed to come out at the top of the hour. August existing home sales, used home sales, I like to call them, falling to a 4 million rate. That's actually better than expectations. Home sales edging down. The high costs seem to be stymieing buyers at this point. The other data we had today, the economy growing in the second quarter at a revised 3.8% annualized pace. The latest revision, fastest in about 2 years. You can credit in large part resilient consumer spending. We also saw evidence of some strength in the job market. Initial applications for unemployment benefits falling to the lowest since mid-July. So as a result of that, rates go up. The 2-year up 4 basis points, 364. 10-year up 3 basis points, 418. Who hates higher rates? That would be tech stocks. So NASDAQ 100 down 190 points, down about 0.8%. Now, meantime, Fed Governor Stephen Myron made his case for more rate cuts earlier today on Bloomberg.
My view is that policy is quite restrictive, and so I'd like to adjust quickly to get back to a more neutral area, right? That just means a series of 50s until you get much closer to zero.
And this breaking news to bring to you, private equity strikes again in the sports world. The Patriots selling an 8% stake, this according to Sportico. So this would value the team at what, $9 billion?
More than $9 billion.
More than $9 billion for the The Patriot, the dreaded Patriots.
You made it sound like private equity was the evil empire here. It strikes again.
Did I really?
Well, there's that new rule passed a year or so ago.
There's no commentary on this end.
No.
Well, there's that new rule about a year ago that private equity could buy up to a 10% stake in these franchises, and we've seen 4 or 5 of these deals, I think, so far.
Yeah, Sixth Street is one of the approved firms that can do that.
Yes, that's right. Approved firms. Excellent.
Anyway, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
All right, JT, thank you so much. Scarlett Fu, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in Midtown Manhattan, streaming live on YouTube as well. As John was just reporting, we got some selling out there in the marketplace. But let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu, and we're joined by Bloomberg's Bailey Lipschultz. Bailey, what are you looking at?
Yeah, let's start with Eli Lilly, the drug maker, down about 1%, so modestly underperforming the S&P 500, though not one of the worst performers. This comes after news that the company halted a study of an experimental drug that would be done in combination with one of its weight loss drugs to help prevent obese patients from losing too much muscle. This has been a long debate for these companies. Eli Lilly, Novo Nordisk leading the charge there with patients who are going on Zepbound, Mounjaro, or Ozempic and are actually eating less and consuming less, but therefore losing not only fat but muscle and other weight. So this coming a bit surprising, according to some analysts, that the company would halt its trial, though its spokesperson pointed to the fact that they reevaluate these drugs trials on a regular basis. So ticker LLY down again about 1% right now in the morning session. Not a sharp move lower, though, really only trading at the lowest level in a few weeks.
I'm also looking at the auto sector doing pretty badly this morning. And of course, if within the S&P 500, you're really talking about Ford, Tesla, and General Motors. But you've got a car or auto adjacent company that's given some disappointing results.
Yeah, worst performer in the S&P 500 this morning by a large margin is CarMax, ticker KMX. Scarlett, this coming after earnings that significantly missed analyst estimates. Truist describing it as, quote, miss across the board with nothing good to see here, which is brutal from the sell side. You're supposed to be playing, incurring favor to the companies, unless you're hold rated, though. Scott Ciccarelli maybe reevaluate that price target of $74 because the stock is below 44. Trading, Scarlett and Paul, at the lowest level since the pandemic, March 2020. So CarMax under pressure. We're keeping an eye on AutoNation, Carvana, pretty much anything in the ecosystem again after not only did total used units come in well below estimates, analysts really saying that those weaker trends have continued so far into this current quarter. So it does seem pretty dire out there.
You know, speaking of things being dire, Robert Bosch over in Germany cutting about 13,000 additional jobs at its auto parts business because you've got a sluggish European car market as well. So not good across the world.
But hey, the markets are trading near all-time highs, so it's all totally fine. Just ignore the consumer. And want to wrap up with Jabil, ticker JBL, the second worst performer, only down 7% to CarMax's 24%, though that is the worst drop for that company since the summer. Jabil is a company in the supply chain ecosystem within tech, so some of their big clients are Amazon, Apple, Tesla, you name it. So they reported results that mostly missed analyst expectations. We had Vital Knowledge calling out pressure on margins in their AI segment. So certainly something to keep an eye on. But broadly speaking, when you look at their forecast for first quarter net revenue, better than expected, as was core EPS. So this could be just one of those moves for a company that's moved pretty sharp to the upside in the last little bit. Right now, trading around $209 a share. A year ago was closer to $113. So giving back some of those gains, but still pretty ugly performance on a one-day kind of basis for Jabil. Again, ticker JBL.
All right, Bailey, thank you so much. Appreciate that. Bailey Lipschultz, Bloomberg News, covers all the equity markets for us. If you want more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Intel, they're talking to anybody. I mean, talking to everybody. The U.S. government who invested. NVIDIA, they invested. Now there's some reporting that they
SoftBank too. Don't forget SoftBank.
That's right, exactly. Masa-san. Talking to maybe Apple. That would really be interesting. So let's check in with somebody who does this tech stuff full time. Ed Ludlow, Bloomberg Tech co-host. Not sure where he is. Somewhere probably out there in the valley somewhere. Ed, talk to us about Intel and their strategy. And is there a play here for Apple to maybe invest in Intel?
Maybe. I think you summed it up perfectly. I mean, Intel is talking to anyone and everyone that makes sense if they could save them, right, and help them get back on track. That's the way that sources frame it, at least, right? This is Intel approaching Apple and saying, would you like to invest in us? And then after that, we could talk about how we work together. I know that you guys don't necessarily always need the history lesson, but remember, for many, many years, Intel Silicon went inside many Apple products, including phones until 2019. When Apple bought Intel's modem business and started doing that itself in-house. So just like the NVIDIA scenario, they have a mixed history of cooperation, rivalry, tension. But I think that, the market's looking very much at this like Intel's trying to do something proactive.
Right, and Intel is part of the national fabric no matter what, even though they have given up a ton of market share and have struggled in the last 10 years or so. Lip-Bu Tan is the CEO of Intel, and originally he drew President Trump's ire for not doing enough, and certainly there were questions about perhaps his potential conflict of interest because of his board seats at Chinese companies and all of that. And I might have gotten that detail wrong, but that's something that was pointed out. Yet, the president now loves him, and he's kind of returning that by being the ultimate deal maker, or trying to be at least.
Well, on paper, as you say, Intel is what this administration in particular it seeks. American companies that are trying to do more of their operational footprint in country, onshoring, call it what you will. And the meeting that took place between the president and Lip-Bu clearly changed the trajectory of things. But let's be very clear, the reporting about Intel approaching Apple is our reporting citing sources. The deal for NVIDIA to invest $5 billion into Intel and work on products, both of those CEOs, when I spoke to them, were unequivocal. The administration played no part in that. And what I would say is that Lip-Bu Tan is a known entity in Silicon Valley. He has decades of experience and relationships. He's also very close with Jensen Huang anyway. He knows people in Silicon Valley well, and that's something to bear in mind.
Why would Apple make an investment here? Would it be simply being a cynical Wall Street guy that I am, that it's just to ingratiate them with the government?
Why indeed? Yeah, why indeed? People I spoke to overnight are like, doesn't make a ton of sense because of the progress that Apple has made on its in-house silicon, be it the main processor or other components. Right now, Apple in lower level handsets has relied on Qualcomm for modem, right? Or for, RF chip. And in other cases, they're using their own. Intel's not really involved in that process. One idea might be like Intel could help them with packaging. So a part of Intel's business is like, they manufacture semiconductors, but they also just package stuff up, which is like low margin and not as exciting. So one hypothesis is that Apple might want to do some of its own stuff around servers, or like even on the Mac side, and Intel could help them with that kind of more mundane stuff.
Or they're being strategic and, just spreading the word and getting people excited. Paul is nodding.
Yeah.
Yep. All right, thanks so much for that. Always appreciate getting your reporting here. Ed Ludlow, Bloomberg Tech co-host out there in Silicon Valley. Again, the news that, Intel may have approached Apple, maybe making an investment in Intel. And that certainly seems to be a good strategy for the company. Stock's up over 50% this year, and that is Intel. Over the last 5 years, it's declined on a per annual basis of like 8-9%. So this has been a real turnaround for Intel, getting some of those AI tailwinds. A little more coming up.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash. We are being brought to you by Oracle. Attention growing businesses, Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Well, the latest economic reports, got a few of them this morning. They show resilience in the economy. So that is pushing Treasury yields higher. The 2-year, which is more policy reactive, we'll say, is up close to 5 basis points, 365 in the twos. And the 10-year yield right now is up close to 4 basis points, 418. And that is pushing tech stocks lower. The Bloomberg Magnificent 7 total return index falling right now 0.9%. Intel approaching Apple about securing an investment in the chip maker. You just heard Ed talk about that. A deal would follow the $5 billion investment last week from NVIDIA. And Intel shares in the early going right now, they're up close to 6%. Then you had earnings from CarMax reporting a significant earnings per share and sales shortfall. That's for the second quarter. As a result of that, CarMax, one of the standouts to the downside, right now down over 24%. And then Starbucks, they're going to close stores, eliminate 900 jobs. This is a $1 billion restructuring effort. And just crossing the tape, Health and Human Services Secretary Robert F. Kennedy Jr. opening an investigation into the safety of the abortion pill, mifepristone. I believe that's made by Danco, which is, if I'm not mistaken, a privately held company. So no equity exposure there. We check the markets view. Oh, I should say the S&P 500 down 24, the Dow down 42, the NASDAQ 100, 113 points lower. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg. Almost forgot the stocks. Scarlet.
Third-day losses. How can you forget about it?
Yeah, well.
It's a sea change here.
Oh, my goodness, a sell-off.
Right, for now. Okay, John Tucker, thank you so much. Paul Sweeney and Scarlett Fu here for Bloomberg Intelligence at the Interactive Broker Studio. John mentioned Starbucks, and this is round 2 of layoffs under new CEO Brian Niccol. Although, can we still call him new?
No, I don't know. No, he's
been
in
like
there.
1 year,
He
right?
owns it.
Okay,
Yep.
he owns it. So
Yep.
let's bring in Michael Halen, who owns the restaurant news coverage for us here at Bloomberg Intelligence. He is our senior research and food service analyst. Michael, when you hear the news about Starbucks closing stores, cutting jobs, 900 jobs, $1 billion restructuring effort, it feels like deja vu.
Yeah, but you know what? This was very clearly communicated to the street back in April on their fiscal 2Q call. Management said that, we expect more restructuring charges. We're going to continue to evaluate our store base. Really, management wanted new CFO, Kathy Smith, to be involved in the process. So this was not a surprise. If we hear about some more store closures and restructuring, then maybe you'll see a bigger reaction in the stock.
All right, a shout out to my Starbucks on Route 35 in Wall Township, New Jersey. They do a great job, great folks, very efficient, very good. Mike, what does this company need to do? What do they say is on their to-do list to turn this company around? What are you looking for?
Yeah, it's more operations and marketing, and we're starting to see things kind of inflect here. We think fiscal 26 should be a nice bounce back year. So, first it's with the operations, right? So it's eliminating menu items, increasing labor, which baristas were very happy about. Creating a smart queue for mobile orders, right? So the stores aren't as chaotic and baristas aren't serving, mobile orders for somebody 30 miles away before helping someone inside the store. And then service standards, right? They're rolling out these green apron service standards this year. It's a big investment on training and really nailing the consumer experience in the store. And then from there, it's the marketing, and marketing seems to be working. They pulled back on discounts, and what they're doing is more marketing. You'll see some TV ads, right? They're doing more digital marketing. And we think that's a smart move. It seems to be paying early dividends. Starbucks non-rewards member transactions are up. Non-discounted rewards members transactions are up. And we think these are a sign that sales are going to inflect higher in the coming months.
Okay, but this is taking a while. Paul and I were just saying that Brian Niccol owns this now. He's been CEO for a year, and they're still in turnaround mode. They're still in kind of like, let's figure out our path forward. Investors, please be patient. Are investors going to continue to be patient for another 6 months to 1 year?
I don't think they're going to be patient for 6 months to 1 year in terms of the stock price. I think Brian Niccol's job is very much safe. You know, you can't turn around an aircraft carrier on a dime, right? This is a massive organization, 18,000 stores just here in North America, over 40,000 globally. So yes, this is taking longer than a lot anticipated, myself included. Are investors going to be happy if they don't see same-store sales inflect here in the first quarter of fiscal 26? No, they're not going to be happy, and you're going to see it reflected in the share price, right? So, I think they're making the right moves. This has been a longer turnaround than most had expected, but I think Brian Niccol's pressing all the right buttons right now.
Yeah, I just got back from some vacation time in Italy. I don't think I saw too many Starbucks in Italy.
I think they have a Starbucks Reserve somewhere. It looks different than the regular Starbucks store.
All right. So, Mike, I mean, you said they have 40,000 stores on this planet. Is that enough, or are they still going to be putting more out there?
They're still going to be building. I think they need to, they're going to have to nail this U.S. operation and remodel, and they're going to spend a little bit less on building stores in the U.S., a little bit more on renovating them.
Okay.
And then China, they really want to get that market nailed before they accelerate growth. So those are their two main markets for growth. They've been the company's two major markets for growth for a long time. But management's doing the right thing. They pulled back on growth to kind of nail the operations, the marketing. Once they get same-store sales and traffic trending back up strongly again, you'll see them reaccelerate development.
Yeah, but the thing is, it's taking time, and other competitors can kind of step into the void in the meantime, right?
Yep.
All right. Michael Halen, always appreciate your joining us. Michael Halen is our Senior Research and Food Service Analyst over at Bloomberg Intelligence. Paul and I are looking at the markets here, and it's a third day of losses for equities. I know. What happened to the bull run? I mean, it's still intact, of course, because we're still near record highs, but we're starting to see some weakness here. So I wonder if this foretells anything more. Let's bring in Dana Dioria right now. She is co-chief investment officer, so co-CIO over at Envestnet. Dana, we got some data this morning that shows the economy is holding up just fine for the second quarter, and I know that is backwards looking. The economy actually grew faster than anticipated, 3.8%, and faster than what was previously reported. Jobless claims also coming in low, which is what you want to see if you're looking for a strong labor market. Do we need to rethink whether the Fed is going to cut rates at the pace that the market expects?
Well, that's probably the question of the day, because certainly we're seeing that the Fed is not necessarily aligned on this, right? And coming off of the FOMC meeting, where it was actually pretty smooth sailing, right? You had one dissenter who wanted to go 50, but other than that, we didn't get this sort of three-way split where, no, 25, 50. It was really pretty aligned around the 25. And now, of course, as Powell said, right, it's inflation and it's employment. And if employment is still looking strong and inflation is looking, kind of bumpy, there is a chance, right, that we get a few less cuts than everybody's anticipating. But there's a lot on the other side of that. I mean, we're sitting right now in a period where markets are, they're losing their footing a little. I don't think it's anything big. I actually think with valuations where they are, you should expect some kind of pullback. But I think there's a lot, to happen before they make the next set of decisions. I still think 2 this year is probably the base case.
Hey, Dana, if in fact the Fed is in a rate cutting mode, is this maybe a time where small and mid cap stocks can actually work?
Yes. I mean, if you're a proponent of diversification into small caps, it's been a long dry run, right? We're finally past the high that we set years ago in the Russell 2000, which is great to see. I do think that is the case. I think, as we know, small caps are much more interest rate sensitive. They're more reliant on capital markets. They do tend to have more floating rate debt. So as, you know, and whether the rate cuts are a little slimmer than we thought or not, we should be entering a period that's more positive for small caps and just from a fundamentals perspective, easier on them. But, you know, we've had these conversations before. I mean, a lot of the problems with small caps, of course, is, you know, profitability. And there's a lot of empirical research suggesting that, you know, no to low probability small cap stocks are, you know, kind of underperformers on a long-term secular basis. So when you're doing small caps, it does make some sense to have kind of a quality overlay or a small value overlay, you know, pay low for it, basically.
Dana, including today, we've got 4 days until the end of the third quarter. And, you know, typically at the end of the quarter, there's some portfolio rebalancing. It kind of changes things up a little bit. Is that a factor this time around, especially since we've got this possible government shutdown looming?
Yeah, I mean, I don't know how much I think the shutdown, you know, it's a sad, sorry state that we're just kind of used to this. I don't think it moves markets tremendously. I think your point is valid on the rebalancing. And you know, this time of year tends to be a little bit of a speed bump for markets, as we know, September, October timeframe. You know, but at the same time, there's a lot solid. I mean, you started the segment, you know, mentioning it, right? Economic growth is solid. Unemployment still looks pretty good. So I think to the extent you're seeing some rebalancing, there might be some efforts to kind of buy in on, you know, some of the missteps that the market may have. So I don't see it as being anything, you know, kind of fundamental to the market. It's not to say that we don't, you know, have some difficult times to weather at some point coming. But if you're a standard average retail investor, you know, this is probably more of an opportunity to do exactly what you just said. Rebalance, make sure you're at the right risk tolerance. It's not a get out of the market kind of situation.
Dana, what's the conversation you have with your clients about alternative investments, something in hedge funds, private equity, private credit, those kinds of things?
It has grown dramatically in the last year or so. I would say the last few years, but really this last year, what you're seeing is just kind of a sea change in how the retail investor, and I'll say advisor base, is looking at these. We get questions all the time now around how to use these types of vehicles, and largely it's because these alts managers and traditional managers getting into the alts game are creating, you know, new products, new vehicles that are much more accessible to the standard advisor and investor. So, you know, it used to be obviously ultra high net worth endowments, you know, LPs, private placements, you're locked up, you have committed capital, you have capital calls you have to manage. Now you have interval funds, right, where they look and smell like a mutual fund. You have to wait for liquidity windows to get out. And then, you know, you also have other fund types like tender offers, right? Private PDCs, private REITs. These are opening up a whole new swath of investors for alternative investing. And it really, you know, it's an educational challenge for our industry, but it's also an opportunity for everyone to kind of get in the game on some of these asset classes that they just couldn't get access to before.
Yeah, it definitely feels like an opportunity because it would feel like every Tom, Dick, and Harry is out there talking about private credit, trying to sell private credit, talking about the democratization of alternative assets. We hear it over and over again. All right, Dana, thank you so much for joining us. Dana Dioria, she is co-CIO of Investnet, joining us from Hartford, Connecticut. John Tucker, we're looking at markets that have pared their losses. Equities still in the red, but not as much as before.
Yeah, it's got a more bullish feel to it, right? At least right now. But they are lower.
Less bearish? More bullish?
But yeah, something like that. With tech on the downside is the latest economic data that is pushing Treasury yields higher at this point. Let's do 8 of the 11 major index groups in the S&P 500 lower right now. Let's do the worst performing stock in the index. That belongs to CarMax. Down over 24% after the earnings report. We got that after the close of regular trading yesterday. Best performer, you want to guess? Intel, 6% higher. Scott Kroner made time at Citigroup Global Markets, tells investors, you know, don't worry too much about these lofty valuations.
You don't have to wig out on the valuation. And that's where we kind of go back and forth with, gosh, is the market rich? The market's rich if you don't think the earnings are going to grow. The market's fine if you think you're going to continue to see this earnings tailwind, which I think, you know, increasingly we're very comfortable predicating a view on.
So the S&P 500, 26 points lower, down 0.4%, 6611. The Dow Jones Industrial Average 36 points lower. That's down less than 0.1%. And the NASDAQ 100 is down 119 points, down just about 0.5%. Two-year yield up 5 basis points. And again, that's weighing on tech. 10-year yield up just about 4 basis points right now. And just to bring you that at the intersection of sports and business, the Patriots set to sell a stake to Sixth Street Partners, and the billionaire Dean Metropoulos set a valuation above $9 billion. Sixth Street's going to buy 3%. Metropoulos will buy 5%. By the way, that Greek billionaire, you know what we know him for?
What?
He was the owner of Pabst Brewing. Yeah.
Nice PBRs.
So the valuation would make the Patriots the second highest valued NFL team, surpassed only by our New York Giants at $10 billion. And if only they could find an offensive line to protect the quarterback, they might be worth more. Anyway, we
Do you
checked the
think
market.
PBRs are going to be available then at Patriots games?
Darn right they are.
Yeah.
Well, he used to own.
Okay, he's a seller.
Ah, okay. Big distinction.
We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Scarlett and Paul.
All right. Thank you so much, John Tucker. And of course, it is UN General Assembly Week here in New York. That means there's a lot of diplomats. There's a lot of government officials from different countries, different regions in town. Traffic is crazy, but it is great if you want to people watch and you want to talk to policymakers. So I'm pleased to say that we have Jessica Roswell here with us. She is the Commissioner for Environment, Water Resilience, and Competitive Circular Economy with the European Commission. Jessica, welcome to Bloomberg.
Thank you very much for having me.
So tell me a little bit first, before we get started, on what you're aiming to accomplish here in New York. What is a competitive circular economy?
Well, we have talked about circular economy for a long time. Actually, since the 70s, we have regulation in Europe on circular or waste management and other things. But we have not really gotten circular. So what we have tried now to do is to get it competitive. I think that is the key to actually go circular, because we need to be circular of many, many reasons in Europe and in the world. So that is, I think that the competitive word is important for actually getting it circular.
From your perspective, Jessica, what is the link between the environment, proper care for the environment, and industrial policy? What is kind of the real focus? How should we think about that link?
I would say that green transition that we are in now, that we are doing in Europe and the world, is the growth part. And I've always come back to that green transition and competitiveness is the two sides of the same coin. And investing in green technology and going green and clean, that is the growth strategy for Europe and for the world. And that is what we see that the industries in Europe is investing in. So I would say it's a must, but it's also something that is a possibility and opportunity for our industries.
A lot of people would look at your title, a lot of people here in the U.S., I should say, will look at your title, look at environment, water resilience, competitive circular economy, and think that means a lot of regulation. That means a lot of a slowdown in how things get done, and not necessarily something that creates jobs and creates a competitive environment. Talk a little bit to us about how your portfolio can create jobs while reducing risks at the same time, and therefore be supportive to economic growth.
Yeah, absolutely. I know I have a very long title, but I'm very proud of all the parts of my title, and even I could say I lack some words. But if we go back to circular economy again, I mean, as I said, for us it's really important of many reasons. We are focusing on security in Europe at the moment, and competitiveness. Security of obvious reasons. We have war in our country, in our region, but we also face we know we are dependent on a lot of other regions around the world when going to digitalization, going to green transition, and also investing in security. So we need to be more circular, and that's why I see competitiveness advantage for our industries to actually gain money for being more circular. So that is what we're trying to do at the moment. But I mean, then I have water. Water is also something that we have taken for granted in Europe and probably in many other places in the world. There's also a competitive link in this. We know that the businesses in Europe are dependent on water. We all are, of course, farming, all you and me also. But also our industries are really dependent on water. That is why we're trying to focus on water. And I would also say that sometimes people say to me that invest in nature is the cost. I would disagree. I would say that investing in nature is it's an investment. And just to have one figure, you talked about a lot of figures before, that the industries in Europe within the Eurozone that has corporate loans are at 75% of these companies are dependent on at least one ecosystem. Water is the obvious one, but also others. So I mean, for me, there is this link, and the awareness of investing in nature has become bigger and bigger. But I'm also working on to make that awareness even bigger, because I think this is it's not good to have. It's something that it's a must for our industry to be prosperous.
So what does that mean for your industry, for people who are really trying to link industrial policy with the environment, when the President of the United States gets in front of the UN General Assembly and effectively says that climate change, energy transition, it is a, quote, hoax? What does that mean? How do people like you react to that?
No, but for me, it's obvious that we need, and also when I talk with the industry in Europe and in other places in the world, they are doing the green transition because they know, and it is not. It is of a lot of reasons, because we need to protect our environment against the climate change, but also because they see a possibility for growth here. So I would say that this is why we invest in this, and also that this is the green transition is the future, and there is no turning back on that, and that is what I hear from industries.
Moving forward, despite whatever the U.S. president is saying, publicly. So you mentioned climate change. I want to come back to that for a moment here, because when it comes to water, what does Europe's water resilience look like today in this era of super hot summers where heat waves and droughts are now very, very common?
No, and I mean, the link with water is obvious. I mean, why we have put forward a water resilience strategy in June of many reasons. We had put water as a priority, as I said, because it's important for all of us. But of course, we're also about the quantity of water. Europe, all parts of Europe is facing droughts, water scarcity. I'm coming from Sweden. We have a lot of water, but also Sweden and Finland and other countries are facing scarcity. So that is why we need to focus on this and be both seeing for the future, and because the floods cost, of course, severe damages in people's lives, but also the cost is very heavy for us, but also the cost of doing nothing is very heavy. So that is why we're talking about the water. But also I want to add, it's quality, not quantity of water, sometimes too much and too little, but it's also the quality of water. We have polluted water in Europe and also in the rest of the world. So we need also to focus on clean water. And that is something that costs a lot of money, but it is about people's health and the environment, of course. And this is something that people are very worried about. If we can take the forever chemicals, the PFAS, and so forth. So it's a lot of things on doing on water, but the good thing is that we are prioritizing this. But as I said, we have taken it for granted for too long.
Jessica, thank you so much for joining us. We really appreciate it. Jessica Roswell, Commissioner for the Environment, Water Resilience, and Competitive Circular Economy at the European Commission. We appreciate you coming into our studios here in New York City. As you said, Scarlett, we benefit from the United Nations Week because a lot of smart people come through town,
Absolutely.
a lot of interesting people, and we get to chat with some of them here on
Yeah, very exciting. Thank you so much for coming in. Jessica Roswell in our interactive broker studio here in Midtown Manhattan. John Tucker, you and I were talking a little bit earlier about the NFL's Patriots selling an 8% stake at over $9 billion.
Oh, is it 8% or 9%?
Just over 8%, maybe?
You sent me the story, and I, of course, didn't read it.
John, is that how you do things around here?
You should know this by now. Wait, $9 billion. Yes, you're
8,
right.
9, the numbers get confusing. Numbers are hard sometimes,
But it's amazing because it's a great franchise, as we all know.
Yes.
It's the NFL, B, it's the Patriots.
That's the valuation we're putting on it based on this deal.
Yes.
3% for the billionaire, the Greek billionaire, and 5% for private equity. So that's what we got.
Yep.
Again, second behind our New York Giants.
Yeah, I wonder what the Cowboys are worth. Have you seen a deal? I don't know if they've done a
They
deal
don't want to sell anything.
They don't want to sell
Yeah, Jerry Jones has been really firm about that.
Because I would think that would be the most highly valued.
Yeah.
Although New York's the bigger
it's so
market.
interesting that the Cowboys are the most highly valued when on the field they don't necessarily have the performance to back that up.
Yeah, I don't know. They're America's team. So, but again, the Patriots right there with all their winning. And again, I think we're going to see more of this because of this rule change that allows private equity. That's because it's gotten as you know, with the business of sports, Scarlett, the values here are just so huge. It's not a millionaire's game business anymore. It's a billionaire's
And a
game.
select group of billionaires, too, right? I mean, how many billionaires can pony up this kind of cash?
And sort of tangential to this, you have the NFL commissioner talking about an international team as well in football. So it's going to be
Well, they got to
interesting.
strike while the iron's hot, right? The NFL now resonates around the world, and no one else has anything close to it. So,
Well, the English Premier League, I mean, some of those franchises, that their followings, like Manchester United in Asia, is huge.
yes.
I mean, those are global brands.
But the game itself is not anything like the NFL.
I don't know. I mean, I think, I'm trying to think.
Them's
I
fighting words.
can't quote the economics here, but I think that in terms of a global game, English Premier European soccer is a global brand, much more than the NFL, and that's what the NFL is trying to get to.
Yeah,
But maybe the total economics of the NFL versus English Premier League, I'm not sure the difference there. But again, it's just we're seeing the numbers have just gotten so huge for all of these franchises that you got to think about different ways to get ownership here. So no longer can some local millionaire who owned a bunch of car dealerships, own a team anymore.
That's why everyone's going into lesser known sports,
Yes, exactly.
lower profile teams, and hoping to get to that point, right?
Yep. So, a lot of people are investing in like women's soccer's been an area of huge
Lacrosse?
growth. Yep. Lacrosse.
Pickleball?
Yep. My friend Joe Tsai, who owns the Brooklyn Nets, he owns 2 or 3 lacrosse teams.
You're friends with Joe Tsai?
High school.
Really?
Yeah.
Oh my gosh.
So I always get good tickets to the Nets, although I'm a Knicks fan.
Paul
so
hangs
it's
out
kind of
with a different crowd.
I know. I did see Paul once at a Yankees game, and he was maybe 15 rows ahead of me.
Well, yeah, we have good seats for the Yankees. Yeah, we invested. I've had those for 40 years, and I'm still like the junior partner of that syndicate, 4 years on. So we got a lot coming up. So coming up right here, we're going to be talking with some more interesting people coming here. Now I lost my little thing.
Well, we have the president of Turkey meeting with the president of the U.S. at some point over the next hour. That's definitely going to be on the calendar. And of course, they're going to be talking about, potential trade deals. This is a trade relationship that's actually more balanced between Turkey and the U.S. than the U.S. with other countries. So there's going to be potentially deals involving Boeing, involving Lockheed Martin. But also we've got the former New York governor, Andrew Cuomo, coming in as well, speaking with our David Gura. And before that, our Tyler Kendall will be speaking with the Dutch Prime Minister Dick Schoof. So we go back to that idea about all these global leaders descending on Midtown Manhattan at a time when there's so much change going on. Everyone's just trying to catch up.
Absolutely, and we have the good fortune here at Bloomberg News, Bloomberg Radio, Bloomberg Television to speak to a lot of them, including Dutch Prime Minister Dick Schoof, speaking with Bloomberg Television anchor Tyler Kendall. Let's go to that right now and take a listen.
Thanks so much, and a big welcome to our global Bloomberg television and radio audiences. I'm Tyler Kendall here on the sidelines of the UN General Assembly, and I'm pleased to say I'm joined now by the Dutch Prime Minister Dick Schoof. Mr. Prime Minister, thanks so much for joining Bloomberg. And I want to start by asking you about a topic that's really dominated the conversation here at the UN, the recent violations of NATO airspace. President Trump says that NATO allies should shoot down Russian aircraft if it happens again. Do you agree with that assessment?
Well, the Russians should be aware that's a possibility. I mean, if they enter NATO airspace, that's a violation. It's a big violation. But of course, we will take care in a way that we think is appropriate, like we did with the drones earlier in Poland.
Well, on those drones, actually, the Netherlands provided the fighter jets, the F-35s. Do you have any plans to provide additional military equipment to our NATO allies, particularly those on the eastern flank?
Yeah, we are also delivering Patriot systems to Poland in the coming weeks. And of course, we are in constant discussions with our NATO allies on how we can protect the eastern border better than due to the Russian aggression war in Ukraine and the fact that they are entering via Ukraine or Belarus airspace, NATO airspace.
So would the Netherlands be prepared to act if this did happen, if there were an aircraft that violated your airspace?
Well, it begins with the reckless actions of the Russians. And of course, I mean, they take the risk. And of course, it's up to NATO command on how to react, and it's minutes work. The pilots have to decide. They have the command lines within NATO. But Putin should realize that there is always that risk.
And part of this conversation is that the U.S. really wants our allies to tamp down on the imports of Russian energy supplies. And you have a really unique perspective into this because the port of Rotterdam is the largest in Europe. Now, the EU is proposing a full ban on Russian oil. to take place earlier than expected, January 1st of 2027. Is this feasible? How would this actually work in practice?
Well, I think it's feasible, and we already brought down oil and gas imports from Russia in Europe by 80%. It was also the chair of the European Commission, Ursula von der Leyen, stating also to President Trump. So we have to deal with the last 20%. That's mainly Hungary and Slovakia. And I think also President Trump can put a lot of pressure on these countries to stop using oil from Russia.
But then we did hear from the Hungarian foreign minister here at the UN that they don't have plans to actually stop that oil, even if they got a direct call from President Trump. Is there any other mechanism that can be used to really force this drawdown?
Well, make sure that they can get oil somewhere else. I mean, so that's very important because they're highly dependent on Russian oil, but they should stop Russian oil because I think it's right. I mean, when we support Ukraine to fight the Russian aggression war, it's very strange that we finance actually Russia by importing their oil and gas.
And part of this conversation, of course, also has to do with China. And your country is home to one of the largest chip equipment firms, ASML. China is ASML's largest market. Wondering if you've gotten any indication from Washington about the direction of export controls. Is there any indication about perhaps the possibility of relief when it comes to export controls?
Well, we have constant discussions with the Trump administration and before that on the American administration in general about exporting to ASML products to China. And we are very keen also from our perspective because we think economic security and national security goes hand in hand. So we take our own export controls, also relating to China, and we are in constant discussion with the American administration.
So you agree with the White House's national security concerns when it comes to the export of this type of very sophisticated equipment to China?
We see the risk, and that's why we put our own export controls, but it's our own decision that we make, and we want also to make sure that ASML can produce and can deliver, because it's a crown jewel. It's very necessary for the whole chip industry and the developments of AI. So we want ASML to flourish as well.
Well, you said that you're in constant contact with the administration. I'm wondering if you've pressured this White House at all for any sort of exemption when it comes to chip-making equipment once that Section 232 investigation wraps up and likely leads to tariffs down the road.
Well, we had a lot of discussion about the import tariffs. And then we said that from a Dutch perspective, we'd be very keen on some special products, but particularly high-tech and med-tech was very important for us to get some carves out on that. And the Article 232, right, is of course a different issue because that's related to national security. So this is just a little bit different, and we are in constant discussion.
Okay, but it could perhaps be a carve-out could be on the table.
Well, I just stick to the word. We are in constant discussion with the American administration on this.
In those discussions, how much pressure is there to invest in the U.S. versus at home?
Well, we invest a lot in the U.S., actually, in general. I think that we invest, that relates to about 1 million workers in the United States, so that's quite impressive. We import a lot from the US as well, so there's another balance between the Netherlands and the US than there is probably between Europe and the US, and that gives us a special position.
In the final minute I have with you, Mr. Prime Minister, I'm wondering how concerned you are about Dutch companies and public agencies using American cloud providers. Are you considering any legislation that would require agencies to buy European cloud or tech services?
Well, we think that the European development is very important because we don't want to be dependent on anybody else, and that not necessarily refer to America, but we want to make sure that the development in Europe is a real European development.
All right, a fascinating conversation. We'll continue to follow. Dutch Prime Minister Dick Schoof, thank you so much for joining Bloomberg. This has been a conversation on the sidelines of the UN General Assembly. I'm Tyler Kendall, and I'll send it back to you.
All right, very good. That was Bloomberg's Tyler Kendall. Speaking with Dutch Prime Minister Dick Schoof, there at the United Nations. Good getting a discussion there. Let's get back to the markets here and stories on the Bloomberg terminal. One of the really cool ones is Sportico. Our good friends at Sportico reporting that the NFL Patriots selling an 8% stake at a valuation north of $9 billion. Kurt Badenhausen joins us here, sports valuation reporter at Sportico. Kurt, what's happening here? Who are the buyers here? Does this valuation surprise anyone?
I think the valuation is probably on par with what most people would expect. Sportico values the Patriots at $8.8 billion, so it's a little bit above that. Sixth Street, the private equity giant that manages over $100 billion, is buying 3% of the franchise, and they've been leaning in very hard into sports this year. We're part of the Boston Celtics consortium with Bill Chisholm leading the way, as well as bought into the San Francisco Giants in Major League Baseball. The other buyer is Dean Metropoulos. He's a Greek billionaire, Boston roots, went to Babson College, and is probably best known for buying Twinkies and Hostess brands back in 2013. So he's worth over $4 billion, and this is his first investment in the major professional sports leagues in North America.
Kurt, I'm so glad that you mentioned Sixth Street because it's one of the firms approved for NFL ownership, one of the private equity firms. And you mentioned that it has some exposure to MLB teams, for instance. But in terms of its NFL ambitions, is that it for Sixth Street? It can only invest in one team, and that would be the Patriots, or can it, sprinkle its investments across different teams?
No, they can invest in a handful of teams. As you mentioned, they were one of the institutional investors that was approved last year when the NFL opened up to private equity, and so this will be the fourth deal done by a private equity firm. Arctos has already done 2 deals, one 10% of the Buffalo Bills and 8% of the Los Angeles Chargers. Ares bought 10% of the Miami Dolphins. This is the first. This will be, assuming it's approved next month at the NFL owner meetings. This will be the first by Sixth Street, and I would expect them to add more to the portfolio. And the most you can buy is 10% of a franchise.
So as these franchise owners sell to these private equity folks, what do they do with the cash? Do they go buy another yacht? Do they reinvest in the team? What do they do?
They count it at home.
Yes, exactly.
Well, we've been told that the Patriots are planning on really putting this money back into the franchise. The Kraft family, led by Robert Kraft, Jonathan Kraft, owned 100% of the team before this, and will maintain more than 90% of the franchise before this. And so this is, again, a way to create some liquidity that can be, again, some people take it and use it for personal use. We've been told the Patriots are going to put this back into the franchise. And for the Patriots are more than just an NFL team. They have, of course, Patriot Place around them, 1.3 million square feet, mixed-use residential development that has dining and retail, shopping, entertainment district that really set the model for other teams to follow in the NFL in terms of mixed-use development. So they also own a Major League Soccer team, which is not part of this deal, New England Revolution. They've been searching for a new stadium for a long time and are trying to do something in the Boston area.
Okay, and in the Boston area, and I bring that up because the Kraft family, Paul and I were reading your reporting, has owned the Patriots since 1994, and they paid they paid what was a record at the time, $172 million for the team, which is mind-boggling given the valuation that we're talking about right now. But there was a period of time, Kurt, when they were toying with the idea of moving the team out of Massachusetts.
That's right. The Patriots were not the Patriots in 1994, but still, just because NFL franchises don't come on the market very much, Robert Kraft was comfortable spending $172 million, lifelong fan.
Yep.
Had been to games as a child a lot. But yeah, that didn't stop him from looking at doing a deal in Connecticut. And listen, it was close. They were basically as good as gone.
Yeah.
And then Robert Kraft stepped up and decided to keep the team in Massachusetts. It was a completely privately financed building when they opened what is now Gillette Stadium.
Right.
And the timing could not have worked out better because the Patriots became the Patriots of today. As the stadium was open, just started winning Super Bowls. Tom Brady had just joined the team and taken over for Drew Bledsoe.
Right. Rest is history.
It just sent them into created one of the financial juggernaut there.
All right, Kurt, we're going to leave it there. That's great reporting. Appreciate you taking the time to join us. That's Kurt Badenhausen, sports evaluations reporter for Sportico. Sportico reporting that the Patriots selling about an 8% stake at a valuation north of $9 billion. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market and industry research. The next hour of Bloomberg Intelligence starts right now. Let's go to John Tucker for a Bloomberg Business Flash.
All right, guys, the S&P 500 dropping for a third straight day, although we're kind of pairing the earlier declines, the major indexes. The latest data shows the economy holding up. And that has the effect of pushing yields higher. The 2-year, which is more policy reactive, up 5 basis points at 365. And then the benchmark, the 10-year, that's just about 4 basis points higher. That's 418. So that is the thing that weighs especially on tech stocks. And then you have Intel. It's actually the best performing stock right now in the S&P 500. It is up close to 6% right now. The company has approached Apple about securing an investment. Then CarMax shares, they're tanking. Worst performer after its earnings results. CarMax shares 22% lower. Meantime, the Fed Governor Stephen Byron, the lone dissenter at the last Fed meeting, he was on the air with Bloomberg this morning making his case for more rate cuts. This exclusive interview with Bloomberg this morning.
You know, I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy.
Right now, the S&P 500, 28 points lower. That is down about 0.4%, 6609 on the index. Dow Jones Industrial Average, 40 points lower, and the NASDAQ 100 down 117 points. And casino news. MGM Resorts International, their proposal for a $2.3 billion expansion of its Empire City Casino in Yonkers, which is just north of Manhattan.
I drive past that all the time.
Yeah, well, they have slots up there. Well, this means it could advance to a state board. They've cleared a key vote by a local advisory committee. So in addition to the slots that they have up there in Yonkers, they could soon add like the board stuff, like, you know, the spinny thing, the spinny wheel thing.
What do they call those? The actual games? The
what? Table games.
Table games. Thank you.
That's
Thank
what
you,
I'm trying to
possibly.
think
The craps
of.
table. I play the 6 and the 8, the point with the full odds.
And
Okay,
do
that
you
was
win?
foreign to me.
That's what I do is I'll start
a winning strategy.
I'll start with $1,000 and 9 or 8 nights out of 10 I can play for as long as I want. Hours.
What's the best odds? Is it blackjack?
I don't know. I don't know.
Well,
I'm one of
whatever.
those people.
Anyway,
If
I
you
play the
know
craps,
how
have
to count
double drinks.
cards, yes.
that's your gaming room. Easy, Scarlett. We check
Yes.
the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul. She's a card shark, apparently.
No, I'm not. I'm saying if.
Oh,
I don't know how to
okay.
count cards.
All right, John Tucker, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. Coming up, we're going to have a discussion, an interview. Former New York Governor Andrew Cuomo speaks with Bloomberg Television's anchor David Gurr. That's coming up in minutes. When that starts, we will bring that to you as simulcast with Bloomberg Television. But right now, let's go to Norma Linda, and we'll see what's happening in stock movers in the equity markets today.
Well, quite a few things to look at today. Market is lower, of course, but looking at shares of Starbucks, that's ticker SBUX, also lower in trading today, down as much as 1%. The big news of the day here for this company is the fact that it will be closing 1% of its stores in the U.S. and Canada. But I mean, this is really a big cosmetic change. They're doing a $1 billion restructuring here. Brian Niccol, who we know was a CEO that came in last year from Chipotle, he's really been trying to change the vibe of Starbucks. He wants it to be a more inviting space. So they're closing down some of these stores, hoping to right size the company here and really just make an integral shift here in terms of how inviting it is and how people feel comfortable with being here in the store. But I mean, as I mentioned, it's only about 1% of stores that are being closed, but this is definitely pressuring shares right now as we're kind of digesting the news.
All right, I'm looking at the S&P 500's best performer today, and it is Intel, up by more than 5.5%.
Yeah, Intel is doing well today, as you mentioned, the best performing stock in the S&P 500. That's ticker INTC here. I mean, this is a name that's really been in the news for quite some time, week after week here. I mean, right now what's going on is the fact that it's going to be seeking investments from Apple, essentially in a comeback bid. I mean, we know the U.S. just invested, took a 10% stake just weeks ago, and we're really seeing a lot of people running back toward this company as we're really trying to invest in U.S. homegrown manufacturing here when it comes to semiconductors. So we are seeing shares up, now up about 6%, as you were calling out there, Scarlett. A lot to digest there. I mean, Seaport Research, they upgraded the stock to neutral from sell. They'd had a sell rating on the stock previously, but they're essentially assuming that there should be some near-term upside here for the company, especially if it receives even more direct investments here.
You know, it's interesting. I'm just looking at, what does it mean for Apple? And Apple's stock this year, it's kind of flattish on the year, but since that April low, it's up 46%.
Wow.
Starting to get a little bit of AI wind maybe at its back, because this is a name.
What AI does it have to offer?
Well, I think the AI wind is, we'll talk to anybody. We'll talk to people who make acquisitions. We'll make maybe an acqui-hire type of thing, as opposed to, we got nothing for you. Which is kind of what we were.
Their balance sheet makes them nimble.
Yes.
That's a great point.
And I just think that the winds have kind of changed a little bit here for Apple. Maybe they're getting a little bit of that tailwind for AI maybe here. And this, I guess, an investment in Intel, like everybody else is doing it. Why not? So,
Why not, right?
What else you got?
Well, I also wanted to keep an idea of people taking stakes here. I mean, we talked about this yesterday on the closing bell, but Lithium Americas has been a name that's also been in focus. That's ticker LAC, based in Vancouver, but focuses on a lot of lithium-based products here. Essentially, they soared yesterday and are continuing a lot of those gains. They closed higher by 96% yesterday, nearly doubling. But the U.S. is saying there's some conversations ongoing about the U.S. potentially taking a stake here in this company. It wants to take equity specifically. This is coming during a renegotiation of the terms of its $2.3 billion loan that was extended by the Energy Department. But it seems as though the U.S. government is making a lot of moves right now, taking a lot of stakes as they really want to bet on U.S. production here.
All right, very good. Norma Linda, thanks so much. Appreciate that. Norma Linda, equities report. Actually, what's your new title now?
Bloomberg Television Markets Correspondent.
Yes.
Is that a promotion?
It is, in fact.
Yay.
Day 4.
So she'll be doing
Nora's a regular presence on Bloomberg Television, and she's already a regular presence on Bloomberg Radio. So we get to see more of her.
So very good.
Looking forward.
Norma Linda. So for more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. I want to get back to that casino story, because there are apparently 3 downstate, and we're downstate as opposed to upstate New York.
What is downstate, by the way?
I learned from reading in Robert Moses' book, Downstate, and all the various regions of the country, we're downstate. Like the Metro New York is downstate.
Okay.
And then there's upstate, which is kind of like Buffalo and all that area. And then there's centers. I don't know.
Buffalo's Canada, basically.
Yes. So, but we're downstate apparently. So there's going to be 3 licenses.
Okay.
Manhattan not getting one. We learned that a couple days ago.
That was next. And then there was Stevie Cohen over at Citi Field would like to have one.
Which is going to be big. I think that would be in Queens. So that would be very interesting, because, again, these mixed use
It would be next to the stadium, right?
Next to Citi
So
Field.
where the auto body shops used to be. Yes,
shops.
okay.
Yeah,
Those
so-
have all been cleared out now.
A lot of them, yeah, a lot of them. So this will really take it up another notch if he gets it. But so I guess that's still in the running. And now this Yonkers license looks like it's getting some traction there. I saw these mixed use around sports stadiums. The first one I really saw in detail was the Atlanta Braves, because it's owned by Liberty Media. Liberty Media. So it was one of those investor
John
days
Malone,
we were down
right?
there, and boy, was that a success. And they were really one of the first. They were the first people in baseball to do it. And they kind of set the blueprint for, you put a stadium there, and it doesn't have to be downtown, which a lot of cities are really good. Camden Yards in Baltimore. You can still put it out kind of in the burbs, but you got to build around it a whole ecosystem of restaurants and residential areas and all that kind of stuff. And so it's not just on game night that you're generating revenue there.
Yeah, you need to create a destination for young people and have them go out there and stay there and spend a lot of money. Nora, Melinda, do you go to any of these games and kind of stay there for the entire day to go gamble and to go eat? And
See,
to go
you
hang
lost
out?
me. Eating, I do. I am a foodie, so that I can jump in on. Gambling, not my thing so much. But I mean, wasn't there something that was supposed to be happening in Times Square? There was supposed to be a casino that was coming in there.
And that didn't go.
That got nixed.
It got nixed. It got axed.
Which I think was the kind of right decision. Do we not have enough in Times Square?
I was just going to
It's
say,
a
I don't
little
think
too
we need to
crowded.
add
Need
something
more
more to
people
that.
concentrated within Times Square?
Oh, please no.
No. So I kind
Spoken like a New Yorker.
I
when
avoid it
walk
like the
through
plague.
to Penn Station, I'll walk through Times Square, and I'm like, people, just here, leave here, go to the High Line, walk down the High Line,
Oh,
have
it's
a
so
nice
beautiful.
walk, get off the bottom, go to one of the best restaurants you're ever going to go to. You don't have, you just have to walk down any street, and you're going to stop at a nice little restaurant. Go there. That's a New York experience.
Well, let me
Get away
ask you,
from
let me
Times Square.
throw this in sort of parenthetically. What has happened to gaming since it was first introduced in our home state, specifically in Atlantic City, where it's, by some measures, a complete disaster?
Yeah, I mean, it was great for me in high school and college. We went down there and saw Sinatra
High
16
school.
times in Atlantic City, 16 times. We had a great time, but no, it never took off. It never took off.
And it didn't make Atlantic City more of a destination,
No.
did it?
My advice to people who want to visit Atlantic City is just keep going and go down to Cape May.
Yeah. But I
Don't
mean,
stop.
there's still great beaches in Atlantic City, but there's, and, I mean, the areas right around the casinos are, that's great. They did a good job there, and they incorporated it into the boardwalk. That's fine. The problem is if you cross the street, then it becomes.
Yeah.
So.
I mean, there's only one Vegas when it comes
There's
down
only
to
one
it.
Vegas. And,
Only
and
one.
all this stuff, you know, you talk to Brian Egger of Bloomberg Intelligence, who covers this industry, says it really has impacted Vegas. All the casinos all over the country, the riverboat stuff, all that stuff. Because Vegas, they just keep giving you more and more reasons to come to Vegas.
Always.
Yeah,
You know.
they've turned it into a family's destination, right?
Have
It's not just
they?
about gaming. Yeah,
Well,
absolutely.
they've tiered it, they've segmented it really well. They went probably too far overboard with, you know, doing a little bit family stuff, and they lost some of the edge. So now they've kind of, they
Gotta
have
stay
something
edgy.
for everybody. They have something for
But you
everybody.
know, the arrival of professional sports teams also
Yeah.
made a big change, made
That's
a big
fair.
difference, because now people go and see their team play in Vegas and then make a whole week out of it, or a
This
weekend
is
if you're on a
true.
budget trip.
Oh, for sure.
But I mean, you can't have a budget when you go to Vegas. That's kind
Never
of the
that. You
problem.
blow through it if you do.
$1,000 a night on the tables. That's the budget.
Now, the people in Vegas, the workers, I would say that they're far friendlier than any other place in terms of the casinos.
Well, they got the hospitality thing down.
The hospitality they have got down.
Exactly.
Absolutely.
Yeah.
Have you guys seen The Last Showgirl?
No.
That was with Kim Basinger.
Break it down for me.
Oh, it was so good.
Folks, we're killing time until Governor Cuomo gets seated and we can
about
start
important
that
things.
interview.
No. It was just very good, and it was about this showgirl who's in this reverie and the last of her kind, and she's kind of coming to terms with this changing Las Vegas that doesn't have room for artists like her.
Oh, wow.
All right.
A lot of talk about Oscar awards.
Very good. All right. Looking at these markets here, we've got some selling still out there in the marketplace, but as John was reporting earlier, kind of off the lows here. The S&P's off 29 points, the Dow's off 70, and the Nasdaq's off 98 points. Looking at gold here, it's had such a huge run, really for the longest times here, and you know it's kind of pulling back a little bit, just kind of stable right here off a couple of bucks, but still $3,730 an ounce for gold. It's just been an extraordinary run. It seems like everybody and their mother wants to own gold here, including central banks, including individuals, consumers, and speculators, and ETFs, and everybody.
Yeah.
From your mouth to God's ears there, buddy. Yeah, so that's why it's continuing to hold.
Up until this 3-day sell-off, you had an S&P 500 that was kind of defying historical trends, because September is said to be the worst month for equities and not very good for bonds either. But September, when the market does climb, has then gone on to gain on average about 19%. So if we can eke out a gain here for the month.
That's right. Strong finish into the end of the year. And again, just a little bit of selling here on the screen with the S&P off 28 points, 0.4%. 10-year Treasury yields up about 4 basis points here, 4.18%. Remember, we were down at 4% just a couple of weeks ago. So a little bit of a lift here coming in recently over the last couple of weeks here. And looking at the Bloomberg Dollar Index, a little bit higher here. And I'm going to call the dollar kind of stable after that 8-9% kind of sell-off earlier in the year. The dollar's kind of stabilized here, not recovered, but certainly stabilized here. So that's a little break there. All right, right now, let's go to Bloomberg Television's David Gura. He's sitting down with former New York City governor and New York City mayor candidate Andrew Cuomo. Let's take a listen right now.
Governor Cuomo, thank you very much for being here. I appreciate it. And I'd love to start with the state of this race. I look at all of the polling. You're not leading in any of them. The most recent one is a Fox News poll. Zohran Mamdani is ahead of you by 18 points. That's on the heels of a Suffolk poll that shows him up 25 points to you. course, it's a four-candidate race. How do you see the path forward here, given the polling and sort of where things stand? I should note that the polling hasn't changed a tremendous amount in recent weeks.
Yeah, it will change dramatically. What you see in the polls is Mamdani is always at about 40%. That leaves 60%. As you accurately pointed out, you have a multi-candidate field, so 4 people or 3 people are breaking up that 60%. I don't think you're going to wind up ultimately with that larger field. I think the field is going to collapse. I think it's going to come down to me versus Mr. Mamdani. And as I said, Mamdani has 40%. He has very radical ideas, which are exciting to one group of the population, especially young people, but are polarizing to many other people. And I think it's going to come down to a one-on-one, and then it is a totally different race, David.
Curtis Sliwa, the Republican candidate, says he's not dropping out. The incumbent mayor, Eric Adams, says he's not dropping out. We've passed the ballot deadline. If we were to have a race where it's you against Zoran Mamdani, polls still show him leading you by a substantial amount. What do you see in the electorate that the data aren't showing when it comes to that particular configuration?
Yeah, well, polls are historically wrong, especially this year, especially in New York. On your first point, you can stay in the race. First of all, technically, nobody can get off the ballot, right? The question is, are you viable in the race? And you can have people who are in the race, but the voters just think they're not really competitive. They can't win. I'm not going to waste my vote. And I think that's what happens here. I think it comes down to me and Mamdani. I think when people understand what Mamdani stands for, besides what he has said on TikTok, you know, he's anti-police, disband the police, legalize prostitution, legalize the drug trade, abolish jails. You know, this would be anarchy in New York. Socialism does not work in New York City. It's antithetical. We're the business capital, right? We're pro-business. Business is the engine that drives the train. So none of that has been communicated yet. And when it does, I can tell you the minds will change.
Is there an effort by you and your campaign to try to convince Eric Adams or Curtis Sliwa to drop out of this race? Are there conversations that are happening behind the scenes to make what I imagine you see as a compelling case for them to step aside to make this more of a one-on-one race?
No, I'm sure they're making their own decisions. Look, I've been in elections where I have dropped out because I thought it was the right thing to do. They have a decision to make. There is no apparent path to victory for them. They, in essence, would act as a spoiler, and that's a decision they have to make. They have to make it personally, and that's their business. But again, I think it's going to come down to a two-person race no matter what, because that's what the polls are going to say, and that is the choice. I am a Democrat. My father was a Democrat. I worked for Bill Clinton. Zoran is a socialist. They call themselves democratic socialists, right? Didn't support Democrats. Said Barack Obama was a liar and evil, and didn't support Kamala Harris against Trump, right? So this is a very different, this is apples and oranges between the two of us.
I want to ask you about some comments that Curtis Sliwa made yesterday. I'm sure you heard them. He was campaigning and suggested that you or affiliates of your campaign had reached out to him and offered him money to the tune of $10 million to drop out of this race. And I'm going to quote from what he said during that campaign event. He called these classic Andrew Cuomo tactics. Why don't you strap up Cuomo to a lie detection machine and ask him, and we'll all be blown to kingdom come because he's behind it. I don't have a polygraph machine with me here, but how do you respond to what he's alleging in those comments?
Look, you have to take Sliwa with a grain of salt, right? He is a known con man. He's lied about being victims of crime before. But it's very simple, David. When he said that, someone should have said, who? Who offered you the money? Let him answer the question. Because it would happen to be a crime, right? Who offered you money? He never said who which sort of tells you, right, that it's all malarkey. There was no person who did it.
I want to ask you, Les, we've talked about the state of the race, where you hope that it's headed, and if we can, I'd like to look back to 1977, so a ways. You were 19, you were a student at Fordham University, your dad was making a run for mayor, and you were helping out on the campaign. He didn't win the Democratic primary and decided to run on an independent line for mayor. He ended up losing that race by 9 points. They say that history doesn't repeat itself, but it rhymes, and I know that you don't want history to repeat itself here. You'd like to win this race in a way that he wasn't able to back then 50 years ago. I'm not the first to point out this historical parallel, but I imagine you've thought about it. And I wonder how that experience has informed your outlook on this race. There was introspection after the primaries. You didn't do as well as you wanted to do. You decided to make this run. What can you learn about that race that your dad waged, and how does that inform the way that you're running this one?
My father was an extraordinary individual on many levels. Highly principled, frankly atypical for a politician. And he did, quote unquote, the right thing, whatever he thought the right thing was. For me, I believe in the Democratic Party. I believe in what my father stood for, what John F. Kennedy stood for, and Robert F. Kennedy stood for, and Bill Clinton, and what Mondami represents, and this Democratic Socialists of America, DSA, socialists, call them whatever you want, is repugnant to the Democratic Party, I know. And that's what's really going on here. This is a civil war within the Democratic Party, right? Where the extreme left is pulling the Democratic Party. And the moderates are afraid of the extreme left. It's the inverse of the Republican Party when they had the Tea Party, and the Tea Party was pulling the Republican moderates too far to the right because they were afraid of them in a primary. That's what's happening here. It's a battle for the soul of the Democratic Party. And the Democratic Party is not anti-business. It's not anti-police. That's not who we are. We're not about redistributing income as a policy, right? You tax to provide a service. You don't tax to take money from the rich to give it to the poor, right? That's why Donald Trump calls him a communist. So this is not the Democratic Party that I believe I represent, and traditionally has served this nation well. He has zero experience in the position, never managed anything, 5 employees, never had a real job. And when you're willing to consider chief executive of New York City, no management experience, ran 5 people, now he's going to run 300,000 employees, $115 billion budget. You wake up any morning, you could have a terrorist attack, you could have another COVID. It just demeans government and demeans public service in a way that I just find abhorrent, and I'm going to do everything I can to stop it.
Governor Cuomo, thank you very much. Appreciate it.
Thank you.
I'll send it back to you.
All right, that was Bloomberg Television's David Gurr speaking with former NY Governor Andrew Cuomo in the upcoming mayoral race there. It's good to hear his comments there. Let's get a little bit of a reset in the market here, and we can do that with Mr. John Tucker and a Bloomberg Business Flash.
All right, guys, this Bloomberg Business Flash brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. A renewed slide in some of the tech mega caps hitting the overall market. The Bloomberg Mag 7 index down just about 0.75%. Is pairing some of the earlier losses, though. S&P 500 32 points lower, 6604 on the index. The Dow Jones Industrial Average is down 101 points. The NASDAQ 100, 122 points lower, and that's down 0.5%. I just want to bring this headline to you. Amazon going to pay $2.5 billion to settle the Federal Trade Commission allegations it duped customers into enrolling in its Prime membership program. Kind of a drop in the bucket. Among the most active, Tesla shares falling down over 3%. European sales of the electric vehicle giant, falling 22% in August. So now it has a market share of just 1.9% there. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash, Scarlett and Paul.
All right. Thank you so much, John Tucker. Let's take a deeper dive into the fixed income market right now and bring in Priya Misra. She's a fixed income portfolio manager at JP Morgan Asset Management. And Priya, I look at bond yields in the Treasury market, and they are rising, more so at the short end of the curve. And we're now looking at 3-week highs for yields. I guess the question that comes to mind now is, are we rethinking the pace of rate cuts that markets had been pricing in?
Thanks for having me. It's a great question, because a lot of the moves into the Fed meeting was the market saying maybe the labor market is weakening, maybe the Fed here does need to reduce the level of restriction, and then we see the Fed come out with a little more dovish dot plot, the Fed actually cutting rates. And so what's happened since then is, I think the market's saying, well, let's look at the data. We haven't had really forward-looking data. I guess you could look at claims and see that the low higher economy is continuing. We're not seeing a pickup in claims. That's good. We still have that big jobs report, next week. So second-tier data and the division at the Fed, I think, has become very clear, as we've heard all the Fed officials this week, and there's more today and the rest of the week. And there's a clear divide at the Fed about the dual mandate, and we know that the dual mandate is in tension because inflation's above target. The unemployment rate has ticked up a little bit. So to answer your question, yes, the market's reassessing. We had priced in a lot of cuts, but I don't think we've had data that should really reduce those level of cuts beyond the cutting to neutral. There's a big debate on what neutral is. We're in the 3% camp. Maybe it's 2.5 to 3.5. I think those cuts are sort of baked in. So we didn't change our view based on the data today in terms of we do expect the Fed to cut in October, December, and really continue that path as long as the data suggests that inflation is not re-accelerating beyond tariff effects. And as long as the labor market remains in this, I think it is in a bit of a fragile position as companies are not hiring a lot. And does that change with OBBB? All of that, I think, is what will drive the market going forward. But right now, we think the Fed remains on their easing path.
Priya, do your clients at JP Morgan, do they ask you about Fed independence? Do a lot of folks, particularly maybe outside of the U.S., are folks still, or should they be concerned about Fed independence?
So it is the #1 question I get from investors, domestic as well as international. There's a lot of hand-wringing, if you may, going on about Fed independence. And it is the holy grail, right, of, I would say, central banks anywhere, the U.S., developing economies. You want a central bank that is independent, that has the ability to do what's right for the economy. So it comes up a lot. We've seen unprecedented attacks on Fed Chair Powell, on Governor Cook. And so I think people are nervous. The biggest question I get is it priced in? And I would say no. And most people agree with that. And then they say, should we price it in? And this is where I have a slightly different view. I don't think we've seen enough. We've seen enough to be worried. Is that a tail risk? Yes. But I don't think we should price it in because there are institutional guardrails at the Fed. Chair Powell is the chair up until middle of next year. It's a committee. We saw the committee powerfully at work last week, where there's a dispersion in the dot plot. I don't think because of political views. I think because the data is pointing in different directions and people are weighting two sides of the mandate differently. So I think, the way the Fed has been set up, those guardrails are in place. I think President Trump, Secretary Bessent understand that. So, of course, we're waiting for the next Fed chair to be announced. I think it's going to be a credible person because, nobody wants the Fed to be viewed as being not credible or not independent. The bond market will absolutely react. And we've seen that the President and the Treasury Secretary are focused on the bond market. So it's not being priced. Is it a concern? Yes. But I would still say our baseline view is the Fed is trying to do the right thing. They're going to be data dependent. And I think the committee will protect, even if you get a political Fed chair. It's a committee-based decision rather than just the Fed chair.
So, Priya, one final question to you. Given all of that, these are some big existential issues that are not going to be resolved in the next week or even month. Where do you want to be in fixed income? Where do you want to be on the curve? How do you want to be positioned when you look at, say, corporate credit?
Sure. So first thing I would say is you want to be in fixed income because you're getting yields. You know, fixed income, I joke, didn't have income for the longest time, and now we have income and we have diversification. The Fed's telling you if the economy slows down, those risk assets start to struggle, the Fed's going to cut more aggressively than what is priced in or what they have talked about. So I think you should be in fixed income, not to talk my book, but I think fixed income has value. Then where in fixed income? I think high quality corporate credit and owning some duration. That's how we've positioned the Core Plus bond fund, because I think companies are strong and they're able to handle tariffs. So owning some spread risk and owning some duration.
Very good. Priya, thank you so much for joining us. We always appreciate getting some of your time. Priya Misra, fixed income portfolio manager, JP Morgan Asset Management. A pretty big story in the world of airplanes, jets. Boeing and Lockheed Martin are poised to win aircraft orders from Turkey as soon as next week for as many as 250 commercial planes and additional F-16 fighter jets, with a possible resolution of a long-running F-35 dispute. So let's break it all down here. We know the President Erdogan is meeting with President Trump today in the White House, so maybe we'll get some news of a deal. George Ferguson joins us. He covers all the airlines and aerospace companies here. Some good days for Boeing, George. It just seems like orders are kind of flowing in here. Talk to us about what you might hear from Turkey.
Yeah, so I would imagine that Turkey could probably top up with some orders for both narrow body and wide body aircraft. Right, Turkey's pretty well positioned, between Europe and Asia. I kind of think of them as a mini Gulf region carrier. Like a mini Emirates or a mini Qatar that has both short haul, so a fair amount of those narrow body airplanes, 737s, A320s. And a sizable long-haul business between Europe and Asia, right? There's, I think Turkey is one of those places you're willing to traverse if you live on either side of the east-west divide. I think I put that correctly. But, it's a place where I think a lot of people that may be concerned about sanctions or problems, they're willing to pass through there. So I think Turkey has a lot of connecting capacity and fast-growing airlines, so opportunities there.
Opportunities there. I want to talk a little bit about Turkey maybe making some purchases from Lockheed Martin. We're talking F-16 fighters. There's also talk about F-35s as well. My understanding, though, was that there's some controversy tied to Turkey's purchases of Russian air defense systems, and that plays into what it's going to do with these Lockheed Martin jets.
Yeah, so as I was mentioning there in the commercial side, yeah, Turkey really straddles, I think, between East and West, right? They have decent relations with Russia, and they've got good relations with the West, and so they do buy Russian anti-aircraft radar type systems, and those are systems that we don't want the Russians or other folks. We don't want them sort of testing against the F-35 for detection. So that's been a hang-up in selling Turkey the F-35. The 16 sounds like the F-16, an interesting compromise. It's not a stealth fighter. It is a very capable single-engine fighter. But again, I think for Turkey, the 35 will be the prize because that's a fifth-generation stealth aircraft and something I'm sure they'd love to have in their portfolio. So the 16 sounds like a bit of a compromise to me.
Hey, George, it seems like Boeing's turned the corner here from several years ago. But I know getting orders is one thing. Actually cranking the planes out of production, out of the assembly line, that's the important metric you've always told us about. Where is Boeing these days on their 737 order deliveries?
Yeah, it's a funny thing, right? You got to deliver the airplane to get the cash to flow. And so, what we've seen in the last couple of months is that Boeing deliveries have been rising, especially for the 737. I think in August we were up in the 40s. They're all not coming off the production line. We're kind of tracking 5, 6, 7 of these per month coming out of inventory. Airplanes they've already built. There's been a hang-up for getting deliveries into China since the pandemic. They're starting to get some of those airplanes into China. India bought some of the Chinese airplanes that maybe the Chinese didn't want, getting some of them out. As they get that inventory whittled down, their costs are going to fall as well because they're not taking care of airplanes on the ramp that are already built. That's just you know, that's just something that sidetracks you from the work you want to be doing. So, you know, what we think we see is a 30s-ish rate out of the factory. And again, we're delivering the inventory. So right now, I'd say they've made some really nice progress. We're looking for a good finish to the year. Seems like they have their quality control issues squared away. Recently had a little bit of a setback with 777X getting delayed to 2027. We have something on the Bloomberg terminal. We don't think it'll be that major of an issue, but it looks like the corner is sustainably being turned.
I like that. The corner is sustainably being turned. It's still kind of making that turn, not quite there yet. The long-term picture for Boeing, George, is still very positive because at the end of the day, you have you have a duopoly. You have Airbus, you have Boeing, and commercial airliners need aircraft, and they can only buy it from one of two places.
You got it. The duopoly, I think, definitely helped Boeing through these travails. But yeah, the backlog for the 737 is close to 10 years. It's the same for the Airbus A320. Supply chains have really kept Airbus from being able to capitalize heavily on, you know, Boeing's missteps here. The other important airplane, 787, 350, A350 on the Airbus side. Those both have 6-7-ish years of backlog. The 787 outsells the A350, so I think you could argue it's a more successful product. And on the defense side, you know, we saw Boeing win the F-47 contract for a 6th-generation fighter. It'll do a lot for their teams that are working on stealth, working on what we say combat cooperative aircraft, CCAs, where you have drones accompanying crewed fighters. And they have a nice defense portfolio. So I think there are a lot better days ahead for Boeing. And like we said, looks like the corner's been turned and they're moving in the right direction for sure.
All right, George, thanks so much. Always appreciate getting a few minutes of your time. George Ferguson, he's a senior aerospace, defense, and airlines analyst. If it flies, he covers it. Bloomberg Intelligence safely ensconced down there in Princeton, New Jersey. He forgot about the train that actually brings you into New York. So he's going to stay down there in Princeton. I know.
I'd like that. If it flies, then he covers it. I remember that.
I mean, yep, that's his thing. That's George Ferguson. All right, now let's get a Bloomberg data check with Mr. John Tucker.
All right, major stock averages, they're all lower, but they have paired their earlier losses. The U.S. economy growing in the second quarter. This is the fastest pace in about 2 years. And the government, this is because the government revised up the previous estimate of consumer spending. You just can't keep the American consumer down. The news has actually pushed up Treasury yields, and higher yields are what's weighing on stocks, especially tech stocks. That's where you pay a lot of times for the projected future earnings for tech. Intel, actually the best performing stock in the S&P 500 right now. That's because they're seeking an investment from Apple, all part of their turnaround plan. And shares of Intel right now up 6.5%. Meantime, Rayanne Mitrione at Callan Family Office says, you know what, investors are taking a bit of a break after a series of record highs.
I think it's not unexpected at this point for the market to take a little bit of a breather. We're up over 30% from the April lows and have had really strong performance kind of leading up to that rate cut we finally saw last week.
Oh, and I did the best performer, the CarMax right now. That's the worst performer in the S&P 500. That comes after their earnings report. Those shares right now down over 20%. And here's one for you. According to Bloomberg Intelligence's fast growth scenario, if the Fed's interest rate cuts fuel strong economic gains, stocks, specifically the S&P 500, can crack 7,000 by year end. We check the markets for you all day long right here on Bloomberg Radio.
Nothing is stopping this equities train. I mean, aside from the last 3 days being down, but pause.
That's a bearish signal. I don't know what is.
Exactly.
You want my stock picks too?
We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg business source. I didn't mean to dish you. It's just,
That's
I'm
okay.
just saying.
I shouldn't be recommending anything.
Exactly. All right. John Tucker, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. The government shutdown October 1st, folks. The White House Budget Office telling federal agencies to prepare plans for mass firings, not furloughs, firings during a possible government shutdown. That's new.
So I'm going to blame all this on Nathan Dean. He's down there in Washington, D.C., senior policy analyst for Bloomberg Intelligence. He talks to everybody. He knows what's going on here. Nathan, where are we on this shutdown here? There's some crazy rhetoric going back and forth.
Yeah, and that rhetoric was anticipated and expected. Obviously, Congress is not here this week. The House is actually not going to come back until after October 1st, or at least that's the plan. And so the rhetoric is only going to increase as we get closer to Sunday night when these senators come back into town. And as a reminder, the government would shut down Tuesday night at midnight, so that only leaves us 2 days for Congress and essentially the Senate to come together and come up with a solution. Now, I'm at a 40% chance of a shutdown, and I'm probably out of consensus on this. Polymarket and the betting markets have it around a 62% chance. But the reason why I don't think that there's going to be a shutdown is I just don't see how this plays well politically for the Democrats. And my one thing that I would call out is that, yes, the Democrats want to be seen fighting President Trump, but this idea of a threat of firing government workers is a very valid threat. And so if you're one of the Democratic senators from Virginia or Maryland, you're certainly going to be wanting to protect those government workers going into this. And kicking the can 7 weeks to have this fight in November is something that's pretty easy to do when it's a clean CR.
Okay, so you see the Senate Democrats coming in and blinking, essentially.
Yeah, and the reason being is that when the Republicans offered a clean CR through November 20th, it's really hard for Democrats to play the message and say that we are not going to accept
All right, Nathan.
that.
Nathan, unfortunately, we got to jump here. The president is speaking. You can understand that. Nathan Dean, senior policy analyst at Bloomberg Intelligence. Right now, let's go down to Washington, D.C. The president is participating in a bilateral meeting with the president of the Republic of Turkey. Let's listen in.
Rigged election, he knows about rigged elections better than anybody. But when I was in exile, we were still friends. That's always a good way to find out, test of friendship. But he's a highly respected man. He's respected very much in his country and all throughout Europe and throughout the world where they know him. He's built a tremendous military, powerful military, uses a lot of our equipment. And it's an honor to have him at the White House. We're going to have a lunch together. We're going to have a discussion, big discussion. We do a lot of trade with Turkey, and we're going to continue. We're going to do some additional trade. They want to buy F-16s, F-35s, and some other things, and we're going to talk to them about that. And we're just going to have, I think, a very interesting couple of hours. We're going to get a lot done. But I have great respect for this man, and we've had a very good relationship for a long time. If you remember, he led Pastor Brunson. He freed Pastor Brunson. Pastor Brunson was put in jail for 35 years before I got there. This was a group that should have stopped it. And the president, after I called him, released him, which was a great thing for our Christian community, our evangelical community. The evangelicals really wanted that. It was very important to him, so I always remembered that. But he released him from 35 years in prison. And Pastor Brunson now is healthy, happy, and well. We're very happy about that. But it's a great honor to have the president of Turkey with us. And how are you?
Fine.
Say a few words.
And you?
Great guy.
Öncelikle bu ziyaretimizi Birleşmiş Milletler Genel Kurulu'yla iç içe olan bir dönemde gerçekleştirdiğimizden dolayı arkadaşlarımla beraber çok mutluyuz. Gerek Sayın Trump'ın birinci döneminde.
Okay, so we are listening to President Erdogan of Turkey, President Trump speaking at a bilateral meeting in the Oval Office of the White House. President Erdogan is speaking now. We'll get a translation after he makes his comments here. But then presumably they will also take Q&A, and that could be, as it typically is, something to pay attention to.
Absolutely, because you never know what's going to happen. What we do expect to happen is that Erdogan, the president of Turkey, and President Trump will come to some kind of trade deals. And there's a lot of talk, and we talked about this with George Ferguson of Bloomberg Intelligence, about Turkey's plan to buy up to $50 billion of commercial jets from Boeing, fighter jets from Lockheed Martin, also LNG, liquefied natural gas, from companies including Woodside Energy and Mercuria Energy. I was reading the Bloomberg News story on this, Paul, and it's fascinating because I did not realize that the U.S.-Turkey trade balance is roughly balanced.
Okay.
That's why Turkey faces only a fairly minimal 15% U.S. tariffs on its exports.
Very good. And again, President Trump calling out the return of an evangelical person, that American that was taken or in jail in Turkey for many years, and he called that out as a positive development in the relationships. But again, it comes down to, as often does with President Trump, is let's put the money where the mouth is in terms of either investing in the U.S., making large commitments to invest in the U.S., or buying U.S. products directly. One way to really ring up a big bill with the U.S. government is to buy aircraft.
Yeah.
They're expensive, so.
Goes right to the president's heart and right to his mission.
And then the other one would be energy for his, for our good friends down in, Texas and Louisiana and that part of the world that liquefied natural gas is such a big part of the energy business down there. So again, those are two areas that have been typically used by countries if they want to buy American products, two ways to go about it. So again, we'll keep in touch with this conversation when they get to the Q&A session. We will bring that to you as well.
This will be the easy part of the meeting where they discuss trade deals and they talk about what's to come. I think the more complicated part of it is Turkey's position here, especially when it comes to geopolitics. Yep. And Turkey perhaps needing U.S. help to engineer some kind of deal in Syria. We know that Turkey is also a very outspoken critic of Israel, which does not mesh well with the president's stance on Israel as well. So these are all things that may be brought up in the Q&A. And certainly there will be other issues, given that the UN General Assembly meeting is taking place in New York right now. Lots of global leaders in New York at the moment that could come up. And I'm expecting, Paul, for the president to be asked about the possibility of a government shutdown. He was supposed to have a meeting with Senate Democrats and House Democrats, and he canceled that this week. So exactly. It's not clear whether there's going to be any further talks right now.
No, and it doesn't. And as we learned earlier, that the Congress is still on break here. Nathan Dean told us they're not coming back until.
I'm sorry, why are they always on break?
I don't know. They have lots of breaks there. So anyway.
I guess they have to go back to their home districts, but still.
Yep, absolutely. All right. Regulatory news coming out for our friends at Amazon. Amazon and the Federal Trade Commission, they reached a $2.5 billion deal in that Prime subscription case. Let's bring in Spencer Soper. He is a Bloomberg tech reporter. Spencer, can you remind us of what this case is and then what the settlement does?
Yeah, so this is about Amazon making, kind of duping consumers into paying for Prime memberships. So the FTC alleged that, they tricked people to cancel their Prime memberships if they wanted to. Internally, at Amazon, they even had a term for this cancellation process called the Iliad, which kind of referred to Homer's epic Odyssey. So there was some pretty damning findings about how Amazon handled this. The settlement is $2.5 billion. $1 billion will go to the U.S. Treasury, and $1.5 billion is for consumer refunds. People will be refunded automatically if it was found they were affected by this case, and you're looking at about $50 per affected consumer. So it's no huge windfall for consumers. And even for Amazon, $2.5 billion is probably like a parking ticket for you and me. But it puts this thing to bed and prevents Amazon from going to a trial, which probably would have been pretty embarrassing.
Okay, so that's what they want to avoid. Just give us some context here about how valuable the Prime program, Prime membership is to Amazon. I know that they don't always give a lot of numbers. The numbers that we do get have to do with how much it costs members. But in terms of the actual number of members and the amount that they spend, aside from knowing that they spend more than regular Amazon customers, we don't have a sense of how much they contribute to margins, for instance.
Well, it's a huge part of Amazon, and the financial nitty gritty I really don't have. But you're talking huge penetration in the U.S. More people live in a home that has a Prime membership that don't. So they've got a majority of the country, and then. To your point, if you have a Prime membership, you're paying Amazon $140 a year or $15 a month, and so you're more likely to buy things on Amazon. And so Prime members spend about twice as much on Amazon as non-Prime members. So it's a critical part of the success. It's also very sticky. People tend not to cancel, which is why this I don't see this as being a huge deal, this settlement. It's kind of like Amazon puts it to bed, but by and large, most people who join Prime are happy with it and stay with it. This was just kind of more of an embarrassment for them.
Yeah, I think it's we find it of huge value in our home. President Trump is still speaking with President Erdogan in their bilateral meeting there in the Oval Office of the White House. We will bring you headlines, and the red headline just crossed the Bloomberg terminal here. According to President Trump, we want Erdogan to stop buying oil from Russia. So that's consistent with what the president has said, and we'll bring you more reporting on that. Spencer, what else is in front of Amazon, just in terms of some of the regulatory issues facing it? It's really hard to keep track of what's going on with some of these big tech companies and the regulative headwinds.
Yeah, that's a good point, and people should know this is an FTC case against Amazon that was specifically against Prime membership. There's still this whole question, this big antitrust lawsuit against Amazon, which is basically saying, you know what, this company is so big and has so much control and so much power that it's impossible for other companies to compete. That's still pending, and that's really the big threat to Amazon, and that's a holdover from the Biden administration. So in terms of the regulatory framework, the significance of this Prime settlement is largely, like, a lot of people are wondering, okay, President Trump took office and there were a lot of these FTC cases pending against big tech companies like Amazon, you know, from the Biden administration. What does the new administration mean for these cases? And so that's really the big question here that we're still wondering about is Amazon was able to put this kind of smaller Prime investigation to bed and pay a little fine, but what is the outlook on these bigger cases that are more of an existential threat to Amazon?
So what is what's the feeling out there in the West there with Silicon Valley and up there in Seattle area about this administration? Is this administration that can ultimately continue the light regulatory touch that the tech industry has always enjoyed, or maybe they won't be able to deliver on that? How concerned is greater technology, greater Silicon Valley about the regulatory environment?
Well, I think that they're all trying to very delicately figure out how to finesse their way through this administration. I guess I think if Trump is anything, he's unpredictable. Right. So I don't think that they take anything for granted. And that is a good question, and I wish I had a nice simple answer for you. I just don't think that. Yeah,
I don't think anybody does at the moment. But I guess try to stay in the good graces of this administration is probably not a bad strategy. Spencer Soper, thank you so much for joining us. Spencer, he covers all the technology for Bloomberg. He's based out there in Seattle, right smack in the middle of the old Microsoft Amazon thing as well. Boy, some big news today if you're in the used car business. CarMax, Richmond, Virginia-based company, stock down 20% today. Some disappointing results and guidance here. Let's get the bottom line here, what's going on. Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst, joins us here. Steve, just tell us what's going on with CarMax. The stock down 20% today. What's the news?
Yeah, it's significantly down today for a couple of reasons. One is the auto sales, used car sales wasn't as good as expected in the second quarter. And then secondly, it's really on the write-down on some of their loans. And the first item is actually not that surprising because there's been a lot of pull-forward demand. Remember in the first quarter when Trump announced these tariffs on autos, a lot of the consumers actually went ahead and bought a lot of cars in concern that prices will go up. So the pull-forward demand really dented second quarter sales.
Then talk to us about the other side of the equation, kind of the write-off of some of these auto loans here. Is that unusual for CarMax?
Well, I mean, this is on the back of the Tricolor Holdings bankruptcy, if you remember. They actually went bankrupt because they wrote a lot of subprime loans that on potentially undocumented, allegedly undocumented buyers. But this seems to be more of a unique case for Tricolor Holdings. So the write-down is a little bit kind of special, given the coincidence that's with the Tricolor. But it's not really out of the ordinary for these auto companies to actually write down some of the loans. The interest rate has been high, right? I think the bright spot now is that the interest rates are coming down. So we don't actually see that is an industry issue, but it does cause for concern. It's not a red flag. I would say it's more of a yellow light, yellow flag.
Talk to us, let's step back a little bit. Talk to us about where we are in the auto business with just how many cars are being produced these days in the U.S., and what does that mean for the used car market, like the CarMaxes of the world? Where are we today?
Yeah, I mean, it's about the annual sales in the auto industry today in the U.S. It's around 16 million. If you include Canada and Mexico, it's around 18, 19 million. The used car market is actually bigger than the new car market. It's a very vibrant market. And look, it's an interesting market. There are a lot of used cars that's coming back from leases. I remember during the COVID era, we had quite a bit of vehicle sales, and prices were really high. And so there's quite a few used cars coming back in the market, and that's impacting prices as well. So even with lower prices, used car sales was down in the second quarter. But then again, it's a function of the pre-buy that happened in the first quarter. So I actually feel that we're probably near the trough, given that interest rates are actually coming down.
So, we talk about the SAR, the seasonally adjusted rate of 16 million. I remember back in the day, 17 million was kind of the norm here. Is this a new lower normal level of production from the U.S. OEMs?
Yeah, you're absolutely right. We haven't really gotten back to the pre-COVID days of 17 million SARs. But I think this is a new normal of 16 million. Look, the average price for a vehicle has actually gone up quite a bit.
Yep.
Today, it's about $48,000 per vehicle. Before COVID, I think we were, around 40. So a significant increase since then. So there is some concerns about affordability. You've seen financing terms being extended. Car buyers actually can get loans for 72-month loans up to 84-month loans just to make the vehicles more affordable. So I do believe this is a new normal. I don't see prices coming back down. Prices don't usually come back down once they're increased. So I think this is going to be the new normal.
So does that mean people are staying in their cars longer because the affordability of getting a new car is that much more difficult?
Yeah, that's a great question. I think they are going to stay in their cars a little bit longer. Look, the cars today are much more reliable, much more durable than they have in the past. So they do last a little bit longer. And if you throw in EVs, right? EVs, it's probably around 4 or 5% of the total fleet today. Those last also a lot longer with less moving parts. So who really benefits are actually the aftermarket retailers like O'Reilly and AutoZone. As people keep their cars a little bit longer, they're probably going to either go get it repaired by the dealer or the mom and pop shop, or they do it themselves. So when they do that, they're going to have to go shop at companies like O'Reilly and AutoZone, which is going to benefit from the old
All right, Steve.
vehicles.
Great stuff. Thanks so much for your time there, Steve. Steve Mann, he covers the autos and the industrial companies for Bloomberg Intelligence. He is based there in Princeton. Again, CarMax down about 20% today on some disappointing results. For our listeners in the U.S., a reminder, you can listen to us via satellite radio and Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Radio begins in just moments. S&P 500 down 24 points. The Dow down 80. The NASDAQ down 56 points. That's about 0.25%. More Bloomberg Radio coming up. This is Bloomberg Good Morning.
CBS News on the Hour, sponsored by ZipRecruiter.
I'm Steve Kathan. The White House has threatened mass firings instead of temporary furloughs if there's a government shutdown next week, according to a memo. Democrats are sticking to their demand for a rollback of Medicaid cuts. CBS's Willie James Inman at the White House.
President Trump is essentially blasting Democrats because he's saying that he reviewed their plans and calls it unserious and ridiculous demands. Now, I'll note that Democrats had proposed a counter-proposal of sorts that would have continued government funding for at least a month, and on top of that, it would have rolled back some of the cuts to Medicaid funding that we saw in the so-called One Big Beautiful Bill.
The government's revised its numbers for economic growth in the second quarter of the year, up at an annual rate of 3.8% instead of 3.3%. CBS's Jason Brooks.
The increase in GDP is credited to lower imports and stronger consumer spending, helping offset weaker investment activity. In addition to that, orders for big-ticket items like appliances and electronics unexpectedly rose 2.9% in August, rebounding from a decline the previous month.
Authorities say the exact motive for yesterday's deadly shooting at an ICE facility in Dallas remains unclear. One detainee was killed, 2 critically wounded. CBS's Camilo Montoya Galvez spoke with the acting ICE director, Todd Lyons.
Director Lyons told us that this shooting in Dallas could have been even deadlier had the shooter been more successful in targeting ICE officials and others who were in the vicinity of that ICE field office in that area.
Well, there's word Amazon has reached a $2.5 billion settlement with the Federal Trade Commission, which accused it of tricking people into signing up for Prime memberships and making it hard to cancel. Delta Airlines is making changes to its Airbus jets to stop toxic fumes from leaking into the cabin.
Last week, the Wall Street Journal reported about thousands of cases where fumes from an Airbus jet's engines have given passengers and crew concussion-like brain injuries. Dr. Robert Harrison has treated more than 100 flight crew members.
And it gets into their brain and can affect the other parts of the nervous system.
Now, the journal reports Delta is replacing the auxiliary power units in the tails of its Airbus jets. Those units can pump the toxic air into the cabin when the plane's 2 main engines aren't running. Michael Wallace, CBS News.
What a baseball season it's been for Cal Raleigh of the Seattle Mariners. Fly ball to right field! Number 60! Last night, he became just the 7th major leaguer to reach 60 home runs in a season. He's the first catcher to do it. Wall Street, right now the Dow is down 71 points. The S&P is down 20. This is CBS News. From the world of music, a special delivery.
Rihanna has given birth to her 3rd child with rapper A$AP Rocky. This one's a girl. The couple posted an announcement to Instagram with pictures of Rihanna holding her newborn swaddled in pink, along with a pair of tiny pink satin boxing gloves. Rocky Irish Mares is named for her famous dad. She joins big brothers RZA, who's 3, and Riot, age 2. Deborah Rodriguez, CBS News.
President Trump complains on social media he was a victim of triple sabotage, noting the failure of a teleprompter and escalator this week at the UN. And he said the sound during his speech to the General Assembly was off for some, including the First Lady. Trump insists it all was not a coincidence and says there should be arrests. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
It's all in the memo. Welcome to the Thursday edition as President Trump's budget director lays out plans for massive federal layoffs if the government shuts down in less than a week. We'll tell you what's inside when Mike Dorning from Bloomberg's Capital Influence team joins us. Michael Shepard as well with us in Washington here as we cover what could happen just less than a week from now. The CBC is holding its annual meetings in Washington. We're going to talk about the agenda with Nicole Austin Hillary, President, CEO of the Congressional Black Caucus Foundation, with analysis from our political panel. Bloomberg Politics contributor Rick Davis, our Republican strategist, with us alongside Ophira Yeskel from the Democratic Governors Association. It's all after a look at Wall Street. We start there now with Charlie Pellet in New York. Charlie, how's the market?
Hi, thank you very much. Good day, Joe Matthew. A down day for the Dow, the S&P, NASDAQ. Just getting word from President Trump. Headlines right now on the Bloomberg Professional Service. The president saying, quote, "We will take some tariff money and distribute it to farmers." The Dow, the S&P, NASDAQ, all in the red right now, with the S&P down 22 at 66.15. That is a gain of just about 0.3%. We've got the Dow lower by 76, down 0.2%, while the NASDAQ Composite Index down now by just about 0.2%. The 10-year is currently yielding 4.18%, with the 2-year 3.65%. Gold up $2 the ounce, 37.38, up just under 0.1%, while West Texas Intermediate crude oil down 0.2%, 64.84 right now for a barrel of WTI. Bitcoin down 1.7%, 111,660 right now on Bitcoin. David Katz is the president and chief investment officer of Matrix Asset Advisors, and this morning on surveillance he told us he has been looking at Washington and sees better market opportunities ahead.
We think now is not the time to jump on the bandwagon and get more aggressive. We think you want to be a little bit more cautious. You have the possible government shutdown in the next week or so. That could cause any sort of a sell-off. We would not chase the rally. We'd buy on any sort of dip in excess of 5%.
David Katz of Matrix, and yes, a whole lot more coming up on a potential shutdown right here on Balance of Power. Amazon has agreed to pay $2.5 billion in penalties and refunds and change its process for how to cancel its Prime subscription to settle a lawsuit by the Federal Trade Commission. Amazon up right now by 0.1%. I mentioned crude oil down 0.3%. BP says oil demand is going to keep growing for the rest of the decade, rolling back its prior projection, but the high point could come as soon as this year. Again, we've got shares of BP up by 0.2%, ExxonMobil up 0.8, Chevron up by 1.1%. Recapping stocks lower, S&P down 0.4%, and for on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. And Balance of Power continues. Back we go to Washington. Once again, your hosts, Joe Matthew and Mario Parker.
All right, Charlie, many thanks. Live from World Headquarters in New York, Charlie Pellet on the markets, and he'll have more in about 15 minutes as we track the Thursday trade. Welcome to Little Friday and the Thursday edition of Balance of Power on Bloomberg Radio, on satellite radio, channel 121, and on YouTube, where you can watch the radio show on TV. Find us by searching Bloomberg Business News Live, as well on Bloomberg Originals. With breaking news to start at high noon here on the East Coast, coming from the White House, and a potential deal in the works with the president of Turkey in the Oval Office with President Trump. They just wrapped their conversation. And indeed, as Charlie mentions, Mario Parker back at my side again today. Mario, a lot of headlines coming out of here. We've got the potential for a deal if Erdogan can help Donald Trump when it comes to Russia, maybe buy less oil, maybe influence Vladimir Putin. He might get some fighter jets from the United States that he's had his eyes on. And how about Donald Trump with an F-35 lapel pin, just to lay it on a little bit thicker in the meeting?
We know these Oval Office sprays are so theatrical and well just choreographed by the White House, right, to be on theme and on message. What's striking, I think, so far from what we've seen is that even as Trump and Erdogan have this really warm relationship that goes back for a while now, this is Erdogan's first visit back here to the U.S., or at least to the White House in about 6 years. He and Biden had strained relations, but you still see, even with that warm relationship that I mentioned, you still see Trump applying pressure on this Russia-Ukraine war.
That's right. We do have a couple of headlines to share with you. Trump says, as far as Turkey is concerned, urging Erdogan to cut Russian oil buys, floating an F-35 deal, as we mentioned, remembering that Turkey was removed from the F-35 program many years ago. The president says the U.S. could lift sanctions against Turkey soon, so something could be dislodged. They're going to have a working lunch. He's going to be here for a couple of hours before the president meets with the leader of Pakistan. Michael Shepard is with us in our studio in Washington, watching all of this unfold. Bloomberg senior editor. Michael, you've seen a lot of state visits since Donald Trump came back into the White House. There does seem to be a certain cadence that they follow. But instead of, in this case, the visiting world leader showering Donald Trump with compliments, it was the other way around. The president kept talking about what a tough man President Erdogan is.
Trump was clearly trying to get something out of his counterpart from Turkey there. As Mario was just noting, he really does want some help with Vladimir Putin. He wants to get Turkey, which has a more proximate relationship with Moscow, to try to exert some influence. And it's not just in purchasing oil. Erdogan has engaged with Putin frequently over the years, and perhaps that personal suasion could be applied in this case. It's unclear whether any of that will work. Vladimir Putin has given no indication whatsoever that he has any desire to pull back on his invasion of Ukraine and his intention to keep prosecuting the war there for the foreseeable future. But his call on Turkey to stop buying Russian oil really echoed what he had said at the United Nations earlier this week, a general call really to some of the other big buyers, including China and India as well.
And Mike, just how just delicate or how enticing, I should say, is the carrot of the reinstatement to the F-35 program? I mean, how strong is Trump's hand here?
Well, that's a great question because, Turkey really was a founding member, as a NATO member country, but really on the ground floor of the F-35 program for many years. But it was removed and denied access to purchasing these advanced jets because it had acquired Russian air defense missiles. And the mixture of the two in the same, because when you acquire those missile systems, you also bring Russian personnel. And the last thing you want to do is have a sensitive U.S. jet next to a sensitive Russian missile defense system in the same country. And it really also, just in terms of look and appearances for many U.S. officials, crossed the line. And that prompted Congress to prohibit Turkey from being part of the F-35 program. So whether Trump can actually just simply sign something and give Turkey access to these F-35s is an open question. Lawmakers may have something to say about it. But in the meantime, we may see some deal-making when it comes to Boeing jets, perhaps an order of up to 250 commercial passenger planes. And there may also be some F-16s thrown in there, too. But we didn't see anything signed. There was no paper released at the top of the visit. So they've got a lot to talk about right now.
Interesting language coming from the president, sort of the polar opposite of the Biden administration when it comes to Turkey. Not only could lift sanctions, but he said Erdogan will be successful in buying what he wants. Presumably, and shortly after that, said that he will discuss Patriot systems and mentioned that Turkey wants to buy F-35s and F-16s. We will talk about it. Is this deal as good as done as far as the president's concerned? Congress would be the roadblock?
In many ways, Congress could stand in the way of the president on a number of things, but we have not seen them demonstrate the wherewithal to do so. Another example is something we may see later today on this, Joe, and that, of course, is the president perhaps signing an order related to the TikTok deal. Many lawmakers have expressed their misgivings over what they've seen about the transaction so far, concerned that it doesn't comport with the 2024 law that on a bipartisan basis they got together to pass. Now, what are they going to do about it? That is the other question. And is there some legal mechanism or step that they could exercise in this case on the F-35 to truly stop the president? So we will have to see how that unfolds. And lawmakers are out this week. They will be back next week to hash through and try to avert a shutdown. But this will be yet another thing for them to tangle with for sure.
And another important topic that I guess we would expect to come up as well is just the Middle East as well, right? I mean, Trump has been stymied on two fronts. If he's just as stymied on Russia, Ukraine, he's also been stymied with Israel, Gaza, of course, and Erdogan is quite essential there as well.
Well, he could be a key player to Trump trying to get through this agreement that he presented earlier this week to regional leaders. Steve Witkoff, his key negotiator, indicated that perhaps we really were on the cusp of getting something. The other parties have been less enthusiastic. Not only the U.S. allies in the Gulf, including Saudi Arabia and Qatar, but even the Israelis have been wary about jumping aboard this as well. And so it remains to be seen whether, even if Erdogan does exert some influence, whether that would be the decisive factor. And Trump indicated today, as he often does, a deal is just around the corner, but it's unclear whether they are actually that close to the goal line today.
Is there more than oil that President Erdogan could do to influence Vladimir Putin? To what extent does their relationship allow a difficult conversation?
You know, that is a good question, and it's unclear whether any leader in the world, perhaps say Xi Jinping, really has that kind of sway over Putin, because he is it's hard to call it a fixation, but he really is determined with the war in Ukraine to continue prosecuting
that. You
that.
could call it a fixation.
And I guess we could, for the purposes of this conversation at least. And when it comes to China, we have seen China previously express its own version of misgivings about what's happened in Ukraine and Putin's responsibility, but they've since moved on, because in terms of geopolitics, it's better for them to really approximate themselves closer to Moscow than to the U.S. right now in this moment, when we do see tensions over trade and geopolitics and technology heightening between Washington and Beijing.
And you mentioned trade, Mike. I mean, this has just been so crucial to Trump's geopolitical policy, not only with the Boeing jets, of course, and then the F-16 program that or F-35 program that he's dangling out there, but just LNG, liquefied natural gas, and maybe trying to fill the void in Europe if Europe is able to wean itself off of Russian energy. How crucial is that?
Well, he sees that as a win-win, because if we're the U.S. able to sell a lot more of the LNG that is being produced increasingly here, that'll be a stopgap for Europe, which has been reliant for years on Russian supplies, and it'll certainly be a boon to producers here. You brought up trade. I heard something interesting in the Oval Office remarks from the president, and he was promising perhaps a cut of the tariff income for U.S. farmers until they start to see more benefits from the tariffs themselves, including the idea that tariffs would pressure China into purchasing or following through on its agreement to purchase more U.S. grain. So this idea of payments directly to farmers certainly would take aim at a base that he has cultivated for years.
Sort of the newest version of the rebate check idea that they were floating a couple of weeks ago. We'll see if that goes anywhere. Sometimes we say things and we don't follow up. Michael Shepard, always a pleasure to have Shep with us in Washington to get the ball rolling, and thank you for walking us through that. Alongside Mario Parker, I'm Joe Matthew. I need to get one of those F-35 pins, but we'll do that another day. Stay with us. Mike Dorning from our Capital Influence team is coming in next. We're less than a week out from a possible shutdown on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ 100 index, Russell 2000, all trading lower. Traders are driving stocks down as concern about stretch valuations overshadows data showing that the economy is holding up. S&P right now down another 26, down 0.4%, had 66.11. The Dow down 98 right now. The Dow dropping 0.2%, while NASDAQ, the composite index, down 0.3%. The NASDAQ 100 index also down 0.3. Russell 2000 down 0.9, and our Mag 7 index down 0.5%. 10-year at 4.17%. Spot gold up $2.50 the ounce, 37.38, up by about 0.1%. And West Texas Intermediate crude down 0.4, 64.72 a barrel. Kimmel's return to ABC, a rating success. He got 6.26 million viewers, the most ever in the show's regular time slot. That total, by the way, significantly higher than the 1.55 million viewers that Jimmy Kimmel Live has averaged this year. This all according to Nielsen data. Kimmel is on ABC. ABC, a part of Disney, and shares of the Walt Disney Company right now, they are trading little change, down by about 0.1%. So recapping here, we are looking at a down Thursday. The Dow, the S&P, NASDAQ, all in the red. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Back we go to Washington. Balance of Power continues right now. Your hosts, Joe Matthew and Mario Parker.
All right, Charlie Pellet, the voice of Wall Street and the New York subway. If you get up to New York and you're on the train, just listen for him. I'm Joe Matthew in Washington. Thanks for being with us on the Thursday edition of Balance of Power. Mario Parker at my side, and the memo is out. We've been talking about this for weeks on this program. We've had a number of lawmakers weigh in on the idea that Russ Vought can't wait for a shutdown. Remember, Mick Mulvaney was at this very desk. He said he was jealous of Vought for this moment because there's a plan somewhere in a black book, and well, it just came out in the form of a memo. Mario, the White House directing federal agencies to come up with a list of reductions in force layoffs. Many federal workers would be deemed unessential and lose their job and likely not get it back if the government were to shut down. This is pretty remarkable. As I read from the memo, once fiscal year 26 appropriations are enacted, agencies should revise their RIFs as needed to retain the minimal number of employees necessary to carry out statutory functions. This is like Doge on steroids.
It is Doge on steroids, for sure. That's a great way to put it, Joe. I mean, this harkens back to March, right? The White House here is acknowledging the fears that Schumer had earlier this year when he essentially decided to forego a shutdown fight in order to preserve federal employees, their jobs, essentially, right? So this is the White House up in the ante. Schumer's up the ante in some ways with his rhetoric this time around. He's more itching for a fight, at least that's what it seems to be publicly. The White House is saying, essentially, with this move, show me your conviction.
Yeah, well, you know what? Hakeem Jeffries showed him something on social media last night. He picked up the story from Politico. White House to agencies prepare mass firing plans. Hakeem Jeffries, listen, Russ, to Mr. Vought. You are a malignant political hack. We will not be intimidated by your threat to engage in mass firings. Get lost. Here's the Democratic leader from earlier in the House.
Republicans have clearly demonstrated they want to shut the government down. Throughout this process, an intentional decision was made by Republican leadership in the House and the Senate not to have a single conversation with Democrats. They're not even pretending as if they want to find common ground.
Now, Mike Dorning doesn't use the word shut down lightly. He's been through this too many times. Deputy team leader of our Capital Influence team. He's with us at the table right now. Mike Dorning, we're 6 days out. Did it just get more difficult to avoid a shutdown?
I think it did get more difficult. They've really ratcheted up the tensions here. In some ways, it makes it harder for the Democratic leaders to back down. And Trump has seized the main character protagonist role here. He's now the one who's driving the action. So that makes it, A, harder for Democrats to back down, and B, more likely that they can blame it on Trump if the government does shut down. That said, it could potentially fracture parts of the Democratic coalition. Some of those federal employees, don't like the idea of being permanently dismissed, for instance.
And Mike, are you surprised at how quickly the White House played this card? I mean, we have been speaking all week just about how Donald Trump kind of seized on the messaging fight here. I mean, and to your point now, he becomes a protagonist as well. Are you surprised that they went essentially to the nuclear option this quickly?
I was a little surprised by that. We started to see that, though. He had initially signaled he would have that, traditional meeting where the president tries to negotiate with the other side, and the other side tries to negotiate, and they all at least pretend like they're trying to do something, and that this would more be something that happened late in the day. But first he canceled that, showy meeting of like, we're all going to try, and then he ratcheted this up. So it was two steps. First, cancel the efforts to look reasonable. Second, just raise the temperature a lot. That probably helps him with his own constituency. We'll see how this gambit plays out.
What about the DMV effect here? District, Maryland, Virginia. Well, maybe it's just the MV effect. The senators from Maryland and Virginia, Tim Kaine, Mark Warner, right, Chris Van Hollen, thinking about the thousands, the tens of thousands of federal workers in their states. There is a thought that Republican leaders are looking across the aisle at those specific senators, knowing that they would be more reluctant to let the government shut down, to let those paychecks stop.
Well, we saw a response from one of the Maryland senators, Chris Van Hollen, that was essentially like, this is mafioso blackmail, we're not going to give in to this. So that's one where we think it's probably not going to have an impact on his vote, at least from what he's shown so far.
Okay.
But I would look at some of the unions to see that sort of disparity. You had the Federation of Government Employees, which mainly represents federal employees, and they're like, hey, let's try to negotiate, guys. But then the AFL-CIO, which is the broader labor movement, was like, no, this is about health care, don't back down. And there you see the different pieces of the Democratic coalition maybe migrating in slightly different directions.
Well, I bring that up in part, Mario. Tom Emmer was on the program a few days back, and he said if Democrats let the government shut down, they just lost the Virginia gubernatorial race. There is a connection here somehow to that race, or at least one they're trying to draw on both sides of the aisle. Is that real for you?
I'm not sure that I would agree with that analysis. We'll see how it plays out.
That anger against Democrats might be a problem for Abigail Spanberger would be the idea here.
That could be a problem. But again, Trump has seized the protagonist role, and he's the one who's setting the agenda. In order to blame it all on the Democrats, he would kind of have to look like the secondary character in this drama, where Schumer was the main character. Schumer was driving the action, but he seized that role of driving the drama to be Trump as the hero, Trump as the one who's saying, bring it on, I'll fire all these workers if you go through with it. So he's the one who's setting the agenda. He's the one who's driving the action. It makes it a little harder, but he looks strong this way instead of looking weak.
Now, Mike, I want to ask you, just to piggyback off of something you and Joe just mentioned, in terms of the health care that's at stake here, right? Democrats have planted as a heel to essentially fight on this. How salient is that message, especially when we look at the Obamacare subsidies?
I mean, that is something that will be very salient going into the midterm elections. In some ways, the timing of this doesn't work to the Democrats' advantage on the Obamacare element because the notices of all the premium increases don't go out till November 1st, and they don't kick in till January 1st. So were this drama to happen later on, people might be more aware of how much their premiums might increase, and it would seem like something that's happening sooner, like at the end of the year. But they've chosen to fight now. I was sort of thinking in the beginning they might delay and have the fight in November.
You got
a meeting tomorrow.
Yeah, this
at
is
4
Charlie
p.m.
Pellet in the Bloomberg Newsroom. We have got the Dow, the S&P, NASDAQ. We're all trading lower right now with the S&P 500 index down 27. Looking at a loss right now of just about 0.4%. The S&P at 6610. We have got the Dow Jones Industrial Average down 88 on the Dow, decline there of just about 0.3%. While NASDAQ is down 83 for NASDAQ, a decline there of just about 0.3%. Our 10-year currently yielding 4.17% with a 2-year right now 3.64%. We do have gold flat on the day, 36.33 the ounce, and West Texas Intermediate crude down 0.4%. WTI right now 64.76 a barrel. Bitcoin right now down 2%, 111,268. Some of the other stories that we're following for you: Starbucks plans to close stores and eliminate 900 jobs in a $1 billion restructuring effort under CEO Brian Niccol. Company's overall store count in the U.S. and Canada will drop by 1% to 18,300, and then it plans to grow the number of stores it operates and refurbish another 1,000 restaurants. Changes all part of Niccol's plan to make its restaurants a more inviting place to visit, with early results showing customers visiting more often, staying longer, and sharing positive feedback.
SIM cards.
Starbucks shares today, they are down now by just about 0.5%. Some of the other stories that we continue to follow here at Bloomberg, we do have BP saying oil demand is going to keep growing for the rest of this decade, rolling back its prior projection that the high point could come as soon as this year. Among some of the oil names today, the oil majors, BP up 0.2%, ExxonMobil trading higher by 0.7, and Chevron up now by 1%. CoreWeave, keeping an eye on that stock, little change.
The only ones who really didn't sign, Jon Snow, who was under George W. Bush, and Steve Mnuchin, who was Donald Trump's first Treasury Secretary, perhaps understandably, but he didn't sign. It's a heavyweight group, and they're making the case that any ability by the president to just fire Fed governors at will would expose the bank to the possibility of political manipulation, and that would lead to worse economic outcomes, higher inflation, greater debt, and a lot of very bad things. So we don't know how much weight this will carry with the Supreme Court.
CoreWeave shares, they're up now.
Decide very soon on whether to let the president go.
Elsewhere in the tech world, keeping an eye on Intel, got an upgrade today to neutral from sell at Seaport Global, which sees near-term upside for the chipmaker if it receives more direct investments. Also, Intel shares, they're up now, surging by 6.9%. Eli Lilly has halted a study of an experimental drug designed to prevent obesity patients from losing too much muscle, citing strategic business reasons it did not disclose. CarMax shares, they're trading lower. This after the company reported a surprise drop in comparable sales as buyers had rushed to buy vehicles in the previous quarter ahead of a tariff on imported vehicles. CarMax shares, KMX on the ticker. Right now we are looking at CarMax shares. They are trading down. We've got CarMax right now down $11.27. In terms of the percentage on CarMax, that is a drop right now of 19.8.
Quick ruling, but this is also, Scarlett, we should note, just about a stay in the issue of whether she can be fired while the case works its way through the courts. The Supreme Court has not officially taken up the case yet. So they could rule that she can stay in her job. They could rule she gets fired, and they could also rule that she keeps her job or gets fired, and they'll take the case and decide later. So we don't exactly know how this is going to play out, but we should, we think, get at least the interim decision reasonably quickly.
All right, and of course, the minute that we do, of course, we're going straight to you, Michael McKee, Bloomberg's international economics and policy correspondent, joining us from Washington. Coming up on Bloomberg Markets, shares of CarMax are plunging and dragging down the auto retailers. This after the company reported significant sales shortfalls for the second quarter. And it's not the only news in the auto sector today. We're going to break it all down for you next. This is Bloomberg.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
This is Bloomberg Markets. I'm Scarlett Fu. South Korea says that investment projects in the U.S. will remain in limbo until visa issues of its Korean employees are resolved. Seoul is urging Washington to act quickly. And this comes after hundreds of South Koreans were taken into custody in a raid this month on a Hyundai and LG Energy battery plant that's currently under construction in Georgia. South Korea's Prime Minister Kim Min-seok sat down with Bloomberg television anchor Sherry Ahn in Seoul for an exclusive interview on the state of U.S.-Korea relations. Take a listen.
Before discussing what kind of solution there is, realistically, without a solution, it's difficult to invest in the United States and carry out the various joint projects currently planned between South Korea and the U.S. We absolutely must find a solution. Several projects are underway between South Korea and the U.S. Without resolving the visa issue, meaningful progress remains virtually impossible. The detention incident dealt a severe blow not only to the general Korean public, but especially to the workers who were actually detained. In the absence of firm assurances regarding their safety, both they and their families are understandably reluctant to enter the U.S. again while this matter remains unresolved.
Are investment projects right now halted until some resolution is acquired on the visa issue?
Although the projects have not been entirely halted or formally placed on hold, it will be very difficult for a large number of workers to enter or re-enter the U.S. until this problem is resolved.
That was an excerpt of Sherry Ahn's conversation with South Korean Prime Minister Kim Min-seok. For the entire interview, go to Bloomberg Terminal or to Bloomberg.com. All right, we're going to stick with autos here for our stock of the hour because looking at shares of CarMax, they are plunging after the company reported a surprise drop in comparable sales. We're also learning that there's a bankruptcy filing from a group of companies related to the ailing First Brands Group. That move triggering another drop in the value of the auto parts suppliers' loans. For more details, we want to bring in Bloomberg's Detroit Bureau Chief David Walsh and Bloomberg's distressed debt reporter Eliza Ronalds-Hannon. Eliza, let me start with you here. Tell us a little bit more about First Brands Group and the companies related to that and the bankruptcy filing that they're experiencing.
Right. Well, First Brands Group is, as we've reported, in line to file for bankruptcy itself. We've reported that that will happen in the coming days or about a week. And the cause of its filing, or the proximate cause, seems to be its heavy reliance on short-term working capital financing that was based on assets receivable and assets payable. So it was stretching out terms to suppliers and also selling its invoices from buyers. And so it had a whole lot of cash on the books, but investors didn't realize the extent to which all of that working capital, or much of it, was financed by short-term loans, which are risky in two ways. One, they come with high interest rates, and two, they can be pulled if lenders get skittish. And that seems to be what has happened. Liquidity is certainly getting tight, as indicated by the plans for a bankruptcy filing, and that drop has come as the company was looking to refinance last month its $6 billion worth of debt, and investors noticed some red flags in the earnings and in the financial statements and asked for a lot more info and for a quality of earnings report.
Okay, so it's racing against the clock here, First Brands, that is. What we should mention, of course, is that First Brands basically sells parts like windshield wipers under different brands, water pumps, and filters. David, let me bring you into the conversation. Where does
into what is now a clean CR. Then on the other side is the administration ratcheting it up with this threat to fire a lot of non-essential personnel. It's not to lay them off like a traditional shutdown where you get back pay and you get back on the payroll when the shutdown is averted. No, this is a permanent firing of non-essential personnel that could gut agencies that, frankly, the administration's had their eye on trying to figure out how to do over the last 9 months. So now it's actually very clear that, different from March, where we faced this and nobody wanted a shutdown, this is a situation where I think everybody wants a shutdown. And I think that raises the potential for government to really go into a significant flux right now.
And Ophira, this is, to Rick's point, this has been hanging over this entire saga for the better part of the year, right? This was Chuck Schumer's worry back in March when he decided to not follow through with the shutdown fight. Does this change the calculus at all on the side of the Democrats? Would Democrats want to see this fight now, or do Chuck Schumer and Jeffries back down because of Rush vote?
Well, I think let's back up here. President Trump and Republicans in Congress who control Congress own this, and they made a promise on day one that they were going to lower costs for the American people. I think Democrats are reasonably asking Republicans to come to the table and honor that, to protect people's health care and to make sure that their health care costs don't continue to skyrocket by protecting these ACA subsidies. And we should also remind people that this one big beautiful budget that they just passed is going to rip away health care from countless other people and is putting our health care system, I think, at risk and sending people's costs through the roof. So I think Democrats are the ones right now who are showing their work and fighting for the American people on an issue that they care about.
Does this memo change the game for you, though? Does this codify what you feared? And do you think it might cause some Democrats to vote yes to avoid a shutdown, to avoid the layoffs?
Well, I think President Trump's taking an interesting approach here, laying off people when he said more people were going to be put to work and sending, again, people's health care costs through the roof.
You also saw what he did with the Doge, though, and as we mentioned earlier, this would be Doge on steroids.
Doge on steroids, and I think
budget director can fire whoever he wants in that world. So do they want to shut down?
Well, I think that approach has proven really unpopular with the American people. Laying off countless people for indiscriminate reasons just to make a point has not proved popular. And again, President Trump said on day one, people's health care costs are going to be people's costs were going to be lowered. He's not living up to that, and I think every item or action that he takes, that Republicans in Congress take, seems designed to send prices through the roof and to not serve the American people. So I think that's a really tough contrast for them.
And Rick, what of this economic gambit that the president is taking right now? Obviously, the economy is strong, but it's in a tenuous spot right now as well. What's the risk here that there's some type of economic blowback that the president ends up owning? I mean, what if we tip into a recession or some such?
Yeah, I don't think anybody's predicting a recession off of a government shutdown. One of the things you got to remember, Mario, is that when you did reconciliation a few months ago, you pounded hundreds of billions of dollars of new spending into the federal government. I mean, over 150 billion into DoD alone. None of that is affected by this. I mean, in essence, you prepaid the priorities that you want before the potential for a government shutdown. I don't think anybody was actually saying that that was the strategy in that additional spending in the reconciliation bill, but it's turning out to be a plus. So there's a lot of people now sort of handicapping this in Washington and saying, well, you know, DOD's already covered, ICE is already covered, you know, a lot of the critical national security components are covered. They can function for quite some time with the cash they now have. Because, you know, we've never really done a spending bill like this. I really think we can't look at this traditionally. I mean, like, I think that the idea that anybody can handicap who the winners and who the losers are in this have not even seen really the beginning of this process. You know, if we'd be having a totally different conversation today if that OMB memo didn't go out, that, you know, Schumer's holding up a clean CR that all the Democrats voted for under the Biden administration. It's all Biden administration spending that all the Democrats in the Senate voted for. And that would be the storyline, right? Is that all Republicans are trying to do is give them back what they had already approved once before and buy more time to do appropriations, which is the proper place to talk about, you know, renewing spending like the ACA subsidies. And yet, now we're talking about a full-on collapse of the federal government at the hands of Russ Vought. I mean, like, Russ has put himself in the middle of this. If you handicap it on a political purposes, you don't want Russ Vought to be the face of the Trump administration, but he is today. And in a shutdown, if he actually does permanently fire hundreds of thousands of employees, which would be the threat he's making today, he will be the face of the Trump administration.
Wow. Ophira, what do you make of the different reactions, the nuances between Chuck Schumer and Hakeem Jeffries in dealing with this moment? Chuck Schumer's been out doing some interviews. He said following the release of the memo, he called it an attempt at intimidation, said unnecessary firings will either be overturned in court or the administration will end up hiring the workers back. Sort of a matter-of-fact reply. Hakeem Jeffries on X, listen, Russ, you're a malignant political hack. We will not be intimidated by your threat to engage in mass firings. Get lost. Which approach works?
I think they're both united on fighting for the American people. I hear fight in both those statements, and I think that's what people want to see right now. And I would push back at Rick on the timing here. People are going to do open enrollment soon. Their premiums are going to jump if we don't see Republicans in Congress take some action to preserve these ACA subsidies. And I think, again, Republicans seem really committed on running on their healthcare, your healthcare costs skyrocketing through the roof, on costs going up. Right now, people want to see costs going down, and I don't think Republicans have a good story to tell on that. It's a huge liability for them.
And Rick, what of the terrain of healthcare that the Democrats have sought to kind of fight this battle on? I mean, how salient do you think that will be with voters, especially, particularly given that you see some moderate Republicans, swing district Republicans, even express at least in some ways some tepid interest in the ACA subsidies being renewed or extended?
Yeah, if you're a Republican in a Trump plus 10 district or below, probably 30 Republicans today are just sweating bullets because they're looking at the midterms going, oh my God, you're going to have the debate is now going to swing to health care. You know, we've already cut $1 trillion out of Medicaid, Medicare, and now we're going to do something on this ACA subsidy. So look, those 30 guys are sweating, but like this administration has not been running with a strategy of retaining Congress, right? I mean, like you could not write a script today that says the Trump administration is doing all these things to ensure that they still have at least a 1-vote margin after the midterms, right? They are running an administration that is an ideological administration, really inspired by Russ Vought and Stephen Miller, and it's kind of, you know, politics is at risk, right? You try to make the best out of it you can. And so, by the way, I mean, like, I think that if Republicans lose the midterms, which is, you know, potentially the case, that the White House will see that as, okay, we don't really care because we're we've assembled all this power now. We have all this capability to just act alone. This has not been a mistake. This is something they've been planning on doing. And I think they're sitting around the table going, well, it'd be nice to have the House and we can set the agenda, but it's not critical to the Trump administration in the function of the power that they've already accumulated.
So then it becomes a question of what the off-ramps are. How long does the government stay closed if it does, in fact, close? This might not be a 2 or 3 day affair. The president already can show off the record longest ever government shutdown. Will he top it again?
I think that remains to be seen, but I think what people do want to see is Republicans come to the table. I think, again, healthcare costs in general are a huge liability for Republicans right now, and every single day they take action to send those costs through the roof. And Democrats, I think, are really having a story to tell right now how they're fighting for the American people, especially on healthcare. And I think that's really personal to people right now. And we're already seeing the effects of the one big, beautiful budget in a place like Virginia, where 3 healthcare clinics have closed, citing specifically the action that Republicans just took to cut healthcare and to fund a tax cut for billionaires.
So why not call the bluff? Shut the government down, see how that plays out in the midterms.
Well, I think people are asking to come to the table. I think we're at the place where Democrats are at the table.
You're still trying to be productive.
I think that's what the American people would like, is to see people come together to the table to address the items that they asked for. Again, in the last election, people were very clear. They want to see their costs come down. President Trump said that was his day one priority. Every single thing he and Republicans do seems designed to do the exact opposite.
I don't mean to be too cute. That's not the most common angle here in Washington. Everybody's trying to get something for themselves, even if it means shutting the government down, right?
Well, I think
everyone minus one.
Well, Democrats, I think, are trying to get something for the American people. I don't think that President Trump and Republicans can say the same. Threatening to lay off countless people when they've already done that in a place like Virginia, where disproportionately there are a lot of federal workers. I think we're starting to see people really do not like that, have raised their voices against that. And I don't think a shutdown would really be popular, from Republicans at least, to show that they're not the ones who are able to come to the table and deliver for the American people.
And Rick, you mentioned, you invoked the midterms and the risk that's there. We know that the midterms have been front and center on the president's mind, especially throughout the summer, his redistricting push, et cetera. This seems to kind of fly in the face of those worries, right?
Well, Mario, I think it's actually kind of a twist to that, right? In other words, I do think the president is worried about the midterms, but he's worried about it because he doesn't think he can win them with the deck of with the cards that he has in his deck right now. So the whole idea behind restructuring the congressional districts in these 5 states is actually to give them new cards, is to actually say, you know what, I don't think we can win, with the members we have, so we got to go create some new districts that we can have a better chance of actually holding our majority. I think the whole redistricting initiative is because of a clear understanding that left today with the process they have in place, they're not going to win the midterms. And so why not try to just change the whole game? And I think it's a very good tactical plan. It's just, I'm not sure it actually builds confidence with American voters. And this is where the construct is always troubling with a lame duck president. His name's not going to be on any ballots anymore. He doesn't have to run for re-election in 2026 or 2028. And they are very ideological driven administration, where it's like, if we have to burn down even Republican seats in the process of winning what we're doing, then so be it. That's what we're going to do. The rest of Republicans in Congress, they're not going to be happy with that, but they're also not likely to complain because they've become captive of that strategy.
We're talking about a lot of the posturing here. Just to give us a sense, just to reset what Democrats are actually looking for in our remaining moments, would an extension of Obamacare subsidies and a promise to have no more rescissions bring Democrats to a yes?
I think Leader Jeffries and Leader Schumer have been very clear.
Those two are done, and the government doesn't close.
I think Leader Schumer and Jeffries have been very clear. They want Republicans to come to the table to protect people's health care and to make sure that their costs don't continue skyrocketing. I think that should hopefully be enough.
But the rescissions promise is also part of this as well, right? I can't claw back funding from something that we've agreed on. I'm just trying to set the baseline for our audience again, because we talk about this a lot. These are really the sticking points. for your party.
And I think for both Leader Jeffries and Leader Schumer, they want to see Republicans come to the table in good faith and talk about both those things. So I think that would be a starting place.
And then you mentioned the story that Democrats have to tell as well. I mean, for earlier this year, a lot of the story was that the Democrats didn't have a story to tell. I mean, how do you see this story on health care, on Medicaid, on just a potential shutdown, even with workers at stake? Do you see that galvanizing both parts of the party? I mean, the progressive and the centrist parts of the party?
Well, I think President Trump made a promise to the American people that he's not living up to, that their costs were going to go down, that America was going to have more jobs coming into it. I think every day people don't feel that in their everyday lives, right? We're talking about healthcare and your AC premium maybe will go up when you open enroll in a couple of months. That's not something I think the American people want to hear right now. And I think Republicans made very clear that their priority is not working people. It was billionaires in this country when they passed that tax cut, and it was funded by ripping away Medicaid, and I think they thought they were being cute by making the effective date of that after the midterms, but it's not, and I think the American people are feeling that every day. So I think Democrats are showing right now in the way that they're fighting for people and working really hard to not just lower their cost, but to protect their freedoms, that we're the folks that people should put their faith in, and I think that kind of fight is something the American people will appreciate.
Just about a minute, Rick. Was it a mistake or a smart strategy for Speaker Johnson to send everybody home until after the 1st of October?
Well, I certainly think that it put all the onus on the Senate, which was part of his strategy, and it put all the onus on the Democrats. In other words, you can't actually amend this now without a government shutdown. So if you actually did cut a deal, you still can't, unless he brought them back, you still can't actually avert a shutdown. And so the reality of it is, normally it's the Senate jamming the House. Now, in this case, it was really the House jamming the Democrats in the Senate, saying, if you get what you want, you're going to still have a shutdown. And so, and by the way, that still can trigger Russ Vought's efforts to try and gut some of the personnel in the administration. So I actually thought it was a pretty interesting gambit. And notice, nobody's really attacking him for it. I mean, I haven't seen the Democrats go after him on it. I mean, Hakeem Jeffries is attacking Russ Vogt.
Just stand by, because Debbie Wasserman Schultz is coming up in our next hour. Rick Davis, Ophelia Heskell, thank you. Our great panel will be back in our second hour here on Balance of Power. Many thanks as well to Mario Parker here in Washington. I'm Joe Matthew. Stay with us as we welcome our global television audience to the conversation right here on Bloomberg.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Consumers bring the fastest growth in 2 years. Welcome to the Thursday edition with the latest reading on GDP growth resonating in Washington with less than a week to a possible government shutdown. We'll be joined in a moment by Stuart Paul at Bloomberg Economics. He's with us on the data, and we'll talk shutdown politics with Democratic Congresswoman Debbie Wasserman Schultz of Florida. Analysis from our political panel today. Bloomberg Politics contributor, Republican strategist Rick Davis is with us alongside Ophelia Heskell from the Democratic Governors Association. We start, as always, on Wall Street. Let's get to the markets first with Charlie Pellet in New York. Charlie, how's it?
Thank you very much, and we're looking just the same as our last update. Joe Matthew, the Dow, the S&P, NASDAQ, they're all in the red right now. It is a down Thursday here. Traders driving stocks lower as valuation worries overshadow data showing that the economy is holding up. S&P right now at 6603, holding just above that 6,600 threshold, down 0.5%. We've got the Dow down 134, drop there of 0.3%. And at midday, we've got the NASDAQ Composite Index down by about 0.5%. The Bloomberg Mag 7 Index lower now by 0.8%. 10-year 4.17%, with the 2-year 3.65%. Gold flat on the day at $37.34 the ounce, while West Texas Intermediate crude oil is down 0.5%, $64.69 a barrel. Among the day's economic reports, the U.S. economy grew at a revised 3.8% annualized pace in the second quarter, stronger than the previously reported 3.3% advance, and initial applications for jobless benefits fell to the lowest since mid-July. Our Stuart Paul will have a whole lot more on the economy coming up in just a moment. Starbucks shares, they are trading right now lower by 0.5%. It plans to close stores and eliminate 900 jobs in a $1 billion restructuring. Also, Amazon has agreed to pay $2.5 billion in penalties and refunds and change its process for how to cancel its Prime subscription to settle a lawsuit by the Federal Trade Commission. Amazon shares, they're down by 0.5%. Right now, we return to Washington. Balance of Power continues. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, the Marathon Man. We thank you, Charlie. As always, he'll be back with a little bit more in about 20 minutes as we follow the Thursday trade here, even as we talk politics in Washington. It's great to have you along on Bloomberg TV and radio. I'm Joe Matthew in the nation's capital as we consider the data today and the deadline. Only 6 days to go until a possible government shutdown. It's not looking like it's going to get easier, with a new memo out today from the budget director at the White House, Russ Vought, calling for significant federal worker layoffs. At the moment the government shuts down, the administration would be in control of where the money goes, and it codifies a conversation that we have been having for months, well, weeks on this program. It's been months in the making, knowing that this deadline was here on the 30th of September. We've been talking to lawmakers, yes, for weeks, about the prospect of Russ Vought getting exactly what he wants. It was Mick Mulvaney on this set who told us he was jealous of Russ Vought at this moment because there was likely a plan. Now we're seeing the plan, and it does seem to be impacting the dynamics on Capitol Hill with more folks looking for a shutdown less than a week out. This comes against the backdrop of some pretty good news on the economy, growing at a revised 3.8% annualized pace in the second quarter. That's up from 3.3 in the latest reading here. The economy rebounding in the second quarter after a contraction in the first, and consumers are carrying their weight. As I mentioned, we're going to talk about this with Stuart Paul in a moment. We heard earlier today from Stephen Myron, the newest member of the Federal Reserve Board, earlier today on Surveillance, his take on this moment in the economy. Listen.
My view is not one of enormous economic pessimism. I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy.
Let's bring him in now. Joining us from New York, Bloomberg Economics U.S. economist Stuart Paul, keeping us honest here on Balance of Power, as always. Stuart, let's start with the numbers, and then we can talk about Mr. Myron's view on things here. How should we be reading the health of the consumer with a number like this? Because I keep hearing everybody's tapped out.
Yeah, so when we look at the spending numbers that we saw in the revised estimates for Q2, the data looks strong as we continue looking into the third quarter, as we look at July, as we look at August retail sales, and tomorrow we'll get PCE spending. The health of the consumer looks pretty good. A lot of it, though, is contingent on the labor market. When the pace of hiring slows, when the pace of wage growth slows, consumers' capacity to spend going forward also gets dulled. And I think that the big factor here that we can think about is firms' hiring plans, firms' expansion plans. And Joe, I want to point you to what I think is the most important revision in the Q2 numbers that were released today, and that's corporate profits. Corporate profits in the second quarter were revised down to about $7 billion from a previously estimated nearly $60 billion. When that's the case, when there's that little in corporate coffers, you can't expect to see the same investment and hiring plans going forward than we previously expected. And when that's the case, when labor market cooling and slowdown in investment, slowdown in firms' expansion plans is the most front and center item on my desk, it's hard to be very optimistic about spending going forward.
Well, that's incredibly significant, Stuart. You just pulled the parking brake as we careen down the highway here. Because the whole story on Wall Street has been, don't worry about the economy, don't worry about the Fed. Look how much money we're making. Corporate profits are soaring, and you're telling me they're not.
Looking at the BEA data and looking at the revisions that we just saw today, the BEA data do not paint that picture. It's a very difficult landscape out there. What's most significant when we break it down at the industry level and to relate it to policy in your world here on Balance of Power is that the firms that are being squeezed most appear to be manufacturers and wholesalers. It's the folks that are in the middle of the supply chain. It's the folks that are not yet able to pass along higher input costs to consumers, and instead they're stuck bearing the burden of the tax incidence created by tariffs. So we do see this consequence of policy bearing out in corporate profits. It's right there in the middle of the supply chain.
So you finally just said the word tariffs. That's what we're talking about here, because it's been seen as good news until, well, now, that companies or exporters were not passing this on to consumers, right? And that's what we hear from the administration. It's not showing up in the CPI, therefore we're getting away with something. But if companies are eating that, it eventually eats into their profit margins, which is a problem for shareholders, which sends stocks lower.
That's right.
This is the scenario.
That's right. It's a problem for shareholders. It's a problem for growth. It's a problem for expansion plans. And ultimately, it'll be a problem for the labor market. It's, again, the thing that I think is most important, that's below the fold, that warrants the most attention today.
Fascinating stuff. What does the Fed think of this right now? Because we're supposed to be looking at, what, two more cuts, before the end of the year. But when you see tape like this, what do you do if you're Jay Powell?
Well, so you have two different things that you need to consider here. You have to have the outlook for the labor market, and you have the outlook for inflation. Now, inflation is still running a bit hot. Tomorrow, we're going to get the Fed's preferred measure, the core PCE price index, which will still show nearly 3% year-on-year core inflation, and that's going to keep the Fed a bit uneasy. I think that we'll still see at least one more cut, likely in December this year, because the balance of risk is shifting to the cooling labor market. There's a very tenuous balance right now in supply and demand for labor. And I think that the Fed is focusing most on that. I think that we're likely to see at least one more cut this year and probably another one in Q1. After that, it's really all about the printed data, which could be affected by the government shutdown. So I'm excited to hear what Congresswoman Debbie Wasserman Schultz has to say about the politics and the expected outcome.
Yeah. You may not be uplifted by it, Stuart, but I appreciate that. It's always great to see you. Stuart Paul, with the read on the data and the economy surrounding it, Bloomberg Economics, U.S. economist, I should say. We are going to talk to Debbie Wasserman Schultz in a moment. We just heard from Hakeem Jeffries, who does not sound like we are getting any closer to a deal, in fact, further away, as Russ Vought shows up with a memo, as I mentioned, at the White House, talking about significant federal worker layoffs if the government shuts down next week. Democrats, in many cases, are saying, I told you so. Here's the Democratic leader from the House.
Republicans have clearly demonstrated they want to shut the government down. Throughout this process, an intentional decision was made by Republican leadership in the House and the Senate not to have a single conversation with Democrats. They're not even pretending as if they want to find common ground.
And of course, Republicans say the same about Democrats, that we're just giving you a clean CR. That's the Biden budget. We'll argue about health care before the end of the year deadline. Why would you close the government down? And it just boils down to an enormous lack of trust following the rescissions packages, following the president's big, beautiful bill that changes to Medicaid, all of which we have discussed with Debbie Wasserman Schultz. And she's back with us now, and not the eve of a shutdown, but pretty darn close. The Democrat from Florida's 25th district, live on Bloomberg TV and radio. Congresswoman, it's great to see you. It's nice to see you smiling, because it feels kind of dark here in Washington. And do you see light at the end of the tunnel here, or do we need to brace for a shutdown?
Well, Democrats are certainly trying to open that aperture of light as wide as possible. And the ball is really in Republicans' court. I am a senior member of the Appropriations Committee, have spent almost my whole career on the Appropriations Committee in Congress, and I've never seen a party like this Republican Party refuse to negotiate an end-of-year spending plan. I mean, when Democrats are at the table, we're ready to negotiate. There are only, as you know, Joe, 3 votes difference. This is the tightest margin that a majority has ever had, and of course, we have to sit down and negotiate a bipartisan spending plan. And what we are trying to do as Democrats is cancel those cuts, lower costs, and make sure we can save Americans' health care. We can negotiate that and should negotiate that right now. And if Republicans refuse to, then shutting the government down will be...
This is Charlie Pellet in the Bloomberg Newsroom. Obviously, technical issues right now. We're getting those resolved. Let me bring you up to date on what's happening with U.S. markets right now. We are looking at a down day with the Dow, the S&P, NASDAQ all declining. Certainly looking ahead to earnings after the close of the trading today here in New York. Costco shares falling now by 0.6%. Again, they do report after the close of trading. But right now, we have got the Dow, the S&P, NASDAQ all lower. S&P at 66.05. That is a drop there of 32 points, down by about 0.5%. Dow Industrials down 122, a decline now of 0.3%, while NASDAQ is down 104. For NASDAQ, a drop there of 0.5%. Broad-based selling today. The Russell 2000 index of small cap shares is slumping 0.9%. Dow Transport's down now just about flat on the day, but still lower. And our Mag 7 index down 0.7%. Balance of power continues right now. Back we go to Washington, and once again, your host, here he is, Joe Matthew.
Okay, Charlie. Congresswoman, you never know what's going to happen around here. I appreciate your standing by for a moment. I think we just took a bolt of lightning or something here in Washington. Let's get back to where we were, because you're talking about something important at this time when a memo emerges from the White House. In the next 6 days, the House won't even be back until after the government is presumably shut down. What could happen if no one's talking? Is this over?
Joe, I hope that bolt of lightning really jolts Republicans to the negotiating table, because the fact that Donald Trump canceled a meeting with our two Democratic leaders, Hakeem Jeffries and Chuck Schumer, and refuses to even sit down and talk about the details of negotiating an end-of-year spending plan so we can lower people's costs, get rid of the cuts, and save Americans' health care, that's just unbelievable. And so on top of that, Donald Trump and Russ Vought have been salivating to be able to have their way with hiring and firing. Look, the reality is that we have to make sure that we negotiate a spending plan in a bipartisan way, and we also have to make sure that people don't lose their health care coverage. This is going to drive up health care costs, not just for people who have an Obamacare policy, but for everyone. You have healthcare insurance companies that are already signaling huge increases in premiums, healthcare facilities closing, hospitals closing, healthcare clinics closing. Republicans need to come to the table, and they need to actually demonstrate that they care about whether or not the most important thing for Americans, which is whether they have their health, is something they're going to leave to chance. And I know as a breast cancer survivor, that would be unacceptable for me, and should be unacceptable for Republicans too.
Yeah. You know, there's a thought that this could change in the Senate. Well, a couple things. That some Democrats might be very concerned about this memo, but more specifically, Democrats and Democratic senators in states like Virginia and Maryland, your colleagues like Tim Kaine, Mark Warner, who have a huge number of federal workers in their state, might not want to see Russ Vought get the steering wheel at this moment and might vote yes to pass a clean CR. What are the odds of that happening? Is that a problem or a break in Democratic unity if it does?
So I think that Democratic senators and House members see that play by Russ Vought for what it is, and that is that they are just trying to use intimidation tactics and to distract the American people from the focus we need to have, which is making sure that we can pass a government funding bill that lowers people's costs, that eliminates the cuts, and that saves people's health care. And Americans want us to come together and work together in a bipartisan way to do that. Mike Johnson, Joe, he canceled the 2 days of voting that we have on Monday and Tuesday, the last 2 days of the fiscal year. They're not even bringing us back to town. Democrats will be there. We will be there ready to work on Monday. If the Republicans just shrug their shoulders and ignore this, then they are giving the middle finger to millions of people who need to make sure they can keep their health care costs affordable.
Wow, I can just see it now. You don't have to tell me, but I can see you all out on the steps of the House the moment the government shuts down next week, asking where Republicans are.
On them, we're at the table, ready to negotiate.
Yeah. We just got a red headline on the terminal, Congresswoman. If you can stick with me for a moment on this. It's certainly a change of subject as we consider geopolitics for a moment. following the meetings at the United Nations General Assembly and the incursions of airspace we've seen Russia provoke in Poland, Estonia, and some other countries on NATO's eastern flank. Europeans are now privately telling Russia, this is according to Bloomberg News, that they are ready to shoot down Russian jets that break into their airspace. Do you trust the administration holding NATO together at this moment?
Well, I certainly hope that Donald Trump lives up to our Article 5 NATO commitment to ensure that we come to the aid of our NATO allies. Russia has been an evil, bad actor. The dangerous games that they're playing, testing and pushing our European allies is an absolute outrage. Donald Trump keeps saying he's run out of patience. He absolutely better make sure, and Congress, I know, will insist, and in a bipartisan way, that we meet our Article 5 obligations to our NATO allies. They have been there for us. We need to be there for them. And Russia and Putin need to understand that you do not mess with the United States of America or our allies, or there will be consequences.
Well, he has been messing with them, which is pretty remarkable to think that we would treat something shy of an attack as a reason to shoot down jets. Does that unnecessarily escalate things if that happens?
Well, I mean, Putin is playing with fire. I mean, he is trying to goad our allies into conflict. And at the end of the day, he needs to withdraw his troops. He invaded Ukraine, a sovereign nation. The United States needs to continue our military support for Ukraine so that they can remain a sovereign nation and that they can get their territory back. If Donald Trump means what he says the other day, that he thinks that Ukraine can actually have all of their territory restored, they can do that as long as we provide that assistance. And we need to stand up and not just leave Ukraine twisting in the wind without our help.
Well, you do wonder if there's going to be a congressional answer to some of this if this type of tension continues, Congresswoman. Yeah.
A lot. And I know I hear from my constituents down here. I represent a large Ukrainian population who want to make sure that their country remains sovereign, and also who want to make sure that the free world remains united against the evil access that includes Russia.
A massive Ukrainian population, one of the biggest in the country, and a massive military presence, of course, in the state of Florida. It's great to have you back, Congresswoman. Let's see you when you're back in town. Debbie Wasserman Schultz, Democrat from Florida, is 25th with us here on Bloomberg TV and radio. I'm Joe Matthew in Washington, where it does feel like we are ever closer to a shutdown. Each day we move. Of course, as the Congresswoman referred, the end of the fiscal year is next Tuesday, September 30. Next Wednesday, the 1st of October, is when the lights would go out, so to speak. And we'll have to hear more from the White House at that point about how monies would be directed. We've got a great conversation coming up with our political panel. Jeannie Shanzano is not with us today. Rick Davis, Bloomberg Politics contributor, and Ophelia Heskell from the Democratic Governors Association straight ahead. Also, we'll compare notes with David Gura, who interviewed Andrew Cuomo today. A fascinating conversation on the New York mayoral race. It's all ahead here on Balance of Power on Bloomberg TV and radio. We must update Wall Street in the meantime, though, and for that we turn to Charlie Pellet, who's with us live from World Headquarters in New York. Charlie, how the markets?
Thank you very much. Lower across the board, Joe Matthew. Do want to begin, however, with a headline that you brought us moments ago. We do have some more details. Bloomberg News reporting that European diplomats have warned the Kremlin that NATO is ready to respond to further violations of its airspace with full force, including by shooting down Russian planes. Russian officials have denied that their planes crossed into Estonian airspace. They also insist that they are not trying to test NATO, saying Russian military flights are guided by international rules. But again, the headline right now on the Bloomberg: Europeans privately tell Russia they are ready to shoot down jets. Keep it locked in to Balance of Power for the latest on this developing story. The Dow, the S&P, NASDAQ all in the red right now, with the S&P down 39. Right now, the S&P is lower by 0.5%. We've got the Dow down 136, a drop there of 0.3%. The NASDAQ Composite Index down 0.6%. 10-year 4.17%, with the 2-year 3.65%. Gold up $3 the ounce, $37.39. That is a gain of 0.1%. Among the commodities, commodities, often sensitive to those headlines that we brought you moments ago, but spot gold right now up under 0.1%. West Texas Intermediate crude trading lower now, WTI down by about 0.1%. And Bitcoin in the red, holding just above $110,000. Bitcoin now down by 3%. So again, recapping, stocks are lower. That headline bears repeating. Europeans privately telling Russia they are ready to shoot down jets. Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matheny.
Headlines flying every day here on Balance of Power. Charlie, thank you so much. Charlie will have more on the markets in about 20 minutes here as we talk politics in the nation's capital and what has turned into a down day on Wall Street with a lot of questions about government funding. If you just heard our conversation with Debbie Wasserman Schultz, you can probably understand why. 6 days out from a shutdown, no deal, no meetings are scheduled. And we may have a very different conversation by this time next week. Fascinating conversation a little bit earlier on Bloomberg as David Gura spent some time with Andrew Cuomo generating the headline, Democratic Party Civil War. That's how the former mayor, the former governor, I should say, is describing the mayoral race that's currently underway. A civil war, one that even President Trump has tried to get involved in to try to get somebody to drop out. Because at the moment, this four-way contest favors Zoran Mamdani. And David Gura is with us now from World Headquarters in New York. It's great to see you two sit down, David, and I appreciate you bringing this conversation to us because this race feels frozen in time.
It does, and you look at the polling data, Joe, and so much of it has stayed the same. It really is kind of glacial in how it's moving, and I think that's an element of frustration for Governor Andrew Cuomo, who had a bad performance in the primary, took some time to think about his performance in that primary, and sought to reinvent his campaign. But as I learned over the course of this conversation with him, a lot of the messaging is still the same. He's raising the specter here of what a Mamdani mayoralty would mean for New York City. And as you laid out, there were a number of directions that we could go, and obviously some questions about the policies that he prioritizes, what he hopes to put in place, and how to pay for them. But really, at this point in time, 40 days out from this election, I thought it was important to start with the state of play and how he sees the path forward to victory. And I started off by asking him about the polling. How do you see the path forward here, given the polling and sort of where things stand? I should note that the polling hasn't changed a tremendous amount in recent weeks.
Yeah, it will change dramatically. What you see in the polls is Mamdani is always at about 40%. That leaves 60%. As you accurately pointed out, you have a multi-candidate field, so 4 people or 3 people are breaking up that 60%. I don't think you're going to wind up ultimately with that larger field. I think the field is going to collapse. I think it's going to come down to me versus Mr. Mamdani. And as I said, Mamdani has 40%. He has very radical ideas, which are exciting to one group of the population, especially young people, but are polarizing to many other people. And I think it's going to come down to a one-on-one, and then it is a totally different race, David.
Curtis Lee, with the Republican candidate, says he's not dropping out. The incumbent mayor, Eric Adams, says he's not dropping out. We've passed the ballot deadline. If we were to have a race where it's you against Zoran Mamdani, polls still show him leading you by a substantial amount. What do you see in the electorate that the data aren't showing when it comes to that particular configuration?
Yeah, well, polls are historically wrong, especially this year, especially in New York. On your first point, you can stay in the race. First of all, technically, nobody can get off the ballot, right? The question is, are you viable in the race? And you can have people who are in the race, but the voters just think they're not really competitive. They can't win. I'm not going to waste my vote. And I think that's what happens here. I think it comes down to me and Mamdani. I think when people understand what Mamdani stands for, besides what he has said on TikTok, he's anti-police, disband the police, legalize prostitution, legalize the drug trade, abolish jails. This would be anarchy in New York. Socialism does not work in New York City. It's antithetical. We're the business capital, right? We're pro-business. Business is the engine that drives the train. So none of that has been communicated yet. And when it does, I can tell you the minds will change.
Is there an effort by you and your campaign to try to convince Eric Adams or Curtis Lewa to drop out of this race? Are there conversations that are happening behind the scenes to make what I imagine you see as a compelling case for them to step aside to make this more of a one-on-one race?
No, I'm sure they're making their own decisions. Look, I've been in elections where I have dropped out because I thought it was the right thing to do. They have a decision to make. There is no apparent path to victory for them. They, in essence, would act as a spoiler, and that's a decision they have to make. They have to make it personally, and that's their business. But again, I think it's going to come down to a two-person race no matter what, because that's what the polls are going to say, and that is the choice. I am a Democrat. My father was a Democrat. I worked for Bill Clinton. Zoran is a socialist. They call themselves Democratic Socialists, right? Didn't support Democrats. Said Barack Obama was a liar and evil, and didn't support Kamala Harris against Trump, right? So this is a very different, this is apples and oranges between the two of us.
I want to ask you about some comments that Curtis Lewa made yesterday. I'm sure you heard them. He was campaigning and suggested that you or affiliates of your campaign had reached out to him and offered him money to the tune of $10 million to drop out of this race. And I'm going to quote from what he said during that campaign event. He called these classic Andrew Cuomo tactics. Why don't you strap up Cuomo to a lie detection machine and ask him, and we'll all be blown to kingdom come because he's behind it. I don't have a polygraph machine with me here, but how do you respond to what he's alleging in those comments?
Look, you have to take Sliwa with a grain of salt, right? He is a known con man. He's lied about being victims of crime before. But it's very simple, David. When he said that, someone should have said, who? Who offered you the money? Let him answer the question, because it would happen to be a crime, right? Who offered you money? He never said who, which sort of tells you, right, that it's all malarkey. There was no person who did it.
I want to ask you, last we've talked about the state of the race, where you hope that it's headed, and if we can, I'd like to look back to 1977, so a ways. You were 19, you were a student at Fordham University, your dad was making a run for mayor, and you were helping out on the campaign. He didn't win the Democratic primary and decided to run on an independent line for mayor. He ended up losing that race by 9 points. They say that history doesn't repeat itself, but it rhymes, and I know that you don't want history to repeat itself here. You'd like to win this race in a way that he wasn't able to back then 50 years ago. I'm not the first to point out this historical parallel, but I imagine you've thought about it. And I wonder how that experience has informed your outlook on this race. There was introspection after the primaries. You didn't do as well as you wanted to do. You decided to make this run. What can you learn about that race that your dad waged, and how does that inform the way that you're running this one?
My father was an extraordinary individual on many levels. Highly principled, frankly atypical for a politician. And he did, quote unquote, the right thing, whatever he thought the right thing was. For me, I believe in the Democratic Party. I believe in what my father stood for, what John F. Kennedy stood for, and Robert F. Kennedy stood for, and Bill Clinton, and what Mondami represents, and this Democratic Socialists of America, DSA, socialists, call them whatever you want, is repugnant to the Democratic Party, I know. And that's what's really going on here. This is a civil war within the Democratic Party, right? Where the extreme left is pulling the Democratic Party. And the moderates are afraid of the extreme left. It's the inverse of the Republican Party when they had the Tea Party, and the Tea Party was pulling the Republican moderates too far to the right because they were afraid of them in a primary. That's what's happening here. It's a battle for the soul of the Democratic Party. And the Democratic Party is not anti-business. It's not anti-police. That's not who we are. We're not about redistributing income as a policy, right? You tax to provide a service. You don't tax to take money from the rich to give it to the poor, right? That's why Donald Trump calls him a communist. So this is not the Democratic Party that I believe I represent and traditionally has served this nation well. He has zero experience in the position, never managed anything, 5 employees, never had a real job. And when you're willing to consider chief executive of New York City, no management experience, ran 5 people, now he's going to run 300,000 employees, $115 billion budget. You wake up any morning, you could have a terrorist attack, you could have another COVID. It just demeans government and demeans public service in a way that I just find abhorrent, and I'm going to do everything I can to stop it.
My conversation there with Andrew Cuomo, the former governor of the state of New York, mounting a campaign here for mayor in New York City. And Joe, what stood out to me a number of times is how he kind of cast himself in the mantle of being a Democrat. He said, I'm a Democrat. My father was a Democrat. I worked for Bill Clinton. You heard there at the end him talking about Democrats saying of Mamdani's platforms, that's not who we are. You have to just go back to the results of that primary, that Democratic primary from a few months ago, that ranked choice primary. Mamdani got 56% of the vote, and Cuomo had 44%. So, yes, he's running on the independent line, but still very much associating himself with the history and the Democratic Party.
Really interesting you brought up his dad. Does part of you think that his father would be impressed by the gains that Zohran Mamdani has made among young progressives?
You know, I think that he might, and far from me to psychoanalyze, what he might have thought, but I do think that it is something that clearly is flummoxing not just Andrew Cuomo, but the other candidates in this race. And you heard Andrew Cuomo there kind of disparaging the TikTok side of this campaign, the success that Zohran Mamdani has had on social media, and yet it is still working and working so effectively for him. And again, going back to what I said before we played that interview, I expected that there would be kind of a marked change in outreach and tone and platform from Governor Cuomo. And to be fair, he is out more. He's on the campaign trail more in and around the city talking to voters. But the way that he has set up the contrast between him and Mamdani remains the same. That is, there's an element of fear less than hope about the direction of the city if Mamdani were to win. And I think that's something that he's continuing to hammer home here in these last 40 days of this campaign.
Really interesting. Always a pleasure to have our friend David Gura with us. Thank you for the great conversation today with the former governor, David, live in New York. As we assemble our panel for their take on this and what it might mean on a grander scale at this moment for the Democratic Party, Bloomberg Politics contributor Rick Davis is here, partner at Stone Court Capital, our Republican strategist, alongside Democratic strategist Ophira Haskell, Director of External Affairs at the Democratic Governors Association. Really interesting to hear the conversation and the language that Andrew Cuomo chose to use. Mamdani's candidacy abhorrent, the competition, a battle for the soul of the Democratic Party. Ophira, he said your party is in a civil war. Is New York a microcosm for what's happening nationally?
Absolutely not. I think New York and the mayor's race is about what's happening in New York. And I think New York voters were very clear that they want a leader who's going to be focused on making life more affordable. And what I just heard Andrew Cuomo say was that he doesn't have a lot of forward-looking vision for how he's going to do that. And I know he's complaining about poll numbers, but I think voters, again, were very clear during the primary about what they want. But I also don't know that it would be helpful to be running as somebody who keeps invoking Trump if you're looking to bring the party together and show that you're going to be a fighter for New Yorkers.
At what point do more seniors in the Democratic Party need to get behind Zohran Mamdani for this candidacy to have credibility?
Well, I think this campaign's about what's going on in New York City, and I think Governor Hochul has been a leader on this and has been very clear. She looks forward to working with him in the mayorship on how they can make life more affordable, keep the city safe, bring more people there. And I think a partnership with somebody in that seat is something that Governor Hochul is looking for. And again, I think Democrats are looking for somebody who's going to show that they're focused on these kitchen table issues, but also that when Trump is trying to come after New Yorkers and their freedoms, that they're a voice that's willing to stand up and fight. And I don't know that we're seeing a lot of that from Andrew Cuomo right now.
Interesting. Rick, you've run a lot of campaigns in your career. There's a Suffolk University City View poll shows Mamdani leading Cuomo by 20 percentage points. Do you believe the landscape as the pollsters are calling it?
Yeah, even Cuomo said that he was talking about Mamdani having 40%, which means he probably does have 45%. And I thought what was really interesting in that Suffolk poll is he has a above majority, over 50% of Hispanics, Asians, African Americans. I mean, like, the basis of the New York Democratic Party is their resilience with diversity. And Cuomo's not getting any of that. When you look at his growth, since he became an independent and said, I'm going to be the guy that beats Mamdani, he hasn't really grown at all. And so if you were to believe his pitch, that there's 60% staying out there, and I can get, the majority of that, then he better start going. The election's a little over a month away, and he has yet to grow a bit. So I really don't understand even the messaging, but let's just leave it at that. Polling looks extremely strong. I think this race is pretty much over, and we'll see where we go from there.
Well, that would be the end of his political career, would it not?
Far be it from
I
me
know
to
it's
say
been
what
called
Andrew
before,
Cuomo might do next. Yeah.
By the way, President Trump has become somewhat invested in this, calling on certain candidates to drop out. Eric Adams, Curtis Sliwa. If there was a head-to-head here, though, the polls still show Mamdani as the next mayor of New York.
Well, I think he, again, has been echoing for what New Yorkers are looking for. He's showing a vision for how we can work on a lot of the issues that people say they want to see Democrats make progress on. And I think we hear time and time again, affordability, affordability, affordability. And I think he's really excited people in New York with that. And they're looking for somebody who's going to drive progress forward on that. And I think, again, he's exciting people, like Rick said, all across the base. I think that's a good thing, and we want to see more of that, obviously.
It's interesting, Trump's involvement in this case, Rick, because he talks about Mamdani so often that you'd think he wants the so-called communist, even though he is a democratic socialist, at least self-labeled, to be there for him as a foil for the next 3.5 years. What do you think Trump's motivations are when it comes to the New York mayoral race? Is he looking at this as a New Yorker or as a national Republican political figure?
Well, I would say for the record, I have no idea what motivates Donald Trump. That being said, what we do know is that he has a substantial business investment, including his own image of being a successful New York businessman in New York City, right? And this could have an impact on the businesses and the activities that he's been involved in his entire life in New York City. I know there are a lot of real estate developers in New York City, him included probably, who are very fearful of this Mamdani as mayor. That being said, you're right. On the other hand, to be able to see the rising star of the Democratic Party being an avowed socialist, who, as Andrew Cuomo said very articulately on our show just now, wants to redistribute income, it is a very hard thing to stomach if you're a Democrat running for re-election in 2026. So Donald Trump will make good use of that. I would doubt there are very many candidates outside of the city of New York who are going to include any of the Mamdani platform in their re-election campaigns in Congress for 2026.
Is that why Hakeem Jeffries has not endorsed the Democratic nominee?
I mean, I can't speak to Leader Jeffries, but I do think that Zoran Mandami's running a campaign that, again, is really focused on issues that I think a lot of Democrats are talking about right now, how we can lower costs for the American people. And we don't all have to agree on everything. I think that's the nice thing about being Democrats. It's a big tent. But I think where we're showing a real contrast is, again, that we're laser focused on how we can make life more affordable for people, keep them safe, put money back in their pockets, and not hearing a lot of that from Republicans on the other side.
Well, maybe that endorsement doesn't matter. You look at these numbers, Rick Davis seems to think this thing's already baked. Does the Democratic leader in Congress matter in a New York mayoral race? Granted, he's from New York.
Well, I think these races tend to come down to local issues and, again, local leaders. And I think Zoran has really distinguished himself in the field as somebody who is focused on how he can make life better for New Yorkers. And I think Governor Hochul jumped in and endorsed him because she's looking for a partner she can work with as governor and make sure we're uniting the party on what really matters, how we can lower costs for people, but also stand up against the president and the actions he takes that hurt.
This is fascinating. To Rick's point, it's almost time to vote in New York.
It is
I'm really glad
almost time
that
to
you could
vote.
both weigh in on this. And a great conversation David Gura brought us with Andrew Cuomo. Ophelia Haskell, thank you, as always. Democratic Governors Association, of course, our friend Rick Davis, Bloomberg Politics contributor and Republican strategist partner at Stone Court Capital. Thank you so much for the great conversation. I'm Joe Matthew in Washington. We've got another good one coming up for you. Chris Sununu is going to sit down with us. The former governor of New Hampshire is on to the next chapter of his career, but he's still talking politics, and he's going to. Pellet has his arms around the markets.
Matthew, lower across the board. Do want to begin with a number of developing stories. Some headlines from the Federal Reserve's Lori Logan saying the time has come to prepare for a new benchmark rate. Logan. Lori Logan speaking in a text ahead of Richmond Fed event. We'll have a whole lot more with our Michael McKee coming up on the Fed. The economy right here on Balance of Power. The other developing story that we are keeping an eye on, we reported this roughly 20 minutes ago, European diplomats are warning that the Kremlin that NATO is ready to respond to further violations of its airspace with full force, including by shooting down Russian planes. That's according to officials familiar with the exchange. We are looking at losses for the U.S. equity market with the Dow, the S&P, NASDAQ very much in the red right now. S&P trading below 6,600, 65.90 where we stand. We've got the S&P down 47, a decline now of 0.7%. Dow Jones Industrial Average now lower by 200 even, down 0.4%, while the NASDAQ Composite Index is down 182, a drop there of 0.8%. The Mag 7 Index down 1.2%. Dow Transport's also lower, down 0.2%. And the SOX, that is the Philadelphia Philadelphia Stock Exchange Semiconductor Index, down 0.7%. 10-year 4.18%, with the 2-year 3.66%. Gold up 39, up by about 0.1%. Crude down 0.1%. WTI 64.89 a barrel, and right now Bitcoin is down 3.6%. 100. BP says oil demand is going to keep growing for the rest of this decade, rolling back its prior projection that the high point could come as soon as this year. Right now we have got oil stocks, they are trading higher. BP, the ADR is up 0.2%. ExxonMobil is advancing by 1.1%. Chevron up by 1%. This on a day again when West Texas Intermediate crude lower, little change, 64.91 a barrel. Again, recapping, S&P down 48, down 0.7%. Balance of Power continues right now. Back we go to Washington once again. Here's your host, Joe Matthew.
All right, Charlie. Many thanks to Charlie Pellet, with us every day here on the fastest show in politics. Thank you for joining us on the Thursday edition of Balance of Power. We've covered a lot of ground this hour already, ticked our way through a possible government shutdown, the better than expected economic data we saw this morning, the New York mayoral race, and we get to cook it all down with an old voice on the show, a friend of the program who has entered a new chapter in his career. I don't know if I can even call it a political career anymore. The former mayor, Republican mayor.
Mayor? We're doing
Were you
mayor
ever a
now?
mayor?
I've been demoted.
I just had a mayor
I just
with
got
me. It
here
just
and
came
I'm
out of my mouth.
demoted.
The former governor of the great state of New Hampshire, the live free or die state, Chris Sununu. Great to see you back.
Great to see you.
You're not here as a senator or a congressman. You came back to Washington as the CEO of Airlines for America, which is the big trade group for the industry. You and I have talked a bunch about why you're not already down here seeking national office or something beyond being governor. And you always had a pretty good answer because you didn't think you could get a lot done here. What are you going to get done in this job?
Well, that's the excitement of it. I mean, when folks first said, hey, come to Airlines America, and I said, well, the Trade Association in Washington, you know, where's the connection with being governor? But the fact that you're looking at rebuilding the air traffic control system of America, which is desperately needed. I mean, 30 years of antiquated technology, and for the first time ever, you have an administration that is making it top priority. You have Secretary Duffy at Transportation, Brian, who's now running the FAA, this great guy, used to be the CEO of Republic Airlines, people that are really have hands-on, on-the-ground experience. I thought, this could be done. This could actually be a win for not just Washington, but for the country in terms of safety, a strategic asset. And it's the airlines. And you have, I mean, I'm not just saying this. The CEOs of the airline industry right now are amazing. These are some of the best CEOs in the country. They're mission focused. They deal with all these strains, international and domestic, and they all want the same thing. They're all rowing in that same direction to make sure that this system gets revitalized for the safety of the country.
It's a national security asset, to your point earlier. Governor, I have a couple of questions for you about this, and I want to get into the toy department with you a little bit, because you must have an amazing shopping list on how exactly we're going to build all of this out. But here we are again on the verge of a possible government shutdown. It does appear that there's a carve-out for the air traffic control system, and we would expect that. But would it mean other disruptions or problems for the industry?
It'll be a strain. So a couple things. Number one, the airlines still stay in the air, right? TSA, that does all the security. The FAA, which basically makes sure that the planes are landing safely and on time. Those are all deemed essential workers. Those folks come to work. So the planes will be there. Now, will the system be strained as it is often with these shutdowns? Absolutely. And that's where we ask for people just to take your time, be a little more patient, give yourself a little extra time. But the planes will get there.
Is it manpower? Do you not everybody gets to work, or they're all working without
They're all
being
working,
paid,
but they're
or?
working without pay.
Okay.
They're working without pay. And so that's a lot to ask.
That's TSA, air traffic controllers, everybody you encounter at the airport.
Hundreds of thousands of workers that make sure that they all are asked to come to work day after day. And so that's why a short shutdown can be managed pretty well. The longer it goes, as you would expect, more days, more weeks, whatever it potentially might be, that just really exponentially increases the strain on the system. The system doesn't shut down, but it will get strained. And so that's where, you know, we're fighting hard to not have the shutdown. We're fighting hard for folks up on the Hill here to understand what those repercussions are, because there could be a potential carve-out for the TSA, but what is likely going to happen is all these new things that are just happening, $12.5 billion allocated, it all comes to a screeching halt. The new simulators they want to buy for FAA, because we need more manpower in those control towers. We want to train people more. We want to get those certifications going. All that comes to a screeching halt. Some of the new technologies that are going to be implemented, everyone has to basically take a pause until the system is turned back on again. So, you know, I've seen Washington, we've all seen Washington fail time and time again. But when you're talking air traffic control reform, this thing is moving. It's really exciting. You know, Senator Cruz has been an absolute leader. Senator Susan Collins of Maine, a leader. Congressman Graves just absolutely gets it. Everyone's pushing hard. No one's accepting failure, what makes it exciting and what makes the potential shutdown really scary.
Well, it is scary when you frame it like that. Let's talk about resources. You don't have enough money to do this all now, right? Congress is going to have a couple of layers, I presume, of funding approvals. You have the president behind you on this. We did talk to Senator Cruz about what would be involved here. This would be an unprecedented undertaking to essentially rebuild the American air traffic control system. The president talks about copper going into fiber, going into IP. It's a Frankenstein-looking system now. How long would it take to rebuild?
Great question. So first, you hit it right on the head. It's a bit of a Frankenstein patchwork system with floppy disks and copper landlines for communication. And that's really what it is more than anything. It's a communication system between the planes to ground, ground to ground, more than anything. And so when you're talking about the epitome of safety with folks in the air, that's where it gets scary. And obviously, the tragedy that happened last January was it was incredibly severe. That everyone in this town and across the country stood up and said, yeah, this should have been done literally 30 years ago. Let's go. Let's get it together. Now, how long will it take? It'll take a few years. Congress has allocated $12.5 billion. That's a good chunk of change. But when you're talking about the most technologically advanced overhaul system that this country's ever seen, it's going to take a lot more than that. But we've kind of outlined what are the quick wins. Let's get the copper, old-fashioned copper out of the ground and put fiber in the ground so these towers can talk to each other. Let's upgrade like I said, the simulators, the opportunities to bring more people, younger people, new workers into the FAA, into those control towers, so you have the redundancy. Those are easy and short wins that the Secretary understands, that the FAA understands, and that we think are going to be undertaken pretty quickly.
So you get that done. That's, I guess, the low-hanging fruit.
Yeah.
Do you essentially then end up building a tandem system? It's like building the other Cape Cod Bridge, and then eventually you just move everybody over to the new one, or does it actually have to be integrated into the existing system?
It would be great to build a whole new system and turn the old one off and the new one. You can't do that. And it'd be great to do it nationally all at once. You just can't do that. So what I think the way they're going to go about it, they're going to bring what they call an integrator, kind of an overseer, if you will, of the project. Sometimes that doesn't go well, right? So the fact is, Secretary Duffy knows there's got to be accountability in that. There's got to be standards. To your point, there's got to be a schedule that has to be kept, because the president's behind it, and he's behind it very loudly. So anyone that comes on board and isn't achieving those goals, they're going to be held to a very loud and public standard. Like, this is not Washington as usual, which is awesome. This is, when I only came down here about not even a month ago, and I told everybody, I said, look, Washington is moving faster than ever because of President Trump and this administration. So if you're going to keep moving at Washington pace, it ain't going to work. We got to not just keep up, but we got to, sprint just to keep pace with these guys. But the team is there to do it, which is really exciting. So what's going to happen is they're going to look at it, I think, regionally, and kind of 3 or 4 major pieces of the system that get overhauled and patchworked in and replaced one at a time.
Boy, fascinating.
Yeah,
I don't know if you have a price
It's
tag on this, but this is a Congress that can't even keep the lights on, it looks like, by the time we get to next Wednesday. Do you trust lawmakers with coming up with the money, or do you have other sources of funding?
So I believe that the additional sources of funding will be there if and when we achieve those results.
I see.
What I've said is get these 3 or 4 wins. Show Congress it's a win. Show some progress, show that it's working. And when you do that, as a governor, I can tell you, we did it in New Hampshire, the legislature says, oh, okay, it's working. There's accountability, there's standards, this isn't just a black hole of money. We're getting something, a return on our investment. The system's getting safer. Our Americans are getting, whether it's better customer service on the front, back end, or sometimes the side you don't see, which is just making sure that plane lands safely on time, gets to your gate, and folks have confidence in the system.
Really interesting.
When all those pieces come together, I have no doubt that Congress will take further actions and, again, keep that investment coming to make sure that this system is built out to fruition, not just piecemeal, not just we tried something, it didn't work. Failure really isn't an option given the level of safety that we're talking.
You sound like you've been in this business your whole life.
I love it. I don't know. It's been 2 weeks. I'm having a ball. I really am. I love the people I work with. I love the projects. And there's other challenges, too. It's not just air traffic control, right? There's all these other challenges that the airlines deal with on a day-to-day basis. But here in Washington, whether it's some other technology issues, some policy, they're going after deregulation hard. That's no secret around here, which is awesome. The previous administration was really tough. They really overregulated.
What does deregulation mean for the airline business?
It means getting rid of all there was basically so much regulation put on in the last 4 years with the previous administration, where basically they had to do drastically less flights. They had to find ways to fit more people on planes, crowd them in, less flights per day. That was the mandate. Just, do less flights. We want more flights. We want more options for Americans.
Because of the number of hours pilots can fly, or was it a number of factors?
I think there were some environmental issues, and those are very important issues. The industry has taken a lead on sustainable aviation fuel. They're putting hundreds of millions of dollars of their own money into new technologies on sustainable, clean energy, clean aviation fuel, which is awesome. We're not just saying, hey, government, you do it. The industry's taking the lead, so it's very exciting. But the previous administration was pretty tough, but now that it's not that the regulations are just off, they're more streamlined to make sure it's a better customer service and a safer system as a whole.
Your industry is not only a national security asset, it's also an economic indicator. Remember the old as goes GM, so goes the nation.
That's right.
As goes the airline business, right? You have a better sense on how many seats you're filling, on how many planes you need to have in the air, of where this economy is going. And there's a big conversation in Washington right now. Are we slowing down? There's some weakness in the job market. There's a lot of noise with tariffs. Canadians don't want to come to New Hampshire anymore. When you add all of this up,
maybe they don't want to come to Massachusetts, but New Hampshire, they're loving New Hampshire.
I bet it's Vermont. But you know what I'm saying. Are we on a trajectory of growth right now, or are we at the beginning of a slowdown?
It's growth. There's no question. So a couple really interesting metrics that I didn't even know. Over the last 5 or 6 years, the average price of an airline ticket in this country is down.
No kidding.
It's not just up a little bit, where inflation's taken everything 25% up. All the competition that has happened has, forced more options for a consumer. You can buy a much cheaper ticket if you want. You can decide not to take baggage or take baggage. You can design your own experience on the plane at a much cheaper price.
So you're less at the whim of the economy? Is that your point?
No, it's because the competition is so strong. It's a great argument that why free markets work.
Yeah.
And when they compete, the prices have come down. Where the opportunity really is on that international market, I think.
Sure.
What the president has done with most of the general agreements is make sure that it's a zero for zero tariff issue on the airlines, and specifically on the manufacturers and the price and the parts. So at least with the European Union, that was a big one, a big win for them. I mean, we got to codify it, as all these tariff deals have to be ultimately codified.
Yeah.
But that was a huge win there in terms of making sure that the tariff issue isn't going to somehow inflate prices or cause some sort of strain. Like I said, I was just shocked to learn that competition. Do you know anything else in America that has come down in price in 5 years? I literally can't think of anything.
And they still seem kind of expensive, I have to admit, which is why I'm amazed to hear that.
But again, but they're not. I mean, there's this idea that, there's the prices are screaming high. I think because they allow you to develop your own experience.
Sure.
So if you want to take an extra bag or whatever, you pay a little more here. But that base price of a ticket has gone down about 2 or 3% over the last few years, which means more families can afford, whether it's for vacationing or traveling. You know, we didn't touch upon something here. What's coming up? The holidays. So when you talk about government shutdown and putting a strain on the system, I don't know about you. What do you do for Thanksgiving? Do you stay at home? Do you Christmas? Do you travel? What do you do?
I try to go home, yeah.
Yeah, try to go home.
But I'm usually driving because and then I end up taking 10 hours to get to New England.
So many millions
Can you
of Americans.
get me home this year?
Can I get you home this year?
To New England.
Well, everyone's loving the airline, so they're flying. If we stay open, if there's no strain shutdown, I'll do what I can to get you home.
When do we get a supersonic? When do we get a Concorde for the future? When's the supersonic jet going to be part of this fleet that you're now helping to run?
I don't know, but I'm going to make that the next.
Let me get
air traffic control taken care of, and then we'll work on the supersonic.
But technology is a big part of your industry here, obviously, and the CEOs that you mentioned are using it to improve things a lot. Forget the planes for a minute. When does AI become a factor, or is it already in the call centers at the airlines?
AI is already in place. I mean, AI is in place almost everywhere. So whether it's call centers, whether it's helping with dynamic pricing, whether it's making sure that you can create, like I said, create your own package and model, whether you want a nonstop flight, whether you want to stop in Des Moines, whether you want to take an extra bag, whether you want just to sit in the back, sit in the front, have extra leg room, whatever it is, you're kind of designing your own system. And AI does that, helps with a lot of that dynamic pricing, which has kept the competition and the prices low. When we're talking about air traffic control, of course AI is going to come into play. The robots aren't landing your planes. Let's not make any mistake about that.
No.
But
they're calling balls and strikes.
But having a backup system that says, you know what, the weather in Los Angeles, and we have a flight leaving Des Moines, but that could affect this connecting flight out of Miami, and in real time crunch all that data to say, hey, the incoming flight from Chicago to Boston, let's get that out of the gate a little faster.
Are you getting the data from the government that you need on that front?
The airlines work very closely. And it's not just with the government. I mean, they've made such huge investments in their own AI systems.
They've got their own data.
Yeah, their own data, their own AI systems.
When it comes to weather specifically.
And when the FAA gets it, you know, when the real bulk of the rebuild of the air traffic control system comes underway, obviously, again, AI won't necessarily be on the front end, but the back end as a kind of a redundancy, a back check system in a variety of different ways, just to make sure that folks are getting from A to B faster, safer, and with confidence.
You get to fly free now?
Do I fly for? Yeah, do I fly for free?
I didn't think you'd answer it.
I haven't flown. I just got the job 2 weeks ago.
Oh man, let's go down to the airport. Let's go to Nashville. We'll go to Vegas together.
I'll find out if I fly for free, and I will let you know when I come back in a week.
All right, fantastic. Please do come back. It's great to see you. I'm happy that you're
now I'm
going to be
right
in
up the
town
road.
now. We're neighbors.
Yeah.
This is
I used to be a cynic about this town, but now I'm like
were.
Shrek. I love the swamp. I love it. This is my swamp now, and I'm loving it here.
I love that as well. Chris Sununu, the former governor of New Hampshire. What a great opportunity to catch up on things without the pressure of elected office. He's the new CEO of Airlines for America, of course, former Republican governor. You never know who you're going to bump into around here. We're going to have to make this a regular thing. That was an interesting hour. I'm glad you got through it with us here on Bloomberg TV and radio. I'll meet you back here for the late edition of Balance of Power alongside Kate Davidson. That is at 5 p.m. Eastern Time. Big thanks to our panel, Rick Davis and Ophira Yeheskel, for spending some time with us. Bloomberg Business Week Daily coming up next here, and I'll see you back here, as I mentioned, a little bit later on. I'm Joe Matthew in Washington. This is Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everyone, live across Bloomberg platforms. This is Bloomberg Business Week Daily for, yes, it is Friday's Eve, Thursday, September 25th, 2025. Carol Masser, Tim Stenivek, and we are seeing stocks definitely off their best levels. They're in the red across the board. Those Mag 7 names really weighing on the trade today.
Yeah, Charlie Pellet's going to have the details, but seeing red across the screen, as you mentioned, Carol, the NASDAQ Composite down a full percentage point right now. The S&P 500 down 0.9%. The Dow down 0.6%. Tesla taking a real beating today as a result of what we heard from Europe and car sales happening in Europe. Tesla, a very small portion, less than 2% of car sales there.
You know who isn't taking a beating is Intel. This stock is one of your top performers in the S&P and the NASDAQ 100. It's up for a third day. We're going to get into why, oh, why might Apple actually want to invest in the company. We'll get to that in just a moment.
Plus, a view from the C-suite on that and more with Cristiano Amon, the CEO and president of Qualcomm. He's going to be joining us in just a few minutes.
We've got the CFO of a firm, Rob O'Hare, is going to be in the house. We'll get a view of consumers, what they are up to, and then leveraging AI to transform women's health. That's all coming your way in just a moment.
First up, though, a check of the day's trade and top business stories. Here he is, Charlie
Hi,
Pellet.
thank you very much. Lower across the board right now on the equity market. Do want to begin with a developing story involving TikTok. We had the headline moments ago here on the Bloomberg Professional Service. Oracle, Silver Lake, and MGX will be the main investors in TikTok. That's according to CNBC citing sources. The three will have a combined 45% ownership of TikTok. Again, developing story right now, headline on the Bloomberg. Stocks in the red right now. Stocks are falling as valuation worries overshadowing data this morning, showing that the economy is holding up. Those numbers, the economic numbers, not having much of an impact on Fed bets, but bond yields kept rising after a weak Treasury sale. We've got the S&P down 59 at 65.78, drop there of 0.9%. Dow Industrials now down 290, a decline of 0.6%. Tech selling off. Nasdaq down 1%. Nasdaq 100 index also down 1%. But our Mag 7 index, as Carol mentioned, down now by just about 1.5%. The 10-year at 4.17% with the 2-year 3.65%. Gold up $9 the ounce, up by about 0.2%. And West Texas Intermediate crude oil WTI 64.78 a barrel, down now by 0.3%. Amazon has agreed to pay $2.5 billion in penalties and refunds and change its process for how to cancel its Prime subscriptions to settle a lawsuit by the Federal Trade Commission. Amazon down by 1.1%. And Starbucks plans to close stores and eliminate 900 jobs. Again, recapping, stocks lower, S&P down 62, drop there of 0.9%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So shares of Apple, little changed. In fact, they're just up about 0.3% as we speak. This nearly 24 hours after the Bloomberg exclusive that Intel has approached Apple about securing an investment in the companies, according to people familiar with the matter. It's all part of efforts to really bolster a business that's now partially owned by the U.S. government. So Apple, little change today. Not the case, though, for Intel, rallying another almost 6% in today's session. And we saw the stock rally yesterday as that news hit late in the Wednesday trade.
Okay, so the story got many, we think it's safe to say, including us, asking why, oh, why would Apple make an investment such as this? Remember, it's just reporting that Intel has approached Apple about this at this point. That's what we have. So we wanted to bring in Mark Gurman because we're really curious about what he's hearing. He's Bloomberg News managing editor for Global Consumer Tech. He is the Apple guy. He covers this company so closely. He joins us from the Bloomberg Los Angeles Bureau. Mark, what are you hearing about this?
From a technology perspective, you guys are right. There is no reason for Apple to want to invest in Intel. But from a play nice with the Trump administration and its do more manufacturing in America standpoint and investments there, it's a great idea. Apple obviously wants to be on the good side of the Trump administration and the White House. There are several things that they want from Trump. They want Trump to help them push back against the EU's Digital Markets Act. They want Trump to help them reduce their tariff payments, right? So they need all sorts of things from him, not to mention the DOJ lawsuit that's supposed to go to trial in 2027. They want his help getting that thrown out. And so they can make Trump look good by investing in Intel. Obviously, the U.S. government now owns 1/10 of the chip maker. Obviously, the U.S. government wants to show its constituents that it has Tim Cook and Apple, the poster child of American innovation, they think, playing nicely with them and partnering with them. So from that perspective, it's just about looking good. From a technology perspective, Apple very likely to never use chips from Intel again. The chip has sailed. The ship has sailed, I should say there. The chip has sailed too, if I'm being honest. They're all in on TSMC-based production. They're all in on processors based on that ARM architecture, not the x86 architecture that Intel uses. Obviously, Apple dropped Intel from its computers half a decade ago. But there are some less advanced chips, low-end nodes, as they call them, not the advanced processors that you think of as SoCs or chips in iPhones and Macs today, that Intel could theoretically, produce for Apple. Apple already sources billions and billions of types of chips and components inside devices that no one's ever heard of or cares about that Intel could theoretically manufacture at some of their facilities for them. There are other things like chip packaging that is not a high-tech process that they could work with Apple on. So there are angles there, but, for all intents and purposes, if they do this, it would be lip service to make things even nicer between Apple and the U.S. government rather than improve technology for the company.
We'll call it CEO presidential diplomacy, if you will. But having said that, Mark, at the same time, doesn't Tim Cook kind of have a fiduciary responsibility to do anything in this environment where if you get negative attention from the White House, it can be problematic for your company and certainly for your share price. So does it also kind of make sense to play nice in this environment? And probably CEOs do it to different degrees with all presidents.
You have to thread the needle if you're Tim Cook, right? On the Trump administration, Donald Trump is obviously very divisive, right? I think that is the most obvious thing that anyone has said on your radio show in a year. Tim Cook has to do what he can do from a fiduciary standpoint to make sure that they're paying less tariffs, to make sure Apple is safe as a business. But there's also the element of employees who are not pro-Trump and customers who are not pro-Trump, and the legions of people who find it, I would say, gross or disgusting that Tim Cook is as close to Donald Trump as he appears to be publicly. I think that I know, and I think that a lot of people know, that a lot of this is just diplomacy or a game to some extent, trying to make the company as effective as possible, trying to save as much money as possible, and just doing his fiduciary duties as a CEO. But there are a lot of people who don't recognize that. And so this goes well beyond the potential Intel investment, but it's certainly a balancing act that Tim Cook has been having to try to strike for a while now.
Ryan Gould, who was part of the deals team, I know you worked on this story too yesterday, Mark. He was part of the deals team that worked on this story as well. He came on our program and he referenced Tim Cook at the White House just a few months ago and the multi-$100 billion commitment to invest in the U.S. that Tim Cook made there. How does this fit into that number in the hundreds of billions of dollars? I think up to $600 billion at this point. Or how would it? How would it? Not how does it. How would it?
I mean, within that $600 billion that they've earmarked, a lot of those are chip-making companies. And so any investment they would make in Intel would just go into that pool. The most interesting thing about that $600 billion number is that it's an eye-watering number because it is eye-watering, right? a lot of it is reality, and some of it are probably things like stock buybacks and dividends and what have you to people in the U.S. and buying back shares in a U.S.-based company, right? So it's not like they're writing $600 billion worth of checks to different chip makers and investments and such. So it is pretty interesting, and I think it goes back to what Carol said about this being CEO and presidential diplomacy. And Apple did some of this with prior administrations. There were similar announcements related to American manufacturing and American innovation with President Biden. Steve Jobs was close to some extent with President Obama. They overlapped in their 10 years there. So certainly this is not abnormal. I just think this is getting more attention because of the divisiveness to some folks about the Trump administration.
So I know your focus is on Apple, but from an Intel perspective, does this money, and shares of Intel this year have absolutely surged up 64.5%. A lot of that has to do with the investment that the U.S. government made, or the ownership of the U.S. government, of course, the NVIDIA investment too, the news there. But I'm wondering if this changes fundamentally Intel at all, and if Apple were to make this investment, if this would help Intel take on some of its rivals and actually move into the AI era.
It's funny. In some cases, an Apple store, you go to an Apple store in a mall or in a particular city, and they get really big tax breaks in some cases to put their store in that mall. They get discounts for putting their store in the mall because the mall sees it as a driver to bring people into the mall and get them to shop at the particular store, right? And so my point being that a partnership with Apple could make Intel look really strong and good and as an innovator, and potentially get them customers, right, from other companies as well. And so the Apple brand is so strong that it could have a positive, layering effect for Intel. And I think that is the play there in addition to the funding.
All right, I have a silly question for you, but here we go. Is it possible Intel could have called up Apple, Mark, and they're like, yeah, we don't want to talk to you? I mean, would they do that? Or is there kind of a Silicon Valley, hey, yeah, we are all always talking to each other?
They're always talking to each other. I mean, they show that they have an enemy-like relationship with Meta, maybe with Google on one hand and Amazon, but all these CEOs and all these executives of all these tech companies are interlinked socially, business-wise. Their spouses know each other. Their kids go to the same schools with each other. They're all linked together, right? There's no getting away from that. So like on the surface, they may show these bad relationships, but there's no declining a call from another CEO at another company. They all know each other. They all text.
All right. Okay. That makes sense. Hey, listen, so on that, I'm just thinking about the H-1B visas and what President Trump has talked about in regards to this, and we've been talking a lot about the impact on the tech sector. I am curious what you are hearing. What's Apple's exposure on this?
Yeah, this is terrible. Honestly, this is terrible. It's not like, so let me take a step back here. The reality is that other countries are producing great talent, countries like India. And I think it's a good thing for America to have the best talent, no matter where they come from. And I think Apple agrees with that specifically. And, the other thing to note is that the Indian community at Apple, from what I've heard, is up in arms about this. There are a lot of people on H-1Bs, a lot of people trying to get green cards. Apple spends a lot of money to help that make that happen. And the engineering talent coming from places like India is just, supreme. There are many executives at Apple. The COO is from India. The COO's deputy, his eventual successor, is from India. Some of their top software engineering executives are from India. So they have a lot of talent from outside the U.S. And Apple is only Apple to some extent because of the talent they have been able to bring in from across the globe. So for Apple, this is a terrible thing. I would say for American innovation, right? American innovation is not only made by Americans, it's made by people who chose to move to America from other countries for a better opportunity and to have an impact. So I don't think this is a good thing at all for Apple, Amazon, Google, Meta, or any of the tech companies, or quite frankly, the country.
And we do have a story in the Bloomberg. I just want to point out that a bipartisan Senate duo is pressing Amazon, Microsoft, other companies on their use of H-1B visas to hire foreign workers with specialized skills. So all of that going on in the background.
Hey, we're speaking with Mark Gurman. He's Bloomberg News managing editor for Global Consumer Tech. He joins us from Los Angeles. Mark, more on the H-1B story. You know, we saw so many tech CEOs just a couple of weeks ago at the White House at that dinner. I was surprised to see a decision such as this from the president, given that it would affect the companies that these individuals run so negatively. Why don't you think we've heard a collective message from the tech community on the H-1B visa issue yet?
Oh, I mean, Tim, you know the answer to that. It's because they're scared of Donald Trump and they don't want to push back on this H-1B visa issue, only for Trump to hit back at them with tariffs or starting to charge Apple more tariffs than they're already paying today, right? I think they are worried if they fight on this issue, they'll come back and be hit harder on other issues, maybe issues that they consider more fundamental to their lobbying efforts. You're not going to see Apple push back publicly against this H-1B issue. They would have done so already. Instead, they're going to work with lobbyists and other groups behind the scenes to have them do their bidding for them, but you're not going to see them push back publicly. That's not going to happen.
All right, we're going to leave it there. Hey, I'm so glad, we are so glad, Mark, that you could lay that out for us, both on the H-1B visas, but also Apple and an Intel possible link up. Mark Gurman, he's Bloomberg News managing editor for Global Consumer Technology. We're going to stay on the tech world because we did have some headlines involving TikTok.
Yeah, Oracle, Silver Lake, and MGX will be the main investors in TikTok. This according to CNBC's David Faber. He reported this on air. He cited people familiar with the matter. Oracle, Silver Lake, and MGX will have a combined 45% ownership of TikTok. That's according to Faber. Looking at shares of Oracle right now, Carol, down about 5.8%.
All right, we're talking TikTok. We just talked about a possible Intel, Apple kind of tie up there with our Mark Gurman. We want to stay again on really the tech world and even that tie up or possible tie up. We've got the head of a company that's one of the world's biggest sellers of the chips at the heart of mobile phones, including Apple, which is its second biggest customer, at least according to Bloomberg data. Great to have with us Cristiano Amon. He is CEO and president of Qualcomm. He joins us from the Snapdragon Summit in Maui, Hawaii, along with our BTech co-host, Ed Ludlow, which you can find on BTV every day at 11 a.m. Wall Street time. Ed out there in our San Francisco bureau. Gentlemen, great to have you both here on Bloomberg Business Week Daily. Cristiano, I want to start with you. I got to ask you, Apple is, according to our data, your second biggest customer. What would a possible Apple-Intel tie-up mean to you guys?
Look, there's no relationship, and actually it has been widely reported for years now that over the next few years, I think Apple will stop, getting chips from Qualcomm, and the company has really moved on not only what we're doing within the Android ecosystem, but we're now in PCs, in automotive, in industrial, in robots. We're even into the data center. So Qualcomm, it's a different company right now. We continue to execute on this strategy, and there's really no relationship.
But in terms of a tie-up, do you think that's even something likely, that there is some deeper relationship between those two companies?
The way I think about it, and like I don't know details, but I can only see two possible angles. One possible angle is Intel continue to invest to become a foundry. In that case, as we are a fabless company, we welcome more foundries. Today, we manufacture our chips with TSMC, with Samsung, and if Intel has the capability to become a competitive foundry in America, we're very happy, and we will look at them as a manufacturer. As far as from a product standpoint, I can't really see a connection because Apple have their own processors.
And we want to get on to other stuff. One more question, though. How are you feeling about the government investing in Intel? I don't know, would it be fair for other companies, even a Qualcomm, to say, wait, what about us?
Look, my understanding of this is there there is an overarching strategic topic, which is manufacturing of semiconductors. And I think we know, and it's been widely reported, that Intel had a struggle to compete with companies like TSMC and Samsung. So anything that is driven towards enhancing the industry manufacturing capability, especially in the United States or even other places, so we have a more geographically diversified manufacturing, that's actually good news. We're looking at the big picture.
Cristiano, like the thing definitively that's changed is the landscape in both PC and mobile. But I really want to start on the PC bit. I look at what's come out of Maui, generation to generation from a year ago. And what's really clear is you want to push even deeper into Windows-based PC. Could you just explain like how the generational updates on the tech help you do that and why it's important?
Yes, and I wish you all here with us. This is actually not that place.
We wish we were there also.
Yes, this has been day 3 of a lot of announcements, a lot of chip announcements. And one thing that we're actually very proud, I think, as I said, earlier to Carol, I think the company is diversifying. We're building products for many different industries, and PCs is one of the growth vectors of the company. So we announced our 2nd generation PC. We just entered this market, and in our 2nd generation, I think people are seeing one of the biggest leaps in performance from generation to generation. We have 40% improvement in the CPU, 80% improvement in the GPU, and we actually have the very first processor in a thin and light laptop running at 5 gigahertz of clock frequency. But the real news is the amount of AI performance. I think the transition of phones and PCs to AI is happening, and those chips are designed to do.
Cristiano, I don't want to make statements because, like, I'm the journalist, and as you know, I love to ask you questions, but I go very deep on what's happening. And so, like, there's an acceptance that this is edge technology that's deployed in the real world. But I kind of want to hold you to how it's going. In February, you basically said that in really specific category, Windows PC priced $800 and above, I think you said you had 10% market share in that. And I'm looking at the specifics of what came out of Maui in the last 3 days. Do you have an update on the ownership you have in that market, or what this latest gen of chipsets will do to push you deeper into it?
Yes, this is a great question. We are, as we're new in this market, and it has been, it's actually, we can leverage a lot of technology. It's actually accretive, I think, to Qualcomm. And we're tracking to what we said. We actually only launched this, you see PCs with our chips in the United States in the top 5 European markets, and we're tracking about 9% right now. I think our projection was by 2029 to get to about 12%, very reasonable. But what is exciting right now, and that's, I think, in your question, is the edge AI transition is happening. Actually, the foundational models now are being designed so they have cloud and edge working side by side. And that is actually creating an opportunity for us to accelerate. And it is reflected in a number of designs. We actually, a while ago, just a couple quarters ago, we talked about having 100 designs across all the major PC OEMs, HP, Dell, Lenovo, Acer, ASUS, Samsung. Now that number is significantly higher, and we're seeing the excitement.
To Carol's question, and I think it's fair, like the NVIDIA-Intel product collaboration puts this emphasis back on x86 against ARM-based chips. How are you tracking the penetration of both in the market? If you're going to react to that NVIDIA and Intel deal and how it changes the market, you must also be tracking it in that context, how you are pushing into that territory.
Yes, when you actually, and I'm gonna quote you when you just said, when you actually dig deeper on it, and it was interesting actually when that announcement happened. It was interesting. We were slightly up. It was kind of neutral to positive to Qualcomm, and we saw, I think, the market stock reaction on ARM, on AMD, and then Intel was up. And the way we actually look at this, we're incredibly excited because what it basically means is, I think it's Intel is sending a message that their integrated GPU and their AI products are, they're not going to, likely not to continue with that because that's what the market is saying. It's going to be NVIDIA. So then as NVIDIA comes in to the integrated GPU market, combining their GPU with Intel x86, it started to bring AI into the PC market, and that is the moment we've been waiting for. And I think that's what we do. And I think the Qualcomm DNA is anything that is battery power, is high performance, low battery life, and a lot of AI. That's where we want the market to be.
So Cristiano, sell us on this moment, because I think a lot of people's experience with AI so far has been LLMs, and LLMs that you can use on your phone, LLMs that you can use in a browser. So if that's the way they are experiencing AI, why will they think that they need to buy a computer that is specialized for AI?
Okay, so this is a little different, and I wish I have time to walk you through all the details. Maybe that's an invitation for you all to come here, I think, next year.
We'll be there.
Okay, we're done. We'll come.
Yes, but here's, I'll give you some very simple data points. The first thing is we used to learn how to interact. We had to learn how to interact with your phone, interact with PC. But now with AI, whether it's what we say, what we write, what we see, the computer knows how to interact with us. So the user interface is changing, and the user interface actually runs where the human is. It runs on your phone. It runs on your PC. So we're starting to see right now, and you see Microsoft doing that with the agents. You see that Google doing that with the agents. That now the computer has this agent ready to interact with you as your assistant as you do things. That's the first thing that is happening. The second thing that is happening is there is incredible amount of processing power that is available. And as companies starting to see AI getting scale, because now it's about not just creating AI in the data center, I need to deploy it, I need to make money. They realize that you can leverage all of this computer. It's transparent to you. It's the wrong thing to talk about AI is cloud or is edge. It doesn't work like that. Just think, for example, if you're Office 365 customer, you have cloud and you have a client. And AI is going to be deployed like that. And companies are saying, if I bring this to the edge, my cost goes down, my latency improves, and I have privacy. And that's what we demonstrated. Many ISVs starting to deploy AI on PCs and in phones.
All right, going to leave it there. Glad we could get that time with you and really cover a lot of ground. Cristiano, thank you so much. Enjoy Maui. We certainly wish we were there. It's a pretty great day here in New York City. Cristiano Amon, he is CEO and president of Qualcomm from the Snapdragon Summit in Hawaii, along with BTech co-host Ed Ludlow in San Francisco. Check him out every day with Caroline Hyde there on Bloomberg Television at 11 a.m. Wall Street time. And be sure to check out Ed's reporting out on this story.
Hey, we are just a little over 90 minutes from the close of U.S. equity trading. Stocks, well, in the red, but off their worst levels of the session. Charlie Pellet watching this closely. Let's get a business flash with him. Hey, Charlie.
Thank you very much. Tim Stenovic sums it up nicely. After the bell, of course, going to be hearing from Costco, just talking with the folks from Qualcomm. Qualcomm shares down now by 2.4%. The Dow, the S&P, NASDAQ, all in the red right now. Tech's being hit especially hard. S&P down 43 now. It's 65.95, down 0.6%. And trading below the big round number of 6,600. We've got the Dow down 208 right now, drop there of 0.4%, while the NASDAQ Composite Index down 0.7. NASDAQ 100 Index also down 0.7%, and our Mag 7 Index, so that's a lot of tech stocks tumbling today with the Mag 7 down by 1.2%. Your 10-year now at 4.17%, the 2-year 3.66%, gold up 0.3%, 37.47 the ounce, and West Texas Intermediate crude flat on the day, $65 a barrel. CarMax lower after the company reported a surprise drop in comparable sales as buyers had rushed to buy vehicles in the previous quarter ahead of a tariff on imported cars. We've got CarMax shares today. They are trading lower. CarMax down now by 19.2%, plunging there. Also Carvana, it is up 0.3% after earlier losses, and the Penske Automotive Group down by 1.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, buy now, pay later is everywhere, every day, as it feels like. You've got companies like Affirm, Afterpay, and Klarna. They've all brought installment payments into everyday life, while big banks and tech firms are also now racing, Tim, into the space.
We talked about the growth and growing competition recently with the founder and CEO of Affirm, Max Levchin. He joined us just a couple of weeks ago. Shares of Affirm, by the way, they're on a tear, up 30% year to date. The company provides a window into the consumer and health of our financial system. So when we were given the opportunity to talk with another key member of the C-suite, we certainly jumped on that. We got Rob O'Hare with us. He's CFO of Affirm. He was featured in a recent edition of the Bloomberg CFO Briefing newsletter. He joins us from San Francisco. By the way, sign up for that newsletter, bloomberg.com/CFO-briefing. Also with us is Nina Trentman. She is Bloomberg News Senior Editor. She writes the Bloomberg CFO Briefing newsletter. She's here in the studio. Rob, that's exactly where I want to start with you. How the consumer is doing. It's a question we posed to Max a few weeks ago, but you guys have real-time data. You're seeing at every moment how people not just are spending money, but how they are with paying it back. How's the consumer in the U.S. doing?
Well, first of all, thanks for having me. In terms of the consumer data that we see a consumer that's strong and healthy. You know, we're originating, over $100 million of loans every day, and right now, all of the repayment data that we see in our daily loan cohorts, it's all really strong, and it's exactly in line with our expectations. So that tells us that the consumer is healthy, and that tells us that we're setting the right underwriting posture in our business.
Rob, how about delinquencies in the business? Are those ticking up? What are you seeing there in the data?
No, I mean, we manage credit. That really is job one internally for us, and we stare at delinquency data. That's part of the repayment data that I was alluding to, and we're seeing outcomes that are exactly in line with what we would expect.
Just wondering, with the Fed cutting interest rates last week and indicating that there might be more cuts to come, how important do you think that is for your consumers, and also how important is it for your business?
It may be helpful for consumers, right? It may reduce the consumer's total costs of credit, which I think is beneficial for them. For us, though, we actually like the rate environment that we're in today. We're very profitable as a business. When we look at loans on a unit level, we're sort of at or above our long-term ranges. So we feel good about this rate environment. If rates were to go down from here, it might be a modest benefit for us. Not all of our funding that we utilize is floating rate in nature, so there could be a lag effect to see any sort of real material benefit. But I think one of the great things about Affirm is that we can be adaptable and we can excel in any macro environment.
One thing we want to ask you about is that Bloomberg Intelligence, our own research team, Rob, has put out a report this morning, and they're projecting that Affirm will surpass 30% growth this year, to ahead of consensus. So just talk to us, if you will, about some of the drivers here when it comes to volume drivers.
Sure. I think it's important to remember that our outlook for fiscal 26, we have a June fiscal year, we've established a minimum GMV for the year. So we don't have a range out there. There's no high end to that estimate. So certainly we put out a minimum number for GMV, and we would hope to achieve that, just given that it is what we think a floor for the business. Closer to home, for Q1, we're guiding that we see about 37% growth in the GMV line in the September quarter, and that would be down from the 43% that we had in the June quarter. So both metrics, I think, are quite healthy and quite strong, and we really like what we're seeing in the business today.
Hey, very briefly, can you just tell us a little bit about the Affirm card? 10% of your users are on the card. Tell us exactly how it works and the profitability on the cards portfolio. Is it better than conventional buy now, pay later?
Our card is slightly better profitability than our business at large. That really stems from the fact that the Affirm card is a repeat usage product. Most of our consumers come to us through one of our merchant integrations and then look to deepen the relationship with Affirm through some of our direct-to-consumer products like Affirm Card. So there's a lot to like about Affirm Card, both for us but for consumers too. It puts all of the utility, all of the financing and flexibility that we offer through Affirm. It puts it on a card, and it allows consumers to transact in places that today Affirm doesn't have quite the level of coverage that we have on e-commerce. So we see a lot of usage for Affirm Card in store, in brick and mortar situations. And you can also utilize Affirm Card quickly and easily at merchants where they don't have an Affirm integration yet.
Yeah, Rob, we're unfortunately running out of time. Maybe just 30 seconds just about the growth in your space. We've seen Klarna recently go public. Like, and how far is that potentially boosting even attention to the space?
We think it's good for investors to have multiple providers in the space so that they can compare and contrast across us and Klarna. I would say our space has been competitive for several years now. We really haven't seen a change in competitive intensity. So, we're focused on driving our objectives, and right now the business looks incredibly strong from our perspective.
All right, gonna leave it there. Rob, thank you so much. Rob O'Hare, Chief Financial Officer of Affirm, featured in a recent Bloomberg CFO briefing newsletter. A new one, by the way, out on Sunday. Find it at bloomberg.com/CFO briefing. And of course, always our thanks to Nina Trentman. She's Bloomberg News Senior Editor. When we come back, AI in data science and global health philanthropy. One view when we come back on Bloomberg Business Week Daily.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ, they're all in the red, with the S&P down now at 6,600 even, lower by 37 points there. Drop there of just about 0.5%, back above 6,600 barely, but indicative of moving off session lows. We got the Dow down 176, now down 0.4%. NASDAQ, the composite index, down 129 for NASDAQ, a drop of 0.6%. Our Mag 7 index down 1%. Today we are seeing tech stocks selling off. The 10-year 4.17% with the 2-year 3.66%. Gold is up 0.6%, 37.57 the ounce. West Texas Intermediate crude up 0.2%, 65.13 a barrel on WTI. And Bitcoin right now at 109,607 on Bitcoin. It is down by 3.5%. Xiaomi's billionaire co-founder has unveiled a $630 smartphone that's designed to take on the just-released iPhone 17, underscoring the Chinese company's broader ambitions to take on American rivals from Apple to Tesla. The Xiaomi 17 will be offered in Pro and Pro Max models. ADRs of Xiaomi, they're up now by 4.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. It is time now for the Bloomberg Business Week Women's Health segment, where we focus on key issues and developing technologies impacting the present and future of women's health around the world. And I got to say, the world of women's health was rocked a little bit this past week.
Yeah, President Trump created a potentially existential crisis for Kenvue, the maker of Tylenol, with just 3 words about the company's most recognized product. He said, "Don't take it." The Trump administration is linking Tylenol's active ingredient acetaminophen to autism and urging pregnant women, Carol, to largely avoid the medication, although decades of scientific research have yet to identify a single cause for autism.
All right, let's get more, though, into the bigger, broader picture of women's health. Dr. Joan LaRoviere is with us, Interim Chief Medical Officer at Boston Children's Hospital, Director of Innovation and Outcomes. She's also co-founder and president of the NGO Virtue Foundation, which is delivering healthcare in over 25 countries. So she has a big global perspective here. She joins us here in studio. Dr. LaRoviere, so nice to have you here with us. How are you?
I'm great, Carol. Thank you so much for having me today.
There's a lot we want to talk to. You're in town with everything that's going on. We're looking at global health with global leaders. I do need to ask you, though, about what we got from the administration this week, the Trump administration, the president on pregnant women taking Tylenol. I'm just curious what it's been like, and I know you've been in New York, but what you've been hearing from your team back at Boston Children's when it comes to this news and what they're hearing from patients and what the guidance is that you're giving them.
Absolutely, Carol. Well, firstly, at Boston Children's, we don't take care of pregnant women. It's a children's hospital, but this obviously encompasses women and children. And I myself don't take care of autism patients. I'm a pediatric cardiac intensive care specialist. But I am hearing from my clinical colleagues that they are getting calls from families, and creating confusion around this is really a challenge. And we're really sort of taking that head on in terms of addressing the questions of families as they're coming to us.
One thing that we've noticed about this moment in time is, and we spoke to a doctor from the American College of Obstetricians and Gynecologists earlier this week, and there's this tension between what we're hearing from professional organizations as far as recommendations go and what we're hearing from the American government and the HHS. And it doesn't seem like that's happened in the past, where you don't necessarily have the government aligned with these professional organizations. I'm just wondering how you're thinking about this moment when it comes to healthcare.
It's a challenging time for healthcare, and I think we just stick to our mission that we are trying to provide the best, safest, most effective care to children that we can.
I am also curious, like we said, you're in town, and we've had the benefit of talking to global leaders about some of the big issues that are out there, whether it's climate change. We've talked a lot about AI this week, but looking at healthcare from a global perspective, I want to bring you into this because you're very involved when it comes to the applications of AI in medicine. Talk to us about kind of where we are today with it and kind of where it can go.
Absolutely. I think we're at one of the most exciting times in healthcare, and I've been involved with AI with Virtue Foundation for 15 years. And never has it been like this moment in time, because I think that the tools that are now unlocked, particularly now with Gen AI, cloud computing, big data, we're seeing use cases that are much more actionable than before, and at an enterprise scale.
What does that mean? Break it down.
Well, I can break it down in the context of what we've done with Virtue
please.
Foundation. I'm happy to talk about some of the hospital use cases too. But in terms of Virtue Foundation, 15 years ago, Dr. Ebi Alahi, my colleague, was in Burundi. And he was there caring for patients and had this eureka moment where he's like, we should have more granular data on the ground to understand what my eyes see. And I should be able to see it here in New York to be able to action on it. And at that time, people are like, what are you talking about, right? It was very early days. And we started that journey of trying to first get the granular data, visualize it geospatially. But I think we've grown up as the technology has grown up. And I think key leverage points for us have been partnerships with Databricks, DataRobot, Carto, and I can break down one now if it's helpful. Yeah.
Well, and talk to us about data, because, especially when it comes to the developing world, if you have data and information, you can assess a situation, then figure out what to do.
Yes.
So talk to us a little bit about that. You do have partnerships with Databricks, as you said, DataRobot, Carto. What are you guys building together?
We are building the marketplace for global health philanthropy.
What does that mean?
So you can actually see what is happening in healthcare facilities and what is the work of healthcare NGOs on the ground in low and middle income countries. And we've used AI. In particular, we've built an enterprise-grade pipeline with Databricks, where we're extracting all the data that exists and co-locating it to a geospatial location. So you're a hospital, Korlebu Hospital in Ghana. Everything that's out there, information-wise, is co-located geospatially to that organization. And you create this vector graph, this knowledge graph, with all these mini knowledge graphs that tell you what's happening in each of those facilities.
At the end of the day, this is all about improving outcomes, and it's helping people live longer, healthier, happier lives. Do we have the data yet that shows that this moment in technology is leading to better outcomes?
I think that's what we're on the cusp of. Would I say that we're there and it's all, completely functional and moving? No. But that is the direction of travel, and those are the tools that are enabling us to do so. For now, I can see this data in ways I couldn't see before. I can send the right teams to the right locations.
Well, what are the better outcomes that you envision? I mean, are we talking about longer life expectancy in the developing and the developed world? Are we talking about lower infant mortality? Like, what are we talking about here?
I think we're talking about all of it. I think eventually economic development will solve some of our problems. But in that window in time, how can we shorten the time it takes till we get really more developed healthcare in these markets? And we feel that this VF Match platform, this actionable data initiative, will allow you to be able to use this information, whether you're a healthcare NGO, whether you're a government in a country, whether you're even a corporation, to determine what you can build to accelerate progress. And we personally are using it to send medical and surgical teams to locations where the medical deserts are, the large populations of patients who need that ophthalmologist or that neurosurgeon or that gynecologist. And so that the people who are doing it, like myself, there are many in global health who are doing this work, know the place they can go to be most useful to the patient and most useful in passing on skill.
And just 10 seconds, so it wasn't so easy to do that before.
No.
And it was probably not unless somebody brought your attention to it.
Yes.
Or you got wind of it, but that's not the most productive way of doing it.
Exactly. This is to create efficiency and scale.
All right, got to leave it there. Dr. Lou Rivera, thank you so much.
Thank you.
Really appreciate it. Interim Chief Medical Officer at Boston Children's Hospital, Director of Innovation and Outcomes, and as we said, co-founder and president of the Virtue Foundation.
Hey, take a look at markets off the worst levels of the day, but still red across the screen. The NASDAQ down 0.6%. The S&P 500 down 0.5 percentage point. The Dow down 0.4%.
All right, when we come back, we'll get a check on some of the specific stocks on the move on this Thursday. Don't go anywhere. This is Bloomberg Business Week Daily.